The contractors' body says workers are also suffering with only minimal payments being made to them to keep them afloat. They claim they have written 6 letters to the Chief Minister and Deputy Chief Ministers but received no response. Last week, the association held protest in Thane. They now plan to send one final letter to the state leadership before approaching the court to recover their dues. The association, which has been active for 25 years, represents 3 lakh contractors across 35 districts in Maharashtra. Each contractor reportedly employs 200 to 300 workers.
Banks, I think, as they evolve,
Welcome back. Let's just quickly revisit Asian screens and figure out what the sense is for our opening here. Asian screens are mixed, absolutely all over the place. Like I've been saying, Singapore is actually doing very well. But then you have Hong Kong, which is sulking a little bit. Taiwan's down. Mainland China is all right. For us, the implied open is suggesting that at least the start should be positive, and we have very strong momentum, coming on the back of the last couple of trading sessions. So 32 points higher as far as the implied open is concerned. I think we now have Nimesh with us, who, of course, got us the details of this this big deal. Nimesh, are you there?
Yeah.
Oh, well, congratulations on calling the deal right, and it's happened, and it's a big one in the wealth management space, isn't it?
Well, absolutely, Surabhi. So, as news stand, UBS, the global wealth management company, has finally agreed to take 4.95% stake in 361. So, 361 is going to issue 2.05 crores equity warrants to UBS, which will be converted over the next 18 months. The issue is at 1,030, which means an 8% premium to yesterday's closing price. So that's one deal, that UBS is buying 4.95% stake in 361. Additionally, 361 through its subsidiary companies is buying out some of the UBS's India businesses for a consideration of 307 crores. It's a slump sale. So for 307 crores, 361 is buying out a few of the India businesses, which includes the stockbroking business and the PMS business of UBS. So two-layer transaction. One, UBS is buying 4.9% stake in 361 via warrants, and additionally there is a small buyout of the India business as well by 361.
All right, Nimesh, rock on. What can I say? Congratulations once again.
Thank
you. Well,
you.
let's talk about banks now, which is the other big story, right? More liquidity coming the banking system's way. Abhishek is standing by to explain this and put this in context. Abhishek, morning.
Morning, Prashant. So not only banks, even NBFCs will be on radar with respect to liquidity flow happening to them from the banking sector as well. So RBI has announced a revised liquidity coverage ratio framework, which will be applicable from 1st of April 2026. So additional runoff rates will be at 2.5% to internet and mobile banking enabled retail and small business customer deposits. Earlier, this was drafted at about 5% rate. Now, funding from non-financial entities such as trust, educational, charitable or religious partnerships as well as LLPs shall attract a lower runoff rate of about 40% from the earlier 100%. So this biggest change is sharp reduction in the runoff factors for wholesale deposits, which augurs well for banking sector. We have a note from Macquarie which states that the impact from these relaxation is that RBI expects a 600 basis point improvement in LCR ratios for the banking system from Q3 FY25 levels. So they believe that this is encouraging and will provide support to the credit cycle. So back of the envelope calculation does indicate a rupees 2.5 to rupees 3 lakh crore increase in liquidity, which may become deployable or more advances being given by the banking sector. So this would imply a 140 to 160 basis point potential increase in credit offtake or credit growth rate for the banking system as well. Back to you.
Okay, all right, Abhishek, thanks a lot for that. And we'll have Pranav of Bernstein, who will join us in a short while from now to discuss these developments and also give us his call on the sector. Well, I'm looking at the steel makers, on more or less on expected lines. We have the government that's imposed 12% safeguard duty on all imports of flat steel. Remember, this had come out. It was a recommendation by the DGTR a month or so ago. And on expected lines, now the green signal has come in from the Finance Ministry as well. The safeguard duty of around 12% will be effective for around 200 days, and that period starts yesterday itself. So going with green for all these names, though, some part of this news would already be in the price. In fact, in the run-up to the announcement coming in from the DGTR, we had the stocks that had run up. We had pricing as well that went up on steel products. But over the last 1 month or so, you haven't seen much movement out there. Morgan Stanley, they say that this move is positive. It removes any kind of uncertainty. However, they're saying if the stocks react positively, they're suggesting to trim positions in some of these steel names. Nonetheless, going with green on all of them. And we'll have Amit Dixit as well, who will be joining in later on the show at around 9 a.m. He'll discuss this in further detail.
Okay, all right. So we'll discuss that development on the safeguard duty with Amit in a bit. Let's get to Ria now. She's watching out for a bunch of stocks, including Anantraj, Pitti Engineering, Mahindra Logistics, and I think even Himadri Speciality. Ria, big list there. Tell us more.
Well, yes, good morning. Let's first take a look at how Pitti Engineering has performed in Q4 of FY25. Now, the net profit has seen a decline of around 22% over the previous year. But if you take a look at the revenue and the EBITDA, those have increased by around 40% and 55% over the previous year in Q4. For FY25, they've also achieved their highest ever consolidated annual revenue, EBITDA and net profit. If you look at the sales volume, that has increased by over 50% on a year-on-year basis in Q4 of FY25, and the sales of the key segment, which is the loose laminations and low value-added assembly segment, are also up around 26.5% over the previous year. Moving on to Mahindra Logistics, the net loss this time around has narrowed to 7.8 crores versus a loss of 12.9 crores that we saw in Q4 of last year. The revenue has seen an increase of around 8% over the previous year, which was driven by robust performance in the 3PL contract logistics segment, new service offerings and strategic account additions as well. They've also appointed Hemant Sikka, who was the president of the farm equipment business, to the CEO of Mahindra Logistics. Now, Motilal Oswal has said that the operational performance this time around for Mahindra Logistics has largely been in line with their estimates. The order intake remains strong and the volumes have also picked up in the B2B express business, but the express business still continues to struggle due to pricing pressure and client churn as well. Lastly, for Himadri Specialty, the net profit is up around 35% over the previous year in Q4 of FY25, but the revenue has seen a decline of around 3.5% on a year-on-year basis. The margins, though, have seen quite a healthy expansion, coming in at 20.6% versus 15.3% that we saw in Q4 of last year. If you look at the sales volumes, those have increased by around 16% on a year-on-year basis in FY25, but for Q4, the sales volumes have declined by 4% over the previous year. The company has also said that operations at Birla Tyres are going to commence in June of 2025, and they've also approved the acquisition of 100% stake in Elixir Carbo Private Limited for rupees 7.5 crores, and we're expecting all three of these stocks to open in the green today.
All right, thank you very much for that. Well, more stocks with news flow. Vivek is here with details. Vivek, morning.
Well, good morning. Some interesting news flow overnight, especially when it comes to the U.S. market for the solar energy space. So now the U.S. has gone ahead and imposed duty on Southeast Asian imports from 4 countries. This is on both solar cells as well as panels, which are the countries that are targeted: Malaysia, Cambodia, Thailand and Vietnam. The U.S. believes that a majority of these countries gets their imports, or at least the raw material, from China, which is why they've gone ahead and imposed quite strict duties. So tariffs will apply on global solar panel manufacturers, both like China's Jinko Solar, one of the world's largest solar manufacturers, as well as Trina Solar. So now, what's the next step? International Trade Commission of the USA will go ahead and vote in June for tariffs to be finalized. Tariffs, the quantum of tariffs vary both depending on the country as well as the company. Tariffs have got as low as 6% to as high as 3,400%. Now, when it comes to Waaree as well as Premier, remember both of these companies do export to the US market, so they will now benefit from a much fairer or playground when it comes to the actual prices. Along with that, Waaree, approximately 20% of revenues in the 9 months gone by, actually they did exports to the US market. So sentiment positive for sure. It'll be important to see what is the final outcome of the tariff revision that comes in. Vedanta, an important development coming in. Remember, there were worries about the company's ability, or the parent company's ability, that is VRL Vedanta Resources, to go ahead and service their debt obligations. Yesterday, one of the promoter entities that held close to 40% stake in the company, known as Twin Star Holdings, has entered into a facility agreement with a whole host of lenders, including Barclays Bank as well as First Abu Dhabi Bank. This particular facility arrangement is for servicing financial indebtedness of the VRL Group, total amount of $530 million. So an overhang has been lifted. However, there has been an encumbrance that has been created over the shares of Vedanta Limited for this particular facility agreement. And lastly, keep an eye out on HG Infra as well. Company has received a battery energy storage system order from Gujarat Urja Vikas Limited. This particular order is for a 300 megawatt, 600 megawatt standalone battery energy storage system in the state of Gujarat.
Okay, all right, got it. Vivek, thank you very much for that. So let's quickly recap our list of stocks to watch. The ones that have positive news flow around them are 361 Wealth Management, banking stocks because of the reprieve on LCR norms, steel makers thanks to the safeguard duty, PT Engineering, Mahindra Logistics, Himadri Speciality, Wari Energies, Premier Energies, Vedanta and HG Infra. There are actually no stocks on the back of any negative news flow today, so it's an all green list. Okay, we do have to take a quick break right now. On the other side, we'll connect with Amnish Agrawal of PL Capital and discuss some fundamental stock ideas.
Part will be to the retail sector, because they are as of now best equipped, unless they are disrupted by a fintech. The corporates, large part of the corporate universe today, are cash positive. The cash flows are positive and can meet most of their growth needs. At the margin, they may have to borrow. Large part of infrastructure funding will come through a market process, which is outside the banking system. It's already happening. Banking money is really short-term saving deposits and some fixed deposits. And the average tenure of a bank deposit, banking system is about a year and a half. Yeah. And you expect to fund the infrastructure over 7 years or a corporate loan over 5 years. You are...
Welcome back. You're tuned in to Bazaar Morning Call. Well, to help us out with some more fundamental analysis, we have Amnish Agrawal, Director Institutional Research at PL Capital. Hi, Amnish. Thanks a lot for joining in. Well, I wanted your view on these consumption/FMCG stocks. I'm looking at a UBS note. They have gone ahead. They've upgraded a couple of stocks, namely Colgate as well as Britannia. They believe there are enough tailwinds for the space from year on, be it on the consumption, be it on earnings growth, as well as it's a place you could hide given the global uncertainty. Would you agree? And what are your top picks?
Okay. Hi, Nigel. You see, as far as your consumption space is concerned, definitely, I think there is some sort of a stability which is coming in. I won't say that there is too much of a momentum right now. Most of the companies in Q4, they are not likely to show any marked improvement on what the situation was in 3Q. But in the backdrop of a normal monsoon, some expected benefits to come to the middle class from the tax cuts, and the inflation cooling down, there is a strong probability that the growth rates, particularly on the volume side, they will start reviving over the next few months. Now, if you look at, say, most of the companies in the sector, I think they are all running at the peak margins, except maybe you can say cases like Britannia or ITC, or some of the, you can say, palm oil users, which earlier were reeling under very high raw material prices in the, you can say, last 2-3 quarters. So I think incrementally, is there money on the table to be made in the sector? The answer is yes. Will the stocks give you very electrifying returns? The answer is no. But at the same time, I think if you purchase them at the right time, I think many of the stocks have the potential to give you 10 to 15% kind of the returns over the next 6 to 8 months. Particularly if you look at, say, global backdrop, I think the Indian markets today are rallying because there was a big sell-off which was happening from the last 4 to 5 months. Now, if I look at on the other side of it, whatever is happening on the global macro front, I think there is likely to be some impact on the growth rate in many of these developed countries in particular. So to that extent, I think the sector looks good. And I think if the leading stocks can give you 10 to 15% returns over the next, say, 6 to 9 months. I think that doesn't look bad at all. Now, as far as our recommendations are concerned, Britannia is one stock which we are pitching right from 4,600. So Britannia is one. The second stock which we are pitching currently is ITC. And the third one, which is not exactly in the staple space, is Titan Industries.
Okay, so those are some of the picks on the consumer side. Got it. Amnish, hi, good to have you on. Well, the deal of the morning is in the wealth management space, and it's really booming, isn't it? And UBS is, I guess, money is now walking that talk. They're showing commitment, buying almost close to 5% equity in 361, and you know, there's a sort of cross synergies benefits as well. What's your sense? Because a lot of these stocks, the listed brokers and wealth management outfits, I mean, the stocks have already had a huge run, and many have recovered very well from the fall as well. Would you be a buyer of anything here?
You see, we don't have any hang on the numbers for these wealth management companies, but in the last few years, these companies have gained tremendously because markets were having a very good run. And there were large number of family offices or even you can see the HNI investors who were actually going to these wealth management firms and buying their products, whether these were, you can say, AIFs, whether these were their PMS and all those stuff. So I think that momentum still continues. The last few months have not been that great, with the impact of which could be visible in the next 1 or 2 quarters. But the way the Indian, you can say, upper middle class is growing today, they want more customized solutions and all. I think this space in the longer term still looks interesting. But nonetheless, I won't be in a position to recommend any particular stock or a name here.
You know, to tell you, sometimes anecdotes and stories work well to describe how well a space is doing, right, or how badly a space is doing. I'll tell you, this is a true story. I can't name the person, but this, you know, veteran banker set up a new shop, his own shop, well-funded, etc. He wanted to hire an executive assistant, and he looked around, interviewed lots of candidates. Most of them were from the wealth management sort of space. They wanted to move, right?
Okay.
But he couldn't afford any. He wanted an executive assistant. And the problem?
Yeah.
ESOPs. And the stocks have done phenomenally well.
Absolutely.
And then finally, he swore off. He said, well, I can't...
Can't afford the wealth managers.
I can't do it.
They're the
Because,
ones who become wealthier.
Yeah, and that's the point. Not just the top guys, but you know, some of these, especially the Indian shops.
Yeah.
You know, the cities and the UBSs, etc. of the world have been in India for a long time.
Yeah.
And actually, they were the only guys.
Yeah.
But now the Indian guys have really, you know,
stolen
have been
a march.
trailblazers, and they've run phenomenally well. And I think at 9:30 we have that discussion. So we'll ask them, you know, whether it's as good as it looks like. It is, of course, as compared to a mutual fund business, a much more sticky business. You get the customer, and the customer kind of sticks with you for a much longer. That's well established. That's a discussion we'll be having at 9:30. But I mean, you know, valuations and how to value these companies, all of that in focus with Feroz and Ashish at 9:30. Amnish, let's talk about BFSI, banking, financial services. What's your sense? Stocks. These norms, liquidity norms, right? The Bank Nifty is up 12% in the last 7 trading sessions. You think a lot of the good news is in the price already?
See, Prashant, we have to look at it in a different way. That if you look at the rally of last few years, banking was, I think, the biggest sector, biggest underperformer. It actually went nowhere. And liquidity was tight, interest rates were high. Now, although all these measures are not going to result in any significant change in their P&L or balance sheet in the near term, I think things are turning better for the banking stocks. And the second thing is banking has got the maximum weight in the Nifty, and whenever the FI buying happens, so banking is also an indicator of that. When FIs sell or they want to exit, then the banking is in the heat. And when they buy, then the banking actually gains. Now, at the current situation, when the interest rates are softening, India is now, I think, relatively better placed than many of the other large economies globally where the markets have done well. The banking, I think, looks reasonably good because the valuations today are not that bloated. They are even now at a discount to where they used to trade 2-3 years back. Yes, the easy 10 to 12% is now, you can say, off the table. But at the same time, if you are looking at, say, next 12 to 15 months kind of a view, I think still many of the leading stocks, they can give you maybe, say, returns in line with earnings or maybe slightly greater than earnings, because the next year the earnings are not going to be anything great. But given the fact that now the sector has got into the momentum, the liquidity is improving and the valuations are not that expensive. And if you look at on a relative basis across sectors, I think banking seems to be reasonably well placed even from now on. But yes, given the run up in the stock price in the last say month or so, one should be cautious and one should be now looking at more like your top names only.
Okay. All right. Let's actually stay with the banking space and wrap our heads around what exactly was announced with respect to these LCR guidelines yesterday. And it is a big relief for banks. The RBI has eased the liquidity coverage ratio norms, giving banks more flexibility in managing their funds. And the implementation of these new norms has also been now pushed. I mean, some are fearing that it could happen from this year itself, but it's happening from the 1st of April, 2026. Pranav Gundapalli, Senior Analyst, India Financials at Bernstein, is with us to make sense of this development and, of course, overall this big run that we're seeing in financial stocks. Pranav, great to have you on. First and foremost, what is your estimate? The fact that these runoff factors, these runoff rates are a lot lower on wholesale deposits as well as these mobile and internet retail deposits, a lot lower than what was earlier being proposed. To what extent does it help?
See, I think RBI had themselves given that it will lead to a 6% increase in the LCR for the sector. So overall, I think the answer is clear. That's a positive development. The changes there are three key changes. I think the first is a reduction in the runoff factors for wholesale deposit. I think this is the biggest positive, and this will benefit banks which have a more granular wholesale deposits, right? So I'm talking about the deposits from trusts, partnerships, HUFs. I think some of the large private sector banks and some of the larger public sector banks have a greater share of these deposits, so they might stand to benefit a bit more. The other two changes are net negative. One is an increase in the runoff factor for retail deposits. It's lower than what was expected, 2.5% runoff versus 5%, but still a negative for banks with high share of retail deposits. So someone like a federal bank, for example, will see a greater impact from this particular change compared to the others. The third is a reduction in the HQLA numbers because of a haircut. But put all of these three together, I think it's still a net positive for most of the banks. And this is in addition to a series of steps that RBI seems to have taken to ensure that growth is revived, or at least there's no further slippage in growth across the sector and the broader economy.
Pranav, that's on LCR, and I mean that I think was the only one regulatory overhang or the small niggle, and that's also very clearly been done away with now. But overall, if you're looking at the results also that are coming in, it's absolutely fabulous blue skies, right? You can't complain. There's decent growth. Margins have not fallen as much. Asset quality seems stable. Growth in many cases, even deposit growth is beating very subdued estimates. I mean, I'm talking about the recent numbers, HDFC Bank, ICICI Bank, etc. So how are you placed on large banks, and how much of this optimism, how much of this, these good numbers are already in the price?
Not a lot. Okay, we are bullish on the overall large private sector banks pack. Right, I think they are well set up and with average valuation, maybe even below average valuations, but clearly above average profitability and growth. So the setup is good for the large private sector banks, and we're bullish on that whole pack. Now, the numbers wise, I think while profitability has been great, I think growth has seen a significant slip from the peaks we saw about 12 to 18 months ago, which is what I think the RBI is trying to fix with all of these measures. So if all these measures result in a pickup in growth, so I'm talking about the private sector banks as a whole, getting back to 16-18% year-on-year growth, I think that will lead to a reasonable re-rating for these stocks. Because today they trade at a significant discount to their long-term multiples, simply because the growth is not as stellar as it used to be, or relative to their public sector peers, the gap is a lot narrower now versus where it was in the last decade.
Pranav, hi, good morning. Prashant here. I think not dark horse, you liked IndusInd Bank, Pranav, right?
Yes.
The last time we spoke. Yeah. Yes. It's up 20% in four sessions now. 15 last week and 4-5% yesterday. Best performing, bank. Of course, here the issues were much deeper, and there's the broader tailwind, but also I guess valuations got very attractive, as you pointed out. So good to kind of sort of spot that. What now on IndusInd in terms of valuations, etc., and also give us a sense of valuations overall.
Okay. See, I think let's talk about IndusInd first. I think IndusInd right now is, I think the valuation as well as the stock performance will probably be determined by what happens at the management level. I think from a numbers perspective, with the MFI issues largely done for the sector and set for a recovery maybe in the first or second quarter of this year, I think from an operating metrics perspective, the concerns are much less. I think the big catalyst for the stock remains the management change. They have a deadline, 1-year deadline for the existing management, and the change has to be recommended to RBI a lot earlier. So getting a credible private sector candidate and more importantly, RBI approving that candidate, I think will be the big catalyst and big reassurance for investors. I think that's the big catalyst to watch out for. And what makes it still attractive from a risk-reward perspective is the cheap valuation. I think for the numbers that IndusInd has generated in the past or can generate going forward, the valuations are cheap because of this overhang on the management. With that getting settled, we should see a reasonable up move on the stock. On the valuations for the overall sector, we think despite the run-up in the last few weeks, the valuations for the sector is still in line with the long-term average, with the private sector banks still trading at below average valuation multiples. So as a pack, if you take the top 4 banks, I think on a price-to-book basis, they're still lower than the long-term average. So a reasonable upside remains, apart from the healthy compounding that they can deliver. So still quite attractive from the large 4 private sector banks perspective.
Okay, so large 4 private sector banks still looking good. And since we have you with us, what about NBFCs? I think, Bajaj Finance, SBI Card, these are some of the stocks that you have on your radar. What's the story here?
I think NBFCs have seen a nice rally in the year so far, thanks to increasing or expectations for rate cuts increasing, or the quantum of rate cuts are increasing. I think that's led to the nice rally, plus the reduction of concerns on asset quality. I think those 2 factors helped drive the nice rally. And then you also had some growth stimulus in the form of tax cuts, which is expected to drive growth back up for some of these names. Now, our concern on the NBFC stocks is more on the valuation. We think most of the good news is priced in. And if we were to assume even sharper rate cuts to justify the valuation, our concern is that those rate cuts will come only if the growth is getting softer, right? So it's unlikely that you will see a return back to 30-40% growth levels, and RBI continues to cut rates at an aggressive pace. Both might not happen together. So if only one of the 2 happens, then maybe the valuations seem a bit of a stretch at this point.
Okay, all right. Pranav, appreciate you joining us. Interesting thoughts there. Thank you very much for the perspective. You have a good day. That's the view coming in on financials from Bernstein. They still like a lot of the large banking names, saying there's still some value left on the table. Take a quick break on that note. Come back on the other side. And of course, we continue our conversation with Abneesh, and also have our technical experts joining in with today's trading setup.
Okay, welcome back. 8 minutes to go for the pre-open session to kick off. Oh boy, look at, I think I missed that. Is it a new line? Gold at $3,400. I saw 3380-ish or so. And we are thinking about 3,400 now. I mean, this is absolutely stunner.
It's 34.84, Prashant. I mean, when we started the show, it was 34.60 already.
I think
and now it's 34.84.
I'm skipping hundreds here with the way it is moving.
I think we'll do a lakh, right? Yesterday we didn't do a lakh in the Indian market. It was almost there, 99,248.
Making charges
It has hit 1 lakh.
Yeah, but just the price of the metal, X of duty, X of making charges, I think even the price of the metal gets set for 1 lakh rupees on gold, I think, in the Indian market today.
It tells you the story, right? I mean, it's all US assets are down, and gold is going up. I mean, the story is right there in terms of what's happening and the faith people are. And by the way, it's not jewelry sales. It's not you and I who's, the two big demand drivers for gold historically used to be Chinese retail buyers and Indian retail buyers. But it's not retail buying, which is propping up. I mean, actually, there are reports which suggest that jewelry sales are actually down sharply here in India because the price is so high. So this is investment demand, reserve buying, that kind of thing. So, and that kind of talks directly to what's happening with the US and the sort of shake-up that we've seen with regards to confidence in US systems and policies with this tango with the Fed and tariffs and whatnot. So I think that's an important point to make, but just incredible the move that we've had in gold.
Like
really.
Chetan Sheth of Nomura just said, right? The US is behaving like an emerging market. The way their equities, their bonds, their currency is behaving, it's like it's becoming a volatile emerging market.
Absolutely, absolutely. And the premium for the US always was about stability, rule of law, and all of those things. So getting appended maybe a little bit at the margin. Sudarshan and Mitesh are with us with what they'd want you to do with regards to trades. Gentlemen, good morning. Great to have both of you here. Mitesh, you go first. How's it looking? 12% for the Nifty bank, 7 days, Nifty up 10%. More here or large part of the gains are behind now?
Morning, Prashant. I think definitely we will make higher highs. Now the question is, because of the run-up as you were highlighting 10-12% in the last few days, there's always a risk of a pullback happening on an intraday or maybe a 1 or 2 day kind of basis. The idea is that trade with long bias, if there are dips around to your positions. For the Nifty, I think anything closer to about 24,000 now, which is also the 200-day average area, which is where the put concentration is, which is where the support pivot on the 2-hour chart is. I think that's the area to buy into. And on the upside, I have been maintaining 24,200 as the target for last 2 days. I think we could hit that. And the next target is 24,500 to about 550 zone. So there's a high probability that we'll head towards those levels. So maintain a long bias. As I said, I think tactically you just have to look at the half-hourly chart and see if there will be a pullback which will allow you a good entry. But otherwise, the bias is on the upside.
Okay, all right. Got it, Mitesh. So maintaining your long bias out there and looking at buying into dips. Sudarshan, what about you?
Yeah, good morning. Well, all is well. We have been trying to be on the long side for many days now, and the market has obliged us. And this is not the end. At least the market is not giving us any signal that the uptrend is coming to an end. There's no sense in my making a call. We just follow what the momentum says. Be long, and if you find intraday dips today also, or small consolidations during the day, that's a time when you can enter on the long side of the market. See, there are 2 events coming up. That's for the Indian markets. Day after tomorrow, we have the NSE monthly settlement. And next Wednesday, we have the next week's settlement. And settlements nowadays can create crazy movements. So since the trap is laid for the shorts, it's the long side which should win these settlements also. Be long. Otherwise, also, it's a good idea. And for the Indian markets, it's a perfect place to be.
Okay, all right. Let's talk about stock-specific action then. What are your calls, Sudarshan, for the day?
Well, it's mainly buying. Aarti Industries is a buy with a stop under 412. CDSL is a buy with a stop under 1285. NHPC is a buying opportunity with a stop under 87. And Tata Power is a buy with a stop under 385.
Got it. Okay, all right. Mitesh, what about you?
So I have an all buy call list as well. Bajaj Auto and the two-wheeler SPAC had a good reversal yesterday with Hero and Bajaj both participating. So Bajaj Auto is a buy with a stop below 81.90. Look for targets of 8,400. Excite is a buy with a stop at 378. Targets of 396 can be looked at here. I picked up a cash stock after a long time. That's Suzlon. Buy with a stop below 58 for targets of 66. And Adani Transmission and Gas ATGN. That's a buy with a stop at 608 for targets of 660.
Okay, all right, gentlemen. Thanks a lot for giving us your picks as well as your call on the indices. For the time being, we'll slip into a short break. You come back, we'll get you pre-opened rates. We'll also have Amit Dixit, analyst at ICICI Securities. He'll analyze the government's official announcement that the 12% safeguard duty is now already at play. Stay with us. We'll get some analysis going. Welcome back. This is Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, we have Amnish Agarwal, who's still with us. Amnish, what are you making of these solar plays? There was a lot of excitement, say, 12 months or so ago. Vare, Premier Energies as well, when they listed, there was plenty of demand. From the top, the stocks came off, but quietly, these stocks actually have been recovering. All right. Okay. All right. We'll try to get Amnish back. The stock that we wanted to ask him about is some of these solar modules and cell manufacturers, which includes Premier as well as Vare. Remember, these stocks actually have seen a sharp pullback, but in the last few trading sessions, they have seen, they've cut their losses actually, and both those two stocks. In fact, on Premier, there was very, very high volumes out there. Mitesh, if you could give us a technical check on these stocks, Vare Energies as well as Premier Energies. Both the stocks, they listed with a lot of fanfare, then they cooled off from the top. But from the recent close, actually, they've gone up a little bit. The news point this morning is the US is putting higher duties on some of our peers, which provides a bit of an opportunity for these solar module and cell players. How are they looking on the charts, either of the two?
So, Nigel, I'm tracking only Premier Energies. The stock, has, as you rightly said, reversed very nicely from the lows about a couple of weeks back. And the first target was around 1,030.40. We are right there. We might actually hit that early in the morning. But the short to medium term trend is definitely looking on the upside. So I will have a revised target of 1130 to about 1140 on Premier Energies. Traders can even, buy with a gap up in case the stock sustains about 1,040. Then yesterday's high become your stop loss. And look for 1130.40 as the first target. We might, again revise it eventually. But for the timing, we start with that kind of a target.
Got that. By the way, Mitesh, do you track technically gold as a commodity?
Unfortunately, not. I think, purely because it's never for trading purposes, always buy and hold. So
you have the chart. You have the chart with you? Can you put it up?
Not right now, I'm sorry.
Okay, not right now. Let me. I'm coming back to you, Mitesh. Let me just quickly read out. There's a tweet coming in from Mr. Uday Kotak on gold, and we were talking about gold right now. So this is what it is coming through. What he's saying essentially, he's saying that the performance of gold over time highlights that the Indian housewife is the smartest fund manager in the world. Governments, central banks, economists who support pump priming, high deficit funding may need to take a leaf from India, a net importer, a store of value forever. So that is, gold and golden words from Mr. Uday Kotak there coming through. So absolutely, I mean, and I think silver started to do well as well. Some have been highlighting the gold-silver ratio historically, and I mean some gaps emerging. So maybe gold, this very sharp up move in gold allows silver to come up a little bit as well. So we'll see. But almost 3,500. I mean, I think the gains have come in faster than anyone thought. By the way, I said this yesterday as well. This is the best start to gold prices in any year since the 1970s. I mean, that is how far back you have to go to see YTD gains. I mean, we are only in April right now, but Jan to April gains are the start is best since the 1970s. So just incredible coming through at this point in time. Let's just come back to equities for a bit as well. That 12% provisional safeguard duty on 5 key categories of steel has come through. Remember, we spoke with the steel secretary recently as well. Nigel, tell us more. Largely in line with expectations?
Well, that's right. It's more or less in line, and it was almost anticipated by everyone that it will come into play. To help us out with what you should do with the stocks from here on, we're joined by Amit Dixit, analyst at ICICI Securities. Hi, Amit. Good morning. Good to see you in. I was reading a couple of notes from Morgan Stanley. They said it's a welcome move. It's a positive move. It was on anticipated lines. But they're also suggesting if you get a bit of a pullback now, maybe you should consider lightening positions on the steel names. What is your call on these steel stocks, and what's your topic?
Yeah. Hi, Nigel. Good morning, and thanks for having me on the show. Well, as far as the duty is concerned, the quantum doesn't come as a surprise. To be honest, it is well in the expected lines. Now, if you look at how the steel prices have behaved, how imports have behaved, they have actually behaved according to the textbook. Steel prices have gone up, imports have come off, largely because people were apprehensive of booking imports because the safeguard duty was almost certainly to go through. So I would say that the current announcement is more of a procedural in nature. Nothing changes on ground, to be honest. Now, what it does is that currently the steel prices that we see, if you look at the quarter-on-quarter difference, it would be, I'm talking about the headline HRC prices. The difference quarter-on-quarter would be approximately 4,000 to 4,500 rupees a ton. And that means a big EBITDA gains for the flat steel players like JSW Steel, Tata Steel. So clearly, it's beneficial for them from an earnings perspective. But going ahead, yes, currently the prices in India are at a level which is higher, even if you assume the safeguard duty in the global prices. So just to give you a perspective, we are actually 7% ahead of the landed price of imports from China, around 12% ahead compared to the landed price of imports from South Korea. Now, these are slightly worrying signs, I would say. So while nobody wants imports in the country, and therefore there could be a case where prices might pull back a bit. But having said that, Q1 is nicely set for the steel companies. Because, as I said, there is a gain on realization front as well as coking coal, and don't forget that there could be a benefit of roughly $10 odd to the steel companies' EBITDA. So clearly, from earnings perspective, a good positive. From a stock perspective, I would say that we will have to wait and watch, see how the import scenario pans up, because we are again entering in a zone where domestic prices are at a premium to the imported steel.
Right. Okay. All right. Domestic prices are at a premium. Got it. Amit, in the run-up to the DGTR announcement, steel prices had moved up. Post the announcement, actually, that's a month or so ago, pricing hasn't moved much, right? And Chinese steel prices continue to remain under pressure. Your observation?
Yes, so that's what I said, that, what happened that when the
these announcements were initially being contemplated, yes, the safeguard duty of 12% was a powerful deterrent. But now, even assuming or even subsuming the safeguard duty in the prices, we are running at a premium. So clearly that doesn't bode very well for imports. So imports might just start increasing, so which is in nobody's interest. So that's why I said that there could be a case where prices could pull back a bit.
But you have been fairly positive on a couple of names, from the steel space. I think Shah Metallics is something that you like. And I think one of the the Jindal companies is what you like. So could you tell us what is your top pick and are you holding on to that rating?
Yeah, so we are holding on to that rating. As I said, that from earnings perspective, it's quite positive because prices, as I said, 4,000 to 4,500 rupees a ton positive movement. Our top pick in the space is JSW Steel, followed by Tata Steel. In the smaller names, of course, we like Shyam Metallics. So our target prices remain the same and the ratings remain the same. We are quite positive overall on the space.
Okay, all right. What about the non-ferrous names? Do you like anything over there? Because, Hindalco saw a big pullback. Valuations have become fairly good now. You also have Vedanta. There's a special situation playing out there. And it's been a very, very volatile stock. It corrected from 480 all the way to around 350. And now it's bounced back a good 20% from the recent lows.
Yeah, so non-ferrous is also, something that we like at this price point. In fact, we like both Vedanta and Hindalco. The issue though with non-ferrous is, as I have been saying, that this is connected with the global movement, global tariff movement. It's not a very local play. So we essentially like the local plays where the consumption growth in India would drive these stocks. Now here prices are governed on a global fashion. Only your premiums change, which are local in nature, but otherwise prices are mostly, governed by what LME is. So that's why, relatively speaking, we are not, if you talk about relative preference, it's like ferrous versus non-ferrous clearly. But non-ferrous is also at a price point where one might consider Vedanta, as you rightly said, it at a very attractive valuation, even Hindalco. But Hindalco's story, we believe that, it will gradually build up when they come up with the expansions and everything. In case of Vedanta, it's a more of an immediate, I would say, impact because of various cost efficiency measures that are going to flow in. Having said that, both the stocks look good. Just that from a relative perspective, we are more positive on ferrous.
All right, Amit, we'll leave it there. Good conversation and good perspective on metals and the steel space in particular. I think the pre-open has settling, and we're up about 0.25%, by the way, on the Nifty. So about 60 points, 24,000, near 24,185 for now. Now, the big story globally, and the reason why U.S. assets all sold off, of course, is President Trump essentially targeting Federal Reserve Chairman Jerome Powell, once again asking him for preemptive rate cuts, and of course, calling him a major loser and whatnot. Our sister network, CNBC, caught up with Evercore ISI's Vice Chairman Krishna Guha. And this is his view. He says this is bad news. If Trump tries to fire Powell or undermine him, markets will sell off. Listen in.
It is clearly in the conceivable set. It's something that we have to take seriously, as a risk, and I think a serious risk to markets. I think we're already seeing, like right here and now, in the equity futures, in the dollar, in the bond yields, we're seeing a clear signal from the market that it doesn't like even the idea that the president might try to remove the Fed chair. There's been some loss of confidence in U.S. economic policy making in recent weeks. We've seen that in this very odd combination of upward pressure at times on longer-term bond yields combined with a weaker dollar. That suggests global investors pulling capital out of the U.S.
And that's been the story of April 2025. Capital coming out of the U.S. 3-year lows on the dollar, gold moving to historic highs. Okay, let's go back to our technical experts for some final ideas. Nifty is about 60 points higher in the pre-open as of now. Sudarshan, what's your 9-10 call?
Well, it's NHPC, buy NHPC with a stop under 87.
Okay, and Mitesh, what about you?
I can choose Suzlon as a buy call for targets of 66.
Suzlon. Okay, got that. By the way, in the pre-open, IndusInd Bank is down 4.5%. Little unusual. We'll try and see if there's anything additional, because otherwise the LCR norms overall are very positive for banks. Those have wholesale deposits as well as those who have large internet and mobile banking based retail deposits. So let's see, 4.6% lower in the pre-open. Vinny is joining in. She's watching out for Shelly Engineering. Vinny, why is that?
Good morning. So before I come to why are we seeing an impact coming in on Shelly Engineering, I just want to take the comments that have come in from Eli Lilly in terms of the announcement that came in for the phase 3 trial of their oral GLP-1 drug. That's spoken about this to CNBC-TV18 previously when the management has joined us. Now this drug, when you talk about it, this is orforglipron drug, which has seen a very good efficacy result. The pill has accomplished its goal by reducing diabetes maker A1C and causing weight loss as well. The weight loss that they've seen coming in 40 weeks is almost 8% of the body weight is furthermore seen a reduction. So that is a very positive sign that has come in for the drug. Now, why are we seeing an impact coming in on Shelly Engineering? Shelly Engineering is a company that manufactures device for GLP-1 drugs. So they mainly make the pen that is used for GLP-1 drugs, which is for insulin side. Now, the healthcare segment accounted to around 19% of the revenue for Shelly Engineering in 9-month FY25. Now, if you see more oral drugs coming in, especially for GLP-1, then the use of pens reduce. And that is why we could see an impact coming in. The management was very bullish on this segment as well. They wanted to expand capacity. 125 crore expansion is what they spoke about. Investment for expanding pens from 40 million, what they're producing right now, to around 100 million in the next couple of years. So that is a big impact that one could see coming in if oral drugs in GLP-1 actually start picking up.
Vinny, thank you very much for that. And we'll try and touch base with the management as well. As Vinny said, stock was on 10 yesterday. It's up a little bit right now, coming up. Well, let's talk about banks and revisit this space, because the LCR norms have come through and they are better for the banking space in terms of liquidity, etc. Abhishek, over to you.
Well, Prashant, RBI has announced a revised liquidity coverage ratio wherein they have mentioned that the additional runoff rate will be 2.5% instead of 5% to internet and mobile-based retail and small business customer deposits. The funding from non-financial entities like educational, charitable and religious trust, a partnership, etc. will now have a lower runoff rate of 40% versus 100% envisaged earlier. So this is the biggest change in sharp reduction in runoff factors, which augurs well for wholesale deposit-based banks like SDFC Bank, Axis Bank and some of the NBFCs as well, like Shriram Finance, etc. Back to you.
Okay, all right. Got that, Abhishek. Thanks very much. So, of course, banks on our radar. They've been leading the charge higher. This morning, however, the gainers are from the metal space. Thanks to that safeguard duty finally coming through. JSW Steel, Tata Steel, probably in leadership position as we kick off. That's just 6 seconds to go now. Waiting for the countdown. Absolutely, and it's a 0.25% basically on the trot after all we've seen over the last 2 weeks or so. So what do we have? First rates, 24,170 on the Nifty, 55,428 on the 55,300 plus on the Bank Nifty as well. Just settling with that, small up essentially was what you have. 12 and 10% in the Nifty Bank and the Nifty respectively in the last 7 days. So be mindful of that. News is positive, but many times markets are, of course, collectively much smarter and ahead. What do we have in terms of mid-cap index? About 1/3% higher in the Nifty mid-cap index, 54,166. The small-cap index will come up on your screen. And I think there as well, you've got gains which are there, about 0.6%. Yesterday, by the way, both the mid and small-cap indices were up 2.5% each. So it's a good-looking screen to begin the day, especially given the 2.5% sell-offs on the US indices. Interesting. Today, this fall on IndusInd and no specific take on it just yet. Of course, we're trying to find out. Pranav Gundapalli of Bernstein was just actually saying that that's one of his preferred picks from a risk-reward perspective. Valuations are more supportive. Stocks down 5%. That we are seeing as of now on the screen. Okay, what else? The lower side of the screen has Infosys, 2% lower. HCL Tech ahead of numbers, about 2% lower. TCS, so a lot of the bravado of IT stocks is coming off. There's some selling in Hero MotoCorp as well. Bajaj Auto, so the two-wheeler stocks are also fairly cautious this morning. IndusInd is now down 5.5%. Our teams will get you more on this in just a bit. The positive side of the market is metals and some other of banking names. Tata Steel, JSW Steel about 1.5-2% higher. Coal India is also charging ahead. Hindalco as well. The overall metal space, not just steel, is looking good. HDFC Bank is continuing its good form and some more buying on Trent and Eternal, some of the consumer names. But otherwise, now we have some red, 20 down almost on the Nifty.
Well, that's right. Keep an eye out on RBL Bank. Massive large trade is seen out there. 2.5 crore shares, I think, changed hands. That's close to around 4% odd. Nimesh is giving us some more details. It appears it's a clean out trade from CDC. So that's important. And we'll try to get you some further clarity with regard to the buyers. But clutch of FIs and DIs, that's what Nimesh is giving us in terms of a feedback. They appear to be on the buy end. And the good news is that there's a clean out trade from CDC, which could have been a bit of an overhang on the stock, comes up for you on the screen. Other couple of names that are doing well in this morning's trade. Keep an eye on Himadri Chemicals. They came out with a set of numbers. Numbers look quite good. So that stock is up and about. Mahindra Logistics, that's the other name that came out with the set of numbers. That as well, quite good. So both those two stocks have opened with sharp gains in today's trading session. You have the metal-related names that are doing well. Tisco is higher. The Nifty has moved into the red, though, as we speak. And you have the Nifty Bank as well. That's flattened out a little bit. The good news is that you have more number of stocks that are advancing in comparison to the number of stocks that are declining. So you'll take some heart from that. IndusInd Bank now down closer around 6%. Anant Raj, though, that's firing away. Large volumes. Anant Raj up 4.5%. Prashant.
Well, it is a mixed kind of a start. I mean, we've had boom markets for the last 7 days now, and this is a much quieter looking screen, as we explained in the morning, expected because of essentially the price performance that we've had very quickly. So, is there anything new? I mean, I think we mentioned bulk of what's moving right now. Raymond, I'm not sure if we mentioned, is up 5%. It's got large volumes in it. Anantraj, I think, is up 4%. Anantraj, by the way, is the number 2 volume-led gainer right now on the index. And I think we did mention Vari, 4% or so. Apart from that, I mean, volumes are thin and there are not very sort of well-owned names which are coming as far as the gainers list go. I think Nigel mentioned RBL and that trade which has gone through. Hero MotoCorp is down 2%, so 38. Infi, by the way, right? I mean, is coming off about almost 2%. Numbers were disappointing, but I mean, yesterday, it just was like a hurrah, the results are out and we just want to rally. I mean, all stocks went up sharply. Index, of course, is down 25% YTD, but I mean, numbers were still poor. High yesterday was 1471, is about 50 rupees off the highs of yesterday. 5-star is down about 2.25%. Chola Finance is down about 2%. Bajaj Auto is down 2%, and so on and so forth. AU Bank is down about 1% as well. I think AU reports numbers today, so we'll let us see how things are when those come through. I just wanted to
point out, Prashant, this news report, which is out on IndusInd.
Yeah.
It's a newspaper report, source-based, from the Economic Times, talking about possibly another audit, this time on their MFI business, and the discrepancy in question is 600 crores. But again, independently, we are trying to verify this. The bank has again not disclosed anything to the stock exchanges with respect to this, whether this appointment has been made, whether indeed they are looking at another audit, this time in their MFI business. Just wanted to place that on record. Yeah. No public disclosure on this. It's a press report at this point in time. The stock is reacting.
I mean, there's also the 20%, right, which the stock has rallied in the last 1 week. So there are these gains and this news report not helping at the margin. Big volumes, 4 million shares already, with just 4 minutes or so behind us now this morning. Karthik Kumar is with us, fund manager at Axis Mutual Fund. Karthik, good morning. Good to have you with us here. The market's just completely flipped from everything is lost and we're going to be in an uncertain world now for the next 4 years to everything is fixed. And stocks have snapped back like anything, right? I mean, in many cases, 20, 25, 30%. Very, very quickly. That puts us once again in a tricky situation. To begin with, India is the best place to get a deal, but I mean, a bilateral trade deal, I don't know what the quickest it's been done in, but it's certainly not weeks. It's got to be in months. What is your sense, Karthik, as you look at and analyze the market situation for now?
You're absolutely right. So from an house perspective, we believe that the markets will be range bound for a while. See, some of the positive things that we've seen over the last few weeks is lower oil prices, lower commodity prices, US dollar weakening, and incrementally lower selling from FIIs. In fact, they've turned buyers recently. So all those are the drivers. But having said that, those positives are balanced out by the fact that there is still tariff uncertainty. Markets can digest good and bad news, but uncertainty is something that it doesn't like. And this earnings quarter is also likely to be subdued. Putting both those things together, I think while we've seen sharp corrections and a recovery subsequently, I think the market's more likely to be range bound going forward for these reasons.
Okay. Karthik, hi. Good to have you on. Good morning. So what's the sense? The thing is that the pullback rally in India has also been, fairly ferocious and quick, but we're still 6-7% off the peak. So it's not like we've recovered all the losses. 26,000 is still some time away. Do you see this current pullback move continuing to those highs, old highs?
I said it's difficult to put a marker there, but having said that, I think the fact that it's still below its all-time high reflects the fact that we are seeing a subdued earnings seasons. There are still earning cuts for the current and the next financial that we are seeing. In fact, the entire breadth of market has seen sharp earnings cuts over the last 3 months. The breadth of earnings revisions is probably at its peak. I think looking at the data going forward, the degree of revisions should start easing off, and the pace of earnings cuts should kind of slow down. But having said that, it reflects the uncertainties and the fact that we are having a subdued earnings season, and that's why we are probably not there at close to all-time highs. But having said that, it's difficult to put a marker there.
Hi, Karthik. Good morning and good to see you in. Nigel on this side. Karthik, I think the last time we chatted, you were talking about you were quite positive on healthcare, pharma names as well, while you were relatively underweight on the staples, and that has been the trend actually for the last couple of months or so. What's your view on staples, though? A couple of sell-side notes have come in, and they are suggesting that maybe now the bad news is in the price. That could be the pocket to hide, and maybe consumption will improve. So from the consumption basket, do you actually like discretionary and you're underweight on staples? Or do you all believe now that maybe the bad news is in the price, so staples is also a pocket you all could look at?
We still are selectively have better representation in consumer and discretionary space rather than the staples space. Yes, the staples have kind of lagged over the last few months. But having said that, the earnings expectations and the earnings revisions still reflects the fact that the environment is not back to what it should be, and the growth is not yet fully there. So, which is why, for those reasons, we find there are better pockets within the discretionary space rather than the stable space. So we continue to keep our position, which is being selectively overweight discretionary, selective areas of discretionary, whereas continue to remain underweight staples. And while valuation on an absolute basis compared to their own history might have come off a bit, but relative to markets, relative to other sectors, it's still on the higher side.
Okay. Karthik, we were talking about the market recovery. Obviously, two sectors which are global facing, they have recovered the least, and that's IT and metals, right, for obvious reasons. I want to get your take on IT. Yesterday, the stocks were rallying as if, it's blue skies and all troubles are over. Nobody was looking at the really subpar Q4 performance, saying it's already in the price. Today is a slightly more measured day. What's the call you're taking on large cap Indian IT services?
Over the last few days have been volatile, but notwithstanding that, essentially we remain close to neutral to slightly underweight on IT, depending on the funds that you're talking about. Some of the uncertainty with regards to the earnings environment for the tech sector, the uncertainty with regards to tariff and its flow through on IT is also reflected in the fact that the sector and the stocks have underperformed substantially over the last 3 to 4 months. So one could argue that part of it is a good part of it is in the price. And so to that extent, what we may see going forward may not be this level of underperformance that we've experienced recently. So we continue to remain underweight to slight, neutral to slight underweight, depending on the funds that you're talking about. Metals is a different story altogether. We still continue to remain underweight metals, and that's more a take on what is happening globally, and that is also reflected in the earnings expectation environment that we see across.
No, I got it. By the way, Karthik, any large price dislocation still where the market is, sold off stocks aggressively in anticipation that demand commentary, etc., will weaken, whereas maybe in your assessment where that is not the case. So, any large dislocations right now?
From a quantitative perspective, what we saw was initially coming into 2025, given the uncertainty, markets really gave up on growth and momentum, so to say, because there was uncertainty in the environment, and growth numbers were kind of, market turned skeptical on some of the high growth stocks, and that took a severe beating in Jan and Feb. But what we are seeing right now is market being a bit more discriminating between growth stocks and looking at growth stocks where it is actually feasible. So some of the dislocation that we'd seen back in January and February, where market took umbrage under, let's say, low vol and low risk and shunned growth areas, that is kind of somewhat unwinding, where again we are looking at selective areas within growth and markets a bit more constructive depending on where it is positioned within the growth segment, whether it's external, internal, and so on and so forth. So I think we are beginning to see that discrimination, which was not the case before.
Okay. All right, Karthik, thank you very much. We'll leave it on that note. Appreciate you being with us on the show today. Let's just go back to the market and see what trends we're picking up. The index is very flat, but at an individual stock level, there's a lot of action. Look at KFIN. KFIN is up another 4%. Then there are stocks which are reacting really well to some of the earnings announcements. Anantraj would be a case in point, 4% up on Anantraj as well. So it's more about individual stocks today, more measured in the market. Raymond is having an excellent morning, 5.5% higher. Alok Industries, we don't talk about the stock usually. I mean, it's an old story then acquired by RIL. Its losses have reduced. Yesterday it reported numbers as well. So there's a small cap name on the radar as well. So individual stocks are doing their thing. On the large cap screen, I just want to point out that there's some very specific selling in two-wheeler stocks today. Hero Moto, Bajaj, these are down about 1.5% to 2%. Otherwise, index is absolutely flat at this point.
It's come off the lows though. I mean, so there is that interest is that maybe the fact that we've done so well recently, capping gains there. But as promised, we've got that wealth management discussion lined up, right? What's the opportunity here? But before we go to our guests, let me bring in Nimesh once again on the big deal which he flagged off earlier. UBS coming into 361 Wealth Management. Nimesh, take it away.
Hi, Prashant. So it's official now. UBS has bought 4.95% stake in 361. So 361 will issue 2 crore warrants, equity warrants, at a price of 1,030, which is an 8% premium to yesterday's closing price. So that's the deal. UBS is now entering into 361. Additionally, 361 and its associates have agreed to buy out the small businesses of UBS in India for a slump sale of 307 crores. So that's the money 361 is going to pay to UBS for buying out their broking businesses, the PMS businesses. But the big deal is UBS, which is a global giant, is now entering the wealth businesses in India, buying out or acquiring at least 4.95% stake in 361. Prashant, this is going to be interesting because the entire wealth space is going to be in focus in the very near term. We also have Nuvama, where there is a large private equity investor who's looking to sell out its stake. So even that could be a potential deal going forward, wherein the PAG, which is a big PE investor, will look to sell its stake in Nuvama. And I understand even there, some very large PEs and strategic investors are interested in buying out that asset as well. So overall, there is a bit of momentum now back in the Indian wealth space, and that's what with UBS now entering into 361.
Absolutely, momentum and how. And, if any validation was needed, you're getting that foreign name coming in and wanting to participate in the story. Thank you very much for that, Nimesh, and thank you for flagging off that deal even before it happened. So what lies ahead for the Indian wealth management space? Has the best played out? Is it only the beginning, or are we in the middle of the cycle? Well, let's put that question to Feroz Aziz, Joint CEO, Anand Rathi Wealth, and Ashish Shankar, MD and CEO at Motilal Oswal Private Wealth. Gentlemen, good morning. And for me, it's very special to have both of you on at our 9:30 corporate slot because, you know, all of us have been discussing wealth management and money-making ideas, the wealth creation journey for close to a decade, right, on our personal finance shows. But here we are talking about your business because it has hit such headlines. Ashish, if I could open with you, I was looking at the Motilal Oswal stock. You know, in September of 23, the stock was 213 rupees. Today, it's 680 rupees after the correction. That's the kind of wealth that wealth management businesses themselves have made. Where are we in the cycle, Ashish?
So, Sulvi, thanks. I know, when we come on the 9:30 news, we have arrived as an industry. So good observation. Look, I think the wealth management industry is extremely tailwinded because large parts of the markets are yet to be organized. I mean, if I look at the total size of financial savings in the country, and when I look at the assisted wealth management industry, it's broadly about 20%, if you read all the reports. And there are multiple tailwinds due to which you are seeing liquidity flowing in. So whether it is, monetization from IPOs, monetization from stake sales. Similarly, more and more companies are being generous with their employee stock options, which are also eventually being monetized. So it's a very tailwinded industry on two counts. One is the amount of liquidity that is flowing in. And second is also the fact that, a large part of the industry is yet to be organized. And of course, I mean, as a company, I think we have multiple streams of businesses across capital markets. And as you know, the last 4-5 years have been extremely tailwinded for capital markets as an industry.
Yeah, absolutely. Let's bring in Feroz as well. Feroz, so good to speak to you on the 9:30 news, like Ashish is saying, right? Not just let's talk money. But again, the question is, isn't the space also getting very, very crowded? There are foreign banks that are really pushing forward with their private banking businesses. Everybody wants a piece of the pie, which has been dominated by Indian outfits like yourselves. What about margins and profitability metrics from here on?
Also, my voice is a little bad, but I'm going to try. Of course, it's always a pleasure, irrespective of the time, to talk to you. Point one is I think the wealth management industry is going to be dependent on the economy, right? If you want to play the India story, wealth management is definitely one of the pieces you will look at, point one. Point two, like Ashish said, there is going to be tailwind, but there are some challenges in the wealth management industry as well. Attrition is one of the largest challenges. Anybody who's been able to solve it is who will have a gathering mass, because rolling stones gather no mass. So the kind of attrition wealth management industry has been seeing historically, that needs to change. That's point two. Point three, you said everybody wants a share of the pie, but it doesn't happen that way. If you look at 10 years back, I'll read out some numbers. 2014, if you look at the top 10 mutual fund distributors as a proxy of the wealth management industry, you would see 3 MNC players, Citi, Hong Kong, HSBC, and you would also see Deutsche in the list of mutual fund distributors. Today, you don't see any MNCs in the top 10 distribution. Indians are relying on Indian names. That's one clear trend which is emerging. I personally think the regulatory framework and the evolution of the regulatory framework is behind us. So the regulatory risk over the next 10 years is far lower than it was in the rear view mirror. So these are some of the challenges, but I think it's a big, big, big opportunity. If you want to play wealth management industry, which is a part of the Nifty Capital Market Index, that's a more broad-based thing than just a specific wealth management part of the value chain.
Thanks for joining us, Ashish and Feroz, and good starting points both of you make there. Prashant here. Ashish, you said, right? I mean, large parts are still unorganized. Can you give us a sense what percent is, because as there are so many wealth managers, are you saying the opportunity is largely for you guys to take business from the unorganized, so-called unorganized segment, from smaller firms? Is that what the game is now about? Because, a large part of the segment which has the money to be able to sort of, invest and has wealth to be able to manage. I mean, I'm assuming that is well catered to in that sense. So is the opportunity market share gains from here, Ashish?
Yeah, so hi Prashant, good morning. So there are two parts to this story. So one is the total stock of savings of households in India, right? So at a $4 trillion economy, total stock of savings is about $12 trillion. Now, if you look at the split, RBI gives that number regularly. Almost 50% is real estate, and rest of it is spread across gold, financial assets, and certain other holdings like jewelry, etc. Now, two things are happening. One is, like Firoz mentioned, the growth of overall financial assets and savings is dependent on the economic growth, right? Second is, from the stock also, there is more financialization happening. If you look at the number of DMATs which have been opened, if you look at the savings which are flowing through SIPs into equity markets, right? So there is a certain stock which is flowing into financial markets. Second, of the incremental savings pie, because, households still save anywhere between 16 to 18%, of their income, is also flowing more and more into financial assets. Now, if you look at the total stock, and if you look at, and then there is a large bank deposit market, which is not necessarily under assisted wealth management. So roughly, I mean, if you go through reports that have been published on wealth management, about 20% of the industry is with assisted wealth management. So I believe there will be more financializations from incremental monetization that is happening in the economy. And B, you will also see a lot of the existing stock of savings, whether it is in physical real estate, whether it is in bank deposits or traditional forms of savings, flowing into financial assets, and which again is, wealth management again being a big beneficiary. So, the industry will grow faster than the economy, but then certain players who have emerged with a strong platform, very sharp focus on this segment, have the opportunity to grow much faster. I mean, we peg the growth, a good player can grow easily at about 20-25%.
I got that. Firoz, two questions to you. One is, do you have to go down the sort of wealth curve? I mean, the top end is, I guess, where you make a lot of the money. I mean, now I spoke to a player, large conglomerate, which is entering wealth management. And I said, well, what segment are you targeting? He said, well, it's open. We're going to be offering our services to whoever wants it. So that is there. So is that happening? Are you also forced, are you and the established players also forced to do it? Sort of move away from the really top end, right? And second is how the attractiveness for investors in your companies, of course, is the fact that once customers come on board, they're kind of sticky, more sticky at least compared to, say, mutual funds or other products. So just talk about that aspect as well. Go on, Firoz.
Good morning, Prashant. If you look at our strategy, we think that a company can't be everything to everyone. A focused strategy is very, very critical. So for the last 17, 18 years, we have been existing. We've always focused on the HNI, not even the ultra HNI segment. There's very few players who have a cap on the clients whom they go irrespective of size. So we went between HNI, but not the really large ones. So our belief is any business should try and not be catering to everyone. You have to specialize if you have to create a niche. That's point one. Point two, I personally think we will not be forced to do it because by design, most who are mass affluent become HNI over a period of time. If you look at last year's, where we have already given our results, so I can speak of it, we made 9% average return for all our clients in a bad year. So that is implied growth without having to bring one new client on one new check. That is the key. If you have implied growths in a business of 9-10%, which implies that the revenues go up automatically by 9-10%, I have to work for the next 10% of my guidance, not for the full 20-25%. So that's what I think is the key differential in the wealth management industry. So I don't think every player will operate very differently. They will reach different destinations in the 10-year period. Unlike other industries where the fates are joined at the hip, I think here, bottom-up strategy will decide what the fate of that business is, not just the industry. Because in the same India, there is one portfolio last year which delivered minus 32% return. There's another portfolio which generated plus 20% return. The macro environment for everyone is same. The Nifty is same. So what depends on is what's your mathematics to create a portfolio and what value you add to the client, rather than which industry you're going to be in or which segment you're going to be in.
Absolutely. Point taken, Feroz, that investors will get more sophisticated, they will get more discerning, and they'll be willing to go where the returns are. So, gentlemen, as we wind down the conversation, just very quick sort of answers will help from you. I go back to my question on profitability. The opportunity is large, absolutely no denying it. But given the fact that the foreigners are coming back in some shape or form or the other, look at this morning's deal, right? So with UBS and 361 Wealth Management, maybe it's like if you can't beat them, join them, right? That's how it seems to be. So in this context, this business will roughly show how much growth across industry and at what margins, and will it need more capital? Ashish, your thoughts, and then I'll ask the same question to Feroz.
So I think on the growth front, Surbi, I kind of, alluded to Prashant that this industry can easily grow at 20-25%. I mean, not the industry. Industry might grow probably at 14-15%, but there's a big opportunity for players like us to, grow at about 20-25% because of the construct of the industry at the moment and the kind of monetization that we're looking forward to. Second, in terms of competition, should be, I mean, wherever there's a big size of opportunity, you will have players coming in and allocating capital and trying to get a piece of the pie. I think what will matter in the end, like Feroz said, is, what kind of focus you bring into different segments that you're operating in, the kind of platform that you're building in, and the kind of talent you can attract. Because at the end of the day, remember, this is a very people-intensive business, at least at the top end of the curve. As you go towards mass affluent and the lower end, I think tech will play a extremely big role. So depending on the platform that you bring in, the kind of products, the kind of solutions that you can penetrate or offer clients, your profitability metrics can be quite healthy in the longer run. I mean, if you look at yields, I think pure wealth management yields have been between 55 to 60 basis points. I think it's sustainable. And on that, you can add on certain other solutions to enhance the yield so that, clients are also served and, you also grow in a profitable and sustainable manner.
Okay. 50, 60 basis points yields at an average, maybe build in more for customized solutions. Feroz, very quickly, you brought up the point of attrition. And, you see on social media all kinds of takes on how well paid wealth management executives themselves are. I mean, even lower down the ranks in the chain. Would this be, given the multiples the market is willing to give, will we see more deals? Is it a good time to maybe offload some equity in the wealth business, shore up on capital to deal with some of these competition issues?
No, I don't think that way, Surabhi, because an RM moving in for short-term gains is not profitable. We did a study of who left Anand Rathi over the last 10 years and benchmarked them to the people who stayed back. And we realized 90% of them were better off as a benchmark, significantly better off. In the wealth management industry, till the RM understands that if he starts moving, the clients stop moving with him. He gets only one chance in life, or two at best, that a client moves with him. I think that will become more and more prominent. But every time the market does well, you have people who want to outbid another person. So Anand Rathi's strategy has been train them inwards. Okay, so I train 480 people as we speak to make them RMs. So that's how attrition can be. If I buy it from somebody, my army, somebody else can buy it out from me. So that can't be a strategy. Buy and build a business can't be. It has to be built brick by brick. That's one. Your question on capital, I think this is the least capital intensive business. So ROEs can be very high. Unless you have a conglomerate with an NBFC business, then you need capital.
No, more from a value unlocking perspective. I mean, the business doesn't need capital, but a good time to. I was asking from a more of value unlocking perspective, from a promoter perspective.
So I think the promoter should ride the run for the next 20 years. If we believe in India, I don't think a promoter. I shored up for myself more equity in the last quarter as visible on BSE. So I bought in my wife's name a couple of lakh shares. So I would.
Feroz, how much? What should the wealth management business be valued? We've got the example of UBS 361. That's been done at about 1.2% of assets. What should be the? Is that the fair one? Should that be the benchmark?
Prashant, in my belief, assets is the most fluid way of measuring it. Some people even count their demat holdings of a client a tax-free bond. So assets is the most unregulated number ever in a wealth management industry. If it is an asset management company, assets are clearly demarked and you have them in your custody using an RTA. So in asset management, I think it's a backward calculation of what was the yield. So I personally think this UBS deal is a bigger message saying that a foreign player will need an Indian partner. Now, Karan sir has been running this wealth management business for the last 18 years. He understands the pulse of India. So MNC is clearly giving a message that you can't go standalone. Several people have tried this. Again, there will be bouts of people wanting to try it. And if you go the full last 25 years to understand India and India's psyche, you can't sit in a foreign country because India is going to be a second decimal number. When 2008 happened, I used to work for RBS. And when crisis happens, wealth management outfits, foreigners pull out during the worst time for the client because that's when the client needs us the most. But the promoter is selling stake in 2008. That's what happened to me. That's why I chose not to work for an MNC. So that's a great message from UBS by doing the things that we did.
I think Karan Bhagat has done a fantastic job. You've done a fantastic job. And I think that last point is absolutely true. It's true for broking as well. Foreign brokers have left India when markets have been down and out for a couple of years. And I think it's generally the rise of Indian entities in the capital market space by all accounts. Feroz and Ashish, thank you very much for joining us. Good speaking with you. And we'll continue this discussion in times to come because this is an industry which is growing and growing very, very well. Well, RBI earlier this week released stricter draft rules on gold loans under which it proposed 75% loan-to-value ratio along with tighter valuation, purity norms and audits. My colleague Ritu caught up with VP Nandakumar, Managing Director and CEO at Manappuram Finance to talk about this and more. Listen in.
The RBI has issued draft circular which contains around more than 70 points, 70 items. So many of these have been already implemented by NBFCs because in our earlier interactions also, and inspection also, they wanted some of these to be implemented, which has been implemented. We had several rounds of discussion. So with this, we have implemented a major portion of that. So first of all, we welcome that because if you take the history, the regulations when these are actually taken up, these are proposed or implemented, initially people, the regulated entities used to feel some element of pressure. But later what we have seen is these all have been very beneficial to the regulated entities. For example, this 20,000 rupees all in a check only without no cash payment. They were all we have implemented, and that has made the business really safe. To the question of these new guidelines, we welcome that, and some of the things there are some element of challenges while implementing initially, but that is going to turn out to be good for the industry. And we believe that these are going to be, these regulations will be applicable to all the regulated entities, including banks, so that definitely there is level playing field. And for risk management, especially in an era of rising prices, this will turn definitely positive for the industry.
Well, Mr. Nandakumar, you said there may be some initial challenges. What are these challenges that you anticipate? And also, when RBI now says that 75 LTV is to be computed on the total repayable amount at maturity versus what you sanction at origination, and this has to be done on an ongoing basis, will you have to reduce your LTV to meet RBI's norms, or what is typically your LTV at the time of dispersal?
If these are implemented across the industry, banks and non-banks, that is what is available. So there is definitely a level playing field. All the entities will have to comply with that. Then it is not going to impact the business.
Okay, you spoke about how the rules are being harmonized between banks and NBFCs, but over the years, NBFCs have really differentiated themselves from banks, because of the quick turnaround. But with this kind of harmonization, more rigorous appraisal processes, end-use checks that you'll have to put in place, do you see this for the industry eroding some of the edge that the NBFCs enjoyed, at least in the short term, and could it weigh on growth while the businesses adjust?
So what I feel is it is not going to impact the growth, a reasonable growth of the industry is possible with that, with risk management to be, the lending will be safe and the confidence for the stakeholders will definitely increase. So there are some processes. That processes will have to be followed. That process will be followed by all the entities. It will be made uniform. So from the business angle, I don't think it is going to impact the business, but from the customer side angle, when these were not there in the past, so far it is not there. So when these questions are asked, there will be some process difference, and the turnaround time also may slightly go up.
Quickly, Mr. Nandakumar, also on the priority sector guidelines that recently came out, RBI's decision to exclude gold loans that are originated by NBFCs and then acquired by banks from being classified as PSL, will this to some extent end up increasing the cost of funds for lenders like you? Could it dent profitability as a result?
These guidelines concerning PSL, that may be neutral as far as NBFCs are concerned.
Quick word on Ashirvad Microfinance as well. RBI had earlier lifted restrictions on the company in January. How soon do you expect the business to bounce back, return to profitability? And any thoughts on, if at all, you may revisit the IPO plans for the company?
The IPO plans are not in the agenda in the very near future, but definitely we will explore that when the things are normal. We are coming back to the normal dispersal slowly. It has not been fully geared up. We have implemented all the guardrails set by the SROs, so it is steadily increasing. So I hope in another 1 quarter it will go back to the normal level of dispersal.
Okay, and when do you expect them to return to profitability in that case?
So in 2-3 quarters, we expect the profit. It will return to profitability.
All right. Mr. Nandakumar, we have to ask you, one of the biggest changes for the company has been that recent deal with Bain. They will become the joint promoter. How does life change? What will Manappuram 2.0 under Bain look like? Will there be any strategic change, portfolio diversification? What sort of changes should shareholders expect?
So this money is expected to use one for totally digitalizing, then definitely for strengthening the non-gold verticals also, strengthening the capital base of our subsidiaries. Also, we now in the new draft, the restriction for opening the branches for the need for getting prior approval for the branches with these are expected to go. So we will get the opportunity to open more branches. We may open around 100 to 200 branches in the next 1 year, etc., etc.
Yeah, Mr. Nandakumar, you also spoke about the board, of course, getting reconstituted, and you yourself will also transition from CEO to non-executive chairman and mentor. What is the roadmap for this succession? How soon will a new CEO also be named?
We are in the process of shortlisting the CEO candidate. We are in discussion, and I hope in 3-4 months' time such a candidate will be onboarded. And as the mentor and chairman of the board, I will definitely support him in his endeavor in building Manappuram 2.
All right, that's Mr. Manappuram talking about the gold financing business in the light of new regulations. We'll take a break on that note, come back on the other side, and we'll have our special offering, Quarter Se Quarter Tak. Today, we bring you key expectations from the pharma sector.
Welcome back. You're tuned into CNBC-TV18 and this is Corporate Radar. Well, a good time to focus on our special offering, Quarter Se Quarter Tak, where we bring you the earnings expectations from every sector. Vinny joins us today to tell us what she's expecting from the pharma sector. Vinny, take it away.
Hi, good morning. For the pharma sector this time, Q4 FY25, analysts are expecting pharma companies to see a sales growth of around 11 to 13% and a EBITDA growth of one could expect in the range of 18 to 19%. Profits are expected to grow somewhere around between 13 to 15% in Q4 FY25. What will be driving this? Operational efficiencies, the currency depreciation side, as well as a reduction in freight cost is something that could support the growth over here. However, in terms of profitability, if you remove Revlimid sales for most of the companies, then we could see a bit of a slowing coming in as the tailwinds could be lower from the API side. The raw material costs on that front could be a bit lower and could have peaked out now in Q4 FY25. And after that, we could see a reduction coming in. So FY26 onwards, maybe some reduction on that front. Now, given that import prices for key APIs as well as key starting materials have increased 8% over the past 3 quarters, these could be factors that could impact the growth going forward. The growth for pharma companies this quarter is expected to be supported by domestic as well as US market growth. Q4 typically, when you look at it, is a seasonally weak quarter coming in for acute heavy companies. So if they are not diversified enough and they're specifically focusing on acute treatments, then maybe some bit of an impact could come in on that. Some of these companies are Alchem Labs, Ipca, that could see a bit of an impact. Now, company-wise, when you look at it, Dr. Reddy's, Zydus, Lupin are expected to outperform the revenue growth, and that could come in at 17 to 20% in this range for these 3 companies on a year-on-year basis. This I'm talking about is the overall business. So it includes US as well as the domestic business. Now, specifically, let's talk about domestic formulation and in terms of the revenue expected that. Over there, you're expecting to see domestic formulation businesses see a growth of 12 to 14% in Q4 FY25. Dr. Reddy's, JB Pharma, Torrent Pharma, Ipca and Sun Pharma will lead the growth in domestic formulation. Growth momentum could be somewhere around 11 to 13% for these companies in terms of organic growth during the quarter. This is mainly driven by ramp up that one is seeing in chronic therapies for these companies. Improving productivity is something that will expand the growth for the company. Now, looking closely and coming to the US side of the business for most of these companies, what are the factors that are impacting over there? Price erosion in the base businesses there. So that will be offsetting the steady traction that one is seeing in key products. So whether you look at the generic Spiriva, Myometric, obviously that's the case that has just come in terms of update for Zydus and Lupin. So a bit of a negative on that front. But specialty scale-ups for Sun Pharma are something like Revlimid supporting the growth for Dr. Reddy's, Zydus, Aurobindo Pharma and Sun Pharma. So good numbers are expected on that front. US formulation revenue is expected to see a strong growth of 8% on a quarter-on-quarter basis. Revlimid sales, that's the key reason for this growth as well. Now, revenue ex Revlimid for the pharma coverage could actually see a growth of around 5%. Pricing is stable. Benefit of limited competition as of now for Spirivat as well as Myabetriq is something that has supported the growth in Q4. Going forward, that could come off as well. Company-wise, Zydus is expected to grow at 20% in the US market, supported by Revlimid as well as Myabetriq or Myabetriq that was supporting the growth in FY25. US market, 12% growth is going to be followed for Lupin and 7% growth is what one could expect for Aurobindo Pharma. EBITDA growth, 18%, 130 basis point improvement in margins. On a year-on-year basis, raw material prices are stable. We're keeping an eye out on exclusivities. How is that going? As well as operating leverage are factors working out well for the company. Key to watch out for in terms of commentary going forward is what investors are watching out for, because what is going to be the outlook in terms of domestic market growth, US pricing, generic pricing, how is that going as well, margin trends going forward, capital allocation plans, and any updates on tariffs is something that we'll keep an eye out on. So yes, all in all, Q4 FY25, another strong quarter is what we're expecting for pharma companies. Robust sales, margins, gains driven by launches is the key factor to watch out for, and commentary is something that we'll keep an eye out on.
Okay. All right. Vinny, got it. Thank you very much for that. It's a very, very comprehensive look ahead to Q4. I'm just looking at the Nifty Pharma Index. Let's pull up the index as well. In the last 1 year, the Nifty Pharma Index is up about 15%. This year, obviously, with the headwinds, market cooling off and the impending US tariff issues, it's still down 8% for 2025. That's, of course, the index rate. Let's pull out a longer-term chart. There we go. This year has been a year of some headwinds. So how should you play the space given the numerous uncertainties involved? Vishal Manchanda is with us. Vishal, good to have you on. So I'm going to start with a very, very basic question. No one knows what's happening with US generics and tariffs and what eventually happens. But if we just go by, leave that aside for a second, go by business growth, prospects of business improvement, then would you bat for some of the specialty US generics player or specialty US pharma players? Or would you bat for CDMO? Would you bat for domestic formulations as a segment? As a segment, what looks most strong or strongest just on the back of business?
Right. So I think as a segment, domestic obviously is stronger than US on a structural basis. So US currently, I think, is doing well for most companies. A large part of the earnings is being contributed by the US. But probably the next 2-3 years, we might see US pulling down earnings because of the drag that we'll see on account of the limited competition launches, contribution from limited launches coming off. So, but domestic will continue to be structural, 8 to 12%. And then, so from a valuation perspective, we'll have to pick and choose where we see the most value. So I think if you look at the large companies which are diversified, I would focus on companies with less of US contribution. So companies like Sun and Cipla have around 30% US contribution, while the others are between 40 to 50%. I would stay away. While tariffs, there is still uncertainty around tariff, and that would impact companies across the board. But obviously, those with larger presence tend to get more impacted. While in our view, tariffs broadly is unlikely in the space. Then again, as you said, if you look at the CDMO category, that's, I think, is extremely richly valued. Valuation is a reason I'll not chase that space. Maybe I'll choose and pick if there are smaller names, relatively less talked about names in the CDMO category where we can probably look at opportunities.
So can you expand on that? You're saying you'll stay away from large US players like maybe Cipla and Sun Pharma. You like CDMO. Who do you like, or what do you like within CDMO?
So just to kind of correct that, US I'll stay away from Reddy, Lupin and Zydus. While if I want to buy something, I'll buy Sun and Cipla because they have relatively lower US presence. And again, if you look at Sun, they have a larger specialty patented business, less of generic business. So Sun is preferred, and Cipla has got a complex pipeline that's going to last for long, not a pipeline that's going to stay for a year or 6 months. So from that point of view, Cipla is preferred. So again, on the CDMO front, I think there are certain names like smaller names like Shilpa Medicare, Jubilant Pharma, which are not considered as pure CDMOs, but they have about, so like Jubilant Pharma has got about 30% of sales coming from CRAMS opportunities. CDMO opportunities. So that's a name I would like to kind of consider as a CDMO bet.
Let's map this with valuations as well, Vishal. I mean, you've given us a basic breakdown of growth, what to play, what to avoid. From a risk-reward perspective, valuations, which would be your top picks?
So again, in the larger names, Cipla and Sun is where I think there is a larger chance of these companies outpacing consensus and based on their ability to offset Revlimid erosion. So I think these two companies should be able to offset the Revlimid erosion through new launches. So that's one. And if I go to the small cap, so then I have preferred names in the small cap category. Which is Pfizer, Shilpa Medicare, Jubilant Pharmova, and Orchid Pharma. So a number of names there. All of these are into various. So Pfizer is more of a domestic play. Orchid is an API play, betting on the import substitution opportunity. Jubilant Pharmova is a diversified play, but with a large presence in the US. So they probably are immune from any tariffs related risk, and they are also proxy to a CDMO. Proximity to CDMO.
Got it. So, Vishal, final question then on tariffs themselves. Your top picks from a US market perspective are Cipla and Sun, like you're saying. Now,
Right.
how grave is the risk of tariffs? I mean, can these companies scale up more quickly from plants, if not in the US, maybe in Canada and Mexico? Do you think they'll be able to mitigate the impact? What are you penciling in with respect to a tariff scenario?
So I'm not assuming companies would shift their manufacturing base to the US. Probably they would want to pass on the tariffs to the consumers, and I think we are in a position to do that. And not only in a position, but they'll also be compelled to do that because they're already operating on wafer thin margins, and if they choose to absorb the tariffs, they probably would get into losses.
Okay, all right. Vishal, appreciate you joining in. Thanks a lot for giving us that perspective on the pharma stocks. By the way, just one stock that I think we should focus on is Dixon, because the reports are indicating that Alphabet, they are shifting their Google Pixel production from Vietnam to India amid all this US tariff issue. So I think that's the reason that the stock has spiked up. It's up close to 6%. Volumes are very, very large. The street believes there could be an incremental opportunity coming in for Dixon, going by a reporter that's online as well. So that's a stock that saw a sharp correction, I think, to around 13,000 odd when the markets were jittery, and now it's pulled back in style from those levels, up close to around $1,000. Well, time to slip into a short break. Come back. Midesh Thakkar will be waiting for us. He'll have some trading strategies.
Banking money is really short-term saving deposits and some fixed deposits. And the average tenure of a bank deposit, banking system is about a year and a half. Yeah. And you expect to fund the infrastructure over 7 years or a corporate loan over 5 years. You are sitting on a mismatch, whatever you say. So it will have to evolve.
To corporate CPs and bonds.
And really, if you look at the lay borrower, the retail borrower, his or her need is to repay every month, and that's what you are collecting. And then you are in sync, and you're repricing the loan maybe on a quarterly basis or half-yearly basis. So that is appropriate financing. Banks, I think, as they evolve, the larger and larger part will be to the retail sector, because they are, as of now, best equipped, unless they're disrupted by a fintech. The corporates, large part of the corporate universe today, are cash positive. The cash flows are positive and can meet most of their growth needs. At the margin, they may have to borrow. Large part of infrastructure funding will come through a market process, which is outside the banking system. It's already happening.
Welcome back. Well, Mitesh Thakkar is back with us. Mitesh, you've been maintaining that positive bias. The Nifty briefly moved into the red, but it's a 100-point bump up from there, and the Nifty Bank continues to lead the way. Levels on both those two indices and individual stock ideas?
So, good morning again, Nigel. I think 24,200 was the second level which I had mentioned. We just hit that a few minutes back. And then now I think, 24,500, 550 zone is the next supply pivot with an revised target of 24,750, which was the weekly closing high we got in December. So I think these two targets look very likely to be met. My only worry in the entire process remains that the rally has been very fast and we are slightly overbought. So one of these days you're going to get a pullback. I don't know which day, but that should be an opportunity to buy afresh. That apart, on the stock side, I have a buy on overall reality, which I would recommend buying with a stop below 1675 for targets of 1730, 1750. And the other one which I like is Dalmia Bharat. I think that's a stock which has done well, and the weekly charts are now turning 1900 for targets of 1990.
All right. The target on Dalmia is what? Mitesh, missed that level?
1990.
1990. Okay. All right, Mitesh, thanks a lot for joining in and giving us those details. Let's focus on the big news that came in overnight. The government has gone ahead and they have implemented the 12% safeguard duty on all flat steel that is imported. Remember, the DGTR had proposed this close around a month or so ago, and we had the steel secretary who joined us on the channel last week, and he said expect it shortly to take shape. And now that proposal that was there, it's been implemented. It will be implemented for a period of close to around 200 days. That starts yesterday. So the 12% safeguard duty is now effective. So that's why stocks there opened up in the green. Morgan Stanley, they say that this is a positive development because there was some kind of hurdles and there was some kind of uncertainty. So the uncertainty is out of the way. The overhang is out of the way. This 12% now is officially take shape. And also they say that if the stock prices have seen a bit of a bounce, they would recommend trimming some of the long positions out there. In fact, with the ICICI Securities analyst who joined us earlier today, he was making an important point that actually now the domestic steel prices are at a premium in comparison to the imported steel, which gives you less headroom to go ahead and take a price increase from these levels as well. So that will be a bit of a negative in that case. Stocks still in the green, though they've come off the high point of the day.
Okay, that's the steel space. Overall market holding on to a gain of about 70 points, so not too bad. Morning. We have to take a break, but on the other side, our special segment, It's the Economy. Lata today discusses why bonds are falling and why Indian bonds are rising. So that discussion coming up with two experts.
investing.
For the past few weeks, there has been a disconnect between the US bond markets and the Indian bond markets, probably Asian bond markets, but clearly between India and the US. What we have seen in India is a rally in the bond markets. We have seen bond yields fall from about 6.5% to all the way down to 6.3%. Today, they are a tad higher, but we have seen bond yields fall and bond prices rise in India. On the other hand, it has been the other story in the US. After a fall to 3.8% on April 2nd, the day of the announcement of the reciprocal tariffs, we have seen US bond yields rise very sharply, which means nobody seems to want to buy US bonds. On an average from April 5th to today, bond yields in the US for the 10-year have ranged around 4.4 to 4.5%, a little inexplicable considering that one was expecting that with the reciprocal tariffs, the US is on top of the game. Why are Indian bond yields and US yields going in opposite directions? Can they continue for long? To argue and understand these issues, I have with me Mitul Kotecha, the head of FX and EM Macro Strategy Asia at Barclays. We also have with us Suyash Chaudhary, the head fixed income at Bandhan Mutual Fund. Gentlemen, thank you very much indeed for your time. Mitul, first, if you can take us, what explains the rise in the US yields? Why doesn't anyone want to buy US bonds?
It's a good question. I think, look, the reality is that there has been a scare in US bond markets. Just a couple of weeks back, there was a lot of discussion about foreign selling of US bonds. There was also concerns about these leverage positions that had been built up. The basis trade was very popular for US treasuries, as well as swap spread pressures. And at the same time, an increase in term premium as markets started worrying about inflation risk going forward. So, there's a number of factors that were weighing on US treasuries, especially towards the longer end of the curve. We've seen a little bit more of a consolidation and a bit more stability since then. Some of those market pressures have eased. But nonetheless, as you say, there is a massive difference between the performance of US treasuries and what's happening with global bond markets, in particular, as you say, India and elsewhere in Asia. But I think, look, the treasury selling may not be over at this point, or at least the treasury pressures may not be over. But look, we think there are some opportunities, and our US rate strategy team have actually been long 5-year US treasuries with the view that some of these pressures are overdone at this point in time.
Okay. Suyash, let me come to you. Would you want to add to this? Why do you see US yields rising? And as Mitul pointed out, actually everything other than US, the yields seem to be falling. I mean, German bonds are also falling. But how do you explain the fall in Indian yields?
So, Lata, one of the notable aspects of the last many years has been the so-called US exceptionalism trade that has drawn a lot of global capital. And, what is remarkable in this phase is you are seeing a global risk-off, and simultaneous with that, you are seeing the dollar weaken by roughly 8 to 10%, depending upon which index you track, since middle of January. And that is the, unprecedented thing in this move, because typically in a risk-off environment, you would see the dollar rising. So it's probably two things happening at the same time, which is the risk-off getting netted off by some unwind of the US exceptionalism trade that is leading to global portfolio managers diversifying away from US to some extent. For emerging markets like us, making the best of a reasonably bad situation, it's good news, because what it allows is for us to run monetary policy relatively more independently. So had the dollar been strengthening into this, even if RBI wanted to ease policy, it would have been difficult for them to be able to transmit the rate cuts that they would be doing. However, in this environment, RBI is able to transmit the rate cut because they don't have pressure on the currency side. That said, the RBI has a better trade-off on inflation versus growth, as the governor very easily clarified that the tariff world will lead to weaker growth, and therefore we have more leeway to act on that. So it's the combination of all these factors basically playing that you have more policy room to ease because currency is not under pressure. And the growth inflation trade-off is relatively clearer for you, as a result of which, bond yields are responding to this environment.
Okay, well, let me quickly complete this argument, Suyash. In India, growth and inflation are under pressure. Growth under pressure because of global headwinds, inflation under pressure because of an expected Chinese-led disinflation. But usually we say that unless the difference between the US yields and the Indian yields should not be too much. At the moment, there's hardly, the difference between the two yields is declining. So wouldn't that be negative for the RBI to cut?
Look, the argument is not as powerful in the current scenario, because you would also remember that post-pandemic US is on a different fiscal trajectory. So the first round of yield narrowing happened because the US is now on a 6.5% kind of fiscal deficit, and India has consolidated. Many other EMs have also consolidated. So that accounted for the first round of narrowing of yield differential. The second round is what we just discussed, which is some bit of the US exceptionalism playing out, and therefore the need to diversify away a bit from dollar assets. And our sense is, that you can actually live with narrower yield differentials given the current trade that is playing globally, which is the need to diversify away into well-run other geographies which have relatively deep capital markets.
Okay. Clearly the rise in US yields is not playing on Asian central bankers. We are seeing many of them going ahead and cutting rates. Mitul, I wanted a slightly longer term view from you. What the US is basically asking every other country is that you run a deficit with me. Don't run a surplus with me. Now, if I don't run a surplus with the US, I don't get dollars from them, and therefore I will not buy US bonds. Is not the Trump administration killing any appetite for US bonds if they ask everyone to run a deficit with them? So is there a structural distaste for US treasuries?
It's a very good point. There is a structural issue here because, as you say, if the reality is if the US suddenly doesn't have large deficits with other countries, then other countries will not be funding the current account deficits, not be providing dollars to the US, and not be buying US treasuries in the same quantities that they have been. And so I think this has been a concern. This has been something that's weighed on US treasury markets. And, I think, as mentioned, the fiscal premium is also rising because clearly, when you look at the bills that are going through the Senate and the House, there is going to be a large increase in the fiscal deficit in the US. And not only about making Trump's tax cuts permanent, but there are other measures going through. So you've got so many headwinds now that are starting to weigh. And as you said, the bigger one here is the longer term structural one is, will there be enough dollars going back into the US to buy US assets if the US succeeds? And it's a big if. If the US succeeds in narrowing its deficit with the rest of the world, that could be a longer term structural issue. And look, for the rest of the world, what we are starting, or not just starting, but from a longer term perspective, we have been seeing a reduction in dollar assets. I mean, China, for instance, has been reducing its US Treasury holdings, its allocation in FX reserves for some time with US dollars. And look, I think India, I would say, is somewhat isolated from a lot of this because India, one, it's a closed economy, it's less trade driven. Two, fiscally, India is in a better position, arguably, with the consolidation that's taking place towards a deficit of around 4.4% of GDP. Borrowing requirements are fairly well constrained. Inflation has come off fairly rapidly, and the currency is stable, if not firmer. And so all of these really do bode well for further gains in Indian bonds. And I think what we've been seeing is that outperformance justified by fundamentals in India, where in the US, that hasn't been the case of late.
What's your Indian bond range or, forecast, say, by June or December, Mitul?
Our 10-year IGB forecast was 6.25% by end of this year. But look, arguably, the move in bond yields in India has been more rapid than anticipated. So it's possible that we could get there even earlier. But we have our forecast of 6.25%, and so the trend we still think is going to be for lower yields in this environment. And India's growth is still holding up better than most countries, but clearly it may be taking a hit from global trade weakness and global recession that we're anticipating. So that could also be a factor supporting India's bond markets.
Suyash, your bond yield forecast by June and December, sixth quarter that Mitul says is only 7-8 basis points away.
So, Lata, like Mitul said, things are happening fast. And, recently we have taken down our terminal repo rate forecast to 5.5%. There is a likelihood that if the global growth shock turns out to be bigger, then this could be even slightly lower. Also, I think one of the very important factors on the table is RBI is really focused on transmission of rate cuts that it is undertaking. So by our calculation, by the end of April, RBI would have conducted almost 4 trillion rupees worth of OMO purchases. Another 2.2 trillion of FX swaps have been done. So all combined, significant liquidity measures have been undertaken, not to mention that the 4 trillion of OMOs have taken out that much duration from the market, thereby creating more duration demand. So our sense is you could easily, kind of see the early sixes. That's probably a good place to work with, for the foreseeable future. All depends upon whether the dollar finds a floor soon enough. Our sense also remains that eventually the Fed will have to sway in favor of curtailing the rise in unemployment, because there may be slightly more permanency to that rather than the one-time shock to inflation. But that is an evolving scenario. So if the Fed were to really swing into action, then by definition, Indian bonds will also have that much more space to fall eventually. Although, like we discussed, on their own, they are doing just about fine till now.
Okay. Well, Mithul, I need a dollar range as well. If you can, a dollar rupee range, but more importantly, a DXY. Does it go much below the current 98.5?
Well, more broadly, we've just actually revised our euro dollar forecast, and we now have really marked to market. Our views on the dollar have been somewhat constructive, and clearly they've been under a lot of pressure. And now we do see potentially, at least in the short term, euro dollar to edge up to sort of 117-ish. And our medium term view now, which is reflective of our sort of augmented PPP fair value measures, is that euro dollar settles around 115 in the next several months. So on that basis, look, we may have seen almost the full bulk of dollar weakness, but you can't rule out a little bit more short-term weakness. What we would say is that positioning is very negative. Sentiment is also very stretched negatively. One thing that is concerning us in terms of the hit to the dollar is obviously the pressure on Powell here and what impact that has on U.S. policy credibility, certainly if he's pressured into lowering rates. So again, that's weighing on the dollar as well. So it's hard to rule out further short-term pressure. And again, as I said, we've now shifted our medium-term view to more sort of consolidation around this 115 euro dollar.
Okay. Actually, you were the first person to say 115 euro dollar when euro dollar was at 1.07. I remember that, Mithul, I think when we last met. But very quickly, just in case Powell is made to leave, I don't think that's anybody's base case because the law is very clear he stays till May 26. But if something were to happen, what's the pell-mell in the market, Mithul?
Look, I think and I agree, it's a very, very low probability event. But if for some reason he is forced to step down ahead of the end of his term, I think markets would react very, very negatively to this. And it would send, in our view, the dollar sharply lower. It would probably send US yields sharply higher. Look, the front end may move lower because markets may expect expectations of rate cuts. But certainly you'd end up with a sharp move on the longer end of the curve, reminiscent of what we just saw a couple of weeks back. So I think markets certainly would not react well to a premature termination of Fed Chair Powell's term.
Okay. Yeah, and many people's forecast of gold at 4,000 perhaps will get advanced if such an event were to happen. But yes, it's nobody's base case that the Fed chairman is removed. Thank you very much, Mithul and Suyash, for joining me in this conversation. So the US Indian bond yields 10-year is likely to get very close to 6%, probably somewhere between 6 and 6.25. That's the expectation from the experts. Wrap up on Bazaar after break. Chartbusters.
Market opens higher despite weak global cues. The Nifty remains well above the 24,100 mark, currently holding at around 24,200. Banking names, they outperform, they climb higher as the RBI has eased the LCR norms.
Shares of solar energy equipment manufacturing companies Premier Energies and Vari Energies have surged as much as 6% after the US has imposed anti-dumping duty on imports of solar equipment from 4 Southeast Asian countries: Malaysia, Cambodia, Thailand and Vietnam.
Shares of Hero MotoCorp and Bajaj Auto decline as Jefferies downgrades the stocks on expectations of lower sales volume. Bajaj Auto is downgraded to a hold rating with the target price cut to around 7,500 rupees from around 10,500 earlier. Hero MotoCorp is downgraded to underperform with the target price 3,200 rupees from around 5,000 rupees earlier.
Steel stocks like JSPL, Tata Steel, SAIL and JSW Steel are trading with modest gains as the government has imposed a 12% safeguard duty on imports. Brokerage Morgan Stanley says that this is a positive development as it removes multiple months of overhang around the imposition of safeguard duties on imports.
Cholamandalam Finance dips nearly 1% after CLSA downgrades the stock to hold with the target price at around 1,600 rupees a share, with expectations of growth tapering off. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Hormuz. Hormuz, well, we wake up to weak cues overnight, but the Nifty bulls, they are not having any of it. They are saying, let the global markets do a thing of their own. The Indian markets have the momentum and the Nifty Bank, that's the one that's in rock solid form.
Absolutely, and continuing from where they left off yesterday, and the bulls kind of realized that what happened overnight in the US is also mostly self-inflicted. So taking cue from that, and of course the recovery that we are seeing in the Dow futures as well earlier this morning is adding to the positive sentiment. Of course, the announcements made with regard to the LCR norms is also having a sentiment boost for the banking names. The Nifty Bank made a record high yesterday, is building on to those gains in today's trading session. At one point it even crossed levels of, now nearing levels of 56,000 now as we speak, just a few hundred, just 120 points away now, 600 points higher on the Nifty Bank. Another day of very, very strong gains in today's session. But what are the charts indicating for the road ahead? Shilpa Raut of Prabhudas Leeladhar is joining in for just that. Shilpa, good morning. Thank you for joining in. Well, it almost seems like the Nifty has taken a bit of a backseat right now because the Nifty Bank has been in the thick of things for the last 2 trading sessions. Where do you see the Nifty Bank now that we have already crossed the previous high? We crossed 55,000, now we are nearing 56,000. And what about your stock recommendations for the morning?
Good morning, Nigel and Hormuz, and thank you for having me on the show. Talking about the indices, yes, we are seeing some solid short covering happening in the market, and we've seen that markets have already consolidated for months, and we've seen the price and the time correction both happening, and the bulls have got the much needed rest already. So Bank Nifty has taken that all-time highs, and now it's done for Nifty. Nifty, I guess, with a solid support at 23,800 in a positional view as well, you can stay long and look for targets of 24,600 to 24,800. And once it crosses that, then Nifty will also see new all-time highs happening there. Bank Nifty, we have a resistance at around 56,200. So already almost approaching that. So if we sustain 56,200, then definitely the levels of 57,500 also opens up. So Bank Nifty, some profit booking can happen at around 56,000 to 56,200.
Okay, all right, 56,000 to 56,200. That could be some profit taking that could creep in on the Nifty Bank. Got that. Shilpa, what about individual stocks? What's on your radar?
Nigel, I have 2 buys. The first one would be a buy in HDFC Life. HDFC Life trading at around 714. I believe it has given a good breakout and is sustaining above 700. From here, the levels of 760 to 785 levels should be the next target. So keep a stop loss at around 695 and stay long in HDFC Life. The other one would be a buy in Dalmia Bharat. Dalmia Bharat also witnessing good short covering. Levels of 2000 to 2030 should be the next targets, and keep a stop loss of 1900.
All right, Shilpa, thank you so much for sparing time and joining us on the show with your views on the index and on specific stocks as well. Well, shifting focus then to our special segment where we get you a few ideas for profit from Money Control Pro. Jitendra Gupta is joining in today to talk about a stock that he is tracking very closely.
Hi, thanks. Today we have Cummins India, which leads the domestic power gen space with vast installed base. Its focus on clean and emission compliant products aligned with India's regulatory shift, giving it an edge both in compliance and innovation. The company's strong balance sheet and cash reserves should act as a cushion during the market volatility. And moreover, the business is doing well in the recent months. In Q3 FY25, company delivered almost 22% growth in revenue, and mostly the demand for high horsepower engines, especially from the booming data center segment, has been a key driver. Domestic revenue grew by almost 18%, while exports surged by 43%. Looking ahead, Cummins is set to benefit from the implementation of the new emission norms, boosting overall demand in the construction and other segments in which it is operating. Its focus on clean energy and cost efficient take places it ahead of the peers. With regulatory tailwinds and product innovation, Cummins is building structural growth levers that are aligned with the India's energy transition. Valuation-wise, Cummins offers an attractive blend of earnings, visibility and valuations. The company has guided double-digit growth in FY25 and FY26 probably, with Q4 expected to be better on the back of higher execution and higher demand for clean technologies.
Some ideas of profit there from Money Control Pro. Now, sources are telling CNBC-TV18 that the government is eyeing ways to restrict money laundering through online gaming platforms. Timsy is joining in with more details on this. Timsy.
Well, in a bid to ensure that the government is able to break the nexus of money laundering via online gaming platforms, sources have told CNBC-TV18 that the government is likely to consider some serious measures in this regard, which includes to propose mandatory registration of the online gaming platforms with the Financial Intelligence Unit. Sources in the know of the development shared with CNBC-TV18 that interministerial consultations are underway on mandating FIU registration for online gaming platforms, which includes discussions between the PMO, MHA, Revenue Department, MeitY, ED and CBDT, which have favoured for this mandatory FIU registration for the gaming platforms. Sources further say that with this move, the government aims that both onshore and offshore online gaming platforms will be easily scrutinized, and it will help the government to keep a tab on the funding and the source of funding that is coming or going out through these platforms. Sources also claimed that the government, if this proposal goes through, will be able to manage to book offshore gaming companies under PMLA in the case of violations. Meanwhile, an email query sent by CNBC-TV18 to Finance Ministry in this regards remains unanswered. Also, just to remind our viewers that the country's Financial Intelligence Unit operates under the aegis of Revenue Department under the Ministry of Finance and is responsible for collecting, analyzing and disseminating financial intelligence and suspected financial transactions. Now, to be seen is whether the proposal goes through or not, and whether this registration actually comes through the light of the day. Back to you.
Thanks a lot for that, Tim. See, for the time being, we slip into a short break. On the other side, we'll be joined by the management of IGI. They'll be discussing the past quarter's numbers. Don't go anywhere.
Back with us here on Chartbusters, on to earnings conversations. Then the company in focus is IGI, the International Gemological Institute. The company reported a 9.6% rise in its revenue from last year. Margins also expanded from last year. We have Temas Printer, who is joining in as the Managing Director and CEO of the company, and Ishwar Iyer, who is the CFO of the company as well. Gentlemen, good morning. Thank you so much for joining in, and congratulations on the quarter gone by as well. How do you 10% revenue growth for the first quarter? What kind of growth are you penciling in for the full year? And also a question on your realizations as well. We're down around 12% on the lab-grown diamonds certification pricing changes that have taken place. So does this now become the new normal at around 950, 960 odd?
Yeah, it would be. And Ishwar can elaborate more. But on a year-on-year basis, it would be around 15 to 20%. That is what we are historically also done and striving for.
Okay, so you're saying realizations will hold around these levels, right?
That's right.
Right, and volume growth you're looking at for the year?
Volume growth is, at the moment, it is 26% or 27%.
Right.
And it's only, it'll only scale up.
Okay, all right. I just wanted, before we get into further details, lab-grown certification as a percentage of your total mix has come down to around 54% approximately. It was at around 60%. Is the need for testing going down?
No, let me just take that question. I think what's happening as far as the lab-grown segment, the way it's evolving, at least for the India market, is that when this lab-grown business started, it was more in terms of stones getting certified. But and that's the story that we've been talking about in the past as well, in terms of the affordability factor that that provides, probably will enable the Indian consumers to come into the fray. Otherwise, this market was actually in the US.
Right.
So what we are seeing is a 5-6% increase in mix of lab-grown jewelry, which was 0% 12-15 months back, is now 5-6% of our revenues. So lab-grown jewelry typically will get consumed in the area in which it's manufactured, which is here in India. So we are seeing the trend that is at least indicating that the Indian consumers are now coming into the fray. And that is what is propelling the growth on the lab-grown jewelry side. So combined between lab-grown stones as well as lab-grown jewelry, the percentages have remained more or less the same.
You at the time of your IPO, you had raised funds and you had mentioned that you're planning to complete the acquisition of IGI Belgium and IGI Netherlands as well. Where has that progressed to? Is this completed as of now?
We completed that in December itself because we had a specific timeline within which we had to complete the process. So we did the acquisition sometime in the last week of December.
And by when does it reflect on your books?
It's got reflected even in December quarter as well as for the quarter this year.
Okay, all right. So you started the year with a revenue growth of close to around 10%. That's in revenue terms, with obviously all the growth came in because of the volumes. Just to pencil numbers for 2025, what kind of revenue growth are you looking at? How much of that will be volume led? And margins are holding steady at around this 64%, 65%.
Yeah, we actually declared a 57% margin last year. That's scaled up to 64%. Obviously, the efficiencies, the way the business model is evolving in terms of the flow through that happens because of the volume and the revenue throughput getting into the bottom line. So that's what's driven the expansion from a margin standpoint. But again, to the point that you made in terms of we did take a pricing correction last year. April, May is when we took the pricing correction, consequent to the movement of the lab-grown segment itself. So we had to keep ourselves relevant in terms of the certification pricing, etc. And that's the reason we took that pricing last year. So from that context, the volume growth is therefore at a higher scale versus the revenue growth because we are cycling that pricing. But if you look at it from a sequential standpoint, I think the gap is insignificant. Actually, the revenue is growing faster than the volume growth, which we think should therefore pan out over the course of the next 3 quarters. So again, 15-20% is what we had committed at the beginning of the year as well. I think we should stick to those estimates for this year.
Revenue growth of 15 to 20%. Margins, as you mentioned, you'll have done various tweaks on the operational side, and that's why your margins have improved.
Yeah, between 57 and 64. I think we should look at it in that range because quarter one is too early for us to, because we are also making significant investments because as the volume throughput is really going up, we are also investing in capabilities, both in people, expanding laboratories, etc. So I think the investments are going in the right place. So I think between 57 and 64 is what I think. Therefore, we should guide.
Very broad.
It is.
To say that.
Of course, it is.
No, but to add to what Ishwar is saying. lab-grown is a volume game.
Yeah.
And we are ramping up our gemologists. We've already recruited 130 gemologists, which is 14% of our staff strength.
Right.
To handle the volumes. Plus, we have taken AI into function.
Indeed.
And the other thing is that we have changed the product mix. We are getting more and more natural diamonds also. So, at IGI, we grade diamonds, and we give you the origin, whether it's earth-mined or man-made.
Right. So, if you could give me a number, what is the charges typically you all do on certification of lab-grown and of natural diamonds? What should the number be, difference? The average we have 950.
Yeah.
But if you want to split it up for us?
Natural diamonds will be just over $40, and this is just under $20 for lab-grown.
Okay. And natural diamond is stable.
Right.
It's rare.
Yeah.
It's unique. So, on lab-grown, it's a volume game.
Yeah.
So you get discounted on more the volume, more than, and the lab-grown is actually increasing the consumer pie because of the affordability. Lab-grown is not cheap.
Yeah.
It is more affordable as relative to natural.
What should your revenue mix look like? Going by all that you all said, lab-grown is growing at a fast clip. On natural diamonds, you're not, you don't see any big downtick in the realizations. So that's holding steady, the average price. But what should the ideal revenue mix be for y'all?
At the moment, between lab-grown as well as lab-grown jewelry, we are in the 55-60% range. I think that should hold as we get on during the course of the next 3 quarters.
But is natural emerging as a segment, because they're at 16.5, but you expect to go to 20 sometime at least by this year?
We were 18 last year. It's gone down to 16.5.
Yeah.
I think again cyclical between quarters. So I think we'll just look at it. I think it's early days, but between 16.5 to 18, I think that range is holding strong at the moment.
All right, gentlemen, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the quarters ahead.
Thank you very much.
Thank you so much.
Appreciate it.
Thank you, Nigel.
There's the management there of International Gemological Institute on the quarter gone by, and of course to discuss the road ahead for the company as well. The stock doing well for itself today, 1.8% higher as we speak. Take a short break. More on the markets and specific stocks on the other side. The Nifty above the mark of 24,200. Stay tuned.
The Maharashtra government is facing heat from its own contractors who claim the state owes them a massive 89,000 crore rupees in pending dues. According to the Maharashtra State Contractors Association and the State Engineers Association, payments have been stalled ever since the launch of the Ladki Bahin scheme and other pre-poll promises in July 2024. The association say the dues span multiple departments, including the Public Works Department, Rural Development Department and the Jal Jeevan Mission. Of the total amount, around 46,000 crore rupees is pending from the people.
Welcome back. Well, some of these solar related plays actually are doing very, very well. Just pull up a few of them. What's happened is the US, they have going to be putting duties on imports that are coming in from various parts of Southeast Asia. And India has the potential, to go ahead and in fact grab some market share on a global front. So that's why you have stocks like Bari Energies. Just pull up the intraday chart out there. It's moved on very, very good volumes. I think a month or so ago, the stock was at around 2,000 rupees and it's bounced back very, very well. So big uptick is what we're seeing. The other one we're looking at is Premier Energy. That one as well has moved up. So Bari is the biggest beneficiary because they have a plant in the United States as well, and exports is relatively a larger part of their business. Premier Energies is another one that's moved up. And a smaller company is Insulation Energy. All these are into solar cells as well as solar modules, or they have plans to move into that particular space. So that's why you have all three of these stocks, Premier, Vare, and Insulation Energy, all of them at the high point of the day.
Vare is also reporting results today, so you
yes.
keep an eye out on that. And of course, despite Vare being at around 2200 or 2300 odd, or around 25 as we speak, it's still significantly lower than its post-listing high, which is around about 3700. So, but still positive developments for these stocks. At the highest point of the day now is Vare 6.5% higher, crossing the mark of 2600. But two auto names that are on our radar today, and that is Bajaj Auto and Hero MotoCorp, and both of them have been downgraded by Jefferies and their price targets have been cut as well. Sudarshan is here to tell us more on this. Sudarshan.
So stock reaction of the two-wheelers will tell you exactly what does the Jefferies note say. So Jefferies has downgraded Bajaj Auto and Hero MotoCorp and has maintained buy call on both TVS Motor and Eicher Motors. So first, for Bajaj Auto, it has been downgraded to hold and target is cut to rupees 7,500 from earlier target of rupees 10,550. For Hero Moto, it's a double downgrade. It's been downgraded to underperform and target has been cut to rupees 3,200 from almost 5,100. As far as Eicher Motor is concerned, here maintained buy call, target is raised to 6,700. For TVS, maintained buy and target is raised to 3,225. So why exactly Jefferies has downgraded these stocks? So first, it has cut two-wheeler industry volume growth estimates for FY 26-27 by 6 percentage point and 2 percentage point each, but it expects a healthy 10% CAGR over FY 25-28. Now for Bajaj Auto and Hero, they have seen a sharper downgrade and also estimates have been cut. For Hero MotoCorp, EPS estimates have been cut in the range of 8 to 11%. For Bajaj Auto, it's been cut in the range of 5 to 7%. And the reason Jefferies has given, because it's both these companies have been reporting lower volumes in comparison to TVS Motor and Eicher Motor. For TVS Motor also, it has cut the EPS estimates, but lower volumes for TVS Motor have been partly offset by PLI benefits that the company has been receiving. For Eicher Motors, it's been one of the top performers. You can see in stock performance also, both TVS and Eicher Motor have been outperforming over the last 6 months, and it's been reflecting on the monthly numbers, quarterly numbers, and these are some of the reasons. That's the reason Jefferies has downgraded Bajaj Auto and Hero MotoCorp, and both the stocks are down in trade as well.
Okay, all right. Thanks a lot for that, Sud. Well, banks, though, are in focus after the RBI eased liquidity norms further. Abhishek joins in to help us understand this news point and what impact it has on the stocks. Abhishek?
Well, RBI has revised a liquidity coverage ratio framework. So they have put additional runoff rate at 2.5% to internet and mobile banking enabled retail and small, business customer deposits from the 5% that was in the proposed or draft norms. Funding from non-financing entities such as trust, that is educational trust, charitable trust and religious trust, partnerships and LLPs will attract a lower runoff rate at about 40% from the earlier 100%. So this augurs well with respect to, wholesale deposits flowing into the banking system. Now, Macquarie has written a note. They say that the impact from RBI relaxation would be that RBI expects a 600 basis point improvement in the LCR ratios for the banking system from the Q3 FY24 LCR levels. So they believe that this is encouraging and will provide support to the credit cycle of the lending institutions. So back of the envelope calculations does indicate that about 2.5 to 3 lakh crore increase will be seen in liquidity which can be deployable. So this would imply a 140 to 160 basis point potential increase in credit growth for the banking system. Up on your chart for reference is the LCR of various banks in Q4 and Q3 FY25. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, on that note, though, we'll have a wrap up on this edition of Chartbusters. As we do that, here's some good news for all our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store. Or you can just scan the QR code that's up for you on the screen.
Despite the state government's claim, especially post-budget, that its finances are in order, the contractors argue otherwise, pointing to stalled development work and growing financial stress on the ground. They allege that payment delays and pendencies were already an issue before July 2024, with a 40% payment pendency. But since the launch of Ladki Bahin and other pre-poll schemes, the regular payment rate has dropped to barely 10%. As a result, work across infrastructure projects, including maintenance and repairs at Mantralaya and Raj Bhavan, has come to a standstill. Projects under PWD, Rural Development and Jal Jeevan Mission have also been halted. The contractors' body says workers are also suffering, with only minimal payments being made to them to keep them afloat. They claim they have written 6 letters to the Chief Minister and Deputy Chief Ministers but received no response. Last week, the association held protest in Thane. They now plan to send one final letter to the state leadership before approaching the court to recover their dues. The association, which has been active for 25 years, represents 3 lakh contractors across 35 districts in Maharashtra. Each contractor reportedly employs 200 to 300 workers.
Banking money is really short-term saving deposits and some fixed deposits. And the average tenure of a bank deposit, banking system is about a year and a half. And you expect to fund the infrastructure over 7 years or a corporate loan over 5 years. You are sitting on a mismatch, whatever you say. So it will have to evolve.
To corporate CPs and bonds.
And really, if you look at the lay borrower, the retail borrower, his or her need is to repay every month, and that's what you are collecting. And then you are in sync, and you're repricing the loan maybe on a quarterly basis or half-yearly basis. So that is appropriate financing. Banks, I think, as they evolve, the larger and larger part will be to the retail sector, because they are, as of now, best equipped, unless they are disrupted by a fintech. The corporates, large part of the corporate universe today, are cash positive. The cash flows are positive and can meet most of their growth needs. At the margin, they may have to borrow. Large part of infrastructure funding will come through a market process, which is outside the banking system. It's already happening.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer, and things are picking up for the market. It was a quiet, flattish start, but now in the last 1 hour, there is momentum and markets once again are advancing. The Nifty Sensex up close to about 0.5%. The Nifty is now closer to 24,250. The Sensex is at 79,800 after soaring close to about 400 points. Banks once again providing the leadership. The Nifty Bank is up more than 1%, and mid-caps, small caps outperforming. Things are looking up and looking good.
Good morning, Reema. Absolutely right. After the kind of handover it received, as well as how Asian markets opened, actually worried that we would see quite a weak start. GIFT Nifty was actually indicating a very subdued start. But despite that, we've actually seen a significant up move as far as markets are concerned. What's taking the markets higher? Well, it's the same story today as well. Banks as well as NBFCs. RBI's final LCR norms are much less restrictive compared to what they were earlier, and the entire banking pack today has built onto the gains, especially names like HDFC Bank and Kotak Mahindra Bank. Some of the PSU banks too doing very well in the session. Bank of Baroda up 3%. The other, lot of banks, also a lot of news flow as well. So RBL Bank, a very large trade in that particular name. British International Investment, earlier known as CDC, has most likely exited the complete stake in the company, a little over 3.8% stake, and the stock too has seen quite a sharp recovery from the day's lowest points. Remember, RBL Bank has recovered quite significantly from the recent lows. IndusInd Bank, on the other hand, reports are indicating that the company has gone ahead and appointed EY to conduct another audit this time around to probe a 600 crore discrepancy as far as the MFI portfolio is concerned. IndusInd Bank at one point of time was down almost 7%, has pared some of those losses, still trading with cuts of a little over 3.5%. A couple of stocks, especially from the solar energy ecosystem, both Wari as well as Premier, both of these stocks, Wari up over 7%. Remember, they also report numbers a little later today. Premier Energy is up almost 6%. USA has gone ahead and imposed very steep duties on the peers from Southeast Asia. And some of the tariffs are all at almost 3,500%. So very high tariffs on some of the select countries and companies. Indian companies seen benefiting. And lastly, very few laggards today, but two-wheeler stocks, both Bajaj and Hero, on the back of downgrades from Jefferies today, seeing a bit of selling pressure, Rima.
Indeed. Let's invite our market guest, Jitendra Arora from ICICI Prudential Life, to join us now to discuss the market fundamentals and his top sectoral bets. Jitendra, I wanted to start off by asking you about banks. The Nifty Bank was the first sectoral index to get back to its record high. It had fallen the least also in the global turmoil, but the way the banks have moved up, it's been a nearly 8,000-point rally over the last couple of days in more than a month on the Nifty Banking Index. Where from here are you overweight banks? Would you buy banks at current levels? And in the financial space, let me rephrase that, what would be your top picks?
Good morning, Rima. Yeah, so I've appeared on this show earlier also, and I think at that point also we highlighted that from a domestic perspective, we continue to like banks. So banks have been one of our favorite picks for last 6 to 12 months. And we continue to hold the same view even as of now. Because if you look at the medium term to long term earnings construct and growth construct and put the valuations on top, we believe that the risk reward for Indian private sector banks is still one of the better ones in the current market. So yes, the banking sector will be one of our overweight calls in the current market.
What about wealth management within the financial space? We've just seen a very large deal brewing now. UBS will be acquiring a near 5% stake in 360, WAM. And wealth management has emerged as one of the fastest growing sector in the financial industry. Do you like wealth management? Is it a part of your portfolio?
So we do not own wealth management companies because, again, by calling it a sector, it's a specialized wealth management companies are still very small part of the overall market. And you do get to play some part of wealth management by owning private sector banks because they also participate in their own way in this industry. But given the rising wealth accumulation by the Indians, obviously it's a very, very interesting segment of the market. However, one must remember that as you become wealthy, the capital can find other shores as well. So then in some ways, it is also part of a global industry at large. So you do not get to retain everything on domestic shores. So to that extent, there can be plays which will compete with you from the international markets rather than only in the domestic market.
Jitendra, how do you then play the capital markets team? Do you feel that an exposure maybe to some of the exchange stocks would be a better play, would be a better way to play this particular theme?
There are various plays available on the capital markets. You can play it through the long-term savings players like insurance. You can also play them through mutual funds, and you can also play them through various exchange and transaction-related plays like RTAs as well as the exchanges. So those are some of the plays available, and some of them have shown remarkable long-term growth. Something like a mutual fund space has shown a remarkable growth over last 20 years in terms of AUM as well as earnings, and I think they are one of the ways to play the entire theme per se. What one has to be cognizant about is essentially the point in cycle where you are entering and exiting, and what kind of multiples are you paying from a short to medium term perspective versus a long term perspective.
Completely take that point up. How are you now looking at the export space? A lot of worries about tariffs, but most of the stocks have recovered quite significantly from the recent lows. So how do you look at the pharma pack in particular? Still tariffs haven't been announced there, but it continues to remain as an overhang.
I agree. But having said that, I still believe that pharma will remain a relatively insulated sector from a tariff perspective. That's what my belief is. Having said that, you will still want to wait to see what's the news coming on that front, because the segment where Indian players are competing, which is essentially the generics, I think we have a fair bit of cost and pricing advantage there. However, our linkages to China in terms of KSMs and APIs is fairly strong. So to that extent, how does that affect the overall sector remains to be seen. But I believe that pharma will remain insulated from a tariff perspective overall, given its critical nature to the US consumer, as well as our own cost competitiveness there.
So your overweight financials broadly, what else? What else do you like at these levels? Tell us what you're holding in your portfolio, and also incrementally when you have to go and buy, because not all the themes that you own in your portfolio will offer the risk reward to give you an entry point. So what would you buy at these levels?
Carefully evaluate some of the retail plays which have been depressed in the current market. We are overweight retail significantly in our portfolio because, again, it's more a domestic consumption growth story which we are trying to play through Indian retail players per se. Within that, you will find that there are names which are currently depressed because of the recent performance. But if you believe in the long-term performance of some of those companies, you will still find them investable even at current points in time. And then you will always have relative plays available within the space, wherein you may want to sell something and buy something, even though it may appear pricier. In terms of other segments, I think you will find a lot of cyclical names which are undergoing correction, and I think another 5 to 10% correction in some of these names will make them very, very interesting opportunities from a 2 to 3 year horizon, given that some of them are undergoing a cyclical depression in their margins, as well as are facing slowdown in terms of their revenue growth. But if you look at the long-term prospects of some of these companies and the multiples where they have reached, I think you will find good, interesting entry points in some of these names.
Sorry, in cyclicals, you mean auto? Which sector are you looking at?
Something like, for instance, building materials.
Building materials.
Okay.
Any other?
Pointing out. In autos, I still think there is some more pain perhaps we are likely to undergo. Similarly, IT also, I believe we are likely to see some more pain. But I think another 5 to 10% lower from current prices, IT would have priced in a significant amount of pain, and we can look to buy into that also with a 2 to 3 year horizon.
Right. Jitendra, you mentioned autos and IT where are two sectors where you expect to see some more pain. Conversely, which are clear sectors that you will be avoiding at the current point of time? Any red flags from any sectors where you feel significant downside still remains?
So nothing per se in terms of a very significant downside at the sector level, because every sector honestly will have players which have not done well even in the current move, and some players which have overextended themselves. So obviously it has to be a bottom-up market per se. So you'll have to evaluate every company from a bottom-up perspective, irrespective of how the sector is doing, because there'll be banks which have not done well in the current banking cycle also from a long-term perspective. But that does not make them a buy per se.
Now, within some of the domestic names you mentioned, consumer durables, how are you looking at them? Names like Havells, Voltas, the upcoming summer season, do you like them at these current levels?
We'll avoid discussing names, but the consumer durables, we do have some plays available where we believe we had bought them in the recent correction, and the valuations had also corrected. So we have exposure over there.
Okay, and one final word, you spoke about retail, where you are evaluating opportunity. Without getting into stocks, but are we when you talk about retail, are we looking at the D-Marts, trends of the world? Or are you also looking at footwear, apparel, etc.? Some of the other
apparel, for instance, may be interesting at this point in time, because again, the valuations have corrected, and also we are seeing earnings slow down. But with the government move on taxation, we expect some of these names may see some kind of growth coming back to them. So yes, that's an interesting space.
Thank you so much, Jitendra, for joining us and giving us a view across a whole host of sectors. Get you soon on the channel once again. Well, we now slip into a short break. We'll get you key expectations from HCL Tech earnings on the other side.
Welcome back. After yesterday's 2.5% up move in the tech sector, today it's a little subdued, so down about 0.5%, maybe taking cues from the Nasdaq performance overnight. Now, all eyes will be on HCL Tech. HCL Tech will be the fourth IT company to report their earnings, fourth large cap IT companies. We already had numbers from Wipro, TCS, Infosys, and broadly it's been a disappointing set of numbers. Now, from HCL Tech, the key to watch will be their guidance for FY26. Remember, Infy gave a guidance of 0 to 3%. For HCL Tech, the expectations are maybe closer to 2 to 4%, maybe 3 to 5%. Some of the optimistic in an optimistic scenario, but they could also choose to be a little conservative and give a wider range, maybe a 2 to 5% or a 1 to 4% kind of a revenue guidance. Margin guidance likely to remain unchanged at 18 to 19%, but that's going to be the key to track. Now, onto the Q4 numbers. Like we've seen with the rest of the large cap IT names, expect a sequential revenue decline. All the companies have reported in the large cap space a revenue decline on a quarter-on-quarter basis. For HCL Tech, dollar revenue seen down 0.9%, constant currency revenue growth seen down 0.6%. For HCL Tech, the key reason for the revenue drop, one is weak seasonality. Secondly, there was a large retail project which came to an end in Q3. So when you compare it quarter on quarter, there will be, that revenue will be absent in Q4. So that will hurt. And also the company had indicated that some of these new discretionary projects are a little slow to start. So that could be another factor. Margins for HCL Tech at seen at 18.1%, again lower on a sequential basis. And here the reason is, one, negative operating leverage, your top line has declined. Two, wage hikes come in. And three, visa costs. So therefore, margins are seen down 140 basis points. Let's see, Infy also missed. Infy was a big miss compared to expectations. So now all eyes on HCL Tech. But again, it won't matter because March is done. What they have to say about FY26 in terms of new projects, and are they being paused? Are they being cancelled? Are they hopeful of things stabilizing now? I think that's going to be key.
Very similar to what Tata Elxsi did, right? Commentary was a lot better than maybe what the street anticipated. It was a sharp mover today. Thank you so much, Rima, for taking us through what are the key expectations as far as HCL Tech is concerned. We'll now take a short break. Abhishek Kapoor from Puravankara joins us on the other side to discuss their FY26 outlook as well as the operational update they gave the exchanges. Welcome back to Trading Hour. As promised, we're now shifting focus to the real estate space. Puravankara, the company, remember, yesterday reported its Q4 FY25 business update and saw a decline in both pre-sales as well as collections on a year-on-year basis. They believe this is due to approval delays that have led to temporary deferral of launches and reveal a strong launch pipeline for FY26. To discuss more on this, we have Abhishek Kapoor, Group CEO at Puravankara. Thank you so much, Abhishek, for joining us. Even last time we had discussed the fact that there appears to be quite a few delays coming in as far as regulatory approvals are concerned, especially in Karnataka. What is the current on-ground status as far as the approvals are concerned, and how many projects of yours have been pushed forward due to these particular regulatory delays?
Vivek, thank you for having me on the show. So just one correction on your previous statement. We have grown the collections by about 9% year on year. Having said that, I think from the perspective of new launches, we are looking at about 13 million square foot of new launches in the coming year. About 6 projects got deferred in terms of launches, which could have come in the last year itself because of regulatory, approvals only in Karnataka itself. Having said that, I think we are very, very positive. In the 13 million square foot, we are expecting 6+ million square foot to be launched in the first 2 quarters itself. And other than that, what's good for us is also the fact that we have deployed about 1,300 crores in the last year, which is generating a GDV of almost 13,000 crores, where we have locked in lands. Of course, the idea is that you create a robust pipeline of lands to be able to launch in the upcoming financial years.
But Abhishek, for this 13 million square feet of launches that you're planning in FY26, is there a regulatory risk that the approvals don't come through and you fall short?
Look, that risk is always there. But having said that, I think what we work towards is that we move all of the projects. What typically may happen or can happen is that some change happens at a later date, and if that policy change affects the approval, then it gets delayed. But having said that, see, these lands are all paid for. The plans have already been submitted. Of this 6 million square foot is in advanced stages, which we are quite certain that should be taken to market before in the first half of the year itself, and the balance will spill over. So that risk, to be honest, is always there, but that only defers the launches. It does not affect in terms of the value that it brings to the table as far as the company is concerned.
Okay, Abhishek, we want to clarify on a couple of numbers from you. We understand that at the start of FY25, the launch pipeline was close to 17 million square feet, right? And we understand that at the end of FY25, you've managed to launch close to 13 million, remainder being impacted by regulatory delays. What was out of the total launch pipeline? How much square feet actually went on sale? And what is it that you expect to recoup in terms of deferred sales by Q1 and Q2 of FY26?
So, Vivek, to just, you're right, I'll just clarify that. About only a short of 4 million square foot is what we took to the market last year. In fact, I would say large amount of projects got deferred largely on account of regulatory approvals, of which what was deferred, which would be about 8 million square foot, of which what I'm suggesting now is about 6 million square foot will go to the market in the first half of the year. And then the rest will get deferred, and of course, and not deferred as in they will come in the second half of the year. And in addition to that, some of the new projects which were acquired will also be taken to the market in this year. So overall speaking, I think almost 8 million got deferred, of which 6 million will come to the market within the first half of the year.
Okay, got that. So last year you planned 13, but you managed to do only 4 million square feet. And again, this year in FY26, you are planning about a 13 million square feet, and a lot of it will be a carry forward from the previous year. So your collections growth, while it is 9% in FY25, it seems slightly lower. What are you anticipating on the collection side for FY26? Will there be a pickup?
Right. Rima, definitely with the new launches, there will be a pickup. And that will add, that will show collection growth, especially in the second half of the year. Because first half of the year, when we do these launches, the collection actually start to hit the business in the second half of the year. Other than that, I'd also like to share that we are getting OC for about 3.9 million square foot in the first half of the year, which also will see possessions coming through within the first 9 months of this financial year, and therefore that will also reflect in the revenue recognition and the collections of the business.
Abhishek, FY26 on a base of a little over 3,900 crores of collections, what is it that we can pencil in for FY26? And pre-sales, given how revenue recognition is done now, on a base of a little over 5,000 crores, what is it that we can expect?
Vivek, we don't give guidance. What we share is the numbers.
A directional number, sure.
Yes. So for example, as I mentioned, 3.9 million square foot of OC will give us about 3,200 crores of recognizable GDV in this financial year. That's a number which is pretty much given, so I can, it's not a forecast, it's given number. As far as the new launches, as I mentioned, 13 million square foot is what we are targeting. We expect to open, in terms of open to sale, at least 9 million square foot, and that should provide us with a total at an average realization of say about 10,000 rupees a square foot. Will realize about 9,000 crores of GDV of launches should go to the market. And basis past performance, one can make estimates of what kind of numbers we will show. But definitely the company's focus is on ensuring that we have good growth in the pre-sales numbers from the 5,000 number for the last financial year.
This 9,000 crore of gross development value GDV is for the first half of the year that you estimate, right?
Total for that we'll open for sale this year. While 13 million you will get the plan sanction, what happens is that you don't open the entire inventory for sale, you open parts. So we will open about 9 million square foot, and that should result into about 9,000 crores worth of GDV being taken to market. Other than that, we will continue to do sustenance sales where we have projects which are ongoing. And we have performed very well. In fact, last year, we have grown our sustenance sales by 22%. I mean, if you break this down a little granularly, the brand has really performed well, and the group has performed well on the sustenance sales. The impact largely has been on account of new launches which got deferred.
Abhishek, give us a view, number one, or give us what is the on-ground trend. Number one, when it comes to demand, is there enough demand when it comes to new launches? Price per square feet or realization, how is it shaping up? Can we expect to see an improvement year on year? And what is the new launch pipeline, especially given the impending entry into the Maharashtra market?
So to answer on ground, I think the momentum continues in terms of sales in the markets that we are present in the West and in the South, where we have inventory for sale. The good news has been commercial absorption has been quite high, which shows that future demand is also there. Fortunately, this is non-perishable demand, and it continues to hit the market as and when it does. Now, as far as our launches are concerned, the 13 million square foot that we spoke about, it's broken into Mumbai or West and South. If you look at it, about 3 million square foot will come in Mumbai, and about 10 million square foot of this will be in the other markets, rest of the country. If you look at the overall performance that we are expecting out of this, I think West will increase in terms of the contribution, and therefore the average realization, especially because of Mumbai projects, will get pulled up on a per square foot basis. So while last year we were at about 9,000 to 10,000 rupees a square foot, that will definitely go up because of the launches in the West.
Just a quick question, Abhishek. What's the reason behind all these approvals coming in on the regulatory front? What is the concern? And on the whole, do we have numbers for Karnataka? How many projects have been delayed? And why will FY26 be any different? I mean, have you heard from them that this time they're going to go faster on the approval front?
Look, I think I'll tell you the sequence of events, and this is an industry issue. It's not just a Puravankara issue. In the sequence of events was the elections, and then post-elections there were a lot of changes in the policy. Some of the examples were like e-Khata, which took some time settling. Some more further changes were brought in the regulatory side, and those what happened is that the government also has a capacity to process so many files, and that is a certain capacity. So, for example, if a department has capacity to process 100 files, due to the delays and changes, we had a bunched up files of say 150 files were there, and therefore that got clogged into the system. So now that the files have started clearing more frequently, and the system's kind of stabilized and the changes have kind of played out, we are expecting that next 2-3 quarters you will see that most of the clearances should come through. That's where the confidence is coming from.
Thank you, Abhishek, for joining in. We need to slip into a very short break. On the other side, 360 ONE and UBS have inked a wealth management deal. We'll get chatting on this with both UBS and 360 ONE's Karan Bhagat to talk more about this collaboration and what it means.
Welcome back. The big deal, of course, which was announced this morning was in the wealth management space. 360 ONE has acquired UBS India Wealth Business. It's entered into collaboration with UBS AG, and UBS is also investing into 360 ONE. It's taking just under a 5% stake in 360 ONE. Let's talk about this big deal. We, of course, did an industry discussion at 9:30 this morning with a couple of players from the space. Now let's talk very specifically about this deal. Karan Bhagat is with us, founder and managing director and CEO at 360 ONE. And Jin Yi Young is co-head of UBS Global Wealth Management. Of course, Asia Pacific country at UBS Singapore. Thank you very much, Karan and Jin, for joining us here. And congratulations from all of us here at CNBC-TV18 on this big deal in the wealth management space. It's booming by all accounts. And Karan, you've been an integral part of it, widely acknowledged as having built this sort of institution with your team. So first of all, congratulations. Tell us a little bit about this deal, Karan, if you will. What does UBS India Wealth bring to 360 ONE?
Thanks a lot. Yeah. So thanks a lot. I think thanks for all the kind words, and it's lovely to be sitting here with JY. I think we've been having a lovely partnership discussion for the last 1 odd year, and has led to this unique collaboration. I think most importantly, what it gets to us is widening the platform for the client, and that's really what I think comes core to the culture of both UBS and 360 ONE, is to serve the clients in the best possible way. And I think given UBS's entire global reach across the globe, it allows us to be able to ensure that as our clients become globally more mobile and also diversify their asset classes, I think we have the ability to offer them the best platform which is out there. And secondly, most importantly, I think, again, UBS from a business perspective has kind of built very, very strong alignment on the wealth management space in terms of culture and how to manage the client's portfolio in a diversified, risk-adjusted asset allocation approach. I think we have a lot to learn from them on what's happened globally, and that's something which both our employees as well as us will be able to take to our clients better. And thirdly, I think as a deep sign of collaboration, I think both UBS's investment into the equity warrants in the business, as well as our partnership in terms of, or our collaboration in terms of looking at the Credit Suisse and UBS business folding into our business, should add a lot of value to both our clients.
Karan, just the basics. You're buying the wealth management business of UBS, the UBS India Wealth Management business, but you're also buying the broking and other sort of businesses as well. That is also part of this broader deal.
No, it's the brokerage business, which is a subset of the wealth management business, not the institutional equities and the investment banking business. So the wealth management business basically includes a broking license, includes the portfolio management business, the distribution business, as well as the loan business associated with the wealth management business.
Okay. My question, because you recently had acquired BNK, so that kind of sort of piqued my interest in terms of whether if you're going in for, but of course it's not the institutional business, it's the broking business of the wealth, the broking side of the wealth business, which comes with it, I'm assuming, which kind of brokes for the wealth business in that sense.
That's right.
And Jin, if I can come to you, congratulations. You're investing 4.95% in 360 ONE. What's the logic you see here, and what motivated you? Selling the wealth business to 360 ONE and then picking up just under 5% stake in the business.
So if I may just, just share with you the logic behind this transaction is that, first of all, we want to bring this word global to the next level. So this transaction basically combines the global and regional reach capabilities of UBS, combining it with the reach and the capabilities of the local 360 ONE India franchise. And this really, we believe that we are best placed to actually serve our global Indian clients, both domestically and also globally. Now, the transaction, okay, it is quite complex. It's actually comprised of 3 pillars. The first pillar is really the collaboration, the strategic collaboration, which is exclusive between agreement between UBS and 361. That anything to do with domestic, business is actually handled or managed, in the good hands of 361, whereas anything global will be handled and managed by UBS. So in that way, we are able to actually collaborate really well. We entered into really good collaboration mode, and we are setting up a joint committee to actually make sure that we identify, explore, and also monitor and review the future potentials that we have. So that's really the focus of the whole collaboration is really on the collaboration, the strategic collaboration agreement. Now, the second part of the transaction is really the business transfer. So that comprises of us transferring our UBS wealth management in India to 361 to really allow our clients to benefit from the expanded wealth management capabilities onshore, right? And at the same time, for the clients who actually booked out of Singapore, 361, to actually be able to benefit and manage and serve by UBS. Of course, these are all subject to regulatory approvals.
Sure.
And the third pillar really is the warrant, right? Well, we all know that the wealth management, scene in India is really, growing at an exponential rate. And simply put, right, we really want to have a piece of the pie too. As you can see, these 3 components add together. We are really intertwining together our capabilities and making sure that we are able to serve our clients, global Indian client wealth management, in the most holistic way.
So at the margin, if one is analyzing the wealth business, right, incrementally, one can make out the case that UBS is getting out of the country from its wealth business, but it's really not. You're selling to 361. So how should we read it? I mean, is it part of a global kind of realignment of portfolios across markets, Jin, at UBS?
No, so what I just described today, just now, is really from a wealth management perspective. Really, is we are 2 companies. Put it this way: we are 2 organizations coming together to serve the global Indians, including domestic Indian clients, and also global
I get
Indian
that.
clients in the most holistic way, and capitalizing what we are do best, right?
Yeah.
And that's the reason why we are entering. We are actually taking up the warrants, a stake, is really because we want to make sure that we have, a piece of the pie, going forward as well. So it's definitely not like we are selling off. We are actually reversing, reinvesting into 361 to ensure that we actually have the holistic view.
And
of course, we are expanding our
for this
future collaboration as
4.95%
well
stake,
into
Jin.
asset management.
Yeah. For this 4.95% stake, what are you paying in terms of valuation? So, 361 is paying about 1.2% of the AUM for as far as when they're buying the UBS India wealth business. What are you paying for this 5%?
So I think that is, we will not divulge details of the transaction, but basically, we look at the deal, the transaction in a holistic way, and in terms of valuation, we both agree that that is the best valuation for both businesses, and that's how we invest into the business.
Karan, you want to tell us, talk a little bit about the valuation in terms of the incoming transaction into 361?
No, I can top it. Obviously, yeah. So we obviously from a valuation perspective, we're a listed entity, and we've essentially taken the pricing of the last 5 days of the volume weighted average price for 361 Wealth. In terms of the UBS business itself, as JY pointed out, it's a good commercial assessment of the value of the business, given the current assets under management, and most importantly, once it gets integrated into our platform, what it can represent over the next 3 to 5 years. Obviously, the business has been built over the last 5 to 7 years. It has a great team, great set of relationship managers, and a very, very unique client base of its own. And I think together with our synergies as well as the global synergies, I think both represent a very, very good collaboration, which can lead to a significantly enhanced valuation.
So this, so the 26,000 crores in assets, I mean, that kind of sort of, it adds on to your asset base, Karan?
Absolutely. It adds on to our asset base, yes.
And in terms of margins that you make and that 26,000 crores makes, I mean, could you give us some sense? How does it compare?
So honestly, I think the UBS India wealth business being kind of private and segmented out, the numbers are not disclosed publicly. But having said that, I think it's fair to say that as a wealth management business, it's more or less representative of a mixed margin between 30 to 60, 30 to 70 basis points. I think typically businesses which are fully kind of pregnant and have the ability to use the entire platform today are anywhere from 50 to 70 basis points in terms of retentions. And other businesses which are in the process of being scaled up and have kind of reached a certain scale, both from an AUM and a number of bankers' perspective, typically are at the 30-35 basis points. So the entire business is in that zip code of 30-35 basis points and moving up to that 55-60 basis points. And I think within our platform, it would kind of fold in back into the similar cost-to-income ratios, which we've been able to build out for the larger business over the last 10 odd years.
Do you expect any sort of client drop-offs, etc.? At all? Or you think you'd be able to retain all these relationships?
Yeah, it's too early to say, but I don't really see. I think it's as JY was talking about it. I think from our side, obviously, we worked really hard to get the synergies right. The combined platform is even a stronger proposition than both the individual platforms were already for the client. Secondly, I think from a culture perspective, as I said earlier, both businesses have traditionally focused very narrowly and very successfully at wealth management, asset management, as well as equities and banking. So I think both from a culture perspective as well as a focus perspective, very close to each other, both in terms of style of doing business also. And then, kind of complement it with the same set of people. Don't see a real reason why clients won't stay on. And honestly, I think being in this business for the last 2 decades, both me and JY honestly feel that for the clients, the most important thing is continuity, as well as the most important thing is a stable and a strong platform. And really, I think this collaboration in more ways than one is about getting these things together. And I think if we can get these things together, there's no reason to believe we'll end up losing clients.
If I may add on this point as well, is that we are very excited about the future of this collaboration. And that was the reason why I mentioned the 3 pillars. The first pillar being the collaboration agreement that is actually the most important, right? Just imagine our global reach of, just talk about NRI clients that is globally within our UBS Wealth Management. They all would like to be served onshore. And we will be able to refer such businesses to 361. And we have a collaboration to actually see how we can make that happen. And likewise, for all resident Indians in 361, we'll be able to access the global facilities and capabilities of UBS as well. That is the powerful part, the most powerful part of our collaboration. And we believe with this, we're able to take the business to the next level jointly.
Absolutely.
Jin, hi, this is Reema here. So if you want to take this collaboration to the next level, would you at some point look at increasing your stake further from the current 4.95%?
Yes, good question. We get that quite a bit, actually. So, like I said, we actually set up a committee, a joint committee that will be, led by both sides of the leadership. We will explore. This is just a really first initial step that we're taking to this collaboration. We intend to take this to the next level. And of course, we're exploring all avenues to do that. And that includes, other options going forward as well. So it all depends on our synergies that we come up with going forward. But definitely, we are keeping that open for now.
What are the other avenues that the committee will be jointly exploring?
Yes, for example, as I mentioned, this is really focusing on wealth management business as well, but not forgetting in UBS, we actually have asset management as well, investment banking as well. And we all know that a lot of corporates in India really want to take their business not just in India but also globally as well. There we can come in to really help. UBS can really help our clients, from an investment banking perspective to bring them to the world as well. So, and that's really from investment banking perspective. And of course, on asset management, right? We really want to think about, asset management solutions that our global clients will need. Perhaps we can also see how we can collaborate with 361 to come up with solutions that is able to help them assess the Indian market as well. And as vice versa, Indian clients in India would like to have global reach as well. Definitely UBS can help in terms of producing solutions from there.
Right. Karan, this is Vivek joining in as well. Karan, what has been the kind of response, what has been the kind of interest that you've seen from your own clients as far as investing into markets outside India is concerned? So far, there have been quite a lot of regulatory restrictions there, right? So does this open up new avenues, and what has been the response you've received so far?
So I think there's a lot of interest, but obviously all the new avenues remain restricted with what is available regulatorily. I think honestly there are three real options from an investment perspective. First is obviously the automatic rupee mutual fund feeders, where the limits has been capped now for the last 2.5, 3 years. And the LRS limits of $250,000 per financial year per individual. That's been quite, kind of utilized quite productively by most of our clients for the last, I would say, 4 to 5 years. In the first 3 to 4 years, most of this money really went to buying a house or for education. But over the last 3-4 years, clients have used it very effectively to build out financial portfolios outside. And recently, I think GIFT City have obviously seen a little bit of more relaxation in terms of being able to invest outside. And we've seen roundabout, maybe not only through us, but through all GIFT City providers put together, around about $150–200 million, which has kind of gone out for financial investments. So while the current quantum of amounts remain relatively small on the LRS and the GIFT City side, I think from a regulatory landscape perspective, it's quite clear. I think the regulator has done a phenomenal job in being able to kind of think through some of these aspects very carefully. And I think as time goes by, I think our own ability to kind of offer this to resident Indians within the regulatory ambit would be higher and higher.
Got that. Karan, by the way, to that question of whether UBS will buy more, will we see, what's your sense? Will we see substantially larger holding, year, 2 years, 3 years down the line?
Honestly, it's a really tough question to answer. As I said earlier, I think, Prashant, I think for me, honestly, like JY put out the three pillars. For me also, it's
But what is your sense? You think it's possible? It would make sense?
It's all in the execution, right? I think we've got the platform right. We need to enhance the platform for our clients. We need to be two firms which are aligned on culture. And third, obviously the rest of it, which is the business case, needs to kind of play out. But I think all these three things need to play out eventually to figure out whether that number is more or not. All I can say is, given the fact that both the firms have been sharply in this business, and we spent the last year, I think that's a good starting point. I think all three things have come out well. The collaboration agreements come out really well. I think our own assessment of each other's strengths has come out well. The client case and the client case for enhancing the platform is solid, and the 4.95% is a great start. So I think that's the way I would look at it. And then we have to see how these things play out. I think beyond a point, there's really no large merit in terms of taking a guess there. But I think these three things coming together is really what is exciting me.
But there is no written roadmap or internal agreement, right? I mean, year down, there's no like some call option kind of.
No, there is no. There is no written roadmap.
It is open, and both of you will sit
nothing
down
at all.
and decide
As JY said, it's absolutely open.
Based on execution. Thank you. Thanks very much, Karan and Jinyi Young, for joining us. Good conversation. We wish you all the best of luck as you guys sort of work together in this new partnership, in this new avatar, so to speak. I think that's the news from the wealth management sort of industry. Stocks, I think, up about 1.25%, but it's done well over the last couple of days or so. Markets looking up, guys. 90 points, 24,200 plus.
Indeed. So what we'll do is get into a break. On the other side, we'll come back and discuss market technicals. We'll get you a few trading ideas with Mitesh. Welcome back. The Nifty is at 24,200, slipped a tad bit from the high of 24,250, but trying to climb back again. Tata Consumer, Asian Paints are some of the names where you've seen a bit of a drop-off in the last 15 minutes. Mitesh Thakkar is now with us for a quick technical check on the market. Mitesh, what's the approach to trade now, midday, and what would the stock calls be?
I think the approach and the bias is possible. Very clearly, I think this is a market which is looking good, except for the fact that, as I've been highlighting since yesterday afternoon, we are quite slightly overwatched. Therefore, we know there could be an intraday dip, maybe today, tomorrow. But the overall bias is definitely on the upside. I've talked about targets of 24,500, 550, and in a good case scenario, 24,758. So I think that's where we are looking at. In the short term, I have a buy on IDFC First Bank with a stop at about 66 for targets of around 51. And the second stock, which I like, that's one slab, which I would recommend buying with the stop at 639 for targets of 670.
Thank you so much, Mitesh, for joining us, giving us a view on the markets and individual stock calls, both IDFC First Bank and Lotus Labs on your buying list. Well, time now for a short break. We'll get you more on the markets on the other side.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and
Welcome back to Trading Hour. Well, have a look at the Nifty or the NSE PSU Banking Index, clearly doing very well in the session. Central Bank of India, Canara Bank, Bank of Baroda, IOB, the top 4 constituents today as far as the NSE PSU Banking Index is concerned. Well, one of the top movers in yesterday's trading session was actually Tata Elxsi, almost 11% up move at one point of time. Today, the stock, after a brief dip, has actually managed to build on to the gains that it saw yesterday. The stock now trading with gains of over 2.5%. And other stock from the pharma pack, we just highlighted Laurus Labs, but Lupin, that particular stock is doing very well. Again, almost a 2.5% uptick on this particular name. A couple of brokerage notes indicating that the company may be in line for a significant drug approval. And on the back of that, Lupin has recovered quite a lot of the losses that stock made, especially after losing the patent litigation as far as Mira background was concerned. But with that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
The most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Stocks firm up after a soft start with mid-caps leading the charge. Realty, FMCG and financials are the prominent gainers, while IT and power stocks are the big drags.
RBI issues amendments to liquidity coverage norms for banks, easing conditions for wholesale deposits, even while tightening conditions for internet and mobile link deposits and GSEC valuation. The move is seen easing liquidity for banks.
India has imposed a safeguard duty of 12% on imports of flat steel products for 200 days to protect the industry from dumping by China. Industry leaders who had been clamoring for the levy hail the move.
361 WAM and UBS have decided to partner on wealth management in India, with the Indian partner gaining access to UBS's global ecosystem and buying its India business. UBS will in turn pick up a near 5% stake in the Indian wealth manager.
No reason to complain at half-time for the Bulls, continuing from where they have been leaving the last 5 trading sessions. You're watching Half-Time Report here from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me is Nigel D'Souza. Nigel, good afternoon. Well, 24,200 on the index, doing very well for itself, but the Nifty Bank is the star of the show yesterday, star of the show today as well, and making on course for 56,000, I guess.
Well, that's right, Hormuz. We'll keep an eye out on on how the Nifty Bank moves from here on, because it's had a super run. The Nifty is still some distance away from its fresh all-time high, but the Nifty Bank is making fresh all-time highs on a day-to-day basis. And just going by what we saw with HDFC Bank as well as with ICICI Bank, the numbers look quite good. I'll keep an eye on Axis Bank. That's the next big number that comes in later this week on the 24th, if I'm not mistaken. So Axis Bank, I think that's going to be another key stock that we'll track from here on. For the time being, it's more or less flattish. Next 2 days, we get its set of numbers as well. But let's focus on the first management that we have on the show. That's Raj Ratan Wire. It's in focus after reporting its Q4 FY25 earnings. The company's margins have seen a bit of a decline, but they're guiding for better times ahead. And as we speak, the stock is now locked close to around 20% higher in trade. To be now joined by Mr. Sunil Choudhary to discuss the past quarter's numbers and the way ahead. Hi, sir. Good morning and good to see you win. Well, your stock price is telling you the picture. The street believes that the worst is behind now. Tell us, what's the road ahead for you? Last year, I think you did, double-digit volume growth. For this year, what kind of volume numbers should we be working with? And if you could break it up for us, in India, how much? As well as in Thailand, how much will it be?
Yeah, so Nigel, we had invested in a new capacity in Chennai. And that was the reason for not so good performance for almost, 1 year. Especially Q3 was not good. We didn't perform well. But I think the worst is behind us. And from here, you can expect that volumes will further grow. I would like to refrain from committing the numbers this time. But yes, we are set to grow from here, and especially the Chennai capacity utilization will improve in the coming quarters, which will be good for the financials of the company.
Okay, give us a few more details then. The Chennai Phase 1, I recall, had got commissioned, and you were doing low volumes on a quarterly basis. How does that business ramping up? Last quarter, what kind of volumes you did in the Chennai unit? And you're refraining from giving us volume guidance. But can you hint at least a broad band? Can it be, in that vicinity of around 10-15%, more than that?
Yeah, so now, as you know, our Pithampur capacity is running at 90%. Thailand is also running at 85-90%. So the growth will come from shifting orders to Chennai as we are getting more and more approvals from our, marquee customers. We will supply more quantity from Chennai, which will, I can see that Chennai this year should cross around 20,000 tons of volume in the coming financial year. Yeah. There may be some reduction in volume at Pithampur, but overall, I'll continue to say we'll grow in volume by 15% at least in the current financial year.
Mr. Chodia, good afternoon. Thank you for joining in. You mentioned there might be some decline in volumes at Pithampur, but you are procuring machinery for value-added wire ropes for that facility, and you are about to convert around 12,000 tons per annum of black wire capacity into to 10,000 tons per annum of wire ropes. By when does that complete and start showing in on your P&L?
Yeah, so as you know, we already have a 12,000 tons per annum capacity of wires, which we are supplying to wire rope industry. And now our management has decided to do further value addition by making wire ropes ourselves. So we have procured plant and machinery, which has a capacity of 10,000 tons per annum. And it will take almost 1 year to complete that project. And the idea behind that is that we will have management capability, capacity, and technical knowledge to do this. And we also think that Rajratan has become a bigger company now, and depending only on one product may not be good for future. So we are testing this product to begin with. And if we are successful, there will be further investment in this product. Yeah, but currently it is to utilize the, the existing capacity of Pithampur for a value-added product rather than selling raw material to wire rope. We want to do it ourselves.
Okay, all right. And if you could tell us, who would your clientele be?
Clientele, these are engineering wire ropes and elevator wire ropes. So it goes into infrastructure, it goes into engineering application, lift, hoist, multiple applications. Yeah. And there is some potential of export also.
Well, so since you mentioned export potential, Mr. Chodia, what's the current revenue mix compared to domestic to exports?
No, we are right now not in wire rope business. We will start that. But our current exports from India are very low. This year we have done around 3,000 tons of export. But next year plan to export is around 10,000 tons from Indian ports to global market. And that is going to be bead wire. That is going to be only bead wire.
Right. And with all of this tariff-related uncertainties that are going around all across the globe, have you seen any pushback from any of your clients? And how do you plan on navigating this situation, or does that not impact you at all?
No, right now it has not impacted us because the duty on our product is not changed. We are not affected by reciprocal duties of USA. There is a little positive in all this because China has been affected. And as you know, we have been competing in global market with China. So as of today, we have been positively affected. I don't want to say that it is going to be very long, benefit.
Okay, all right. But you stand to gain, right? If you
Currently we stand to gain, and we are seeing that the orders are improving.
Okay, all right.
China has larger duty on the similar product.
Correct, and that's been a bit of a pain point for you because they have, been dumping their material. Now that provides an opportunity for a company like yours, Rajratan, right?
Yeah.
Okay, all right. Just to get back on that point that you were talking about, the black wire capacity, which you're, converting to wire rope now. Could you give us a brief number? What is the average realization in both these two products? And will there be a margin difference as well?
Yes, so currently we sell that product with a EBITDA margin of 7-8%. And if we do value addition and make wire ropes out of the same production capacity by adding finishing capacity of wire ropes, we are expecting the margin to be similar to bead wire.
So margins will be similar in both.
Will come back to
what bead wire? This 12-13% that you're doing.
Consolidated, we are doing 14%, and includes black wire also. Okay, which is small quantity but lower margin. So I expect 15-16% EBITDA in a competitive market we should get.
Correct. So currently you're getting around 7 to 8%, which because you're going to be converting it into a more value accretive product, you can get 15 to 16%. And if you could give us a brief idea on the realizations, what is the difference?
The wire ropes depends on the construction and sizes, but it is close to 100,000 rupees a ton. Yeah.
Okay, and what is the difference between the two?
The selling price difference is around 25,000 rupees. Value addition will be doing from here. Like we sell wire at 75 rupees a kg, and wire rope we expect to sell at 100 rupees a kg.
Right. How's the cost picture shaping up for you, Mr. Chodia? Because the quarter gone by had raw material costs that were lower both sequentially as well as on a year-on-year basis, but your other expenses had seen a sharp jump. Could you quantify as to what led to that jump, and also what's the cost situation looking like on the ground for the ongoing quarter?
No, if you look at India numbers, these numbers include the cost incurred in Chennai. Okay, so you will see that at EBITDA level, we are close to last year's number in spite of volatility in the market, in spite of global turmoil in the market. But there is a heavier cost of depreciation and finance cost, and also other expenses. So all put together, this will go down in coming quarters because Chennai will start making more production, and it will be divided over larger production. Yeah.
Okay, all right. Very quickly, sir, before we let you go, as of now, you've given us the one number that 15% volume growth is something that we could be looking at for this year. And Chennai facility will contribute 20,000 tons. So we have got those numbers. If you could tell us on the margins, what should it look at, since now things have got streamlined? There was a time when you were doing margins closer to 20%. But now it's settled down in this vicinity of around 13-14%. On an average for the year, since you're going to have the benefit of operating leverage, what should the margin look like? Around 15% would be doable?
Nigel, we are not projecting much of margin improvement because, the 20-21% were post-COVID when China was shut. We very well realize that China is back into action. They are selling material across the globe, and we are fortunately able to compete with them. Coming back to the Indian market, all our competitors have increased capacities, and there is a pressure on the price in India also. But fortunately, Rajratan has good number of clients, good approvals, product quality is good. So we are still able to maintain this profit, and going forward, there will be some improvement in profit because of the higher quantities we target to sell.
So margins will
reduce the cost. Hence, margin. Yeah.
So margins, sir, will be in the vicinity of 13-14%, right?
It can be little better than 14%.
Little better than 14% for the time being. And what about, in revenues, what should it be? I think last year we were chatting about it could be closer to around 1,000 crores. You've ended, I think, somewhere in that vicinity. Revenue.
We have done 937, but part of it has gone into capitalization. You will see in our annual report. So we have done around 950 crores of top line, and next year definitely we are doing 1,100 crore plus.
So one final question from my end, Mr. Chodia, since you mentioned competition and everybody increasing capacity around you as well. So if you may not want to take price hikes in the near future, you may not cut prices as well. And so just to ensure that your margins remain where they are.
Yeah, so we know that we are competing in the market, but as you know, this is a difficult product. Putting up capacity is not enough. Getting approval from key customers is the answer to this business, okay, which takes very long time. We are fortunate that our Chennai facility has got major approvals in place, and that is why we will be able to sell 20,000 tons from there this year.
Okay. You spoke about competitive intensity, sir. I recall, when things were going all guns blazing, not just a China factor, domestically, a couple of large players had shut down, which helped you on market share. So just give us a couple of details. What is your updated market share here in India? And what about Thailand?
We remain around 40% in India.
Okay.
And in auto, it is more than 40%. But overall, bead wire, we are 40%. And in Thailand, we have closed the year with 32% market share.
32% market share. All right. Grace, Mr. Choudhary, thanks a lot for joining in and giving us all those details. We'll hold you to these numbers. There could be an incremental benefit because of the pressure that's being put on the Chinese in the open market. And as you're saying, you have capacity coming on stream, so you'd like to ramp up out there. Thanks a lot for joining in.
Thank you.
That was the management there of Raj Ratan Global Wires. There are interesting comments that they made with regards to their market share and even to the pricing bit that they mentioned. And they also mentioned that their Chennai plant will be able to supply more orders going forward as well. The stock in a 20% upper circuit as we speak, and has been the case throughout this session. We'll take a short break, but just as we do that, some good news for our viewers, and that's India's business news leader, which is the all-new CNBC TV18 app, which now puts India's business news leader just a click away. You can get financial news updates, in-depth articles, and of course breaking news at the tip of your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that's up on your screen to download the app. We take a short break, back with more on the markets and specific stocks on the other side. Stay tuned. Back with us here on Halftime Report, still 24,200 on the Nifty, still 75 points higher, holding on to gains for the 6th straight session. There was a bit of a cool off on the Nifty Bank from the highs, but it is still looking to hold on to higher levels. Remember, the Nifty Bank saw a very, very sharp surge in yesterday's trade, still up another 400 points in today's session, 0.75% higher, around about that 55,700, 55,800 mark. It got, well, tantalizingly close to 56,000, but is still facing some bit of resistance at those levels. And it is because of these heavyweight banking names. Yesterday's move was courtesy of the results from HDFC Bank and ICICI Bank, and today's move is courtesy the Reserve Bank of India, which has eased liquidity norms further. And Abhishek is joining in with more details on that. Abhishek.
Well, RBI has revised a liquidity coverage ratio framework. So they have put additional runoff rate at 2.5% to internet and mobile banking enabled retail and small, business customer deposits from the 5% that was in the proposed or draft norms. Funding from non-financing entities such as trust, that is educational trust, charitable trust and religious trust, partnerships and LLPs will attract a lower runoff rate at about 40% from the earlier 100%. So this augurs well with respect to, wholesale deposits flowing into the banking system. Now, Macquarie has written a note. They say that the impact from RBI relaxation would be that RBI expects a 600 basis point improvement in the LCR ratios for the banking system from the Q3 FY24 LCR levels. So they believe that this is encouraging and will provide support to the credit cycle of the lending institutions. So back of the envelope calculations does indicate that about 2.5 to 3 lakh crore increase will be seen in liquidity, which can be deployable. So this would imply a 140 to 160 basis point potential increase in credit growth for the banking system. Up on your chart for reference is the LCR of various banks in Q4 and Q3 FY25. Back to you.
Thanks a lot for that, Abhishek. In fact, Pranav of Bernstein believes the RBI's LCR norms will help banks that have granular wholesale deposits and high share of retail deposits. Let's listen in to what he had to tell us earlier today.
A reduction in the runoff factors for wholesale deposit. I think this is the biggest positive And this will benefit banks which have a more granular wholesale deposits, right? So I'm talking about the deposits from trusts, partnerships, HUFs. I think some of the large private sector banks and some of the larger public sector banks have a greater share of these deposits, so they might stand to benefit a bit more. The other two changes are net negative. The one is an increase in the runoff factor for retail deposits. It's lower than what was expected, 2.5% runoff versus 5%, but still a negative for banks with high share of retail deposits.
Banks is one sector that's doing well. What's other also doing well is some of these consumption names, and they are flying around, and Colgate is one of them, 5% higher now on the stock, and that's after UBS upgraded the stock in today's trade. At the highest point of the day is Colgate. Of course, we'll be reporting results in the next few days, so keep an eye out on Colgate. 2670 on the stock, 5% higher at the day's highs. Take a short break. I have a chart check with Sachidanand Uttekar of Trade Bulls, some trading ideas on the other side, and of course how the setup on the FNO side looks as well. Stay tuned.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account. And you know, the person did not even kind of entertain me. So I went in chappals, and you know, as a student you go there and like, so kala, like, you know, come to like, and so on. And then after conviction, after some convincing, filled the form, 2 days, 3 days, like, you know, and opened my account. By the time you're like gone, like, you know, your interest is like lost. So the point was like you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, you know, in like low single digits. And now it is at like high single digits. Stocks used to be high single digit and it's slightly higher single digit. Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do like e-commerce, unregulated products. We will not do anything which is not good for the customer.
Welcome back. Well, markets holding with a fair shade of green, and this is very good, in fact, because you go by the overnight cues. You had US markets that are down. You know, they were struggling overnight. The globe as well is in a bit of a tizzy, but our market's holding rock solid, so that's good. And you know, what's been leading the way is the Nifty Bank. And I think it holds all the aces now. If the Nifty needs to drive on from here on, we'll have to see an even bigger move coming in from the Nifty Bank. So in the last 1 month or so, the Nifty is up close to around 4%. But you have the Nifty Bank that's up close to around 10%. And it'll have to lead the way from here on. One factor that's working in their favor, in the bank's favor, is that FIs are relatively underweight and bulk of their holdings is towards the banks and financials. So they need to come back, then they're going to be putting their money where they have, where they have lightened positions. So in the downtrend, we did see a lot of selling on banks, and now in fact that's fighting back. So 56,000 mark though on the Nifty Bank, that's the important mark. We almost went there today, and from there we pulled back close to 200 to 300 points or thereabouts. I think that 56,000 mark becomes a bit of a resistance zone, 56,000, 56,200. On the Nifty, what is encouraging is the buy on dips is working, and you have put writing. So the 24,000 put is fairly active. If you're looking at the support level, 23,800 on the way up was a bit of a resistance. So now that becomes a support, 23,800, 23,850. And you have the 24,000 put, you have the 24,200 put, both of them are pretty active in today's trading session. On the upside though, I expect the bears just in the near term to come in there and fight for the 24,300 to 24,350 level. Why is that? It's seeing a fair bit of activity in today's trading session. The markets are up, mind you, but the premium on the 24,200 call, well, it's lower, telling you there is some aggressive writing that we're seeing at that level. These contracts expire in the next two sessions itself, so that's an important mark. On the Nifty, 24,350, that's going to be a resistance. On the Nifty Bank, the 56,000 mark is an important resistance level that we're looking at. Let's welcome our expert, though. We have Sachidanand Utekar of Trade Bulls, who joins us on the show. Hi Sachi, good afternoon. Good to see you win. Who would have thought the Bulls are feeling so good, right? We went down to 21,700 and everyone was calling for lower levels, but the market has flipped it on its head. We have had a 10% rally from those levels, and on the Nifty Bank it's been even bigger. How do you trade the index?
Good afternoon, Nigel. Good afternoon, Hormoz. I think clearly the market momentum is very strong and very significant. In fact, the way Nifty, reached above that 23,900 hurdle with a gap, I think that is a very significant development within the progressing uptrend. If you look at the data from the options perspective, there's a clear-cut sign that 24,500 is something that can be seen during this particular expiry itself. We are expecting that this particular rally may continue towards 24,440, 24,500 thereabouts. Even if you look at the writing data, as you rightly said, 24,200, 250 looks like a decent base. So until unless we don't see a change in sequence on the lower side, the possibility of this particular momentum getting carried forward is quite high. Even if you look at the Nifty Bank data, which has been very significant, I think the developments from a price perspective are still indicating that this particular rally may extend its legs towards 57,160 thereabout, which may be seen in the in the coming series itself. So we are optimistic when it comes to both the indices. From a trading perspective, I think the Nifty is still giving us a better reward to risk opportunity. One can place a stop loss somewhere close to around 24,110 on a closing basis and look for a target of around 24,440, which can be achieved during this particular week itself. So we are looking at buying opportunities. When we look at the individual constituents which can drive this particular rally forward, we are looking at something like a Reliance, which has still not contributed so much. But if you look at the recent data, it is now challenging its 200-day exponential moving average, which is placed at around 1,300. The V-shaped recovery is very supportive, and if you look at the way its ADX is again moving, especially on the weekly charts, there is a possibility that Reliance may display a strong breakout move towards 1360. From a trading perspective, one can expect a swing towards 1325. Keeping a stop loss at 1274, one can add fresh long positions in Reliance. The second stock on our radar has been SBI. Now, if you look at the last two trading sessions, we have already seen a strong vertical rally in this particular counter. But if you look at the overall structure, it is a classic breakout from an inverse head and shoulder formation with a neckline which was placed somewhere close to around 780. If you look at the pattern target, it is placed somewhere close to around 880. So there is a good amount of headroom still available. From a trading perspective, again, the way the ADX has jumped above that 25 mark, it is a good sign that this ongoing momentum would continue. So even here, we are recommending, building long positions, keeping a stop loss at 818 on a closing basis. One can expect an immediate swing towards 856, followed by 880. Disclosure would be that we have recommended both these counters to our clients.
All right, Sachitanand, thank you so much for sparing time joining us today with your views on the index and on specific stocks as well. SBI, one of his recommendations up for the 6th day running today, target of 880 on the upside is still lower than the all-time high that the stock had made, which is around 912. But the Indian markets are relatively better placed compared to other Asian markets. However, valuations are still expensive, says Chetan Seth of Nomura. He also shares his views on the US-China trade war. Listen in.
I would just say that I think India looks okay from a regional context. Look, I look at Asia, ex-Japan markets, and literally you go market by market. There are challenges in pretty much every market. North Asia is clearly more trade exposed. So whether it's China, Korea, Taiwan, those markets have problems. Southeast Asian markets are too small for some of these markets. It'll be very difficult to strike some of those trade deals. And then we have India, which has very less trade dependency with the US, as well as other North Asian markets. And then, of course, there's a possibility of a trade deal coming through as well. That's not to say that stocks are out of the woods. I think it's going to be choppy. I think the market might also consolidate because at the end of the day, if let's say US equities is under pressure, the issue with India still is that we are at like 21, 22 times. It's not a cheap market. So stocks are not out of the woods. I think the US-China trade deal, which is the second one, I think it's going to be very difficult. At least my sense is that some of the issues which US has with respect to China, these issues cannot be resolved quite quickly. And the longer these issues last and we don't see any sort of deal or some sort of a compromise between these two large economies, it will also have impact on pretty much the global economy as well as global financial assets, I would say.
The Maharashtra government is facing heat from its own contractors who claim the state owes them a massive 89,000 crore rupees in pending dues. According to the Maharashtra State Contractors Association and the State Engineers Association, payments have been stalled ever since the launch of the Ladki Bahin scheme and other pre-poll promises in July 2024. The association say the dues span multiple departments, including the Public Works Department, Rural Development Department, and the Jal Jeevan Mission. Of the total amount, around 46,000 crore rupees is pending from the PWD alone. Despite the state government's claim, especially post-budget, that its finances are in order, the contractors argue otherwise, pointing to stalled development work and growing financial stress on the ground. They allege that payment delays and pendencies were already an issue before July 2024 with a 40% payment pendency. But since the launch of Ladki Bahin and other pre-poll schemes, the regular payment rate has dropped to barely 10%. As a result, work across infrastructure projects, including maintenance and repairs at Mantralaya and Raj Bhavan, has come to a standstill. Projects under PWD, Rural Development and Jal Jeevan Mission have also been halted. The contractors' body says workers are also suffering with only minimal payments being made to them to keep them afloat. They claim they have written 6 letters to the Chief Minister and Deputy Chief Ministers but received no response. Last week, the association held protest in Thane. They now plan to send one final letter to the state leadership before approaching the court to recover their.
Welcome back. And Interarc Building Solutions is the next management on the show. Now, the company has secured a 300 crore rupee order from a tire manufacturing company in Gujarat. We are now being joined by Arvind Nanda, who is the managing director of the company. Mr. Nanda, good afternoon. Thank you so much for joining in. Could you tell us more about this latest order win? If you could also share the name of the tire company from whom you have received the order. What's the timeline? How do you expect this 300 crore rupees to accrue onto your balance sheet and such details?
Thank you for having me on the show. Unfortunately, I'm not able to disclose the name because the company that we got the order from wants us to keep it under the wraps for a few days. It will come out very soon. It's a well-known company, and we have been working with this tire company for many years. The main difference in getting a very large order is that this company is setting up the full greenfield plant for a full tire manufacturing at one shot. We have done plant for a company called CEAT earlier, and of course other companies in the tire line. but invariably they build in phases. But I think the demand seems to be going through the roof for them, and they have decided to set up a full greenfield plant at one shot. So it's a 300 crore plus order. The execution will start sometime in June, July, and I think it should finish in 10 to 12 months. So partly it will accrue this year substantially, and some going in the next year. So it's a good order in that sense that normally pre-engineered building orders are not very long term. So this is like 12 months, which is a long-term order. And I think the biggest breakthrough for InterArc is to have secured the largest pre-engineered building order in public domain, at least that we have got. And we have broken that jinx that these large orders can be done in pre-engineered buildings and can be done by InterArc. So we are very happy about these two landmarks that we have achieved by getting this order.
So fair to say that some bit of it accrues into your P&L by the second half of this year, and then something spills over onto into FY27 as well. And what are the kind of margins that would you be enjoying on this order?
The margins are similar orders, have similar margins in the sense whatever is our expected margins. So it's not less. But invariably, because the larger orders are there, so they become more productive for us. Our work and effort involved in terms of engineering, design, even manufacturing, it doesn't come to the same. So invariably, the margins become better because our operational leverage in this business is pretty high. So we are expecting a good margin, much better than we would do on 10 orders of 30 crores or 30 orders of 10 crores. That's for sure.
So a larger value implying a larger margin, if you could say that, Mr. Nanda. But your margins did improve in the third quarter. They went up to around 9.5%, if I am correct, 9.6% from 8.7% that you did in Q3 of 24. What do you expect to end the year with in this quarter? Do you see double digits in the fourth quarter, or do you see double digits in FY26?
Well, we are in a silent period, so I can't give anything which is not already in public domain. In public domain, we had given out some figures which were higher than what the third quarter was as our expected target for the current year, and I think we will achieve it. And the next year, yes, because of capacity expansion also, and a lot of new orders coming in, the capacity expansion will enable us to take more orders. The market is doing very well. The shortage is not of orders, at least at our level where we have reached today. So I think the margins are only have one way, which is up, going up in the next year as well.
But since you're in a silent period, you can give us a yes or no answer as well, Mr. Nanda, that you had mentioned 2,200 crores annually by FY26 in terms of top line. You still maintain that, stick to that?
Yes, 20%. And then we had given a figure out that we'll double the 23 figures by 27-28, and we stick to that.
The current order book, Mr. Nanda, it was around 1,300 crores at the end of the third quarter. What does this order and some of the others that you may have won during the fourth quarter as well, what does the consolidated book figure stand at as of the March quarter?
Well, again, I'm not allowed to give that figure out. But yes, with orders like this, it substantially goes up. That's logical. Our turnover is also going up every quarter, so that consumes more of our order book. But I think the market, the way it has been and the way we have secured this order will definitely be a big add-on to our order book. Definitely.
So is there any such large order in the pipeline as well in the near future that you are bidding for or that you're expecting to win?
We are bidding for a lot of orders, not of this value, but a good substantial order nowadays is between 100 to 150 crores is pretty, I mean, we could be bidding for quite a few orders like that. Some of them will get finalized before we announce our results in the middle of May. Some may get later. But yes, we are bidding for quite a few. I would say a substantial number of 100 crore plus orders.
So you're expecting some substantial orders to come in before the mid of May, right?
We are.
Yeah. So how's your new facility that you just inaugurated in Andhra scaling up, Mr. Nanda? You had mentioned that around about peak revenue potential of around 550 crores for each of your facility. How is that facility scaling up, and what is the capacity utilization across the board as of now?
Well, the capacity in Andhra phase 2 is on line. I think it is to go into trial production in early May, mid-May, and then full production by early June. We have also adding capacity in North India plant, which we had added to our capacity expansion plan because of a lot of new business that we were seeing. That will also come into play by end of May, early June. So both are online at the last stages, literally. Then we are now planning our new capacity expansions, which we will announce as soon as they are finalized. But all the announced capacity expansion plans are online, and most of them will be in play by June latest. So they will contribute substantially.
So there are more capacity expansions on the anvil, right? Because you mentioned that there is no dearth of orders. You are expecting to win more. There is demand on the ground as well. So there is further capacity expansion that you are planning from what you are just about to finish.
Yes, absolutely. But in pre-engineered building, what happens is the capacity expansion has to be very people-oriented also. It is not only the factory, because we design engineer the building for the client. Our sales team has to be excellent in dealing with them. Then the project management at the end. So we have to put everything together. It's just not putting up a factory which solves your problem. But so we are working, at I would say super speed compared to what we were doing earlier. Primarily because we are seeing a lot of business, and I think the respect that we are getting in the market, the kind of confidence that the customers are having in us, I think it is up to us to scale up as fast as possible.
So where and what kind of expansion are you planning for, Mr. Nanda? If you could shed more light on that.
Well, we are finishing Andhra. As we said, the full Andhra plant will be in play. We are adding one more line in our North India Kicha plant. And then, as everybody is aware, we have bought land in Gujarat earlier. We are looking at some more land also to see where should we do the next phase, which we want to start building as soon as this capacity expansion is in place. So it is just a decision to be made. Where should we go? Close to one of our existing plants or to Gujarat for the next phase. But whatever it happens, will happen very soon.
So you have not earmarked any geography?
Yeah, West we have. Gujarat is very much on the anvil because Gujarat we already bought the land last year and it's in our possession now, and we are starting the development as well. So ideally it should be the West because we already have South and North substantial capacity. But because of the speed required, we are considering that it may be speedier to do it near one of our existing plants, because if you have a full team already sitting somewhere with people available and contractors available, sometimes it is faster, because now the speed has become also very important. That the faster we get into play, we don't want to miss this boom which is happening in the next 4 or 5 years, because if you miss out on that, then other competitors will take the business because companies are not going to stop setting up plants. And we are also trying to get into new fields like high-rise buildings. We are trying to get into data centers. So those are also very large areas of business which we are trying to get into. We are trying to build up an export market as well, which in volumes, of course, is not very great right now. It will take a year or two. But data centers and high-rise buildings are a very, very important business going forward for us. So we are trying to increase the speed that we can go by.
All right, Mr. Nanda, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of InterArc Building Products on the road ahead, and of course planning for more capacity expansion. The stock though is now at the lowest point of the day, a % lower as we speak. Take a short break, but before that, a small programming note for our viewers. CNBC-TV18 and HSBC India are back with season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. You can scan the QR code now and submit your entry for the SME Champion Awards season 2.
Association, which has been active for 25 years, represents 3 lakh contractors across 45 districts in Maharashtra. Each contractor reportedly employs 200 to 300 workers.
Banking money is really short-term saving deposits and some fixed deposits. And the average tenure of a bank deposit, banking system is about a year and a half. and you expect to fund the infrastructure over 7 years or a corporate loan over 5 years, you are sitting on a mismatch, whatever you say. So it will have to evolve.
To corporate CPs and bonds.
And really, if you look at the lay borrower, the retail borrower, his or her need is to repay every month, and that's what you are collecting. And then you are in sync, and you're repricing the loan maybe on a quarterly basis or half-yearly basis. So that is appropriate financing. Banks, I think, as they evolve, larger and larger part will be to the retail sector, because they are, as of now, best equipped, unless they are disrupted by a fintech. The corporates, large part of the corporate universe today, are cash positive. The cash flows are positive and can meet most of their growth needs. At the margin, they may have to borrow. Large part of infrastructure funding will come through a market process, which is outside the banking system. It's already happening.
Welcome back. Still 65 points higher on the Nifty, just below that 24,200 mark. But by the way, the Dow futures in the last few minutes have seen a very, very sharp acceleration from the lows. Now they are up almost 370 points as we speak, so indicating a bit of a rebound on Wall Street after the steep sell-off that was seen overnight. But time for our special segment, Midcap Microscope, where Nigel takes a closer look at FIAM Industries, a key player in the two-wheeler domestic market. Nigel takes us through that.
Well, today we're taking a closer look at FIAM Industries, a player in India's auto component sector. FIAM generates almost all its revenues domestically, and so it is relatively insulated from that trade tariff war. From around 130 crores of debt in FY19, they're currently sitting on no debt at all. In fact, the cash in its books is nearly 6% of its market capitalization. FIAM's revenue model is heavily tilted towards the two-wheeler segment, which contributes close to 97% of its top line. Honda and TVS alone, they are the two large clients, which account for more than 55% of its revenues. But Bajaj Auto doesn't feature in its client list. The automotive lighting business constitutes more than 70% of its total business. But there's been a shift towards LED lighting over the last few years, as the company is focused on the premiumization trend. Over 60% of its auto lighting revenues now comes in from LEDs, where realizations are nearly thrice of what they get in conventional halogen lights. Well, FIAM's revenue has grown steadily, from around 1,200 crores to around 2,000 crores in 2024. They have outgrown the two-wheeler market while maintaining margins in that band of around 12 to around 13%. The reason they can maintain their margins is because they're supported by strong backward integration, namely in the PCB manufacturing as well as in molding. Currently, the stock trades at roughly around 13 to 14 times its forward earnings. That's reasonable for a company whose return ratios are more than 20%. Well, growth is going to be the key monitorable. The company has a healthy pipeline of new projects, and rising LED penetration bodes well for them. There also could be additional growth levers in store. As time passes, they eye a higher exposure to the export markets. They're also looking to grow the four-wheeler business, as the company is now headed by Mr. Vineet Saini, who was earlier heading Lumax Industries. Well, the company, in fact, won some orders from Mahindra and Mahindra, and now they're looking to move up the value chain. They're looking basically at getting high-price orders. Well, before we wind down, we need to take on board some risk as well. Well, the promoter reduced stake a year or so ago, which led to higher institutional holding in the company, though this made some of their investors a little bit nervous. The company will also bear the brunt if there's a slowdown in the two-wheeler market, and we'll also need to track how they can scale their presence in the four-wheeler market as well as in the export market. Well, let's track this one and see if FIAM Industries can outshine the auto component sector.
We'll certainly look forward to that. Nigel, thanks a lot for that detailed breakdown on FEM Industries. By the way, Bajaj Auto and Hero MotoCorp are the two names where Jefferies has downgraded, and they have also cut their target prices on both of these stocks, and both of them trading with losses of anywhere between 1% and 3/4 and around 2.5%. Mind you, both of them have significantly corrected from their record high levels as well. Sudarshan is joining in with more on that. Sudarshan.
So Jefferies has today come out with a note on two-wheeler space, and it has downgraded Bajaj Auto and Hero MotoCorp, while it has maintained buy call on TVS Motor and Eicher Motors. Also, if you look at the sales numbers of last few months and even quarterly numbers, two companies that have been outperforming are TVS Motor and Eicher Motors, and while the underperformance has been coming in from Bajaj Auto and Hero. Now today Jefferies has downgraded Bajaj Auto to hold, and target is cut to 7,500 from more than 10,500, and for Hero MotoCorp it's a double downgrade. It's been downgraded to underperform, and target here is cut to 3,200 from 5,075. For Eicher, target is increased to 6,700, and for TVS Motor, target has been raised to 3,225 from 3,150 per share. Now, why it has been downgraded? Jefferies has given the reason of because of the lower volumes. Both Hero MotoCorp and Bajaj Auto have been underperforming and have been releasing lower volumes in comparison to TVS Motor and Eicher Motors, and that's the reason even EPS estimates for both these companies have been cut. For Hero MotoCorp, cut is in the range of 8 to 11%, while for Bajaj Auto, cut is in the range of 5 to 8%. For TVS Motor too, the EPS estimates have been cut, but now EPS estimate cut for TVS Motor has been offset by the PLI benefits that company will be getting. As of now, company is yet to report in its quarterly numbers about the PLI benefits, but whenever it comes, it will factor in, and it will PLI benefits will offset the lower volume impact that the TVS Motor will see. In the next few days, these companies will also report quarterly earnings, and we'll have to see in the last few months how these companies have performed. But for today, you can see the stock reaction. Both Hero MotoCorp and Bajaj Auto are under pressure, and while Eicher Motor and TVS Motor are higher in trade.
All right, Sudarshan, thank you so much for that detailed breakdown of Jefferies downgrading the two-wheeler names Bajaj Auto and Hero MotoCorp, but remain a buy on Eicher and TVS. Take a short break, more on the markets and on the other side. And of course, we put the spotlight on HCL Tech and its Q4 results later today. Stay tuned. Welcome back. A slight cool off from the highs, but still holding on to gains is the Nifty. 55 points higher is the index, currently at 24,180. The European markets have opened. They have opened with a negative tick, but better than what was feared across the street after the Wall Street sell-off that we saw overnight. The Stock 600 index currently trading 0.7% lower. The DAX has opened around 0.5% lower. The FTSE has opened just below the flat line. The CAC as well in France has opened with losses of around 0.4%. So it's a slightly negative start for the European markets, but not as bad as what Wall Street saw last night. And of course, there is some rebound signs on Wall Street as well, because the Dow futures currently are up around about 300 points. By the way, back to our own markets, then pull up Delta Corp. It's about to report results today, and that stock is zooming away at the highest point of the day now, ahead of its results, 7.5% higher on Delta Corp. So good going for that stock. And of course, some of the other names on the negative side include the likes of Cholamandalam, that is down 4.5%, which is the top loser on the Nifty 500. That's of course after CLSA downgraded the stock, citing expensive valuations. So 4.5% lower on Cholamandalam. Just Dial is giving up some of those gains that it saw yesterday after its results, so that too is trading lower by around about 3% in today's trade. Some profit booking coming at higher levels for Just Dial. Cyient is the other one, 2.5% lower there as well. Nykaa is down 2.5%. We spoke about Hero MotoCorp. So these are some of the losers, but some of the gainers today include the likes of Asahi India Glass, is bucking the trend today, almost 9% higher today, and Apar Industries too trading with healthy gains. By the way, just before we wrap, Dixon Technologies is now up 6% at the highest point of the day, nearing levels of 17,000 is Dixon Technologies. But with that, we call time on this edition of Halftime Report. From Nigel, me and the team that put this show together, thank you so much for watching. Business Lunch for the next 30 minutes.
Stocks firm up after a soft start with mid-caps leading the charge. Realty and FMCG and financials are the prominent gainers, while IT as well as power drags. RBI issues amendments to the liquidity coverage norms for banks, easing conditions for wholesale deposits even while tightening conditions for internet and mobile linked deposits and government security valuations. The move is seen easing liquidity for banks. India has imposed a safeguard duty of 12% on imports of flat steel products for 200 days to protect the industry from dumping by China. Industry leaders who had made clamoring for the levy hailed the move. 361 WAM and UBS have decided to partner on wealth management in India, with Indian partner gaining access to UBS's global economic system and buying its India business. UBS will in turn pick up a near 5% stake in the Indian wealth manager. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Today, we did see a bit of a blip that came in the markets at the morning. When you look at it, it went in the red. But now the Nifty has recovered and it is holding on to that green level that we've seen for the Nifty 50 as well. So 0.2% of gain as of now for the Nifty 50, managing to hold on to this 24,100 levels. 53-point uptick is what we're seeing. Nifty Bank up almost 0.7% in today's trading session. Obviously, yesterday also we had seen that banking names were in those gaining side, HDFC Bank, ICICI Bank, and bank today is also continuing to see a good move. Whether you look at PSU banks or the private banks, managing to hold on to good gains in today's trading session as well. Other than that, let's look at the mid and small cap. We're seeing a bit of an outperformance that's coming for the Nifty mid cap as well as the small cap. Nifty mid cap is up almost 1%, like you can see. Small cap also near that percent of gain that we're seeing coming in for the Nifty small cap. 152 points uptick over there. Top sectorial gainer today, we have the Nifty Realty that's managing to do well. So Realty names, whether you look at Anant Raj, that reported its numbers, so keep an eye out on that one. We had Purvankara, we spoke to the management as well in terms of the Q4 update, so that's something to watch out for. Other than that, real estate names like DLF, Brigade, managing to hold on to good gains in today's trading session. Let's look at Nifty IT. We've seen those IT numbers come in. Nothing sort of an excitement that I've seen so far in terms of earnings. So Nifty IT is among the top drags, coming in down 0.3%. We'll have HCL Tech that's going to be reporting its numbers today. So keep an eye out on the IT pack, and anything in sort of a commentary that we see coming in from these companies is going to be key to watch out for. Other than that, some of these other movers in today's trading session, specifically I want to highlight is Eris Life Sciences. That's the one that we should focus on as well. We're seeing some bit of an up move in that one. We're seeing SBFC Finance. That's another one. This is in the last hour of trading session that we're seeing a good up move coming in for these stocks as well. So that is something to focus on as well. And other than that, Domes Industries. That's the one that I'll keep an eye out on. But let's move on and get started with one of the important updates that came in today was 361 WAM. That's gaining in today's trading session, right? And this is coming after the company has announced a strategic collaboration with UBS. Now, as a part of this collaboration, 361 WAM will issue 2.05 crore warrants to UBS, and this is on a preferential basis, around 1,030 rupees per warrant, which amounts to a 4.95% stake. Now, these warrants can be converted into an equal number of equity shares within 18 months from the date of allotment. Earlier today, we also managed to speak to Karan Bhagat of 361 WAM as well as Jin Ye Yong, who is of UBS Global Wealth Management, to understand the strategy behind this collaboration and what is the future potential now comes in for both these companies.
I think most importantly what it gets to us is widening the platform for the client, and that's really what I think comes core to the culture of both UBS and 361, is to serve the clients in the best possible way. As a deep sign of I think collaboration, I think both UBS's investment into the equity warrants in the business, as well as our partnership in terms of, or our collaboration in terms of looking at the Credit Suisse and UBS business folding into our business, should add a lot of value to both our clients.
First of all, we want to bring this word global to the next level. So this transaction basically combines the global and regional reach capabilities of UBS, combining it with the reach and the capabilities of the local 361 India franchise. And this really, we believe that we are best placed to actually serve our global Indian clients, both domestically and also globally. That the wealth management, scene in India is really, growing at an exponential rate. And simply put, right, we really want to have a piece of the pie too. As you can see, these three components add together. We are really intertwining together our capabilities and making sure that we are able to serve our clients, global Indian client wealth management, in the most holistic way.
And moving on, the banking index, that is also at a record high level following a sharp rally over the past month that we saw. Now, Ritu is here to tell us what is fueling the banking rally.
Well, there's been a spate of positive developments for the banking system that could explain this rally in banking stocks. And at the heart of this is a regulatory environment that is turning more supportive under Governor Sanjay Malhotra. Now, the central bank has deferred tighter project finance norms and also provided banks more time to comply with these new LCR requirements. And that is signaling to the street a pro-growth and pro-liquidity stance. This shift has also boosted street confidence, and adding to the momentum, systemic liquidity has also flipped into surplus after a 4-month deficit. RBI injected nearly 15.5 lakh crores in the system in recent months, whether that is through OMOs, VRRs and forex swaps as well. Now, while the recent 50 basis point rate cut will weigh on the bank NIMs, it is aimed at squarely boosting credit demand and economic growth, which is also positive. CRISIL also expects credit growth to rise by 200 basis points this fiscal, helped by these tailwinds to about 13 to 14%. Now, the strong show by large banks like HDFC and ICICI Bank in their fourth quarter has also helped boost sentiments to some extent. Now, on the regulatory front, the latest LCR relaxations are a big positive because compared to the earlier proposals, the final norms are more lenient and are expected to improve the aggregate LCR of banks by 600 basis points and free up to 3 lakh crores of lendable resources, potentially lifting overall credit by about 1.5% as per ICRA estimates. Now, RBI has also lowered risk weights on bank lending to NBFCs and MFIs, and that could free up an estimated 40,000 crores of capital, creating 200 basis points of additional lendable capacity as per Macquarie. Co-lending norms, they've also been expanded to include all sectors and regulated entities, and even priority sector norms have been revised, enhancing loan limits and broadening the scope overall for renewable energy and housing credit. So put together, it is a combination of the ample liquidity, regulatory easing and strong earnings that's fueling this banking rally that we're seeing. But that said, keep in mind, not all concerns are off the table. Deposit and credit growth momentum remains a key watch point, and there are still lingering concerns about asset quality issues in unsecured loans as well as the microfinance segment.
Okay, Ritu, thank you so much for that. We'll surely be keeping an eye out on more updates coming in there as well. But moving on to sources, what they are saying, they're telling CNBC-TV18 that the government is now eyeing ways to restrict money laundering through online gaming platforms. Tim C is joining in with us to give us more details on this front. Tim C.
Well, in a bid to ensure that the government is able to break the nexus of money laundering via online gaming platforms, sources have told CNBC-TV18 that the government is likely to consider some serious measures in this regard, which includes to propose mandatory registration of the online gaming platforms with the Financial Intelligence Unit. Sources in the know of the development shared with CNBC-TV18 that interministerial consultations are underway on mandating FIU registration for online gaming platforms, which includes discussions between the PMO, MHA, Revenue Department, MeitY, ED and CBDT, which have favoured for this mandatory FIU registration for the gaming platforms. Sources further say that with this move, the government aims that both onshore and offshore online gaming platforms will be easily scrutinized, and it will help the government to keep a tab on the funding and the source of funding that is coming or going out through these platforms. Sources also claimed that the government, if this proposal goes through, will be able to manage to book offshore gaming companies under PMLA in the case of violations. Meanwhile, an email query sent by CNBC-TV18 to Finance Ministry in this regards remains unanswered. Also, just to remind our viewers that The country's Financial Intelligence Unit operates under the aegis of Revenue Department under the Ministry of Finance and is responsible for collecting, analyzing and disseminating financial intelligence and suspected financial transactions. Now, to be seen is whether the proposal goes through or not and whether this registration actually comes through the light of the day. Back to you.
Okay, Timsy, thank you so much for that. Now, on that note, we're going to slip into a very short break. When we return, we get you a whole host of global updates, including President Trump's latest comments on the Fed chair. Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj.
Welcome back. Thanks for staying tuned into Business Lunch on CNBC TV18. Now let's move on. And Donald Trump is reported to be studying whether to remove the Federal Reserve Chair, Jerome Powell, and who he says has been too slow to cut rates. The news has jangled nerves on the markets, but does the US president have the power to sack the Fed boss? Take a look at this report.
Donald Trump wants rid of Jerome Powell. He blames the Federal Reserve Chair for being too slow to cut rates and says his termination cannot come soon enough.
If we had a Fed chairman that understood what he was doing, interest rates would be coming down too.
Trump's advisors say they are studying whether to oust Powell before his term ends next year. But can a US president fire the Fed chief? The short answer is no one seems to know for sure. White House economic advisor Kevin Hassett says Trump's team is studying the question. He suggested there may be new legal analysis on the matter, though it wasn't immediately clear what he was referring to. Powell himself says the president has no power to fire him, and he won't go even if Trump tells him to. The Federal Reserve Act of 1913 says he cannot be dismissed for disagreements over policy. But all eyes are on a case now at the Supreme Court, looking at whether Trump overreached in firing 2 Federal Labor Board members. That could set a precedent for the Fed too, though Powell thinks not.
I don't think that that decision will apply to the Fed, but I don't know. It's a situation that we're monitoring carefully.
Stocks have fallen again as Trump ramps up his standoff with Powell. Investors are concerned that ousting the Fed chief, or even trying to, could undermine the bank's status as an independent, objective decision maker. Traders worry that policymakers could be pushed to cut rates, potentially fueling inflation. Brian Crowes is president of Scharf Investments.
If politics starts getting into monetary policy, you now, as a foreign investor, even a U.S. domestic investor, can't necessarily trust that your interest as a bondholder will be respected. And so that's a potential risk for the dollar and a potential risk for interest rates.
Those fears show up in the foreign exchange markets, with the dollar now at multi-year lows against other currencies. Even if Powell is pushed out, Trump may not get his wish for lower rates. The Fed structure would give remaining board members and regional bank presidents the power to set policy. If they resisted making cuts, Trump would then have to decide if he wants to assault the central bank as a whole. That's a move that would be very unlikely to soothe markets.
On that note, also listen into more reactions to Donald Trump's comments that are coming in. Now, Evercore ISI's Vice Chairman Krishna Guha said that any attempt by Trump to fire Powell would likely trigger a steep sell-off in the U.S. equity markets. Listen in.
It is clearly in the conceivable set. It's something that we have to take seriously, as a risk, and I think a serious risk to markets. I think we're already seeing, like right here and now, in the equity futures, in the dollar, in the bond yields, we're seeing a clear signal from the market that it doesn't like even the idea that the president might try to remove the Fed chair. There's been some loss of confidence in U.S. economic policy making in recent weeks. We've seen that in this very odd combination of upward pressure at times on longer-term bond yields combined with a weaker dollar. That suggests global investors pulling capital out of the U.S. You've seen those inflation expectations well behaved, well anchored. And that's what will eventually allow the Fed to be able to cut rates when we get to the point that unemployment has increased materially. But if you start to raise questions about Federal Reserve independence, you are raising the bar for the Federal Reserve to cut. If you actually did try to remove the Federal Reserve chairman, I think you would see a severe reaction in markets with yields higher, dollars lower, and equity selling off. I can't believe that that's what the administration is trying to achieve.
Also, Roger Ferguson, former Federal Reserve Vice Chairman, also warns that attacks on Fed's independence and trade policies may harm U.S. market stability. Listen in.
Obviously, as with most people who have been following the independent central bank for years, I do not think these attacks should be happening. You just played a piece from my friend Austin Goolsbee, the president of the Chicago Fed. I agree with him wholeheartedly. It is unwise to call into question the independence of the Federal Reserve System, as it is to call into question the independence of any central bank. We've learned that credibility at the central bank is critical to exercising monetary policy and to creating, trust and confidence in the U.S. economy. We've already seen, international investors call into question, perhaps, the stability and reserve currency nature of the dollar. It is unusual to have equity markets down and the dollar go down as well. Normally, when equity markets are down, individuals look for dollars in order to buy, the fixed income, the riskless asset that the U.S. offers in terms of our treasuries. There's been less of that of late.
And the latest CNBC All-America Economic Survey shows that a majority of respondents view President Trump's sweeping tariff policies as damaging. CNBC's Steve Leisman breaks this down for us.
A plurality of Americans think across-the-board tariffs are a bad idea, with most believing they'll hurt jobs and be worse for inflation. And the public is having a hard time believing there's a payoff at the end of the process. The CNBC All-America Economic Survey finds 49% of respondents say across-the-board tariffs are a bad idea, with 45% feeling strongly about it. 35% support them, and 15% are undecided. So there is some scope for the president to gain some support. Among those most negative on tariffs are Democrats, African Americans, 18 to 34-year-olds, and those Americans living in the urban environment. Most positive include Republicans, rural dwellers, those with income above $100,000, and men 50 and older. Majorities think tariffs hurt importers, the cost of everyday goods, the overall economy, and workers. But by 51 to 37%, Americans say they'll help companies producing in the U.S. Americans have also not embraced the president's concern about our allies representing an economic threat to the U.S. Mexico, Japan, Canada, the EU, and the UK are all overwhelmingly seen by the public as more of an economic opportunity than an economic threat. Only China is seen by Americans as more of a threat, but by a modest 44 to 35% margin. It remains to be seen whether it matters if President Trump is out of step with the broad public on tariffs and trade. The president's base backs him on tariffs, believing his policy will yield results over time. But their tariff support is 20 points below his overall support. Democrats overwhelmingly disapprove of tariffs, as do independents, by a 2-to-1 margin. Steve Leisman, CNBC Business News.
Okay, on that note, we're going to slip into a very short break. But as we slip into the break, here's some good news coming in for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or scan the QR code on your screens.
Time on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day.
Welcome back. Thanks for staying tuned into Business Lunch on CNBC-TV18. I just want to mark the flashes at the bottom of your screen. Sources are telling our sister channel, that CNBC Awaaz, that government is looking to relax norms for AC and fridge companies. Relaxation of BIS norms possible on import of AC compressors. Now, this BIS norms also, there's going to be a relaxation for AC compressors with capacity which is going to be of less than 2 tons. Now, on the back of that, we've seen all these stocks that are buzzing in trade. The AC stocks, Blue Star, Havells, Voltas, all of them seen a spike up coming in the trading session as of now. So yes, something to watch out for and where that's going to be headed as well. But let's move on, and we have more updates that are coming in from the visit that is of US Vice President J.D. Vance on his family. And what is the latest update coming in from Jaipur? Vance and his family visited the Amer Fort and are expected to visit Hawa Mahal before addressing a gathering at 3 p.m. today. Parikshit is joining in with us from Jaipur for more details on this one.
After completing the Delhi leg of his India visit, US Vice President J.D. Vance and his family arrived in Jaipur. They're staying at the famous Rambagh Palace and they visited the Amer Fort a short while back. You could see their pictures touring the fort and they were welcomed in a traditional Rajasthani way with elephants and Rajasthani folk dancers at the Amer Fort. The big headline coming out of the Vance visit so far is on the trade front, with both J.D. Vance and Narendra Modi announcing the finalization of terms of reference for the bilateral trade agreement. According to USTR Jamieson Greer, this sets the roadmap for the negotiations and sets the road for a positive, mutually beneficial trade agreement between India and US. However, he said there is a serious lack of reciprocity in trade on the Indian side. He said that US companies face not just tariff and non-tariff barriers, but also lack of market access. There are issues related to standards and regulations in the agriculture sector, and all of that needs to be addressed in a holistic manner. He also said that there is a $45 billion trade deficit that needs to be reduced. The average applied tariff of US is only 3.3%, whereas the average applied tariff of India is as high as 17%. All of that needs to be brought down, and there needs to be parity in the trading relationship and an equal level playing field for American companies. He also said that there is a need for US to secure some long-term benefits, which could imply US is looking for long-term energy contracts and defense contracts as well. So while the Vance visit is a pivotal one, an important one in the ongoing trade negotiations, the two sides are yet to resolve some of the outstanding issues such as agriculture and dairy and market access issues.
Thank you so much for that, Parikshit. But let's move on. And Prime Minister Narendra Modi has departed for Saudi Arabia, where he will discuss trade, investments, energy and defense cooperation with the Saudi delegation. The two countries are expected to finalize several agreements to bolster cooperation. PM Modi and the Saudi Crown Prince Mohammed bin Salman are also going to co-chair the bilateral Strategic Partnership Council meeting. Modi will be the first Indian Prime Minister to visit Saudi Arabia in the last 40 years. And tributes are poured in from across the world to mark Pope Francis' death. India has declared a 3-day state mourning as a mark of Sanch at CNBC-TV18. Thank you so much for tuning in. Up next, you have Midcap Radar.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account.
Huh.
And the person did not even kind of entertain me. So I was in chappal, and as a student you go there and so kala come to and so on, and then after conviction, after some convincing, fill the form. 2 days, 3 days, and open my account. By the time you're gone, your interest is lost.
Yeah.
So the point was you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do e-commerce, unregulated products. We will not do anything which is not good for the customer.
As we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I would just say that I think India looks okay from a regional context. Look, I look at Asia, ex-Japan markets, and literally you go market by market. There are challenges in pretty much every market. North Asia is clearly more trade exposed. So whether it's China, Korea, Taiwan, those markets have problems. Southeast Asian markets are too small for some of these markets. It'll be very difficult to strike some of those trade deals. And then we have India, which has very less trade dependency with the US, as well as other North Asian markets. And then, of course, there's a possibility of a trade deal coming through as well. That's not to say that stocks are out of the woods. I think it's going to be choppy. I think the market might also consolidate because at the end of the day, if let's say US equities is under pressure, the issue with India still is that we are at 21, 22 times. It's not a cheap market. So stocks are not out of the woods. I think the US-China trade deal, which is the second one, I think it's going to be very difficult. At least my sense is that some of the issues which US has with respect to China, these issues cannot be resolved quite quickly. And the longer these issues last and we don't see any sort of deal or some sort of a compromise between these two large economies, it will also have impact on pretty much the global economy as well as global financial assets, I would say. I would just say that it's going to be choppy. It's going to be volatile. Incrementally, news flow, at least on the tariff front, might be positive, but that does not mean that we are out of the woods, because in the end, I think the market will very intensely scrutinize how the US data, hard data, will emerge in the months ahead.
On a normal day, you would take 65 points as a quiet trading session, but when it comes on the back of 5 straight days of gains, you would still be very happy about it. You're watching Midcap Radar live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Patakia. With me, as always, is Vivek Iyer. Vivek, good afternoon. Well, 6th day of gains, a slight cool off from the highs of the day, but of course, the Nifty Bank making new highs and the broader markets continuing to do what they are.
Absolutely right. Good afternoon, Hormas. Hormas, coming to trade today, you wouldn't have been surprised, at this point of time if you had seen markets in the red, given the kind of weak handover we got both from the US as well as Asian markets. All of them quite muted, but despite that, Indian markets have seen, open very subdued, but they've seen quite a sharp recovery. In fact, the mid-cap and the small-cap indices, both of them trading firmly in the green. But we have quite a lot lined up on the show, management interaction as well. So let's start off with the top headlines. Stocks firm, with mid-caps leading the charge. Realty, FMCG and PSU banks are the prominent gainers, while IT drags.
Gandhar Oil Refinery has surged after announcing an MOU with the Jawaharlal Nehru Port Authority for development of the Vadhavan Port Terminal. The estimated investment for the project is nearly 1,000 crore rupees.
Shares of solar energy equipment manufacturing companies Premier Energies and Waaree Energies surge after US imposes anti-dumping duty on imports of solar equipment from 4 Southeast Asian countries, Malaysia, Cambodia, Thailand as well as Vietnam.
Cholamandalam Investment has seen a dip of over 4% after CLSA has downgraded the stock to a hold rating with a price target of 1,600 rupees, with the expectations of growth tapering off and higher valuations. Meanwhile, RBL Bank is under pressure after almost 4% equity changed hands in a block deal. Sources have said that told CNBC-TV18 that British International Investment is the likely seller in this clean-out trade.
Mahindra Logistics in focus after its Q4 numbers. Revenues higher by 8% while EBITDA surges over 37% on a year-on-year basis. Meanwhile, Hemant Sikka, who was the president of farm equipment business at M&M, has been appointed as CEO of Mahindra Logistics. Welcome to Midcap Radar. Well, no, it's actually a green screen that you can see, and especially in the last 15 to 20 minutes of trade, post a news break by our colleagues at CNBC Awaaz, AC manufacturing companies have seen quite a sharp spike. Names like Voltas, Havells, Blue Star, all of these stocks doing quite well in the session. But Hormas has stepped over to the wall, and Hormas has quite a few mid-cap stocks on his radar. Hormas, over to you. What are the top buzzing names in the broader end of the market?
Again, a green screen, and again, it's very difficult to find losers in a market like this, particularly when the advance decline is firmly in favor of the advances. So we will start off with some of the gainers in the broader markets today, and Apar Industries is one of them, 6% higher at the highest point of the day. Asahi India Glass and Data Patterns has seen a very sharp surge in the last few minutes, 6.5% higher on that stock as well. And there is no stopping Dixon Technology, 6% higher, nearing the mark of 17,000. There are plenty of newsmakers as well in today's trading session, particularly the 2 solar module manufacturing companies, Premier and Waaree. Divergent charts for both of them. Premier opened higher and has now cooled off. Waaree cooled off from the opening highs earlier and has now surged to the highest point of the day, 6.5% higher there as well. Colgate after the upgrade from UBS, and 361 WAM, of course, after the deal with UBS, doing very well for itself in today's session. Real estate as a pocket has done well today, is the top sectoral marginal gainer. Phoenix Mills, Oberoi, Prestige Estates, all at the highest point of the day, gains of anywhere between 3 to 5%. Stocks doing well on the back of strong volumes in today's trading session. UTI, AMC, the capital market names continue to do well. SJVN, Aarti Industries also surging in today's session on very strong volumes. And lastly, stocks that have made new highs in today's trading session include the likes of J&K Bank, Krishna Medical, JK Cement. Of course, these are broader market names. Of course, a lot of large cap names too making new highs in today's session. But at the highest point of the day is JK Cement and J&K Bank making new highs in today's session, Vivek.
Well, thank you so much, Harmaz. I've noticed that in the last couple of trading sessions, Harmaz doesn't really have too many laggards. The screen is green even in the broader end of the markets. But it's a good time to welcome Srikanth Chauhan from Kotak Securities for a technical check on the market. Thank you so much, Srikanth, for joining us. First up, Bank Nifty continues to hit new highs. Do you see strength continuing there? And what are the levels on the Nifty that you're looking at?
Good afternoon, Vivek, Harmaz. Yeah, I think still Bank Nifty has broken its previous high, and it's a sector-specific index. So most of the time, whenever we see a very strong pullback in the market, we see some activity or specific activity in any sector-specific index. So this time, Bank Nifty is doing well, and it has broken its previous high. So based on its technical formation, we may see the levels of minimum 57,500 and maximum could be 58,000. Because most of the time, whenever any index crosses its all-time high, we see at least 7 to 10% sort of rally in the market. So based on that, I'm expecting Bank Nifty to move towards 60,000. And the strategy should be to buy if there is any correction in Bank Nifty. Again, we may see some retesting of the previous high of 54,500. So that could be the next the possibility. If there is any correction, then there we should look for taking some position. For Nifty, it is very close to its immediate highest level of 24,250. So there I am expecting Nifty to spend some time, and 24,000 is now going to act as major support. So for next few days, Nifty to remain within the range of 24,500 and 24,000. So accordingly, we have to design our strategy.
There'll be some landmark 60,000 on the Nifty Bank. That is almost a 13,000 point move from the lows of March that it made around 47,700. But Srikanth, good afternoon. Thank you for joining in. And do banking stocks feature in your list since you expect the Nifty Bank to hit levels of 60,000 in the near future? What are your stock recommendations for the afternoon?
Yeah, Urmas, afternoon. I think, see, Bank Nifty, I mean to say all these private banks, they are moving up gradually. So we have not seen any euphoric sort of trend in banks. They are moving up gradually. ICICI Bank, Axis, they are very close to their previous highs. HDFC Bank has already crossed its previous high, but State Bank is still far away from its recent immediate highest level of 900 something. So I am of the view that still from here, State Bank can move to the next levels of at least 900 or 920. Currently, it is around 825, 830. So from here, we need to take a positional view on the stock and create long position accordingly. But specifically, if we go through with some mid-cap stocks from the BFSI space, then in that space, we like Union Bank, which is currently trading around 129. And if we go through with its technical formation, then it is indicating us that the stock is again heading for the levels of 150 or 160 in the near term. So it's a buy at current levels. And the other stock which we like is Paradeep Phosphate. There also, if you see the technical pattern, then it's a rising top, rising bottom sort of formation. But on a weekly and monthly basis, the stock has formed V-shaped recovery. So based on that, the stock can go to the levels of 170, 175 in next few weeks or months. So it will take some time, but it's a positional buy at current levels.
Okay, thank you so much, Srikanth, for joining us, giving us a view on the markets as well, just stock-specific views or stock-specific calls. Time now for a short break. Amit Mahajan from Paris Defense joins us on the other side to discuss the operational update, recent announcement, as well as FY26 outlook. Welcome back to Midcap Radar. Well, as promised, Paras Defense is the company on our radar after the company announced that it will build India's first indigenous magnetic resonance imaging machine as part of a consortium spearheaded by the Society for Applied Microwave Electronics Engineering and Research. Amit Mahajan, Director of Paras Defense, joins us now to discuss this and more. Thank you so much, Amit. We have you frequently on the show, and we generally quiz you about numbers. This time around, first up, what we want to understand from you is what is the exact nature of the announcement? Who are you partnered with? What is your share in the partnership? And what is the scope of this partnership that you potentially have?
So firstly, thank you so much for having me on this show. It's always a pleasure to interact with you. Yes, we usually discuss on different topics, and I'm very, very pleasantly surprised that we're talking about medical equipment, that too a very, very unique one, unlike the defense and the space that we always discuss. So yes, Paras was very, very fortunate that we were considered as one of the consortium partners when Samir floated a requirement for MRI machines. And the reason why Paras also got interested into something like this is because one, we are doing a very, very critical technology in the medical domain, all right, but for the first time in India, right? This technology, if you see worldwide, is also handled by very few companies. And the reason for that is the complexity of this particular technology. This is something that excites Paras. When Samir, who is an existing, you can say, government organization partner in a lot of development that we do, when Samir contacted us, we felt that yes, there was a need for expanding our critical development capability beyond just defense and space, and also assist the self-reliance in MRI technology. And hence we got into this particular domain. The magnet manufacturing comes very close to our capability, where it involves very, very precision manufacturing and precision integration. And hence we chose magnet. Magnet becomes one of the most critical part of the MRI machine, and that's where we are.
Amit, good afternoon. Thank you for joining in. Since we are on this subject, we have to talk numbers, can't not talk about it. But what is the revenue potential that you're expecting from this product, and the likely margins that you're set to enjoy from the supply of this?
So the good part is the Mighty is on board. Samir is a part of Mighty. And they have been extremely industry friendly when it comes to this particular technology. They have already requested the ministry and the government that the consortium should get some amount of business visibility once they develop this particular equipment. The first equipment will be put on for trials, and no sooner it gets successful, the consortium should get an X amount of business. Now, I don't want to get into how much of that business, because that itself is a good amount. But if you look at the global business and the Indian requirement, it runs into hundreds of $1 million per year. And today it is only an imported machines market. So you can imagine, not only we are making this particular product, rather indigenously developing this particular product, but also we are making it cheaper, which means today, say an XYZ imported machine cannot be afforded in tier 3, tier 4 cities. They will be able to afford this, increasing the market, and then also, doing everything in-house here in India. This will open up floodgates. I am talking about hundreds of MRI machines to be delivered every year. Each MRI machine will yield the consortium, if I have to say as a whole, a PAT of more than 30%.
Okay, a PAT margin of 30% is what you're targeting for each machine. You don't want to give an exact number as far as what could be the opportunity size. Okay, we take that on board. Amit, we want to understand one thing. You are largely present as far as the defense space is concerned, as the name of the company itself suggests. So what is it that you see as overlapping when it comes to the digital MRI space, when it comes to the medtech space? Why foray into a different line of business? And would you have, or have you seen any pushback from the board in terms of entering into a different line of business, any capital allocation feedback that you've received?
The only reason why, like I mentioned to you, we do not have a long-term strategy of completely having a medtech vertical. But the reason why we are into this is we are extremely responsive towards our customers' needs. If a customer sees a particular capability of ours, which can be exploited to create something which has never been created, and we are extremely responsive towards something which has never been attempted. That's the trigger point when we got into something like this. Now, looking at the larger picture, you see MRI machine is a classic blend of electronics, the blend of mechanical, blend of RF, and blend of an precision integrated equipment. Now, when you look at this, the capabilities are exactly similar than what we are delivering to defense as well as space. So we being a part of the MRI consortium is not a surprise, for the reason that the capabilities that are required to build an MRI machine, we already have in-house.
Right.
The thing is, we never looked at that dimension.
Right. Thank you so much, Amit, for joining us, talking to us about the latest foray that you've made, and we wish you all the best. We'll get you on the channel once again post Q4 results, where we will definitely quiz you on the numbers. But moving on, we'll now focus on a very important news break from our colleagues at CNBC Awaaz. The focus is on the air conditioner companies. Now, sources have told CNBC Awaaz that the government is looking to relax BIS norms for AC and fridge companies. Alok Priyadarshi, our colleague from CNBC Awaaz, now joins in with exclusive details. Over to you, Alok.
Yes, with the upcoming heat season in the May and June, there is anticipation that the AC and fridge manufacturing companies may face short supply of major components, important components which are imported, like fan motors, PCBs, AC compressors, and all the other items. That is very less manufacturing in India, and most of the items are imported items. So the government is first we come to know from the sources that the government is going to relax the BIS norms as far as the less than 2-ton capacity of the compressor is concerned. So this will ease the demand for the AC manufacturing companies. And secondly, the already which is joint venture companies which are manufacturing with the Indian companies, they may be given boost under the PLI scheme, so that the fan motors and other items which is very critical to manufacturing of AC and fridge may be ramped up. And thirdly, the PLI scheme which is going under already in white goods segment, maybe the investment may be cleared as soon as possible, so that in the summer season the AC and fridge companies may not face short supply of the critical AC component which are mostly imported from the China and other countries.
All right, Alok, thank you so much for getting us this exclusive news break from CNBC Awaaz, and it's showing up in the price as well. There's a sharp spike in all of these AC manufacturing companies, be it Blue Star, be it Voltas, although they have cooled off slightly from the highs, but still trading with gains of anywhere between 1.5% to 2.5%. Take a short break, but as we do that, here's some good news for our viewers. India's business news leader, now that's just a click away, and that is CNBC TV18's all-new app, which gets you breaking news, in-depth articles and financial world updates at your fingertips. You can download the app from the Apple Store or the Google Play Store, or you can even scan the QR code that comes up on your screen to download the app. Take a short break, back on the other side.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account.
Huh.
And the person did not even kind of entertain me. So I went chappal, and as a student you go there and So come to and so on. And then after conviction, after some convincing, fill the form. 2 days, 3 days, and open my account. By the time you're gone, your interest is lost.
Yeah.
So the point was you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do e-commerce, unregulated products. We will not do anything which is not good for the customer.
Welcome back. Some earnings reactions then. Mahindra Logistics and Pitti Engineering, both of them have seen a surge today after in reaction to their quarterly results. Rhea is here with more on that.
Well, both of these stocks are reacting positively to their Q4 earnings. First up, for Pitti Engineering, the net profit saw a decline of around 22% over the previous year. But if you look at the revenue and the EBITDA, revenue went up by around 40% over the previous year, and the EBITDA also saw an increase of around 55% over the previous year. They've also achieved their highest ever consolidated annual revenue, EBITDA and net profit in FY25. If you take a look at the sales volume, that has increased by over 50% on a year-on-year basis in Q4 of FY25, and the sales of the key segment for this company, loose laminations and value-added assemblies, are also up over 26% over the previous year. Moving on to Mahindra Logistics, we saw a very strong set of numbers coming in for Q4. The net loss has narrowed to 7.8 crores versus a loss of 12.9 crores that we saw in Q4 of last year. The revenue was also up around 8.2%, which was driven by robust performance in the 3PL contract logistics segment, in new service offerings and strategic account additions as well. They've also appointed Hemant Sikka, who was the president of the farm equipment business, as the CEO of Mahindra Logistics. Now, Motilal Oswal has said that the operational performance for this company was largely in line with their estimates. The order intake has remained strong and volumes have also picked up in the B2B express business, but the express business still continues to struggle due to pricing pressures and client churns. Going forward, the company is targeting a revenue growth in mid to high teens and an ROE of 18% by FY26.
Thank you so much, Ria, for joining us and putting the spotlight on two important results that came in post-market hours yesterday. Stocks reacting to both of those numbers. Well, it's now time for our special segment, Mid-Cap Microscope. Nigel takes a closer look at FIAM Industries, a key player in the two-wheeler domestic market. Over to you, Nigel.
Well, today we're taking a closer look at FIAM Industries, a player in India's auto component sector. FIAM generates almost all its revenues domestically, and so it is relatively insulated from that trade tariff war. From around 130 crores of debt in FY19, they're currently sitting on no debt at all. In fact, the cash in its books is nearly 6% of its market capitalization. FIAM's revenue model is heavily tilted towards the two-wheeler segment, which contributes close to 97% of its top line. Honda and TVS alone, they are the two large clients, which account for more than 55% of its revenues. But Bajaj Auto doesn't feature in its client list. The automotive lighting business constitutes more than 70% of its total business. But there's been a shift towards LED lighting over the last few years, as the company is focused on the premiumization trend. Over 60% of its auto lighting revenues now comes in from LEDs, where realizations are nearly thrice of what they get in conventional halogen lights. Well, FIAM's revenue has grown steadily, from around 1,200 crores to around 2,000 crores in 2024. They have outgrown the two-wheeler market while maintaining margins in that band of around 12 to around 13%. The reason they can maintain their margins is because they're supported by strong backward integration, namely in the PCB manufacturing as well as in molding. Currently, the stock trades at roughly around 13 to 14 times its forward earnings. That's reasonable for a company whose return ratios are more than 20%. Well, growth is going to be the key monitorable. The company has a healthy pipeline of new projects, and rising LED penetration bodes well for them. There also could be additional growth levers in store. As time passes, they eye a higher exposure to the export markets. They're also looking to grow the four-wheeler business, as the company is now headed by Mr. Vineet Saini, who was earlier heading Lumax Industries. Well, the company, in fact, won some orders from Mahindra & Mahindra, and now they're looking to move up the value chain. They're looking basically at getting high-price orders. Well, before we wind down, we need to take on board some risk as well. Well, the promoter reduced stake a year or so ago, which led to higher institutional holding in the company, though this made some of their investors a little bit nervous. The company will also bear the brunt if there's a slowdown in the two-wheeler market, and we'll also need to track how they can scale their presence in the four-wheeler market as well as in the export market. Well, let's track this one and see if FIAM Industries can outshine the auto component sector.
Nigel, thanks a lot for that. FIAM Industries on our mid-cap microscope. With that, we call time on this edition of Mid-Cap Radar. We leave you with the indices still holding on to some gains. The Nifty up 50 points, the Sensex up around 200, and the Nifty Bank still nearing levels of 56,000. From Vivek, me and the team that put this show together, thank you so much for watching. MF Corner on the other side.
Hello, good afternoon. You've tuned into MF Corner on CNBC TV18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Now, today what we're going to be discussing is actually we're going to be solving all your queries that you all have sent us on mutual fund related, whether it's what to invest in, what mutual funds are looking attractive, or if you all have any other investment doubts in mutual fund. And to solve all those queries today, we have our expert joining in with us. We do have Mr. Suresh Sadagopan, founder of Ladder 7 Wealth Planners, joining in with us to solve all those queries. Thank you so much, Suresh, for joining in with us this afternoon on CNBC TV18. It's a pleasure having you on the show. And, you know, given this volatile time, we have a whole host of queries, so I want to cover as much as we can. And I'll get started with the first query for today. We have Sailesh Singh, who's writing to us from Ahmedabad. He's saying that he's been a regular in terms of investing, and he's invested in many mutual funds, and especially through SIPs. Now, this is mainly with the goal of retirement, which is still 6 years away. So he has investments in multiple funds, as you can see on the screen as well. Wants to exit from Mirai Asset Large as well as large and mid-cap fund, and there's a Mirai Asset large cap fund as well, which he's invested in, and he wants to exit from this. What is your advice? Which fund should he exit? What is your understanding that comes in as well? He has a whole host of other funds as well, like DSP, Nifty 50, Equal Weight, Motilal Oswal, Nasdaq 100 FOF, Parag Parikh, Flexi Cap, as well as SBI Small Cap. Your view on this, Suresh?
So for anybody who has put together a portfolio, I think it has been a proper calibrated approach towards putting together the portfolio. So if I assume that these portions of the portfolio have been put in place and only is worried about this Mirai Asset large cap and Mirai Asset large and mid cap. So if you're only worried about that, I can suggest probably a balanced advantage fund. Considering that he is 54 years old and his portfolio seems to be largely in terms of equity-oriented fund, and I mean, even across the board, including international and even small cap. So I'm suggesting balanced advantage fund at this point in time. I mean, it's an opportune time for him to exit a couple of them which are not performing as well as it should, and get into balanced advantage. It will have a component of, it's a dynamically managed fund. It will have a component of equity and debt. And how much equity, how much debt will be managed by the fund manager.
Factors that he's spoken about as well that you should keep in mind before investing as well, in terms of your years of remaining for retirement as well, your risk profile. So that all also needs to be addressed. But as of now, which is not performing well, you can exit those and maybe look at balance advantage, more dynamic in terms of the allocation portfolio that comes in. Suresh, the next query we have is coming in from Rupesh, who's writing to us from Pune. He says that since there are many mutual funds within the same category, such as small, mid, large caps, how can one actually pick the best mutual fund? And I think that's very important because it's so overwhelming when you look at so many options that you have that you want to know which is the best fund to pick up, and returns are almost sometimes the similar ones. So then how do you pick up funds?
Yeah. I will say something very simple and easy to execute. can probably look at a simple index fund which invests across different categories. And if you are going to be a new person investing in the market, especially in mutual funds, I think a simple index fund will be a good choice. You will essentially get what exactly the market is doing in terms of returns. So I would say a good index fund which is investing across categories would be a Nifty 500 kind of a fund. If you put it in Nifty 500, it has a good amount of large caps which gives stability to the portfolio, 75 to 80%. Balance will be predominantly in mid caps and about 5-6% will be in small caps. So it gives you exposure across the board. And since it's a passively managed fund, you don't really have to worry too much. Expense ratios are low. Returns are as per the benchmark, and incidentally, Nifty 500 has been pretty good returns over a period of time. So I would suggest a simple fund like that in your portfolio.
Okay, simple funds, basic fund, index funds is what, Suresh is mentioning. Beginners can always look at that because obviously simple, low expense ratio are some of the benefits that come in on that front as well. And just when you're starting off, it's easier to invest in such kind of funds. Also, you can choose balance advantage fund as well. And that's what is mentioned as well. Next query for today, Suresh, we have is coming in from Naresh. He's writing to us from Mumbai. He says that he wants to invest in international funds and instant redemption funds and wants to know the best ones to invest in. Your view and suggestions coming in for this one.
As far as international funds are concerned, I mean, it has reached a certain threshold mutual funds can invest up to, which is about roughly $7 billion. It has reached in 2022, it's almost 3 years back. Ever since we have all been waiting eagerly for the Reserve Bank to up the limit, but it has still not happened. So most of the AMCs have paused the investment and sometimes they open it out. And whenever it is possible, you can invest. So it's not really a window which is available all the time. So if at all it is possible, you can invest. The other thing which you can do, I mean, I'm not suggesting this. I mean, for mature investors, we suggest the LRS route, Reversed Remittance Scheme, that route, where any Indian citizen can invest up to $250,000 abroad. So for that, you have to open a separate account. So my suggestion is that, I mean, let us currently park it away for the moment. So it is not available for most people. As far as the other portion, instant redemption funds are concerned, it's a very good thought that you have given to this particular category. Where, I mean, at any point in time, if you really want liquidity and you have invested in a, let us say, a liquid fund, and you want liquidity up to 90%, you can actually cash out from the online portal. So instant liquidity is there. Redemption limit is, like I said, up to 90%. Tata Liquid Fund, Axis Liquid Fund, these are some of the instant redemption funds. It gives you best of both worlds. I mean, you get a reasonable return also. At the same time, you get you have liquidity up to 90%. So you can consider some of these. I mean, these are by no means the only fund. There are many other funds. You can consider this category. I mean, it's a good category.
Okay, interesting views coming in there. Let's move on to the next query. We have Abhilash, who's writing to us from Mumbai. He has invested rupees 3 lakh each in Axis Midcap Fund, Mirai Asset Large and Midcap Fund, and he wants to know whether he should stay invested in these funds or exit now. I mean, I'm not sure when was this investment made as well, long-term or short-term, but your view coming on both these funds.
Yeah, so we don't have too much of context here, Abhilash. So, I mean, we are hamstrung on that front. So, as the Axis Midcap Fund, I mean, if you wanted to participate in Midcap, and Axis had done quite well, even if there was a lag. Now, I think the performance has caught up and the fund is on the mend. So, Axis Midcap is something that you can keep in your portfolio. Whereas at large and midcap, there has been a lag on that. And I would suggest, like I suggested slightly earlier in the show, Motilal Oswal Nifty 500 fund. I mean, that's for the large part, like I mentioned before, it's a large and mid cap. I mean, 90% plus is large and mid cap component with a small dash of small cap. So instead of that, I'm suggesting a simple passive fund which can do wonders in your portfolio.
Okay, that's a view coming in there for you, Abhilash. Let's move on to the next query. Madan Mohan is writing to us from Hyderabad. He says that he wants to invest in mutual funds and under the systematic withdrawal plan. And with an initial lock-in of almost 2-year time period, he needs 1.5 lakh rupees per month. And this is coming in from April 2027. Wants to know how to go about this. How do you plan a systematic withdrawal as well? And they've given the requirement that they need as well is 1.5 lakhs. This is going to be from April 2027. What should they do, Suresh?
So what you need to do is you have to ensure that by April 2027 you have something like 3 crores. And assuming you have 3 crores and you're investing or you're shifting money from somewhere into an appropriate debt fund. So you have 3 crores in an appropriate debt fund. I mean, I would suggest a typical corporate bond fund or banking and PSU debt fund or any other debt fund, appropriate debt fund. Once you have that money, then you can withdraw something like 1,50,000 per month. I mean, I'm assuming a withdrawal rate of something like 6%. So that will give you that 1,50,000 on a kind of a perpetual basis. So it's possible. It's systematic withdrawal. I think you must have already figured. It's an excellent tax adjusted way of actually getting the return. So it is not exactly a way of getting interest alone. You are drawing from the interest and principal, but that does not matter. If the fund is performing above 6%, you can withdraw that 1,50,000 in perpetuity.
Okay. So keep an eye out on those numbers over there and the investments that you require to make as well for that 1,50,000 you want to withdraw every month. Next query, Lakshmi is writing to us from Chennai. She says that she has been investing around 66,000 rupees for 5 years via SIP and wants to know how her total returns will look like after 5 years. She's given a breakup also of her investments coming in, right? And different funds that she's given, 3 funds that she had been investing in. So one is ICICI Prudential Nifty Bank Fund, where she's investing 16,000 rupees. We have the UTI Nifty 200 Momentum 30 Index Fund regular plan, 20,000 rupees, and ICICI Prudential India Opportunities Fund Growth 30,000 rupees. So what is the expected return that could look like? And any suggestions, to get better return? Should she shift, or what is the outlook here?
Yeah, I was having that in mind. Talk to her regarding that. So Lakshmi, I mean, it's very curious that you have invested in sectoral funds, you have invested in thematic funds, you have invested in smart beta funds. I'm supposing that your portfolio may be outside of this as well, because these are something which you tend to do as a satellite, not as a core. So I'm assuming that. But anyway, if it is the core, I would suggest you to look at the core funds like large cap, mid cap, international, those kind of things apart from this. The reason why I'm saying this is that if it is a central fund, it can do extremely well at certain point. It may lack the larger market at certain point. That is the same with a thematic fund. So you have to be very careful when you are actually going for a thematic fund, sectoral fund, these kind of funds. On average, MFs have given more than 12% return over a long period of time. And you have given yourself something like 5 years, which is not bad at all. If you look at the time frame you give for mutual fund, equity mutual funds. So by that token, assuming that the markets do hold up and you are able to get that 12% per annum kind of return compounded for 5 years, you will land up something like at 5.4 crores at the end of these 5 years. It should be possible, but Lakshmi, I would suggest that you really look at your portfolio and have the core components in place. Satellite components are fine. Core components should be maybe 60-70% at least. Satellite components can be 20-30%. That's my suggestion.
Okay. On that note, we're going to step into a very short break. Viewers, don't go anywhere. On the other side, we'll continue our discussion and solve more of your mutual fund queries.
The Maharashtra government is facing heat from its own contractors who claim the state owes them a massive 89,000 crore rupees in pending dues. According to the Maharashtra State Contractors Association and the State Engineers Association, payments have been stalled ever since the launch of the Ladki Bahin scheme and other pre-poll promises in July 2024. The association say the dues span multiple departments, including the Public Works Department, Rural Development Department, and the Jal Jeevan Mission.
Welcome back to MF Corner on CNBC-TV18. We still have with us Suresh Sadagopan, who's the founder at Letter 7 Wealth Planners, to solve all your mutual fund queries. Let's keep it going then. This next query we have is coming in from Manikumar Ramalingam, who's writing to us from Chennai. He wants to know how much cash should one hold and what should the investment allocation be in flexi cap, large cap, mid and small cap. What is the best allocation that comes in at such a time period also and otherwise? Because I think emergency fund is also something that you need to keep aside.
Yeah, sure. So how much cash should you hold? I mean, there are two components to it, like you mentioned. One is the liquidity component and one is the emergency fund component. So let me first address the liquidity component. For most of the people who have stable jobs where the income is coming in on a regular basis, we normally suggest up to 3 months of liquidity, which should include all your EMIs. But for those people who are in kind of turbulent industries or people who are entrepreneurs themselves, so depending on their perception, depending on their own estimation, it can be anywhere between 6 months of expenses to almost 2 years of expenses. Because, I mean, if somebody is starting up on their own, they may have to keep a much larger amount by the side. So that is one. The second thing is the emergency or the contingency. So sometimes there are cookies which come in life which we have not really anticipated. And sometimes some of the contingencies we can anticipate. Like, for example, if there is a member in the family, elderly person in the family, who may have medical requirement. We don't know when it will come, but it can potentially come at any point. So accordingly, as per our judgment, we can have an appropriate amount of money. It can be 5 lakhs, it can be 10 lakhs. Based on our judgment, we can have a certain amount of contingency also by the side. So these two things are very important. I mean, a lot of people understood the importance of that during COVID time. I think we are in a much better footing at this point in time. Now, coming to the exact allocations in large cap, mid cap, small cap, and so on and so forth. See, there is no exact way of saying that, okay, for such and such person, it should be this much large cap, this much mid cap, and things like that. See, on a very broad basis, we normally say that a person who is young potentially has a much more risk capacity, not risk appetite, risk capacity. Because that person may have a long working life ahead and the risk capacity may be more. So to that extent, we may broadly say, okay, this person can take much more risk as compared to another person who is probably at 50. So there is no particular thing. A lot of things will also depend on when the goals are coming. If a lot of goals are coming in the next maybe 3 to 5 years, a lot of it cannot go into equity at all. So I would only say that, I mean, you should actually consult somebody who can actually advise on your specific position, your financial position, your personal position, and when the goals are coming, and so on and so forth. So very broadly, I would say, I mean, if you want to keep it very simple, again, I go back to my favorite Nifty 500 kind of a fund. I mean, apart from that, go to a financial advisor and review your case and get that done.
True. Okay, this next query is also a very short and sweet query in a form, I'm going to say, because Akshay Kuderkar is writing to us from Mumbai. He's just saying he wants suggestions of top mutual funds to invest in for a period of 5 years. So what would you suggest to Akshay? What is looking the best to you right now?
Yeah, since I don't have too much of information in this case, and he's looking at top funds to invest over 5 years, so I presume Akshay is somebody who's trying to invest maybe for the first time, or he's a comparatively new investor. So in that kind of a person, for that kind of a person, I would suggest a passive fund. I mean, I've been a great advocate of passive funds. I mean, Nifty 500, you get participation in across the market. We call it a all market fund. So this particular thing, Nifty 500. So that is something I would suggest. And in a time like this, where we don't know where everything is going. So I would also suggest a multi-asset fund. Multi-asset fund will have equity, it will have debt, it will have gold, it can also have a direct real estate in some cases. So one can look at a multi-asset fund. I mean, one of the multi-asset funds which came to my view is ICICI Pru multi-asset fund. There are so many multi-asset funds. I mean, don't go with one name which I have to mention. So look at all the multi-asset funds and you can zero in on one of those things.
Okay, let's move on to the next query. We have Amit Murkute who's writing to us from Mumbai. He wants to know a good index fund to invest in, given that the market, we're seeing a correction in the market. Index funds, what would you look at? You know, they're normally mirroring what the index is doing. So any recommendation there?
Yeah, I mean, if you want to play it very, very safe and to stick with the blue chip of the world, then Nifty 50 or Nifty 100 would be what I would be suggesting. But if you are slightly more adventurous and you are willing to wait for the longer term, then Nifty 500, the all market index is what I would typically suggest. Investing in Nifty 500 is not that very risky as compared to Nifty 50, though it has certain component of mid and small caps, maybe 20, 22%, 25%, that's all. So I would recommend Nifty 500, but if a person wants to play slightly more safer, Nifty 50 or Nifty 100.
Okay, that's a view coming in there for the index funds. Let's move on to the next query. Suresh, we have G. Nair Subhash. He has been investing in quant small cap, which now is at a lower NAV. Should he continue or redeem it? I think this concern comes in given that recent time we've seen that correction coming in. And you know, sometimes in the small cap, mid cap, the correction was sharper. So that NAV has gone lower. Your suggestion coming in for this one? He's been holding it for some time is what he's saying.
So, Subhash, what I presume is if you have invested in a small cap fund, I presume that you understand the risks in that. I mean, it gives very high returns at certain points. And there is also massive volatility which comes in the intervening period. So that's the very nature of small cap funds. So what you have experienced is not really very unique to one small cap. I mean, the entire sector is prone to that. So if you are really looking at small cap as a category, you want to keep it there over a period of time, you want to get good returns. In fact, small cap category over a period of time does give good returns. So if you have a 7-10 year kind of a horizon and you want to keep invested in the small cap fund, and one small cap is as good as most of the other funds. So hold on to the investment. If you have money to put in, again, I don't know how much you have in one small cap. Don't overdo it. But if you have some space to invest more, you can definitely do that. But keep reviewing this from time to time. Any portfolio is not good enough in all points of time. You should ideally review once every 6 months.
Okay. Next query is from Kshitij Kumar, and he wants to know, do funds with smaller AUM normally outperform funds with larger AUM? Is that a case or is that a study that you've seen?
Yeah, I mean, I keep hearing about this from time to time, but truly speaking, there is no empirical evidence to show that. See, the largest funds which are available in the market today, I mean, we have a couple of funds now. Parag Parib is, I think, at 93,000 crores. And we have HDFC Balance Advantage Fund, slightly more, 94,000 crores. They seem very, very large. But I mean, if you look at the entire market, it is some 300 lakh crores and things like that. I mean, it's very, very large, $4 million, that kind of a market cap. So, I mean, compared to that, this is going to pale into insignificance. So, truly speaking, there is no real logic as far as large AUMs not able to perform as well as the smaller one. I would say that how the fund manager is managing that and how the stock pick, I mean, they are doing. I think that is going to be more important for how the fund performs.
Okay. Suresh, next query. Sachin Bakha is writing to us and he wants to know, you've spoken about balance advantage funds. So which balance advantage fund should they be investing in? They want to know the best one.
Yeah, I mean, so it's a very loaded question. Best balance advantage fund. I mean, it changes from quarter to quarter. I mean, in fact, not only balance advantage fund, all the funds, I mean, they cycle. I mean, what is there in one quarter, after 4 quarters, you read that it's the second or third quarter. It can happen. Okay. So the point is now, balance advantage fund is a good one. I think probably you have understood that and that is why you are asking this query. At this point in time, it's a good fund. You don't have to really break your head about where to invest. It's a dynamic asset allocation fund. So you may consider some of the good ones in the firmament, which is one is HDFC Balance Advantage Fund, there is SBI Balance Advantage Fund, HDFC Balance Advantage, and there are many such Balance Advantage funds which are there. I mean, you may consider one. I mean, couple of the names which I mentioned, or anything apart from that aspect. I mean, do your homework.
Okay, absolutely. It's important to do your homework before you invest anywhere. Though Suresh has managed to answer a lot of your queries as well. But Suresh, thank you so much, for giving us your time and solving all those mutual fund queries. And viewers, thank you so much for sending us your queries. Keep sending them as well. We'll keep taking them as often as we can. But that's all the time we have on this edition of MF Corner on CNBC TV18. Thank you so much for tuning in. Up next, you have Closing Bell.
Around 46,000 crore rupees is pending from the PWD alone. Despite the state government's claim, especially post-budget, that its finances are in order, the contractors argue otherwise, pointing to stalled development work and growing financial stress on the ground. They allege that payment delays and pendencies were already an issue before July 2024, with a 40% payment pendency. But since the launch of Ladki Bahin and other pre-poll schemes, the regular payment rate has dropped to barely 10%. As a result, work across infrastructure projects, including maintenance and repairs at Mantralaya and Raj Bhavan, has come to a standstill. Projects under PWD, Rural Development and Jal Jeevan Mission have also been halted. The contractors' body says workers are also suffering, with only minimal payments being made to them to keep them afloat. They claim they have written 6 letters to the Chief Minister and Deputy Chief Ministers but received no response. Last week, the association held protest in Thane. They now plan to send one final letter to the state leadership before approaching the court to recover their dues. The association, which has been active for 25 years, represents 3 lakh contractors across 35 districts in Maharashtra. Each contractor reportedly employs 200 to 300 workers.
Banking money is really short-term saving deposits and some fixed deposits. And the average tenure of a bank deposit, banking system is about a year and a half. And you expect to fund the infrastructure over 7 years or a corporate loan over 5 years. You are sitting on a mismatch, whatever you say. So it will have to evolve.
To corporate CPs and bonds.
And really, if you look at the lay borrower, the retail borrower, his or her need is to repay every month, and that's
headlines. To understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
We have Taiwan index that's opened up with a decline of 0.5%, Hang Seng down 0.4%.
Both leaders also formally announced the finalization of terms of reference for the bilateral trade agreement.
So the upside level for the Nifty is 24,546.
That UBS is buying 4.95% stake in 361.
First rates 24,170 on the Nifty, 55,428 on the 55,300 plus on the Bank Nifty as well.
Markets can digest good and bad news, but uncertainty is something that it doesn't like.
Nifty is now closer to 24,250. The Sensex is at 79,800.
That the wealth management, seen in India is really, growing at an exponential rate.
Could see their pictures touring the fort, and they were welcomed in a traditional Rajasthani way.
AC manufacturing companies have seen quite a sharp spike. Names like Voltas, Havells, Blue Star, all of these stocks doing quite well in the session.
Well, that is the day so far, and it is actually a pretty decent session all told. It's quieter, much quieter as compared to the last few days. It's been absolutely boom, boom. Today it is not boom, boom, but it is softer boom. I guess this is Closing Bell. We're coming to you from the CNBC TV18 Motilal Oswal studios. I'm Prashant. Surabhi is with me here in the studios, and Nigel is joining us from the newsroom floor. Reema should be with us shortly as well. Guys, hi afternoon.
Hi, good afternoon. I think the markets will take the softer boom. Prashant, it's not too bad, right? We've been outperforming global markets throughout this rock and roll month of April, Liberation Day and whatnot. The markets come off, it's done a great job at a recovery. We're above our moving averages. And even after yesterday's rocket move, the markets held its own. And today it's more about mid-caps, more about individual stocks that are moving higher. So soft boom, looking good.
So tomorrow, if the Nifty is up 1%, you'll call it?
One doesn't do. One is not boom. You need at least two. But anyway, I mean, it's, as Surabhi said, it's 1% of the mid-cap index. It's 1% of the small-cap index. Nifty is up just about 0.25%. So there is that. Of course, Nifty is up 10% in the last 7 trading sessions. Nifty Bank is up 12% in the last 7 trading sessions. So there is, a fair bit of run which has happened from the lows in early March. So, you got to keep that in mind. In any case, it's turning out to be a pretty good start to the week. We're still in the early stages of the week, but it is pretty good. Lots to talk about in terms of individual stocks in a couple of sectors as well. And we'll do that. Bank Nifty, by the way, is still up 0.8. So that is, of course, the first index yesterday to make a new all-time high. Those LCR norms are helping, and we've got an interesting discussion coming up with the Federal Bank management on implications as they see it coming through. 55,740 on the Nifty Bank.
Well, it's the
I
PSU
think
banks.
Before you talk about the reaction, I think it's the tie. It's a pristine green tie, very nicely centrally located, in sync with the market's move today. Nice strip of green there.
Well, it's the PSU banks actually, which are doing much better. The PSU banking index at one point of time was up nearly 2%, now up 1.25%. But today you've got FMCG participating. Yesterday, while all the sectors did well, FMCG was lagging. But today you've got strength in ITC, HUL, Tata Consumer. Tata Consumer reports numbers later this week. And today there is strength in the FMCG basket. You call it the normal, the expectedly normal monsoon this time around, more money in the hands of consumers on account of the budget. But FMCG is a pocket of strength. HDFC Bank continues to gain ground. It was up nearly 2% yesterday. It's added on another 1.2%. SBI is higher. And M&M is on the front foot. On the way down, it's Innocent Bank that continues to be the top laggard, 4.5% lower. IT is giving up some of the gains from yesterday. Infosys, Wipro under pressure. HCL Tech, remember, reports numbers later in the evening. Bharti Airtel, which has been a rank outperformer with a 40% plus return in the last 1 year, is seeing a bit of profit booking. And two-wheeler names, Hero and Bajaj Auto, down 1.5–2% on the back of the Jefferies downgrade.
Yeah, that's definitely, it's weighed on these stocks, the two-wheeler names, Bajaj and Hero, throughout the session today. The broader market, let's focus on that because that's where you have a nice flurry of green and stocks are moving to either individual earnings or individual news flow. Now, case in point would be something like, let's say, Dixon. Dixon seems to be quite excited because there are reports suggesting that some of those supply chain shifts when it comes to high-profile mobile items like iPhones, perhaps that could be coming in the weeks and months ahead. Apple could reconsider its supply chain alignments, and that seems to be working well for that stock. Data patterns, you'd remember yesterday, Nuvama had initiated a positive report, a buy rating on a bunch of defense stocks, and Data Patterns was one of them. It seems that there's follow-through buying on names like this. Puravankara up 10%. We spoke with the management earlier in the day. Business outlook seems, quite robust. So that's up and about. There are names like Wari Energies, where the fact that the US perhaps is not going to be importing more from China when it comes to solar equipment, renewable energy equipment, that seems to be, adding to a nice green sentiment on these stocks. And by the way, look at the wealth managers. Let's not take our eyes off it. In the morning, these stocks started a little subdued because they've rallied a lot. But look at them now. Look at Motilal Oswal, 4%. Look at 360 ONE Wealth Management, where the deal with the UBS has happened today. Stocks now at the day's high, almost 3.5–4% higher. That's Motilal. Let's pull up 360 ONE as well. And even Angel is finding some traction. Yeah, look at a big spike on 360 ONE. So this is a very, very hot space. We'll talk about this as we go forward. But wealth managers definitely in focus. So what should you be doing in the last hour of trade? As always, let's ask Mitesh for some advice. Mitesh, so index has been a little quiet and range bound today. Lots of stock specific action. What are you going with now?
Yeah. So I think, actually the index, the way it's run up, I think, not surprised that there will be some profit booking or some supply happening at higher levels the call writers would be fighting to protect 24,200. That's an important level. And then 24,500, 550 is the zone. So I think maybe some stocks will play catch up, especially the ones which have been sideways consolidating and are breaking out right now. One of them is Max Health, which has come on radar. That's a buy of the stock below 1100 for targets of 1180 to about 1190 on the upside. And the other one is Mahindra and Mahindra. I think, again, the stock which was not participating in the last few days has started picking up and today has given a clear breakout. So buy here with the stock at about 2780 for targets of 2880.
Yeah, big move on M&M today. Thank you very much, Mitesh, for joining in. Let's talk about Innocent Bank. In the morning, there were reports that ENY, the bank has appointed ENY to conduct a forensic audit of the microfinance book. Ritu has now picked up some more details on that because this has been weighing on the stock. Ritu.
That's right, Reema. We've been able to confirm some of the reports that emerged this morning that Indus Bank has indeed appointed Ernst & Young to carry out a forensic audit of its microfinance portfolio following the discovery of a near 600 crore discrepancy by its auditors. The issue, we understand, is related to the accrual of interest income, which relates to the microfinance book and is believed to have emerged over the last couple of quarters, that is the second and the third quarter of FY25. Now, while the bank has not made any disclosures regarding these discrepancies, which we understand it has been in talks with the regulator for, what the bank has done is set aside some provisions, again, not call them out as provisions for these discrepancies, but the bank nonetheless has been making these provisions. We understand these provisions have been drawn from the contingent provisions of the bank, which stood at about 1325 crores as of the third quarter, down from about 1525 crores in the previous quarter. Now, their micro loan book, that stands at about 32,500 odd crores as of December, and the bank had also reported about 300 crores in new stress formation and about 344 crores in write-offs in the microfinance finance segment alone in the third quarter. So more trouble brewing for Indus Bank, yes, and the audit is going to reveal the extent of the issue. We have reached out to the bank for a comment, which is still awaited.
Thank you very much for that. Innocent Bank has also had a phenomenal run in the last 1 week, where the stock has gained close to about 20%, so some profit booking also visible. Gurmeet Chadha, Managing Partner and CIO at Complete Circle, is now with us. Gurmeet, how have you read the developments that we've seen on Innocent Bank? The stock initially nosedived, it started recovering, and now this.
In banking, we always say there is never one cockroach in the kitchen. And once stress builds up, it builds up, and there's nothing against the management of the bank here. I think it's just that maybe to give a more positive response, I think they're themselves initiating. Probably there's a bit of a cleanup happening now, and there could be a bit of RBI intervention also on that. So probably they want to start, with addressing all possible concerns, and that's why probably proactively taking it. And microfinance was one part of the portfolio which was reason for its underperformance before the FX loss and the derivative issue came forth. And this has happened with earlier also. Whenever a bank does clean up, we saw that with RBL also, Rima, when they had issues in credit card and unsecured, the stock underperformed and it's still trying to recover. So, once you get a bit of a, bank business is leveraged. You take ROAs of 1.5%, 2%, and you leverage it 6-7 times, and then you calculate ROEs. But if asset quality comes under question, the street would not assign you a 3-4 price to book multiple, which it will assign to pristine asset quality, which it does to others. So I think it's more in terms of what a multiple a bank gets. It's a function of the quality of the asset book, and I think these issues will take a little time to fix. And RBI is doing so much for banking. They've done away with the liquidity coverage ratio. The runoff percentage has been given some waiver. So there are a lot of other opportunities in this space other than to just pick point one and see if there are any bargains left.
And we'll, of course, keep an eye out on that one. Stock, of course, has done well, right? Now 15% with today's 5% drop. Otherwise, it was kind of sort of going one way over the last 4-5 odd trading sessions. Gurmeet, there are, for many, and in the mutual fund space, this is what has happened in the market in the last 5-6 days is a real pain trade, because there are a few who are sitting on a large amount of cash who didn't come back in as the market started to reverse. So, and you got to, if you're managing a large amount of money, you can't decide, you can't flip in and out, right? You got to take a decisive call, in or out. And that's the problem. What is your sense? Is the market kind of, we've gone from being absolutely despondent to thinking everything is fixed. A little overdone on the other side as well now?
Prashant, it always happens. The easier part is to take a cash call when things are not going your way. The most difficult part is to get back in. I know so many clients, with personal experience who probably some of them even got COVID right. But they weren't able to get back at 7,000, 8,000 at the Nifty. People were then waiting for 5,000. Similarly, people were right now waiting for 19, 20,000 on the Nifty. And I personally believe in, principally speaking, and each to his own, fund manager job is not to take an asset allocation call. The asset allocation call has to be at the client level. He is giving money for equity to you. You are not supposed to take large cash calls. See, some bit of it is fine. You rotate, you keep some cushion, 5-10% cash calls are fine. To take large cash calls, because you're not running an asset allocator fund. You're running an equity fund where the mandate is growth. So to me, principally, that's not on. That's the job of an advisor or the client. I personally think that the market will probably now wait for earnings. I don't think so it's overdone. In fact, I spoke to you that market looked oversold at those levels because there was too much negativity and India had very little role there. And now once the market realizes that probably you are not uniquely disadvantaged and has some advantage, you see a bit of covering. And this K-shape, W-shape, we keep listening. Market is always V-shaped. When it recovers fast. We have seen that so many times. So, just stay in the game. I think the only thing you should do is, keep rotating. I think what market is not telling you is that keep booking mistakes in this upside. If you have previous mistakes and you're getting good exit points, do that. Be a little more conservative and moderate going forward.
I like that. Gurmeet's phrase, you're not uniquely disadvantaged. You're not uniquely advantaged, also maybe uniquely advantaged. I remember that.
It's relative to Shanta these days.
No. But I think, point taken, and that's it's each to his own, as you said, right? But it's a debate. It'll never go away, I guess. There are those who believe on the other side as well, but the arguments on both sides. What have you been doing, Gurmeet, lately? We've spoken about lots of stocks, etc. But, stocks have snapped back, 20-25%. What have you been doing?
I heard this term, I think, Prashant, somebody speaking to you, I'm forgetting the name, it's called trade nationalism. And I think that is what we're going to see now, going forward. So I think everything would be more inward, domestic looking, which actually means it's good for, domestic manufacturing, commodities, cement, and somebody also said it could be from NASDAQ to Dow Jones now, or from the main street to the Wall Street to the main street. I think increasingly, you will see now more focus on jobs, more focus on the lower strata, more focus on blue collar jobs. And this will happen with governments all across the world. Companies spending on defense. So we added some defense names when we last spoke. I think banks were very juicy when they were at 48, 49,000. So we went overweight financials. We are now adding some more names in energy. I think so. We're looking at demand where earnings are not very cyclical. There is some secularity on earnings. So energy is one sector where both in generation and transmission, we see some secularity in earnings. Telecom is another sector. You will not see much variation. You have basically 2.5 players now. And two players now increasingly gaining market share, better ARPUs, and pivoting in terms of digital and other offerings other than mobility. And we are adding some niche names, like for example, recycling, which to me is a huge billion-dollar opportunity considering the global waste management is $600 billion. We are hardly $10-12 billion. And little bit, dibbling into autos. I think that there is a lot of negativity in the price. Both in terms of OEMs and auto components. So we are selectively dipping in there and gradually will build exposure over the next couple of weeks.
Okay, all right, got that. So autos, maybe even OEMs and niche plays like recycling. Got it. Interesting ideas there, Gurmeet. Well, Gurmeet spoke about financials and that is one of his top picks as well. Let's talk about the latest move, which again is a shot in the arm for banks because it's a big relief coming in from the Reserve Bank of India. Now, yesterday, the RBI clarified that the liquidity coverage ratio norms, the final norms that are coming in, will be a little more flexible, less onerous than the draft that was proposed a couple of months back. To talk about this, we have Harsh Dugar, Executive Director at Federal Bank, joining in. Mr. Dugar, thank you very much for taking this quick call. So the RBI itself outlined that once these guidelines are implemented from the 1st of April 26, the impact, I think, is going to be 6 percentage points in terms of overall LCR. But you tell us the fact that, now these norms, this runoff rate, as it's called, it's not as high for wholesale deposits. Even for the internet and mobile banking, it's not 5% as was proposed, it's 2.5%. So how does this impact your operations and liquidity?
See, I'll comment on the banking sector as a whole. As has been mentioned, there has been obviously a couple of things. Earlier, it was anticipated that the higher runoff rate would be at 5 percentage point for the IMD segment, which has now been done at 2.5%. The biggest benefit which is coming in is a substantial reduction in the runoff rate for non-financial operational deposits. That being brought down from 100% to 40% is going to provide significant liquidity and reduction in the requirements, because as was mentioned by RBI in this thing, that it will actually increase the LCR from the present from 100 to 106%, which was earlier anticipated to go down to 90% as per the draft guidelines. So that's something which is going to be a fillip, and that will obviously provide significant liquidity, about 2.5 to 3 lakh crores is what we were anticipating, which will aid the credit growth as well. So it's a big plus for the segment as a whole, and it is becoming effective from 1st of April 2026. So that's something which I think banks can, in general, look forward to: a higher liquidity to manage growth and support credit growth.
Okay. Harsha, hi. So have you done any analysis for Federal Bank? And first, if you could also tell us, what is your share of wholesale deposits? What's your current LCR? And now with these relaxed norms, what would be the incremental liquidity which is now available for you, perhaps to lend?
So we are in a silent period, and I would like to avoid any questions which is pertaining to the bank in particular. To the segment and about the guidelines we can comment on. So I would request you on that part.
Okay, so this 6% increased liquidity now, which is available to the system as a whole, what would be the incremental lending that will happen on account of that?
Yeah, so if you look at it, the credit growth is expected to be supported to the extent of about 1.5 percentage points, which is significant, because considering that we were talking about earlier liquidity in terms of an issue for deposit growth, so this will indirectly help in terms of supporting credit growth. So broadly, the 6 percentage point savings in the LCR, which RBI commented on for the system as a whole, will result in some liquidity being released to the extent of about 2.5 to 3 lakh crores, which in turn will aid credit growth by about 1.5%. So that's for the system as a whole.
So 1 to 1.5 percentage boost to credit growth system-wide, you'd say, from next year, right? Which is when these norms come into effect, from 1st April 26.
Absolutely, from April 26.
Okay. I mean, 1.5% additional credit growth. I think the market will like that. Mr. Dugar, just before we let you go for this year, because we're going through bank earnings, and I mean, the big chatter on the street is everything else is fine. When will growth pick up for banks? So just the broad thoughts very quickly on this.
So yeah, there's been a little bit of a muted growth in terms of it, but we are anticipating that will come back. There are obviously uncertainties because on account of the tariff wars which is going on, the uncertainties on account of that has definitely muted if you look at the wholesale the credit growth outlook. But if you look at it on the retail side, people do see that this growth may come back during the course of the year, whether it's microfinance, and yet people are talking about it bottoming out in Q1 and Q2. So you'll see this coming in. Unsecured loan growth, which was muted last year, may also revive. So overall, yes, we are still guiding for 11 to 13% for the system level is what we are looking at, the system as a whole.
11 to 13% system-wide growth this year. All right, Mr. Dugar, that's helpful context. Thank you very much for that perspective. Good talking to you. And of course, we'll discuss the bank-specific questions once the results are out. That's Federal Bank on the latest moves on LCR from the Reserve Bank of India. That's banking. Gurmeet, the one sector I wanted to take up with you before we let you go is EMS. We've discussed this in the past. I mean, you've always told us you like Dixon. The stock's always been expensive. Let's pull up the stocks before I toss this to Gurmeet. Dixon is just one. I also looked at a smaller name like Avalon Tech, another EMS player. Stocks up about 9%. So there's a lot of selective buying going on in this whole EMS side of the market. Anything that you would buy here, Gurmeet, now after the correction?
I think, Subi, one learning is that you should focus other than fundamentals on where the government is wanting money. So if you see 22, 23, nobody would have thought that PSUs and defense would lead the rally. Similarly, we saw maximum PLI in electronics. And I think that's why I'm saying these trade deals have to be very closely watched. We are moving into a multipolar world. We'll probably see in the next 90 days a lot of trade deals. The sense we are getting in terms of speaking to our clients is that there are clear areas where government sees an opportunity. Pharma, textiles, PLI would be enhanced in electronics. But I think electronics, most good news is in the price. I mean, you are not going to make much money entering Dixon at 16, 17,000, at least in the near term. I may be proven wrong. So, pharma, auto. So you'll see a lot of these deals getting staged. And I think there's a lot of spaces China will vacate because it has also moved up from 3,000 per capita dollars to 11, 12,000 now. And we are still at about 2,000. So, toys, leather, bit of textile. So as I said, a lot of focus will come to generating jobs. And that's one concern government has, which is the jobless growth. And a lot of sectors which are labor intensive might actually gain, but you probably need to wait it out a little bit.
Fair enough. Gurmeet, good conversation as always. And I'm sure as a business owner yourself, you've been watching what's happening in the wealth management space closely. The recent transactions.
Absolutely.
So that's absolutely exciting. That's another conversation. Thank you very much, Gurmeet. Appreciate it. As always here on CNBC. We'll take a quick commercial break here. We're going to come back and we will connect with Rupen Rajguru from Julius Baer on the other side. Stay tuned.
You are in sync and you're repricing the loan maybe on a quarterly basis or half-yearly basis. So that is appropriate financing. Banks, I think, as they evolve, larger and larger part will be to the retail sector because they are, as of now, best equipped unless they're disrupted by a fintech. The corporates, large part of the corporate universe today, are cash positive. The cash flows are positive and can meet most of their growth needs. At the margin, they may have to borrow. Large part of infrastructure funding will come through a market process, which is outside the banking system. It's already happening.
Welcome back. Markets have come off a tad bit. The Nifty is now at 24,150. The day's high today was 24,250 thereabout. So we've slipped a bit. Even the Nifty Bank at session highs, it was up close to about 750 points, 700, 750 points. Now up nearly just 350 points. Some of the drags today outside of Innocent Bank and IT names, Power Grid. Power Grid is a bit subdued in trade. Coal India and Adani Ports are some of the names where you are seeing incremental pressure. ONGC too, now down close to about 0.5%. Rupen Rajguru, head of equity investments and strategy at Julius Baer, is now with us on the show. Rupen, hi, afternoon, and thanks for joining in. What's the outlook now on the markets? We've seen the markets correct sharply in the early part of April and bounce back equally sharply.
Yeah, hi, afternoon, Rima. So you're right, we had a big yo-yo in the market, specifically in the month of April. And India probably is one of the few countries who is, YTD now is giving positive returns at a Nifty level, while mid and small caps are still lower. If you look through, Rima, Indian markets actually, if at all we were to use that term bottoming, we did not, when this tariff tantrum came into the picture, we did not breach the previous low, which was closer to 21,800. So now probably in hindsight, we can say that was the bottom of the market, and that was before all the tariff related news came into picture. So why were we down? Because we had corrected before all these global issues, because the earnings were slowing down and the economy was slowing down. So what we believe that now we are entering a bit of cyclical recovery in macros. So in India, what we believe is the government capex, which first half of last year, if you recollect, because of election was not there. So probably this year, the government will front load the capex. Secondly, the RBI has been pretty supportive for growth with rate cuts and a lot of other measures. So RBI also wants growth. Plus, monsoons are also going to be good as per the early indications. And also the effect of the tax cuts will come into picture from 1st of April onwards. So all in all, we might be seeing a bit of cyclical recovery. So from a market perspective, unless something on the global scale, which as of now you and I can't predict happens, I think we are pretty constructive in the medium term as far as market is concerned.
Rupen, run us through some ideas. That's stocks where you think there is still opportunity, because stocks have snapped back very quickly, and before you can say anything, I mean, valuations are in many cases without any incremental change in earnings or anything, or maybe it's all, of course, based on what future projections will look like, but nothing is very meaningfully changed. It's looking better generally, but it was we always knew, right? I mean, maybe second half of as we get into the thick of the new fiscal year, things will get better because of easier liquidity, etc. Where do you think there is still sort of serious value price dislocation, which one can take advantage of?
Sure. Yeah. Hi, afternoon, Prashant. Well, this market definitely is going to be a difficult market because we are not in an era of, as you rightly said, there were sharp moves on the downside and equally sharp move on the upside, and probably we are, back to where we were. Here, the pockets of opportunity would come through, in some of the segments. I've been saying this on your channel for quite some time. BFSI as a space has been looking good and actually has been one of a better performer in last few quarters. Within BFSI, while the top 3-4 banks have done well, what we believe now that since the overall credit cycle is or the NPA cycle has been pretty stable, credit cost has been pretty benign, and liquidity coming back into picture. So some of the mid-tier banks, also specifically some of those banks in which we have seen a change in management, and some of the key KMPs from a large bank has joined as a CEO of those new banks. Those we believe might be a good turnaround candidates and are ripe for a re-rating. Some of the other segments, as I said, consumption, specifically on the low-end consumption, we believe, as I just explained about some of the tax measures will come into play, rural recovery thanks to monsoon, and also the inflation is benign, and for the first time in 3 years, the real wage growth, specifically for that daily wage earner, is going to be positive. So the low-end discretionary consumption will clearly be a winner, and those segments have been ignored by the market. So be it footwear, apparels, QSR, liquor, all those segments, definitely we find opportunities there. And amongst not contrarian, but one sector which probably, again, on a YOY basis would see a better year next year is going to be cement. So that is one segment which we believe should do well. So these are some of the ideas which we are looking into. But yes, at an aggregate level, there are not many value opportunities, so to say.
Would you call IT a value opportunity? Because you like large cap IT and you've liked it. You've been constructive on it for a while. So a few questions here. One, did you ride the downturn in IT over the last 3 months where we saw IT stocks correct nearly 25%? 2, are you buying at these levels? And 3, what kind of a return can IT stocks give? Even if they're attractive valuation-wise, there is no growth. So in the absence of growth, and if we have about a 3, 4, 5% kind of a growth, then what kind of a stock price return should we expect?
Sure. So, Rima, in fact, we had significantly reduced our weightage in IT towards end of last year, and we have been underweight. And as we speak today, we are considering the kind of fall which we have seen in the stock prices. We are more constructive on IT as we speak. And if you look through, IT has a very strong correlation with, IT index with NASDAQ. So historically, whenever Nasdaq has done well, IT has done well, and vice versa. And this year Nasdaq is down, and IT also index is down. That's a strong correlation. And IT as a sector, in fact, large cap ITs, if you were to just do a YOY or calendar year calculations, the differential between the 52-week high and 52-week low for IT stocks is one of the highest. So be it the large names also, typically we see that 20, 25, 30% movement between the lows and the highs of the year. And that's always happened. Why has it happened? Because obviously because of the news flow. And as you rightly said, currently we are in a IT down cycle, so to say, and probably in a US down cycle. So from 92 till now, there have been 4 or 5 US down cycles. And so far, there hasn't been a single year in which the IT has degrown. So coming to the current scenario, what has happened? Yes, all the headwinds, what you articulated, is there and to some extent is known in the price. IT stocks are pricing in a significant US slowdown, if not recession. But now at valuations, so a lot of these large companies, and typically all the IT companies are a classic, I would say, mature industry, which, as you rightly said, growing at 4-5%. Probably this year might be lower and next year might be slightly higher than that. With an 80% on an average payout, when you go below 20 PE, your overall dividend yield or FCF yield works out 4 to 5%, depending on what kind of valuation you are trading. So in an environment in which we are, while we have seen a good rally from the lows, but globally still things can be murkier. So if one wants to play defensive, probably the maximum negative news is more or less there in the IT. And it would be a good defensive bet, and that 4% dividend yield, and if it falls further, 5% dividend yield for those stocks. And historically, we have seen stocks bouncing back from here. So sorry for the long answer, but we are constructive on large cap IT names at the current juncture.
Okay, I wanted to ask you, why not mid-cap IT? Because that is where the growth is, right? I mean, large-cap IT is growing at 3-4%, but you got companies like Persistent, Coforge, which are growing very, very strongly, 25, 28 times earnings FY27. But that is for our next conversation, Rupen. Thank you very much for joining us. Good speaking with you and appreciate your time here on CNBC TV18. We'll take a quick commercial break here. We're going to come back with what's happening in dealing rooms. So Nimish will help us with that, what's on his chatter list today. And of course, some short-term trading ideas coming up as well.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account.
Huh.
And the person did not even kind of entertain me. So I went chappal, and as a student you go there and so kala come to and so on, and then after conviction, after some convincing, fill the form, 2 days, 3 days, and open my account. By the time you're gone, your interest is lost.
Yeah.
So the point was you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do e-commerce, unregulated products. We will not do anything which is not good for the customer.
Welcome back to the markets. Well, keeping it fairly steady at this point in time. If you look at the Nifty, gain is still about 45 odd points, but caps are still up about 1% or so. Nimesh is back as usual from, with all the dealing room buzz and chatter. Nimesh, so it's a slightly quieter day. Bulls seem to be digesting their winnings of the last couple of sessions. What have you picked up?
Well, Surabhi, it may look a quieter day on the Nifty, but there is a lot of action in the broader market stocks. So again, the mid and small cap indices are outperforming. A lot of individual stocks has started seeing a bit of buying traction as well. The one sector which stands out in terms of buy flows is the consumption names. All the consumer stocks are again very well bid. So you'll see a slightly higher FI figure, largely towards the consumption stocks. Look at the ITC, for example. The volumes today is the highest in last 3 months in ITC. So that's a kind of delivery which is getting marked for the consumer stocks by the larger institutions today. Again, financials are doing good thanks to the further liquidity ease by the RBI. But within the broader sectors, I spoke about consumers, banks doing good. PSU as a theme is again catching a lot of attention, not only from institutional investors but from larger HNI investors as well. So again, that's one pocket which is selectively outperforming, which is the PSU basket. Today, for instance, all the PSU banks are also well bid by large institutions. Technically, now I think the big resistance is now turn out the support. So 23,800 will act as a very strong support on the downside, at least in the near term. And the feedback is that given the kind of FII flow and newer sectors participating, the momentum can continue both on the Nifty and on the Nifty Bank.
Oh, absolutely. Nimesh, markets full of deals, chatter. So let's get to the meat of it. What are you picking up?
Well, Prashant, I guess deals are on, so that's going to happen. But there is a lot of buying interest as well into individual stocks. The first stock on my list is Federal Bank. Looks like some bit of accumulation is happening from very long-only funds into Federal Bank at current levels. So the delivery marking is quite high, and that's the trend in today's market as well. So that's the first stock. The second stock is KEI Industries. This is interesting. We saw a sharp derating for all those polycaps in KEI Industries, and at these levels now, a couple of AIFs and domestic AIFs have been accumulating at these levels. So that's the second name in my list. Third, couple of PSUs. I spoke about broadly the PSUs being well bid. Canara Bank and South Indian Bank. These are the two names within the PSU bank stocks which are very, very well bid. So expect high delivery volumes, and there is buying interest as well from large institutions. And the last is SJVN. It was part of my list a few days back as well. Again, a very strong chatter of company likely to bag a very large order, and hence the volumes are on the higher side from larger HNIs in SJVN.
Oh. Okay, all right. Nimesh, thank you very much for that, for all the buzz and the chatter as always. We actually will quickly move on to Mitesh now, get some final trading ideas in before we get to the next story. Mitesh, so what final thoughts? Any new stocks coming up on the radar?
Yeah. So I think I have two stocks, and we've seen the market slightly come up, and I've been highlighting since last 2 days that could be a risk. But yet I think I would go with some BTST calls. NHPC for me is a BTST. Keep a stop below 89 for a target of around 91.5 or thereabouts. And the other one which I like is BTST on Popular Reality with a stop at about 1685 for targets of 1725.
Got that. Let's talk about Ola Electric. That's in focus after Maharashtra government's order on stores without trade certificate. How does this impact Ola? Sudarshan now joins in for more. Sudarshan.
So there is another update related to trade certificate issue of Ola Electric. Now CNBC-TV18 has accessed the letter written by Maharashtra Transport Joint Commissioner, and he has written a letter to local authorities asking the closure of all the showrooms that are operating without trade certificate. So the letter, it's been mentioned in both versions, English and Marathi versions, and the numbers that Maharashtra Transport Department has given in both the releases differ, but we are going with the numbers that they have given in the English version of the release. And it says that 107 of 131 stores of Ola Electric in Maharashtra are operating without trade certificates, and as of now they have closed 43 stores, and also they have seized vehicles, and the number is more than 200. Exactly, it is 214. The letter says that most showrooms and service centers are operating without trade certificates, and data that has been received so far shows that showrooms operating without trade certificates have not been closed, and that's the reason Joint Commissioner has asked local authorities to make sure those stores and service centers are closed immediately, and also login ID of all those centers operating without trade certificates has to be collected within 1 day. CNBC-TV18 has spoken to Maharashtra Joint Commissioner, Transport Commissioner, and he has said, as per rules, stores cannot operate without trade certificates, and he has asked reply from Ola Electric, and once the company replies, those replies will be examined and further action will be taken accordingly.
Okay, all right, Sudarshan, thanks very much for that. Going has been really tough for Ola Electric. Can you imagine the 52-week high for this stock? 52-week high for Ola Electric many months back was about 155 rupees. From that level, the stock's now come down to just about 50 odd. So tough going for investors here. That's Ola. However, let's talk about something that's at the other end of the spectrum. One part of the market that's been rock solid, rock steady and sizzling most of the time. We're talking about wealth management. By the way, before we talk about what the management said, let's put up the stock. Look at 361 Wealth Management now, 6% higher. Serious momentum in the wealth management stock space. And it's not alone. Angel is picking up. Motilal is picking up. Even Nuvama is now positive. Nuvama is up about 1%. So the chase for wealth management stocks is on. And these are still off 20 to 30% off their all-time highs, most of these stocks in the market correction. So what's the story here? The big deal of the day, obviously, is 361 Wealth Management with UBS. The stock has been moving higher after the company announced a strategic collaboration with UBS. And as a part of this deal, 361 Wealth Management will be issuing warrants to UBS on a preferential basis. Now, this will result in UBS picking up about a 4.95% stake in this listed entity, that is 361 Wealth Management. And it's happening at a premium price as well. The price at which this deal is happening is 1,030 rupees a piece. So the warrants can be converted into an equal number of course, equity shares within 18 months from the date of allotment. We caught up with Karan Bhagat of 361 Wealth Management as well as Ginny Young of UBS Global Wealth Management today to understand the strategy behind this collaboration. Take a look.
I think most importantly what it gets to us is widening the platform for the client. And that's really what I think comes core to the culture of both UBS and 361, is to serve the clients in the best possible way. As a deep sign of, I think, collaboration, I think both UBS's investment into the equity warrants in the business, as well as our partnership in terms of, or our collaboration in terms of looking at the Credit Suisse and UBS business folding into our business, should add a lot of value to both our clients.
First of all, we want to bring this word global to the next level. So this transaction basically combines the global and regional reach capabilities of UBS, combining it with the reach and the capabilities of the local 361 India franchise. And this really, we believe that we are best placed to actually serve our global Indian clients, both domestically and also globally. That the wealth management, scene in India is really, growing at an exponential rate. And simply put, right, we really want to have a piece of the pie too. As you can see, these three components add together. We are really intertwining together our capabilities and making sure that we are able to serve our clients, global Indian client wealth management, in the most holistic way.
Okay, Post, that's the big deal that's taking place in the wealth management. Talking about the corporate earnings today, on the deck will be HCL Tech, that reports numbers later, and the key to track will be the FY26 guidance. Now, towards the end of March or early April, the guidance set was about 2 to 4%, 3 to 5%, but anything which is up to, say, 1 to 5% would be par for the course. But what we saw with the case of Infosys is that despite the company reporting a lower than expected guidance of 0 to 3%, investors still liked it because, for one, they gave a guidance, and two, they believe that it's not as bad as what the worst case scenario would have been. So watch for the FY26 guidance. As I said, 1 to 4, 2 to 5% should be perhaps in line with street expectation. Margin guidance for HCL Tech likely to remain unchanged at 18 to 19%. Now, on to the top line. Revenue for HCL Tech is likely to decline quarter on quarter. We've seen even for the rest of the IT companies, whether it's Wipro, TCS or Infosys, the top line had declined. One, on account of seasonality. Two, the macro got tougher towards the end of the quarter. And for HCL Tech in particular, there was this large retail client whose project came to an end in Q3. So sequentially, that that would have an impact. Margins too for HCL Tech would decline sequentially quarter on quarter to 18.1%. One, negative operating leverage. Two, wage hikes. And three, some visa costs. But focus on the commentary, focus on the FY26 guidance. That is going to be the key to track. But let's invite Jay Bala of cashthechaos.com on the show now. Jay, afternoon, and thanks for joining in. Today is a quieter session. We've had 4-5 solid days on the trot. Today, markets seem to be consolidating. What have you made of the day so far?
Hi, I'm good to be here. See, more importantly, what I've made of the day, it's more important what I've made of the recent couple of weeks. For the first time in several weeks, there's arisen a bullish case for the markets for the medium term. And if this is the start of the bullish move or the resumption of the uptrend that started from the pandemic low, and we take the decline from the September high to April low as a correction, we could possibly be thinking of something like 29,000 to 35,000 on the Nifty over the next 12 months time frame. But this comes with an important, extremely important caveat. Reliance Industries, Nifty IT Index are strongly disagreeing with this view. So, whether you're going to be long or short from this point onwards, you need to keep hedges from this point going forward. That even the bullish case is not all clear because of this. Even HDFC Bank, for that matter, is actually coming to likely an important top that's coming up at 1950. If HDFC Bank sinks back into its previous range of about 1880, sub 1900, that will probably signal this is a bull trap. But as I said earlier, for the first time in several weeks and several months, there has arisen a very bullish case for the markets.
And your bullish case, Jay, is leading you to believe in about 12 months, if the bullish case works out, we could be 29,000 to between 35,000 on the Nifty.
That's right. And
but do you? I mean, it's all about probability, right? The probability is higher because that's how you got to decide. Or you think, because I remember speaking with you and you saying either it's this or that. So it's kind of extreme on both sides. So are you still in that situation, or you think that on balance the probability of the market moving up in this fashion as you're describing is more now?
See, I would give the bullish case a very slight edge. I would say something like 60-40 for the favoring the bullish case. See, the problem with the markets is that if Reliance alone had been painting a downtrend for the slightly medium term, then the markets have done without Reliance. Like between 2008 and 2015. Reliance was flat for 5 years, and the rest of the market did okay. But this is doing along with the Nifty IT Index and along with a possible top for the for the HDFC Bank, which is now the private sector bank, which are giving the lift to the markets. And in the global space, the US techs, the mega techs, and the Nasdaq Composite are signaling a downtrend. Even there is indecision. The Dow is actually raising a bullish potential. So that's the reason why I'm saying you can do three things here. One, you can be bullish, bearish, or you can be the hedges. I'm very comfortable doing nothing. That's very few people are comfortable doing. And whatever I'm doing, it's in my trading account, not in my investment accounts. I'm keeping my trading account active, in the investment account silent.
Got it. Jay, just stay on. I think we have the US Vice President speaking at that public event in Jaipur on his India visit. Let's listen into what Mr. J.D. Vance is saying.
Inspires remarkable loyalty because of the strength of his belief in his people and in his country. Now, we're so grateful for Prime Minister Modi's hospitality as well as the reception that he and everyone else in this country have given us on this first trip for me to India. This is my first time visiting the birthplace of my wife's parents, and she's, of course, in the front row there. There you are, Usha. Thank you. She's a bit of a celebrity, it turns out, in India, I think more so than her husband. But I haven't been here long, but already I've been fortunate enough to visit the Akshardham Temple. Did I pronounce that right, honey? I did okay? All right. With my family this morning, as a matter of fact. And last night, Prime Minister Modi welcomed me, Usha, and our 3 small children at his beautiful home. I've been amazed by the ancient beauty of the architecture of India, by the richness of India's history and traditions, but also by India's laser-like focus on the future. And those things, I think this appreciation for history and tradition and this focus on the future is very much something that I think animates this country in 2025. Now, in other countries I visited, it sometimes feels like there's a flatness, a saneness, a desire to just be like everyone else in the world. But it's different here. There's a vitality to India, a sense of infinite possibility, of new homes to be built, new skylines to be raised, and lives to be enriched. And there's a pride in being Indian, a feeling of excitement about the days that lie ahead. Now, it's a striking contrast with too many in the West, where some in our leadership class seem stricken by self-doubt and even fear of the future. To them, humanity is always one bad decision away from catastrophe. The world will soon end, they tell us, because we're burning too much fuel, or making too many things, or having too many children. And so, rather than invest in the future, they too often retreat from it. Some of them pass laws that force their nations to use less power. They cancel nuclear and other energy generation facilities, even as their choices, the choices of these leaders, lead to more dependence on foreign adversaries. Meanwhile, their message to their friends, to countries like India, is to tell them that they're not allowed to grow. Well, President Trump rejects these failed ideas. He wants America to grow, he wants India to grow, and he wants to build the future with our partners all over the globe. And when I look at this audience, or when I visit this incredible country over these last couple of days, I see a people that will not be held back. Now, the most profound responsibility I believe that all of us have is not to ourselves, but to the next generation, to make sure we leave them with a better society than the one that our parents and our grandparents gave us. And this is the world that America seeks to create with you. We want to build a bright new world, one that's constantly innovating, one that's helping people to form families, making it easier to build, invest, and trade together in pursuit of common goals. Now, I believe that our nations have much to offer one another, and that's why we come to you as partners looking to strengthen our relationship. Now, we're not here to preach that you do things any one particular way. Too often in the past, Washington approached Prime Minister Modi with an attitude of preachiness, or even one of condescension. Prior administrations saw India as a source of low-cost labor on the one hand, even as they criticized the Prime Minister's government, arguably the most popular in the democratic world. And as I told Prime Minister Modi last night, he's got approval ratings that would make me jealous. But it wasn't just India. This attitude captured too much of our economic relationship with the rest of the world. So we shipped countless jobs overseas, and with them our capacity to make things, from furniture, appliances, and even weapons of war. We traded hard power for soft power, because with economic integration, we were told, would also come peace through sameness. Over time, we'd all assume the same sort of bland, secular, universal values, no matter where you lived. The world was flat after all. That was the thesis, and that was what they told us. And when that thesis proved false, or at least incomplete, leaders in the West took it upon themselves to flatten it by any means necessary. But many people across the world, and I think your country counts among them, they did not want to be flattened. Many were proud of where they came from, their way of life, the kind of jobs they worked, and the kind of jobs their parents worked before them. And that very much includes people in my own country, the United States of America. Now, some of you are aware of my own background. I actually didn't plan to talk about my background at all until last night at dinner, while my children mostly behaved. We gave them an A- for behavior with the Prime Minister. The Prime Minister said, I have one request. I want you to talk a little bit about your background. And so I wanted to do that. For those of you who don't know anything about me, I wanted to talk about it. I come from, and I'm biased, the greatest state in the Union, the state of Ohio, a longtime manufacturing powerhouse in the United States of America. My home specifically is a place called Middletown. Now, it's not a massive city by any means. It's not Jaipur, but it's a decent-sized town and a place where people make things, which has been a point of pride in Middletown for generations. It's filled with families like my own, some of whom called us hillbillies, Americans who came down from the surrounding hills and mountains of West Virginia, Tennessee, and Kentucky to cities like Middletown in pursuit of the manufacturing jobs that were creating widespread prosperity for families all across America. They came to Middletown in search of what we call back home the American dream. In Middletown, my parents raised me. My grandparents raised me. They taught us to work hard. They taught me to study hard. And they taught me to love God and my country and always be good to your own. My granddad, who I called Papaw growing up, he typified that. Late into life, he worked as a steelmaker at the local mill. And I know India has a lot of those. Papaw's job gave him a good wage, stable hours, and a generous pension. All that allowed him to support not just him and my grandmother, but his own daughter and grandkids with him. Now, by the time I came around, money was awfully tight, but he worked hard to make a good living for all of us. Now, I know Papaw and Mamaw were grateful for the way of life their country made possible. Their generation bore witness to the formation of America's great middle class. And by creating an economy centered around production, around workers who build things, and around the value of their labor, our nation's leaders then transformed their country and made thousands of little Middletowns possible. The government supported its labor force. We created incentives for productive industries to take root and struck good deals with international partners to sell the goods made in the United States of America. But as America settled into world historic prosperity it generated, our leaders began to take that very prosperity and what created it for granted. They forgot the importance of building, of supporting productive industry, of striking fair deals, and of supporting our workers and their families. And as time went on, we saw the consequences. In my hometown, factories left, jobs evaporated, America's middle towns ceased to be the lifeblood of our nation's economy. And the United States, as it became transformed, those very people, the working class, the background of the United States of America, were dismissed as backwards for holding on to the values their people had held dear for generations. Now, Middletown's story is my story, but it's hardly unusual in the United States of America. There are tens of millions of Americans who, over the last 20 or so years, have woken up to what's happening in our nation. But I believe they woke up well before it's too late. Now, like you, we want to appreciate our history, our culture, our religion. We want to do commerce and strike good deals with our friends. We want to found our vision of the future upon the proud recognition of our heritage rather than self-loathing and fear. I work for a president who has long understood all of this, whether through fighting those who seek to erase American history or in support of fair trade deals abroad. He has been consistent on these issues for decades. And as a result, under the Trump administration, America now has a government that has learned from the mistakes of the past. It's why President Trump cares so deeply about protecting the manufacturing economy that is the lifeblood of American prosperity and making sure America's workers have opportunities for good jobs. As we saw earlier this month, he will go to extraordinary lengths to protect and expand those opportunities for all Americans. And so today I come here with a simple message. Our administration seeks trade partners on the basis of fairness and of shared national interests. We want to build relationships with our foreign partners who respect their workers, who don't suppress their wages to boost exports, but respect the value of their labor. We want partners that are committed to working with America to build things, not just allowing themselves to become a conduit for transshipping others' goods. And finally, we want to partner with people and countries who recognize the historic nature of the moment we're in, of the need to come together and build something truly new, a system of global trade that is balanced, one that is open, and one that is stable and fair. Now, I want to be clear, America's partners need not look exactly like America, nor must our governments do everything exactly the same way. But we should have some common goals, and I believe here in India we do. in both economics and in national security. And that's why we're so excited. That's why I'm so excited to be here today. In India, America has a friend, and we seek to strengthen the warm bonds our great nations already share. Now, critics have attacked my president, President Trump, for starting a trade war in an effort to bring back the jobs of the past, but nothing could be further from the truth. He seeks to rebalance global trade so that America, with friends like India, can build a future worth having for all of our people together. And when President Trump and Prime Minister Modi announced in February that our countries aim to more than double our bilateral trade to $500 billion by the end of the decade, I know that both of them meant it. And I'm encouraged by everything our nations are doing to get us there. As many of you are aware, both of our governments are hard at work on a trade agreement built on shared priorities, like creating new jobs, building durable supply chains, and achieving prosperity for our workers. In our meeting yesterday, Prime Minister Modi and I made very good progress on all of those points. And we are especially excited to formally announce that America and India have officially finalized the terms of reference for the trade negotiation. I think this is a vital step. Thank you. I believe this is a vital step toward realizing President Trump's and Prime Minister Modi's vision, because it sets a roadmap toward a final deal between our nations. I believe there is much that America and India can accomplish together. And on that note, I want to talk about a few areas of collaboration today, how India and the United States can work together. First, perhaps most importantly, to protect our nations. Second, to build great things. And finally, to innovate the cutting-edge technologies both our countries will need in the years to come. Now, on defense, our countries already enjoy a close relationship, one of the closest relationships in the world. America does more military exercises with India than we do with any other nation on earth. The U.S.-India Compact that President Trump and Prime Minister Modi announced in February will lay the foundation for even closer collaboration between our countries. From javelins to Stryker combat vehicles, our nations will co-produce many of the munitions and equipment that we'll need to deter foreign aggressors. Not because we seek war, but because we seek peace, and we believe the best path to peace is through mutual strength. And launching the Joint Autonomous Systems Industry Alliance will enable America and India to develop the most state-of-the-art maritime systems needed for victory. It's fitting that India, this year, is hosting the Quad Leaders Summit this fall. Our interests in a free, open, peaceful, and prosperous Indo-Pacific are in full alignment. Both of us know that the region must remain safe from any hostile powers that seek to dominate it. Growing relations between our countries over the last decade are part of what led America to designate India a major defense partner, the first of that class. This designation means that India now shares with the UAE a defense and technology infrastructure and partnership with the United States on par with America's closest allies and friends. But we actually feel that India has much more to gain from its continued defense partnership with the United States, and let me sketch that out a little bit. We, of course, want to collaborate more. We want to work together more, and we want your nation to buy more of our military equipment, which of course we believe is the best in class. American fifth-generation F-35s, for example, would give the Indian Air Force the ability to defend your airspace and protect your people like never before. And I've met a lot of great people from the Indian Air Force just in the last couple of days. India, like America, wants to build, and that will mean that we have to produce more energy. It's more energy production and more energy consumption. And it's one of the many reasons why I think our nations have so much to gain by strengthening our energy ties. As President Trump is fond of saying, America has once again begun to drill, baby, drill. And we think that will inure to the benefit of Americans, but will also benefit India as well. Past administrations in the United States of America, I think motivated by a fear of the future, have tied our hands and restricted American investments in oil and natural gas production. This administration recognizes that cheap Dependable energy is an essential part of making things and is an essential part of economic independence for both of our nations. Of course, America is blessed with vast natural resources and an unusual capacity to generate energy, so much that we want to be able to sell it to our friends like India. We believe your nation will benefit from American energy exports and expanding those exports. You'll be able to build more, make more, and grow more, but at much lower energy costs. We also want to help India explore its own considerable natural resources, including its offshore natural gas reserves and critical mineral supplies. We have the capacity and we have the desire to help. Moreover, we think energy co-production will help beat unfair competitors in other foreign markets. But India, we believe, can go a long way to enhance energy ties between our nations. And one suggestion I have is maybe consider dropping some of the non-tariff barriers for American access to the Indian market. Now, I've talked about this, of course, with Prime Minister Modi. And look, President Trump and I know that Prime Minister Modi is a tough negotiator. He drives a hard bargain. It's one of the reasons why we respect him. And we don't blame Prime Minister Modi for fighting for India's industry. But we do blame American leaders of the past for failing to do the same for our workers. And we believe that we can fix that to the mutual benefit of both the United States and India. Let me give an example. American ethanol, we believe made from the finest corn in the world, can play a tremendous role in enhancing our partnership. And I know our farmers would be delighted to support India's energy security ambitions. We welcome the Modi government's budget announcement to amend India's civil nuclear liability laws, which currently prevent U.S. producers from exporting small modular reactors and building larger U.S.-designed reactors in India. There's much that we can create, much that we can do together. We believe that American energy can help realize India's nuclear power production goals, and this is very important, as well as its AI ambitions. Because as the United States knows well, and I know that India knows well, there is no AI future without energy security and energy dominance. And that brings me to my final point of collaboration. I believe that the technological collaboration between our countries is going to extend well beyond defense and energy. The U.S.-India Trust Initiative that President Trump and Prime Minister Modi have launched will be a cornerstone of the partnership in the future. It'll build on billions of dollars of planned investments that American companies have already announced across India. In the years to come, we're going to see data centers, pharmaceuticals, undersea cables, and countless other critical goods being developed and being built because of the American and Indian economic partnership. And I'll say it again, I think that our nations have so much to gain by investing in one another. America investing in India, and of course, India investing in the United States of America. And I know that Americans, our people, are excited about that prospect, and that President Trump and I are looking forward to stronger ties. Americans want further access to Indian markets. This is a great place to do business, and we want to give our people more access to this country. And Indians, we believe, will thrive from greater commerce from the United States. This is very much a win-win partnership. It certainly will be far into the future. And as I know this audience knows better than most, neither Americans nor Indians are alone in looking to scale up their manufacturing capacity. The competition extends well beyond cheap consumer goods and into munitions, energy, infrastructure, and all sorts of other cutting-edge technologies. I believe that if our nations fail to keep pace, the consequences for the Indo-Pacific, but really the consequences for the entire world, will be quite dire. And this, again, is where India and the United States have so much to offer one another. We've got great hardware, the leading artificial intelligence hardware in the world. You have one of the most exciting startup technology infrastructures anywhere in the world. There's a lot to be gained by working together. And this is why President Trump and I both welcome India's leadership in a number of diplomatic organizations, but of course in the Quad. We believe a stronger India means greater economic prosperity, but also greater stability across the Indo-Pacific. which is, of course, a shared goal for all of us in this room, and is a shared goal for both of our countries. Now, I want to close with one last story, or maybe a couple of stories. So, you know, my son Ewan is 7 years old. He's our firstborn son. And yesterday, after we had dinner at the Prime Minister's house, the food was so good and the Prime Minister was so kind to our 3 children that Ewan came up to me afterwards and he said, "Dad, you know, I think maybe I could live in India." But I think after about 90 minutes in the Jaipur sun today at the Great Palace, he suggested that maybe we should move to England. So you take the good with the bad here. But I want to talk about Prime Minister Modi because I think he's a special person. I first met Prime Minister Modi at the AI Action Summit in February, and we had a lot of important discussions on AI and other policies to prepare for. The Prime Minister also managed to figure out that my son Vivek was actually turning 5 years old on the trip. This was in Paris just a couple of months ago. So think about this. Amid a huge international policy conference, he took the time to stop by where I was staying, wish our second son, Vivek, a happy birthday, and even bring him a gift. Ush and I were both genuinely touched by his graciousness, and we've been even more impressed by his warmth since we arrived in India. Now, it's interesting. Some of you may know that when you're a politician, your kids spend almost as much time in the limelight as you do, and the great things about kids is they are brutally honest. They're brutally honest with everybody, whether you want them to be or not. And our 7-year-old, our 5-year-old, and then our 3-year-old baby girl, Mirabelle, it's interesting. They've only really attached themselves to, they've only really liked, I should say, they've only really built a rapport with 2 world leaders. The first, of course, is President Trump. He just has a certain energy about him. But Prime Minister Modi, it's the exact same thing. Our kids just like him. And I think that because kids are such good, strong of characters, I just like Prime Minister Modi too. And I think it's a great foundation for the future of our relationship. I could tell when Prime Minister Modi came over a couple of months ago, and I believe today that he is a serious leader who has thought deeply about India's future prosperity and security, not just for the rest of his time in office, but over the next century. And I want to end by making a simple, overarching point. We are now officially 1/4 into the 21st century, 25 years in 75 years to go. And I really believe that the future of the 21st century is going to be determined by the strength of the United States-India partnership. I believe, thank you. I believe that if India and the United States work together successfully, we are going to see a 21st century that is prosperous and peaceful. But I also believe that if we fail to work together successfully, the 21st century could be a very dark time for all of humanity. So I want to say it's clear to me, as it is to most observers, that President Trump, of course, intends to rebalance America's economic relationship with the rest of the world. That's going to fundamentally will cause profound changes within our borders in the United States, but of course with other countries as well. But I believe that this rebalancing is going to produce great benefits for American workers. It's going to produce great benefits for the people of India. And because our partnership is so important to the future of the world, I believe President Trump's efforts, joined, of course, by the whole country of India and Prime Minister Modi, will make the 21st century the best century in human history. Let's do it together. God bless you, and thank you for having me.
The market closed with gains, small gains off the day's high. Nifty ends near 24,140 levels. Sensex holds on to 79,500. Real estate FMC stocks were the top gainers, while IT stocks slid in today's session.
A big boost to banks after RBI issues amendments to the liquidity coverage norms. While RBI eases conditions for wholesale deposits, the central bank tightens conditions for internet and mobile linked deposits and GSEC valuation.
Steel companies buzz and trade after the government imposes 12% safeguard duty on import of some steel products. Brokerages see this as a positive for the sector. Hello and welcome to a fresh new edition of Markets Forward, your go-to program where we aim to get you everything you need to know as you gear up for the next trading session. Today was a slower day after really go-go markets we've had over the last 2 weeks or so. I'm Prashant. With me, my colleague Surabhi. Surabhi, hi.
Hi, Prashant. Slow day, but not bad because digesting the recent rocket gains that we've made.
Yeah.
And pretty decent for the mid-caps. Mid-caps were outperforming. The breadth of the market was good. And there were several pockets of action today.
Lots of pockets of action, and mid-cap and small-cap indices 1% plus in gains. And I mean, can't complain. So it's been I think today was the 8th day. Nifty Bank is up 13%. And the Nifty is still up 10 because today, by the time we closed, it was kind of, gains fizzled out. We ended with about a 15-odd point gain. So not very much to show for it. Market breadth was positive. I think almost 2:1 in favor of advances. And a lot of action there in terms of single stocks really coming through. Let's actually go take it across straight to Vivek to quickly wrap up the day's action in terms of what moved up and down. Vivek, over to you.
Thank you so much for that. Like you mentioned, another session with the advanced decline ratio, market breadth, very strong, very positive. Well, first on the list has to be banks as well as NBFCs. These are the set of stocks that did quite well. Remember, RBI's final LCR norms quite less restrictive against what the initial draft norms were. Names like SBI, Kotak Mahindra, HDFC Bank, all of them gained quite significantly in the session today. The other set of stocks that rebounded quite smartly were the FMCG and especially the consumer discretionary names, especially towards the later part of the trading session. So names like Colgate also seeing a double upgrade by UBS, almost 4.5% higher, ITC, Imami, and even some of the other names like United Spirits as well as Radico Khaitan doing very well in the session. Both of them seeing quite a bit of buying activity emerge in the later half of the session. The other stocks that did quite well were the solar EPC players or players present in the solar value chain. Waaree Energies, this particular company seen as a beneficiary as the US overnight imposed very restrictive tariffs on certain Southeast Asian countries as far as solar cells and ingots were concerned. Dixon Technologies, another sharp mover in the session. Amongst the top F&O gainers today, along with that, the Street sees the company as a beneficiary of shifting of certain supply chains to India. Now, also keep an eye out on Voltas, this particular stock. Post the CNBC hours news break saw quite a bit of a surge. Our sources tell that there could be a likely relaxation of BIS norms for AC and AC components, especially compressors, Voltas being amongst the key beneficiary if that does come into fruition. On the other hand, quite a few negatives as well. IndusInd Bank Street was worried on the back of the fact that the bank has gone ahead and appointed EY to conduct a forensic audit into a 600 crore discrepancy as far as the MFI book is concerned. Stock ended low by almost 5%, and two-wheeler stocks, especially Hero Motor, amongst the top laggards today. Jefferies downgraded select two-wheeler stocks. They've gone ahead and cut volume estimates for the entire space. And Cholafin, one of the few stocks as far as the broad end of the markets are concerned, a CLSA downgrade coming in, and that stock too ended significantly lower. Chola Investment and Finance is the stock we're talking about.
Okay, indeed, there was some pressure over there. Thank you very much for that, Vivek. Well, let's now get to our guest before we talk about the next sector in focus, which is banking. We have Jay Bala of Cash the Chaos joining in, also Sudeep Bandyopadhyay of IndiTrade Capital. Gentlemen, good afternoon. Good to have you on. Jay, first, let me come to you on the market's technical construct and makeup right now. We've had a couple of very, very strong days, backed by liquidity, backed by FPI flows. What do you make of the market, and what is the trading advice that you'd have at this point in time?
Yeah, for the first time in several months, the markets are starting to look bullish, and it's probably completed a correction from September to April. But this is just a slight edge over the bearish case, so it's not that decks are not completely clear. Reliance Industries and Nifty IT Index strongly disagrees with this view. So I would consider Reliance as a complete sector. And so because of that, two sectors are strongly displaying and they have heavy weight within the index. And banking index, which is lifting the markets, that's within that, the HDFC Bank, the top name within it, it's probably completing a important top. If it were to drop into 1880, it'll mean an important reversal. As far as trading advice goes, whether you're bullish or bearish, definitely hedges are a must because the markets can go either way. And in the bullish case, you have to wait for a pullback to come through. If the markets were to pull back somewhere close to 23,270 to 22,970 and holds that, that will be a bullish addendum to the market.
Got that, Jay. Stay with us. I'm going to come back to you. IndusInd Bank, and we were talking about banks and financial stocks, of course, quite a bit lately. But the stock was down 5 after rallying about 15-20% over the last 4-5 days. The lender has appointed EY to conduct a second forensic audit to probe a 600 crore rupee discrepancy in its MFI portfolio. Ritu is here with latest. Ritu.
Well, Prashant, it keeps getting worse for IndusInd Bank, even as that derivative portfolio forensic audit is still on from Grant Thornton. The initial hit has been estimated. Now our sources are confirming the reports that had surfaced that IndusInd Bank has indeed now appointed Ernst & Young to carry out a forensic audit, this time of its microfinance portfolio, following the discovery of a near 600 crore discrepancy in this book. Now, the issue we understand is related to the accrual of interest income in this microfinance book and is believed to have emerged between the second and third quarter of the last financial year. Now, while the bank has not made any public disclosures about these discrepancies amid the ongoing forensic audit, the bank has been drawing from its contingent provisions to account for some of these lapses and make these kind of provisions, even though it has not spelt them out in public, as we understand. For context, the contingent provisions of the bank stood at about 1325 crores as of the third quarter, down from about 1525 crores in the previous quarter. Their micro loan book is about 32,500 odd crores, and they had reported about 305 crores in new stress and 344 crores in write-offs in the microfinance segment alone in the third quarter. So more trouble brewing. The audit's going to reveal the extent of the trouble. We've reached out to the bank for a comment, which is still awaited.
Okay, fair enough. Ritu, thanks very much for the latest update. And that's the reason why this stock was under pressure throughout the session today. We also have Sudeep Bandopadhyay with us. Let's get in a quick view. Sudeep, IndusInd Bank, just when you think the worst of the troubles are over, all the issues are out, this is something absolutely new. Your advice?
Microfinance book issue is across the industry. I mean, I'm not sure exactly, what happened here, but that the microfinance book for all the lenders is under pressure is very well known, and I suspect that part of it is already provided for or lying in some form or shape in their contingency provisions. So I won't worry too much. Of course, this kind of revelation, unnerves the market, and the share price got depressed today. But I won't read too much into it. I suspect that by and large, the entire microfinance issue is well known to the market and pretty well factored in their books as well, because auditors would not, have kind of rested without that being thoroughly examined. So I won't attach too much of weightage to this particular issue, and probably this dip is a buying opportunity for IndusInd Bank, because valuation-wise, we all know it's absolutely very, very attractive.
Sure. Okay. So you're saying perhaps this could be a good entry point for IndusInd. Got it. We want to take slightly broader questions in the rest of the banking space as well. It's the hottest part of the market right now. Before that, let's address this issue of new regulations from the RBI. The Reserve Bank of India has issued amendments to its liquidity coverage norms. RBI has eased conditions for wholesale deposits. It has, however, tightened conditions for internet and mobile linked deposits, as well as GSEC valuation. Abhishek is here with the details.
Well, RBI has announced, a revised liquidity coverage ratio in favor of the banks. And if you take a look, additional runoff rate is at 2.5% to internet and mobile banking enabled retail and small business deposits, which was earlier envisaged at 5% in the draft norms. So funding from non-financial entities such as trust like educational trust, charitable trust and religious trust, partnerships and LLLPs shall attract a lower run rate of, 40% runoff versus 100% envisaged earlier. So the biggest change is the sharp reduction that you are seeing in runoff factors for the wholesale deposits, and that's a bonanza for entities like HDFC Bank and Axis Bank is what analysts have mentioned. So Macquarie has written a note. They say that the impact from RBI relaxation, the RBI expects a 600 basis point improvement in LCR ratios for the banking system from Q3 FY25 LCR levels. So they believe that this is encouraging and will provide strong support in the credit cycle. Back to envelope calculation for them shows that there will be a release of 2.5 to 3 lakh crore worth of liquidity which may get deployed in this system. So hence, this would imply a 140 to 160 basis point potential increase in credit growth for the banking sector in FY27, because these rules are applicable from 1st of April 2026. So on your screen for reference are the various LCR of various banks as of Q4 and Q3 FY25. Back to you.
Okay. All right, Abhishek. Got it. Thank you very much for that. Jay, just quickly back to you. Since you're saying overall the market setup is looking positive after a long time, what about banks? They're in leadership position. Any trades here?
Yeah, see, IndusInd Bank you discussed. I don't think the high of 2024 and the all-time high is going to get taken out before 2026. It's going to consolidate in a sideways range for several months. When it comes to HDFC Bank, that's the leader here. And HDFC Bank, if for the bull case, if it were to drop under 1900, it's a little, not a perfect number. It's a rough number. More importantly, it's a structure that matters. So take it as a rough number. It can be 1900. If the HDFC Bank were to give up all these gains and drop into that zone, that will be very impactful for the overall market and the bull case and for the banking sector. So watch IndusInd Bank like a hawk in the next couple of sessions or by the end of the week. If it were to give up all the gains or some of the gains or major portion of the gains that it gives that made it this week, then that'll be quite negative and damage the bullish case.
Okay, so watch IndusInd Bank like a hawk, says Jay. We will definitely do that. But I think with that, we are completely out of time. Apologies for that, gentlemen. Shorter chat today, but thank you for joining in. Okay, well, with that, I suppose it's a wrap. Day 2, Tuesday done.
And I think that JD Vance's speech is going to be the highlight, which is going to be analyzed threadbare for the rest of the evening. Absolutely. Well, we'll take your leave. Thank you very much for staying with us. But news and updates continue. We'll take a quick commercial break. Be right back.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty gain for the sixth straight session. Banks and FMCG stocks lead the rally. Gold prices continue to hit record highs. 10 grams of gold now costs more than 1 lakh rupees in India. Nifty Bank rallies again as the RBI eases liquidity coverage norms for the bank. Governor Sanjay Malhotra signals a pro-growth and pro-liquidity stance boosts investor confidence.
He wants America to grow, he wants India to grow, and he wants to build the future with our partners all over the globe.
U.S. Vice President J.D. Vance says the India-U.S. relationship will determine the future of the 21st century, and a strong alliance is a win-win for both. Nudges India to buy more defense equipment from the U.S., including the F-35 fighter jets, calls for strengthening energy ties and more market access for U.S. companies. U.S. trade representatives welcome India's constructive engagement in tariff negotiations after Prime Minister Modi held bilateral talks with Vice President Vance. U.S. also claims serious lack of reciprocity in the trade relationship, calls for increasing market access, reducing non-tariff barriers, and a robust set of additional commitments to ensure long-term benefits. India's proposed digital competition law is likely to be put on the back burner considering concerns from the U.S. government and industry. Sources say government is unlikely to introduce the bill anytime soon due to the ongoing efforts to clinch a trade deal with the U.S. Walmart-owned Flipkart will shift its holding company from Singapore to India as it gears up to go public in the next 12 to 18 months. The move is aimed at easing compliance and streamlining tax structures. CNBC-TV18 was the first to report on Flipkart's plans to shift its domicile in December last year. The Delhi High Court pulls up Yoga Guru Ramdev for using the term Sharbat Jihad at Hamdard's Ruh Afza while promoting Patanjali's rose syrup. The court rules the comments are indefensible and shock the conscience. Patanjali Foods agrees to take down all ads targeting Ruh Afza after the rebuke. The Enforcement Directorate is likely to examine Gensol Engineering case under the Prevention of Money Laundering Act. SEBI has accused the company of diverting and misusing funds and barred its promoters from the market. The funeral of Pope Francis will be held on Saturday as tributes continue to pour in. U.S. President Trump and several world leaders will be in attendance. The Vatican releases images of the Pope dressed in a red robe in an open casket. Harvard files a lawsuit against the U.S. government for freezing funds worth $2 billion. The move sets up a landmark legal battle between America's oldest university and the Trump administration. Well, straight to the day's trading action. The Wall Street extended its winning streak on to day 6 now. The Nifty holding on to 24,000. Banks continue to lead from the front with the Nifty Bank hitting another record high. The banking heavyweights like HDFC, ICICI Bank and Kotak all continue to see buying. So that's the Nifty for you. Closing flat, but still above 24,000. The Sensex adding about 190 points. The Nifty Bank, as we pointed out, 300-point gain there today. And the Nifty Mid-Cap Index didn't do badly either. It was up by about 500-odd points. The rupee, meanwhile, trading in a narrow range, ending the day at 85.18 against the dollar. The greenback fell 6 paise after 6 to 7 days of gain. Support from positive domestic equities was negated by dollar short covering by investors. This as concerns over economic headwinds from tariffs persist. Now, in the commodities market, gold prices in India at another all-time high, crossing the 1 lakh rupee per 10-gram mark for the first time. Spot gold prices hit a record high of $3,473 an ounce in the global market. The yellow metal rallying on the back of a weak dollar index and increasing global economic uncertainty. So if you're buying gold, well, get ready to shell out a lot more. In the oil market, crude oil prices rose as investors used yesterday's losses to cover short positions. However, concerns persist over economic headwinds from tariffs and the U.S. monetary policy that could dampen fuel demand. But back home, the Reserve Bank of India has eased liquidity coverage norms for banks. The revised norms, among others, will allow banks to set aside lesser funds as a buffer against deposits raised through digital channels. Remember, the RBI Governor Sanjay Malhotra had earlier said that the net impact of the measures will improve the liquidity coverage ratio of banks by 6 percentage points as of the 31st of December 2024. And staying with the banking sector, the Nifty Bank rallying for the 6th day in a row as the RBI eases liquidity coverage norms. Governor Sanjay Malhotra signaling a pro-growth and pro-liquidity stance has boosted investor confidence. Ritu joins us now with more on the key triggers fueling the banking rally. Ritu.
Well, a spate of positive developments for the banking system that could explain the rally we're seeing in banking stocks, but at the heart of it is a regulatory environment that is turning more supportive under RBI Governor Sanjay Malhotra. RBI has deferred tighter project finance norms, and they've even provided banks additional time to comply with these new LCR requirements, and to the street that is signaling a clear pro-growth stance. Adding to the momentum, systemic liquidity has also flipped into surplus after a 4-month deficit, with the RBI injecting more than 15.5 lakh crores in the system in the recent months through OMOs, VRRs and forex swaps. Now, while the recent 50 basis point rate cut may weigh on bank NIMs, it is aimed at boosting credit growth and demand, and CRISIL expects credit growth to rise by up to 200 basis points this fiscal, helped by these tailwinds. The strong show by banks like HDFC and ICICI Bank in their fourth quarter has also helped boost sentiments. Now, on the regulatory front, these latest LCR relaxations are a big positive because compared to earlier draft norms, the final rules are more lenient, and they are expected to improve the aggregate LCR of banks by 600 basis points, freeing up almost 3 lakh crores of lendable resources and potentially lifting the overall credit growth by up to 1.5%, according to ICRA estimates. RBI also recently lowered the risk weight on bank lending to NBFCs and MFIs. That could free up an estimated 40,000 crores of capital. Now, co-lending norms, they've also been expanded to include all sectors and all regulated entities, and even priority sector lending norms have been revised, enhancing the loan limits and broadening the scope for renewable and housing credit. So put together, it is a powerful combination of ample liquidity, regulatory easing, and strong earnings that is fueling this banking rally. But that said, not all concerns are off the table. Deposit and credit growth momentum remains a key watch point, and there are still some lingering risks around asset quality issues in unsecured loans and microfinance segment.
All right, Ritu, many thanks. And the big story, US Vice President J.D. Vance in Jaipur on day 2 of his India visit. Vance, along with his family, visited the Amer Fort and the Hawa Mahal in the Pink City. He then addressed the Rajasthan International Centre. In his speech, Vance said the India-US relationship will determine the future of the 21st century, and a strong alliance is a win-win for both nations. Vance also nudged India to buy more defence equipment from the US, including the F-35 fighter jets. Remember, President Trump has said the same. Vance has called for strengthening energy ties as well and asked for more market access for US companies, wants India to drop non-tariff barriers. Now, last night, Prime Minister Modi hosted J.D. Vance and his family for dinner and held bilateral talks. The US trade representative released a statement on the talks, welcoming India's constructive approach. The statement also claimed there's a serious lack of reciprocity in the trade relationship and called for reducing non-tariff barriers and robust set of additional commitments to ensure long-term benefits. Here's J.D. Vance speaking in Jaipur.
We actually feel that India has much more to gain from its continued defense partnership with the United States, and let me sketch that out a little bit. We, of course, want to collaborate more. We want to work together more, and we want your nation to buy more of our military equipment, which, of course, we believe is the best in class. American fifth-generation F-35s, for example, would give the Indian Air Force the ability to defend your airspace and protect your people like never before. And I've met a lot of great people from the Indian Air Force just in the last couple of days. India, like America, wants to build. And that will mean that we have to produce more energy. It's more energy production and more energy consumption. And it's one of the many reasons why I think our nations have so much to gain by strengthening our energy ties. As President Trump is fond of saying, America has once again begun to drill, baby, drill. And we think that will inure to the benefit of Americans, but will also benefit India as well. Today, I come here with a simple message. Our administration seeks trade partners on the basis of fairness and of shared national interests. We want to build relationships with our foreign partners who respect their workers, who don't suppress their wages to boost exports, but respect the value of their labor. We want partners that are committed to working with America to build things, not just allowing themselves to become a conduit for transshipping others' goods. And finally, we want to partner with people and countries who recognize the historic nature of the moment we're in, of the need to come together and build something truly new, a system of global trade that is balanced, one that is open, and one that is stable and fair. Now, I want to be clear, America's partners need not look exactly like America, nor must our governments do everything exactly the same way. but we should have some common goals, and I believe here in India we do.
Parikshit Luthra joins us now from Jaipur. Parikshit, what did the audience in Jaipur make of J.D. Vance's speech?
Well, the speech was definitely well appreciated. He made a hard-hitting speech for over 30 minutes at the Rajasthan International Centre here in Jaipur, where it is quite hot as well. And you saw that reference from J.D. Vance to the heat here. But there were a couple of very clear messages. One, they seek a strong trading partnership with India. He said that both Prime Minister Modi and J.D. Vance spoke about shared priorities when it comes to trade during that meeting yesterday, and they want a strong trade deal for the future. And he clearly outlined the ambitions of the Trump administration here. One, to have more market access for American companies. One, for India to drop those non-tariff barriers as soon as possible. For India to be a big buyer of defense equipment and not just think about co-production of defense equipment. Be a big buyer of items like F-35s, which India has actually not considered, not decided on at all. Number two, the energy relationship. Clearly, there was a major push, and perhaps the clearest push from the Trump administration to India to buy more energy, oil and gas, ethanol from the United States. He said that we're making American ethanol that can help your farmers, that can serve your factories, your cars all across the country. You want to manufacture more, you want to build more, and America can be your reliable supplier of cheap oil and gas as well. He also said that you may have ambitions to have nuclear energy or for artificial intelligence or data centers. All of those can be powered by American energy. So clearly what he was talking about was long-term contracts in both the defense and the energy sector, something that India will have to make some very strategic geopolitical choices over. There was also a dig and a message when it comes to China that if India and US work together, then this could be the most pivotal partnership for the 21st century. But if they don't, then it could be disastrous for the 21st century as well. And therefore, India and US must come together to make technological advancements for the benefit of both countries and for the world as well.
All right, Parikshit, many thanks for joining us there. You know, hang on, Parikshit, you're also working on another story which is separate from what's happening in Jaipur, but linked to what's happening in Jaipur as well. We learned that the proposed digital competition law is likely to be put on the back burner, and that could have implications, you know, for, of course, the ongoing trade negotiations between India and the US, because US industry bodies have been vehemently opposing the proposed digital law.
This has to be seen in the light of an olive branch that India has been extending to the US administration since the time Trump 2.0 was sworn in. We've done away with the equalization levy. We've settled a case, antitrust case against Google for just about 20 crores. We've reduced tariffs on bourbon whiskey, high-end cars, high-end motorcycles as well, and also reduced tariffs on other goods. All of this to make sure that we address concerns of the US administration. Now, the digital competition law has been highlighted by different industry bodies, including the Coalition of Service Industries to CNBC-TV18 as a major hurdle in US investments in India, a major hurdle for companies like Amazon and Google. So they've been wanting this to be set aside. What India has done right now is that we've not taken a call as to when we want to bring this. And top sources telling us that this bill is now going to be put on the back burner because India's priority right now is to clinch a trade deal with the US. We don't want any hiccups there. We want to have an early agreement so that even the 10% baseline reciprocal tariffs is paused. So because the entire focus is on the Indo-US trade negotiation, this somehow this issue of the digital competition law can take a backseat for the moment. Deliberations on this have been going on since November 2013. The committee, the MCA-led committee, which had made a report on the digital competition law and the importance of such a law to regulate big tech in the digital marketplace, has been pending with the government for almost a year now. Stakeholder consultations are over, but there is no clarity on when this bill would be brought in Parliament. In fact, the Minister of State for Corporate Affairs he even went on to say, we're not going to rush through with this law. All due process would be followed.
All right, Parikshit, many thanks for joining us. Parikshit Luthra there reporting from Jaipur, where J.D. Vance has just finished addressing the Indian media. Ever since Donald Trump assumed office and triggered the tariff war, India has been undertaking several measures. The tax on Harley-Davidson in India was among President Trump's most repeated growls. The Indian government has cut the basic import duty to 40% and 30% depending on the size of the bike. Now, this move was announced in the budget before Prime Minister Modi visited Washington. And it's not just super bikes. The government has cut the effective import duty on bourbon whiskey from 150% to 100%. The tariff has also been reduced on ethanol switches, synthetic flavouring essences, among other items. And it's not just tariff measures. India has also removed the 6% equalization levy on online advertisements. This was commonly or popularly called the Google tax. Now, the move will benefit US tech giants Google, Meta and others who've long opposed the equalization levy. Now, CNBC-TV18's Newsbreak has been confirmed. Flipkart will shift its holding company from Singapore to India as it gears up to go public in the next 12 to 18 months. The Walmart-owned firm's board approved the move in a board meeting last week. Rachna joins us now with more. Rachna, you reported on this proposed move in December of 2024. What does this mean for Flipkart, this reverse flip as it's called?
That's right, Shireen. We reported this on 19th December 2024. Speaking about this move, it's a strategic move that marks a significant realignment of Flipkart's corporate structure with its core operations in India and is widely seen as a precursor to the company going ahead with its much anticipated IPO. The IPO is now expected within the next 12 to 18 months, like we had reported earlier. But remember, Flipkart had moved its holding company to Singapore back in 2011 to access global capital and tax benefits. So this reversal comes almost 14 years after that move, and it's not merely just about the location. It's about compliance. By relocating, the company sidesteps the complexities of India's stringent FEMA and FDI regulations, which currently foreign-controlled firms in the e-commerce sector are navigating. So being domiciled in India will also eliminate dual oversight for Flipkart from Singapore and Indian authorities, streamlining governance and tax structures. In a statement, Flipkart said that the shift reflects its deep and unwavering commitment to India. It also cites the country's strong economic growth, digital transformation, and business-friendly policies as key reasons that drove this decision. Well, this decision mirrors what former subsidiary PhonePe did in 2022, a relocation that costed parent company Walmart nearly $1 billion in just taxes. Walmart, which now holds about 85% stake in Flipkart after a fresh $3.5 billion investment last year that valued the company at $36 billion, aims to list both Flipkart and PhonePe in India. Other marquee investors like Tiger Global, Google, DST Global, Qatar Investment Authority and Singapore's GIC hold about 15% stake in Flipkart. Now, Flipkart's domicile shift is also part of a larger trend that we're seeing across the industry. Razorpay, Pine Labs, Zepto and InMobi, all these have also shifted their base to India to cash in on the country's IPO boom. With dual listings not being allowed in India, domestic domicile is now a must for companies eyeing local public offerings. And at $36 billion valuation, Flipkart's IPO could outshine Hyundai's 2024 listing, which came in at $19 billion and was a record then. So when it happens, it could potentially set a new record for the Indian markets. And it would do so in spite of recording a 2,358 crore rupee loss in FY24 on the revenue of nearly 18,000 crore rupees. So we will be keeping a close eye on this.
All right, Rachna, many thanks for joining us. Flipkart moving its domicile back to India, preparing for a mega IPO. Time for us to head into a break, but after SEBI tightens its screws, the Enforcement Directorate is likely to probe Gensol Engineering. That and more when we return.
Trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour.
And the Delhi High Court has pulled up Yoga Guru Ramdev for using the term Sharbat Jihad and taking a dig at Hamdard's Ruh Afza while promoting Patanjali's rose syrup. The court called his comments indefensible and has directed the firm to pull down the ad immediately. Hamdard had filed a plea before the High Court against Patanjali Foods' disparaging advertisements. Ashmit joins us now with more. Ashmit, take us to what was said in court.
Well, the Delhi High Court, I beg your pardon, will have none of this. The Delhi High Court making it very clear that this is something that has shocked the court's conscience, that this is deplorable and that this is something that needs to be taken down. These were the words that fell from the Delhi High Court after Hamdard had moved the Delhi High Court seeking a takedown of these comments issued by Baba Ramdev. Baba Ramdev, in reference to Hamdard, had said that this money that is being made from this sharbat, from Ruh Afza, is being used to create mosques, is being used to create madrasas. He also used the phrase Sharbat Jihad, and this is something which the court in its word said that it has shocked the court's conscience. Mukul Rohatgi appeared for Hamdard and he said that these comments that have been made is not just disparaging to Hamdard, it is not just defamatory in nature, but it goes a step beyond in that it qualifies as a case of hate speech. Now, it is after the High Court's stern observations that Baba Ramdev's counsels went back to the Delhi High Court and said that fine, we'll agree to take it down. But the High Court did not stop there. It has sought an affidavit from Baba Ramdev to give an undertaking to the High Court that no such comments will be made in the future. Now, what's interesting is that this is not the first run-in with the law. Baba Ramdev just last year had been pulled up by the Apex Court for making very outlandish claims through advertisements regarding his products. He was made to appear before the Supreme Court and also apologized in national dailies.
All right, Ashwat, many thanks for joining us. Now, the Enforcement Directorate is likely to examine Gensol Engineering under the Prevention of Money Laundering Act. The move comes just days after the market regulator SEBI accused the company's promoters of diverting and misusing funds. Shivani standing by with some more trouble for Gensol Engineering. Shivani.
Well, absolutely. Now, the ED is now circling in on Gensol Engineering, and sources tell us that the agency is likely to look into the Gensol matter under the Prevention of Money Laundering Act or the PMLA to examine whether illicit funds were siphoned and layered through the company's financial structure. Now, under PMLA, remember, the ED has the power to investigate not just the original allegations like the fraud or diversion, but also the movement of money that could be aimed at concealing or legitimizing illegal proceeds. What's raised red flags is alleged fund diversion by Gensol's former MD Anmol Jaggi to Blue Smart, the electric mobility startup he co-founded, for personal gains, including purchase of a luxury property. Now, the ED yesterday itself confiscated a stake in the Gensol Engineering allegedly held by a shareholder linked to the Mahadev betting app network. That case, remember, is already under the agency's scanner for large-scale financial fraud and illegal betting operations, and this Gensol stake is now being viewed as part of the broader trail. The probe is still in its early stages, but sources say that the ED will likely reach out to regulatory bodies like SEBI and MCA for financial records and compliance history. If the ED finds grounds under PMLA, it could attach assets, freeze accounts, and even summon key individuals linked to the transactions. Remember, sources also told CNBC TV18 that MCA is now looking at the matter, and the ministry told us that they will take necessary steps and actions as and when needed. So this is now a full-blown multi-agency crackdown with SEBI, MCA and ED all looking into the different layers of the same puzzle. One that began with the promising EV startup but is now mired in allegations of financial misconduct. Back to you.
Shivani, many thanks. And the US dollar plunged to a 3-year low and bond markets were rattled after President Trump renewed his attack on Fed Chief Jerome Powell. Trump has been at loggerheads with Powell, a man he appointed as the head of the Federal Reserve during his first term. Here's a report on why the markets are worried about this standoff. Take a look.
Donald Trump wants rid of Jerome Powell. He blames the Federal Reserve Chair for being too slow to cut rates and says his termination cannot come soon enough.
If we had a Fed chairman that understood what he was doing, interest rates would be coming down too.
Trump's advisers say they are studying whether to oust Powell before his term ends next year. But can a US president fire the Fed chief? The short answer is no one seems to know for sure. White House economic advisor Kevin Hassett says Trump's team is studying the question. He suggested there may be new legal analysis on the matter, though it wasn't immediately clear what he was referring to. Powell himself says the president has no power to fire him, and he won't go even if Trump tells him to. The Federal Reserve Act of 1913 says he cannot be dismissed for disagreements over policy. But all eyes are on a case now at the Supreme Court, looking at whether Trump overreached in firing 2 Federal Labor Board members. That could set a precedent for the Fed too, though Powell thinks not.
I don't think that that decision will apply to the Fed, but I don't know. It's a situation that we're monitoring carefully.
Stocks have fallen again as Trump ramps up his standoff with Powell. Investors are concerned that ousting the Fed chief, or even trying to, could undermine the bank's status as an independent, objective decision maker. Traders worry that policymakers could be pushed to cut rates, potentially fueling inflation. Brian Crowes is president of Scharf Investments.
If politics starts getting into monetary policy, you now, as a foreign investor, even a U.S. domestic investor, can't necessarily trust that your interest as a bondholder will be respected. And so that's a potential risk for the dollar and a potential risk for interest rates.
Those fears show up in the foreign exchange markets, with the dollar now at multi-year lows against other currencies. Even if Powell is pushed out, Trump may not get his wish for lower rates. The Fed structure would give remaining board members and regional bank presidents the power to set policy. If they resisted making cuts, Trump would then have to decide if he wants to assault the central bank as a whole. That's a move that would be very unlikely to soothe markets.
Well, Trump versus Jerome Powell. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, the top of the talk and the conversation clearly continues to be the gold prices, where we have seen all-time highs, a string of that really, so much so that for the international markets we've seen levels of $3,475 an ounce and above that, and for the Indian prices 99,000 plus kind of levels. It's a lakh rupees really when you go out to buy gold, and much higher than that. If you look at the gold prices itself, it has outperformed various asset classes and various other commodities within the space itself. We have seen gold prices gain up by 31% in this year now. The gold prices are up by 47% in the last 12 months as well. And with the kind of scenario that we are working with, even as the gold prices are heating up, but the markets do believe that until the tariff as a concern continues, until the time you do see recession concerns in US, and the fact that you could be looking at more statements and tweets coming in from the US president talking about the US Fed autonomy or independence being taken away, and then of course investigation into critical minerals, all of that has led to premium in case of gold prices. It has become a major safe haven, especially at a time where you have the dollar index trading at a 3-year lows, and that's exactly how the various other currencies have been doing as well. If you look at the banks and brokerages on the kind of levels that they have been talking about, well, it's much on the higher side. With Bank of America to Citi to Goldman Sachs talking about 3,700 on the higher side. And if a such situation continues, then an extreme case can take the gold prices to $4,000 an ounce as well in this current year itself. While of course there's a lot of caution as well, as people tell you to await those corrections as well. 8 to 10 to 15% of a downside is another thing that the market seems to be waiting for at this point in time. Well, it is also going to be an interesting period, because this is the month where you also have Akshay Tritiya, an auspicious time where Indians go out and buy gold. And then that is exactly when the wedding season and the festival season also begins. With these all-time high prices, the questions that I'm going to be putting to my guests is on where do they see the gold prices going, and how is gold at these all-time highs changing buying patterns in case in Indian markets there. Joining me on the show is Suvankar Sen from Senco. I have with me Varghese Alucas joining us from Jos Alucas. Shreyansh Kapoor is from Kashi Jewels. And we also have Avinash Gupta joining in to weigh in on where the gold prices can be headed and the way forward from here. Suvankar, hi, I'll start with you first. And gold price as a discussion really seems to have become like a everyday conversation. People wake up talking about gold prices and perhaps go to bed doing the same. What is your sense as we stand very close to $3,500 an ounce? Where do you see gold prices headed from here?
So see, Manisha, every time a gold price reaches any level, we feel that there is always a chance of it going above by 10 more percent and below by 10 more percent anytime, especially with the volatility that we have been seeing in the last 5 months, 6 months. I think that movement of 10% above or below has become a very common thing. So when we see all these predictions by the big banks and Goldman Sachs and all of them of 3,800, I don't see that it is it will be a surprise anymore. Nothing surprises us anymore, because what it is today also, I think that people always thought that yes, it will reach, but the pace and the speed at which things are moving is a little too fast for comfort. And I think consumers that you were saying that how they are behaving in this kind of a moving situation. So if you really ask, Manisha, I think value-wise, the jewelry business for everyone, it will always be a good number. The prices have moved up by almost 25-30%. But obviously, this price movement will impact volumes. The budget of the consumers will not increase to the rate of which the gold prices are increasing. So we are anyway looking at a volume dip of 20-25%, though value-wise, you will always see that there is going to be a growth of 10-15% across the industry. So that's how it is. And, lightweight jewelry, people are working within budgets, 1 lakh, 1.5 lakhs, 10 grams itself is about 1 lakh now. So therefore, we need to all work towards fulfilling that demand. But we are proud to be a part of the industry. Once again, gold has proved that in any times of crisis, this is the commodity to go for. So even if it corrects, I think that the faith and trust on the gold as a commodity will only become stronger, and consumers will look forward in buying it anytime they would be able to buy it. So that's the way to look at it.
Oh, well, absolutely. Shreyansh, my next question is to you. I actually want to get the elephant out of the room first. So what is your sense? As Suvankar says, well, 3,800 could also go and doesn't surprise him anymore. What is your sense? What range are you working with in sense of prices?
So, Manisha, this morning waking up and seeing the Shubh figure of 101, 1,01,000, like in India, we always have the number one coming in, and then we always consider that very auspicious, very Shubh. So I think it's a great sign for our industry to start and mark Akshaya Tithi, which is going to start next week. I feel, which we had a talk last week, and, we were at that time looking at a figure of 3,700. But the way things are, I mean, now we're looking at a 3,900 figure. So from the consumer point of view, it makes things difficult because the budget is what does not, like Suvankar was rightly saying, the budget does not change so fast as the way the gold is going up. So, I mean, that is really making a difference for customers' mindset. They have to rework their thought, maybe, and the manufacturers also have to rework the product. We have to start making very light jewelry, which is going to be in the budget range.
Oh, well, yes, a lot of things change as we go forward from here because of 46% of gain in gold prices in a matter of 12 months is something that the street hasn't seen in a very, very long time. Avinash, as I said, my first sense from all of you really is going to be about prices. Everybody seems to be rejoicing the fact that Indian households hold a lot of gold. So clearly in that sense, we've seen investment returns quite on the higher side. But from these levels, what is your sense? Where are prices going?
See, honestly, I am with all my panelists. The gold is going higher and it might surprise 3,800, 3,900 also. In last interview with you, you asked me what's your take. I said before the April end, it might touch 3,500. And now with the parabolic move of gold, I don't think it is very difficult for it to touch 3,800 also. And on a small note, I want to differ with my co-panelists, even though they are retailers. Definitely, I feel the consumer in India has surprised always, and it has given the kind of volume it has always been giving to the country jewelry community, and it will give in this year also at this price also. The volumes will not go down because gold has given a solid return to everyone. And if I look at all the portfolio managers, they have always been advocating that gold is a dead investment. Today, they are talking about 15 to 20% of gold should be there in their portfolio. So I don't think gold quantity is going to go down in the coming months.
I absolutely agree with that, Avinash, because a lot of people have been saying that gold is an idle investment and you shouldn't be putting too much of your portfolio diversification within that. A lot of them are really doing a U-turn here. Mr. Alukas, I want to take away from what Avinash just said that, well, yes, value-while we might see the sales go higher, volume might see a decline, but we do understand that Indian consumers can surprise. Is that something that you're looking at as well? What is your sense on the kind of sales we might look at this Akshaya Tritiya and the wedding season? And first of all, what's your sense on prices?
Yeah, we are very positive on coming Akshaya Tritiya, where all the jewelers have been stocking up. As you know, the gold prices has gone up. So there were a lot of demands for lightweight jewelry, where we are working on with the lightweight jewelry, which can be budget friendly to the customers. The gold price today, if you look into the price in the morning, it has gone up by 275 rupees per gram for 22 carat jewelry. So this is something a shock for the jewelers, and even the customers who are looking into the morning newspaper or in the TV or social media. They are coming to know about this much of hike in the price. So we all are really waiting for this Akshaya to come and happen, and we are preparing to get into the ornaments in such a way that we are able to now almost we have started taking the bookings for the Akshaya Tritiya with a lot of promotions, offers, gold gift coins. So we still have confidence that Indian customers specifically buy during the festival season like Akshaya Tritiya, and we are very confident that it will happen, and the prices have been going higher and higher. It gives more confidence for the customers to buy jewelry again and again, as mentioned by everyone, that it is not a dead investment or it is not a style statement. People keep on buying as the prices appreciate. So every expectation is very high on the Akshaya sales, which is going to come out April 30th.
Oh, well, absolutely. Akshaya Tritiya is going to be a test of on whether or not the Indian consumers have digested these higher prices. Are they going to only buy gold as a token, perhaps move to a silver or platinum, which is at $1,000 an ounce? So it really is going to be quite interesting to see on how the Indian consumer behaves this Akshaya Tritiya, a day when most of the Indians step out and do buy some sense of gold there. So, Mankar, just coming back to you, and all of you have said $3,700 to $3,900 per ounce as a possibility on the higher side now. So, Ankar, when it comes to Akshaya Tritiya, when it comes to people buying gold, stepping out, do you also see a chase in pattern now? Do you see lightweight jewelry? Do you see low caratage jewelry? More innovations, more themes, more designs perhaps in work?
Yes, we are. We are actually. If you hear the feedback of all of us panelists, we are dealing with the consumers. And last 1-2 months, we have actually got a lot of feedback from the consumers that we need to keep on creating more and more products which are within the budget. So if the prices have gone up by 30-40%, at least reduction of weight by 15-20% will only make it easier. The designs needs to be sleeker. Diamond jewelry is also taking a good I would say support because of the gold prices going up. People are preferring 14 karat, 18 karat jewelry. Either it is in plain gold or studded with diamonds. So I think that is also getting a boost because of the increase in gold price. Platinum also it's a much smaller niche segment, but compared to gold, obviously platinum is much cheaper today. So for the men's jewelry, I think platinum can play a big role for people to invest, because if you really look at it, the way the gold prices have moved up so much, the other metals have not increased in their prices. So that always keeps an opportunity for the upside. But yes, from a manufacturing point of view, the weight has to be lighter for now till the Indian consumers gets used to this new levels and new prices. And while we can always see that upside of 10% is there, but in our heart and in our mind, we also hope that even if the price is correct to some extent, be it whatever, 5, 7, 10%, it will only encourage the Indian consumers to come and buy more, hoping that the prices will go up in the future.
Oh, well, absolutely. Once the people get adjusted to these higher prices, you will see them coming in. Clearly, the consumers found 40,000 expensive, and then 50, and then 60, and we're standing at ₹1,00,000 at 10 grams now. It is going to take some time for the consumers to get adjusted to that 5-figure there. Avinash, as Suvankar said, well, yes, platinum seems to be coming into play yet again. You deal both with gold and silver as well. Have you seen some rub-off effect coming in on silver? With gold getting so expensive, is silver making its due deserve now?
No, definitely silver is going up. Silver sales are going up because the jewelry which is nowadays made in India on silver is equivalent quality of gold. So aspirational people who are not having the deeper pocket to buy gold jewelry, silver jewelry is complementing them, and silver jewelry is going in a good way. And things are in a positive mode for silver also, Manisha.
Shreyansh, the other thing that the street will watch out for is perhaps more studded jewelry, as again Suvankar said that diamonds are coming back in a big way, and we are looking at studded jewelry, gemstones, precious stones coming. Is that making inroads yet again?
Yes, coming from Kanpur and UP, heart of India, we see a lot of middle class and upper middle class customers moving, they're changing their demand from gold towards diamond jewelry. And it's in both the categories of 18 karat diamond jewelry as well as 14 karat diamond jewelry, because they're really budget friendly. They add bling, they add sparkle, they look great, they stand out in the crowd. And jewelry is all about celebration. It's all about feeling good. It's all about happiness. And Akshay, like we say, something which never ends. So, as gold itself is about 50% value-wise in a diamond jewelry. So, the gold itself will appreciate. And now the natural diamonds have also started appreciating. So it's a win-win for customers to pick up diamond jewelry.
Mr. Alukas coming in from south of India, where gold is prime, and I can imagine on how people would be counting on the kind of returns that they've seen in those huge big gold jewelry that they buy there. Even as the prices are trading at ₹1,00,000 10 grams right now, Do you see South India as well going in for studded jewelry, or do you think South India will do what it does best, buy only gold jewelry?
No, as you say that this diamond jewelry is picking up into the South markets also, as because of this price point and as you said, sparkling style statement with the diamond jewelry. And most of the traditional customers still looking into above 40 or some above 50 still looking into gold jewelry, but the young crowd or the youngsters are looking into lightweight diamond jewelry, which most of the stores are performing more than 15-20%, which is above from earlier years. So diamond jewelry is picking up because of the style statement, the costing, and 18-karat jewelry, the prices of gold, and the percentage of gold is lesser. So even diamond jewelry is slowly picking up along with the men's jewelry in platinum. Also, we feel that silver jewelry also is being used by the customers in some time when the gold prices are high. So when you see overall, we get more percentage other than gold, which is going into diamond jewelry, platinum jewelry, and silver jewelry.
All right, so we've spoken about prices, we've spoken about sales, and of course the buying patterns, and the fact that people are also looking at platinum and silver in replacement of gold, which is trading at ₹1,00,000 at 10 grams. You still have to get used to saying that number again and again. But gentlemen, stay on with us. We'll go for a very short break. When we come back, we'll also look at the market of exchange and scrap in sense of jewelry, which also seems to have surged up with the kind of prices that we are dealing with after this break. Welcome back. You're watching Commodity Champions, and we are dealing with ₹1,00,000 of 10 grams when it comes to gold prices. So, Ankara, would you say that the exchange market seems to be really picking up? Because we do understand that exchange of old jewelry for new jewelry usually is a 15 to 20% of a market, but that really seems to have gone to almost 40, even 50% in case of some jewelers.
Manisha, what we are seeing is that the exchange percentage is close to 35, between 35 to 40%. And that is the signal that consumers are having limited cash in their pockets and they want to take the best, I would say, opportunity of the higher gold price and exchange their old jewelry, hallmarked or non-hallmarked, and get the new jewelry. So that is something that is helping the industry to continue to have footfalls. And even for those people who have weddings in their family, they need to buy the jewelry that they need to buy, and they are utilizing these old jewelry to exchange them for the new jewelry. So that is something that is really, really supporting the business. And from a retail point of view, as others have said, that the jewelers are coming out with offers and discounts and special offers for the old gold exchanges that consumers are doing, only to ensure that they get the best benefit in this kind of a situation.
So, Suvankar, what is your offer and a special offer during this time?
So there is a lot of offers. One has to, make sure that the gold prices are very competitive. So we are giving certain, discounts on making charges. We have reduced the gold rates to make it affordable for the consumers. If you're coming out with your old jewelry, then there is no deduction on the losses that people do during melting. So if the purity of the jewelry is above 22 carat, there is no deduction. And so therefore, we are trying to ensure that the consumers gets the best benefit. And even for Akshaya Tritiya, consumers give money in advance. So we've tried to kind of come up with an offer for the consumers in which, if they have given the money in advance, so whichever will be the better rate, whether it's a time of paying the money in advance or during the time of buying, whichever will be the lower rate, the consumer will get the best benefit. So in this way, consumer also gets the confidence that, yes, it is a good time, auspicious time to buy, and they will get the best possible price to buy their jewelry. So there are such offers to make sure that the consumers keep buying. And finally, for every gold that you consumers are buying, we are giving silver as free, because we also firmly believe that instead of just giving money as discount, if we can give a value in the form of silver in the future, the consumers will also get a very good return from the investments in silver that they will do.
Oh, well, absolutely. Shreyansh, what is your sense with the way Suvankar said that absolutely going out to ensure lower-end customers? Is loyalty of customers a bit of a question mark right now? Is it? I mean, do you have to get really competitive right now to lure in those people walking in?
Right. So being a 70-year-old brand and a company, we do have a lot of loyal customers. And like you were rightly saying, nowadays, earlier what we had is like 20-30% customers used to come and pay in old gold. But now with the high gold prices, it's almost 50-60% customers are now paying. Every other customer I see takes out their old gold jewelry, they get it valued, and they use it as an adjustment for buying the new jewelry, which is helpful for them because, whatever the old jewelry they were lying idle comes to use, and for us, it's a raw material. So this is helping out. As far as offers are concerned, obviously the best offer we need to do is whatever we can help the customer in the high gold rates. So we are planning to come up with multiple offers. One was, we are trying to have a lowest rate possible on that day. Also having a good discount on diamond jewelry. So again, try to push more towards the diamond jewelry. And then more importantly, which I think no one is talking about, that having more and more designs. And we are planning to launch almost 3,000 to 5,000 designs, with lightweight range to show to the customers on Akshaya Tritiya.
Another thing that comes to mind is, Mr. Alukas, this one is to you. We do understand that people are getting old gold and buying new gold. So they're exchanging gold for gold. Are they selling their old gold as well for money? Have you seen that also happen?
So coming back to us, we feel normal days as it is only 30% of jewelry is being exchanged. But past 2 months, we have been saying it is been climbing to 40%, 50%. 2 days back, we have seen 75% of our purchases have returned into old gold jewelry. So that is in case of exchanging. And coming to cash, there are people selling also. There have been 10 to 15% increase in people selling jewelry for cash, where they require for some medical assistance or some business purpose, who have been holding up gold for 10, 15 years, seeing the prices have come up more than, as you said, 50% every year, or 30%, 40%. So people who have got for 2,000, 3,000, the prices have, which has almost reached 9,000, there are people to sell. At the same time, there are people to exchange their jewelry. So we feel both exchange is happening with buying new jewelry who cannot afford to pay this price. They're exchanging their old jewelry to new jewelry. But there are people who also wanted to sell and get money, are also taking this opportunity to sell it and get cash for that. So that is also have increased in 15% from earlier times.
So clearly, a lot of old gold coming into the markets. Avinash, there were reports on how the jewelers are facing some sense of a liquidity crunch as well with the kind of old gold coming into the markets for cash or exchange. Has that situation eased as of now?
See, on 8th April, when the prices went down to 29.82, there were rumors in the market that gold will go down to 55,000. And because of that, there was surge in sales of old gold by the consumer, which has subsided as everyone has told that it has reduced. They are coming for exchange, but they're not coming for sale. So exchanging or making a fusion statement jewelry is a different subject than coming and selling it. So I think it has been subsided, and now when the Akshaya Tritiya is coming forward, I think everyone is moving towards buying new jewelry, and it will go on till Akshaya Tritiya and the wedding season throughout. So definitely it will surge, but there will be an exchange or using the old jewelry, keeping the sentiments intact by making combining it with the new jewelry that they are ordering.
So, Vankar, the other thing really is that, when we boast about the fact that Indian households have perhaps the maximum gold in the world, that figure is still out as a guesstimate, whether it's 30,000 tons or more than that as well. But this clearly has been, women going out and buying gold, and then you have women saving to buy gold, etc. And suddenly this is shot out of their budget. And that also in a matter of last 12 months itself. Do you see a slight decline coming in there? Would you see a changing pattern when people step out and buy gold? Do you think it's become more of a financialization right now than just pure jewelry for adornment?
So see, the Indian women have always been very wise in saving their money in the form of gold. And yes, today in the short period of say 6 months, because of the increase in gold price, we are looking at giving lighter weight jewelry, which we spoke of. So like we are seeing a volume dip of 20-25%. So that is where we as the jewelers needs to create jewelry where we reduce the weight by 20-30%. So make it affordable for the Indian women. Anyway, the design sense, when it's a wedding jewelry, obviously they will need to have a broad look. So we need to look at whether 18 karat purity will solve that problem. But when it's a day-to-day, everyday wear jewelry, I think, sleek gold jewelry or gold jewelry studded with diamonds and other gemstones will be the solution to continue to, supply jewelry to the Indian women and make them look beautiful. So I guess that's the changing trend. And because of these jumps, whenever such big changes happen overall in the macroeconomic scenario, I think that our transformation from design sense and what we offer to the customer has to change in a very, very fast manner. So I think that's the way to look at it. And yes, we have to deal with lower volumes and lighter weight jewelry.
Oh, well, absolutely. I get your point, gentlemen. The prices are much higher than what anybody thought you could see in such a short span of time. But as you guys said, in sense of value, we might see the sales go higher. There, of course, is a bigger number in sense of exchange, which has gone up by 40, 50, 60, 70%. And the old gold in sense of for cash also seems to be coming into the market. But I absolutely understand, as confused are consumers on when to buy, what to buy, how much to buy, what would give them better return. I do understand that as an industry as well, you will also need to align yourself understanding prices, consumer buying process and changing patterns as well. So clearly uncertain times, but who are holding gold clearly are, laughing to the bank right now with the kind of gains that we've seen. 47% up in last 12 months. But it will be interesting to see on how Akshaya Tritiya goes and how the rest of the season really performs with the gold prices on where they are. Thank you so much, all of you, for joining in and weighing in on, of course, the expectation on the gold prices and your expectation on what kind of season this could really open up to be. Well, with that, that's all the time that we have on Commodity Champions. Thank you for watching.
Hello, welcome to our special broadcast here from Jaipur in Rajasthan. I'm Parikshit Luthra. US Vice President J.D. Vance, his wife Usha Vance and 3 children visited Jaipur today. They visited the Amer Fort, the Hawa Mahal. You can see pictures of them going all across these forts, having a good time with their family. The big message from J.D. Vance here in Jaipur was that India needs to buy more US defense equipment, allow American companies greater access to India, support Donald Trump's clarion call for drill, baby, drill. Also laying out the wish list that US has for India. He urged India to buy more defense equipment, as we said earlier, especially F-35 fighter jets. He called for strengthening the energy partnership and said that US can be a long-term, reliable supplier of cheap energy to India, and the kind of energy that India needs for its development needs, for its manufacturing needs, and for having data centers and AI technology as well. Last night, Prime Minister Modi hosted J.D. Vance and his family at 7 Lok Kalyan Marg for dinner. Following that, the US Trade Representative issued a statement that he welcomed the finalization of terms of reference for the bilateral trade negotiations. Now, this is an important aspect of the negotiation as it lays out the contours, the boundaries, and also the ambition of every chapter of the trade negotiation. The US also said that they appreciate the constructive approach that India has followed when it comes to this trade negotiation. They have acknowledged the kind of tariff reductions that that India has done for the United States, but there is more that the US wants. The USTR even said that they are looking for more robust, long-term commitments that are beneficial to the US economy and US businesses. So what does this visit of J.D. Vance really imply for India-US ties? Joining us right now to break all of this down is Meera Shankar, former Indian ambassador to the United States. Air Vice Marshal Manmohan Bahadur. Also on the show with us is Raymond Vikri, Senior Associate and Chair on India and Emerging Economies at CSIS. Prabhash Ranjan, Professor and Vice Dean, Research at Jindal Global Law School. Ladies and gentlemen, thank you very much for joining us today. Air Marshal Bahadur, if I could begin with the F-35 question. First time we heard this was in the White House when Donald Trump said that we want India to buy more defense equipment and maybe even F-35s eventually. Today you had J.D. Vance again signaling, saying that we want you to be a big buyer of defense equipment from the US and we want to offer F-35s, stealth fighters. Give us a sense whether this really fits into the Air Force scheme of things. Is this the kind of platform that we really want? And despite the pressure, will India go ahead for it?
Thank you for getting me in. And F-35 is a carrot that has been dangled for quite some time now in front of India. We've got to manage our interests just the way the Americans are doing for their trade and for their strategic interests. So we need to remember that our Air Force is still 36% Russian, and so are the other 2 services. So when we are getting an equipment, and incidentally, we've never bought a fighter aircraft from the United States, ever. Transport, helicopters, yes. So to get that into our scheme of things, vis-a-vis our radars, which are Russians, basically, the latest being the S-400. If you remember, Turkey was moved out of the F-35 program because they went in for S-400s, or they were wanting to go in for S-400s. So we have to keep the broader picture in mind and then take a call. Having said that, if I may just add, there is a lot of trumpet blowing that happens everywhere with every country. We had in 2012 the Defense Technology Trade Initiative, DTTI, and a lot of brouhaha was there on this. What happened to that? I mean, you cannot change our interests, or the American interests can't change just because a new person comes in the White House every 4 years. And this time when it has happened, it has upset the whole apple cart. I mean, if Ukraine can be thrown out like a fly in a teacup, we need to be careful. Because tomorrow another person comes as the President of the United States. Where is the history of continuity vis-a-vis military ties with India and the United States? The United States was the first country that imposed sanctions in Pokhran II when it happened. So I'm sure our negotiators will demand their pound of flesh, just as the Americans will. We need to take a broad view, keeping our strategic interests in mind.
Right, so you're saying we need to take a broad view and also look at continuity of supply. You said that 36% of our defense equipment is Russian. We need to keep our strategic needs in mind. We've never bought a fighter aircraft from the United States. And if we do, we need to make sure we get a pound of flesh in terms of long-term contracts and long-term maintenance contracts. Is this what you're saying, Air Marshal Bahadur?
That is absolutely correct. And what is it that they are going to offer? Are they going to offer the latest avionics with the F-35 when they come in? I doubt it, because they know that we will have to synchronize everything electronic and avionic with our ground defense, air defense systems. And that's where the Russian equipment comes in. So will we get what we want? That is to be studied.
Right. Let me get in Ambassador Meera Shankar at this point. Ambassador Shankar, how did you see J.D. Vance's speech here at the Rajasthan International Centre? I was here in the hall. The speech was very, very strong. He began his speech by speaking about Prime Minister Modi, thanking him about how his children loved India and how the only people, the two leaders that their children really like are Prime Minister Modi and Donald Trump. So he made all the right noises, but he made some very strong demands. In fact, rather than how the trade could be mutually beneficial, it was more like buy more defense equipment, buy more fighters, buy more energy. So what was your sense from J.D. Vance's speech and the message he delivered?
Well, he delivered Trump's message. He's amplifying it. And the message has been that this is something which the US wants, and it's not looking really, talks about reciprocal trade, but it's not looking at reciprocity in terms of trade. It's looking at pushing unilateral advantage. And that is something that India will have to consider very carefully, because in the process of trying to manage the Trump administration's shift in trade policy, I think India cannot open up sectors which are problematic, like agriculture across the board, nor should it take defense equipment if it feels it does not need it, or if the terms and conditions don't meet our requirements of localization of production, of continuity of supply, and if it's too expensive, because your whole strategy at the moment is to try to indigenize your defense production. You are looking at the Tejas Mark I aircraft, which are still being rolled out. You are looking at the Tejas Mark II aircraft, for which we are buying the GE engine, upgrade. And that agreement, I don't think, has been finalized as yet. That is India's priority. And we are also keen to buy maritime patrol aircraft. We are keen, perhaps, also looking at Stryker carriers, vehicles. So there are areas where we certainly want to work with the US and get technology, but it's not something which the US can and should dictate to us. It is something we have to decide on the basis of our requirements. And there are areas where there is synergy between the US and India in the field of energy, in the field of defense technology, in the field of high technology. And we should see where we can work in all these areas. At the moment, from what I understand, we are looking at opening up sectors of the Indian economy in return for the US not putting punitive tariffs. So no additional benefit to India from the framework that the US is pushing. I think we need to be very clear that it has to work for both countries. It's a synergy in relationships means that there has to be a win-win situation for both countries. And if it is at the cost of one country, it can't be sustained. The relationship will go sour.
Very important point, ma'am. You're saying that when you speak about a synergy in partnership, it has to be a win-win for both, not at the cost of one country. Currently, we're not getting any additional benefits from the framework that US is pushing. It seems that India is wanting to give concessions to avoid reciprocal tariffs. Let me get in Prabhash Ranjan at this point. Prabhash Ranjan, one of the points that the Coalition of Service Industries, which represents the likes of Google, also Amazon in the US, is the fact that India must support a continued moratorium on e-commerce duties. We must reduce tariffs to zero for ICT products under the WTO framework. How do you think India will fare if we give in to concessions on the terms of the United States? What will happen to our obligations with other countries? What are some of the challenges that we could possibly land ourselves in?
Thank you, Parikshit, for having me. I think that's a very important question, and I completely agree with Ambassador Shankar that any deal that we strike with the US has to be beneficial for India. Now, what is important for us to understand is that the Trump administration has launched an offensive against the global rule-based multilateral system. And India, which has always championed a rule-based multilateral system, has to express its concern about this. So, if you look at countries like China, or if you look at many other developing countries, they have taken, or they have at least publicly announced much more, stronger terms in terms of what the US is doing to the international trading system. India's response has largely been that it has been silent on this. And I think that's where the problem lies, that we should not look at this only from the point of view of striking a deal with the US, but we should also look at it from the point of view of the larger multilateral trading system and where we stand in it. So let's take the example of the bilateral trade agreement that is being negotiated currently. Now, if this bilateral trade agreement will not be applicable on an MFN basis, which means that whatever tariffs India reduces for products coming from America without extending them to European Union or UK or other countries, then other countries will have a problem with this. Now, maybe US will be able to deal with it, but how will we deal with it? Now, if it is to be done on MFN basis, which means that you reduce tariff rates for everyone, then perhaps you don't need to have a separate negotiation for a bilateral trade agreement. So how do you get around this is going to be a major legal and economic challenge for India. And since India and the US both are members of the WTO, and US has still not pulled out, not yet, from the WTO, it is important for India to keep reminding the US, not just privately, which I'm sure they must be doing, but also publicly, as Brazil has done, as several other countries have done, that you need to respect international law contained in the WTO, and we have to work with each other within the WTO framework, because that's a framework that exists, that has existed for 3 decades. If we take GATT, it goes back to 1948. The principles are well established, and you can't suddenly throw those principles out and say that we are going to negotiate based on a completely different set of rules. That's going to be complete chaos, certainly for developing countries like India. So I think India has to be careful, has to keep reminding US, both publicly and privately, to respect WTO law and to work within the framework of the WTO.
Right, that's an important point, that if you make a sweetheart deal for the United States, others will have a problem and they could take you to WTO as well. Let me also bring in Raymond Vickery. Raymond Vickery, a very authoritative voice when it comes to American politics, American trade policies as well. Raymond, what I would like to understand from you, it seems that Donald Trump is not really interested in any sort of trade deal. If there is a president who can pull out of trade agreements, who can change his mind on a country like China overnight, then how do you take the US administration at face value when they're saying that we want a mutually beneficial trade agreement? All it seems to be boiling down to is that the US wants us to buy more energy, buy more defense, and have very long-term contracts with the US, and somehow US wants to be our biggest supplier of energy in future. So keeping these different messages in mind, how does India navigate the new White House?
Well, thanks very much for having me. I think you're absolutely right. India and the United States have worked together to build peace and prosperity in the world, and each president, whether it be Republican or Democrat, has advanced that. But these are not normal times in the United States, and I wouldn't want your viewers to think so. There are attacks on the rule of law, on the media, on higher education that Vice President Vance has led the charge on. And he is a chief isolationist. In spite of what is being said today in India. It is very important, it seems to me, to heed what the law professor has just said. The approach of the Trump administration is that of a real estate developer. It's transactional. It's what can you do for me today? Don't worry about the longer run, but what do I get out of this? And the basic problem is in regard to tariffs that the Trump administration has a view that we can completely wall off the rest of the world in essence, except on our terms, that we'll bring all manufacturing back to the United States. We won't have extended international supply chains. And what is going on now in the U.S.-India relationships, we would hope would lessen barriers to trade. But that runs completely contrary to the Trump approach that manufacturing ought to all be reshored to the United States. So it remains to be seen how this will turn out. In regard to energy particularly, I think it's important to recognize that the United States and India have a great interest in being able to have responsible energy rather than just drill, baby, drill. I helped get the civil nuclear deal through Congress. One hopes that there would be progress in that clean energy source. And across the board, it's going to be necessary to take into account the environmental impacts of these. India has been a leader. The United States is stepping out of it. So in sum, I would say that yes, the U.S.-India relationship is strong, but simply abandoning the multilateral system in favor of a transactional approach is not in the interest of the United States or India. The rule of law, a rules-based approach, should apply across the board, not just in regard to tariffs and the economic relationship, but respect for human rights, respect for democracy, respect for rule of law, for science. And unfortunately, this administration in the United States is headed in exactly the opposite direction.
Right. You know, we may have a early trade deal with the US as well. Raymond, it could come in the next 3 months or so. But do you also feel that there is no guarantee that even if we have a trade deal, Trump would respect it? Tomorrow he may just go ahead and may want something more in 2026?
Well, that's been his history, that he makes deals and then walks away from them. Went bankrupt 9 times in the private sector, and yet portrays himself as the greatest deal maker of all times. So India has to follow its self-interest, and the way in which to do that, it seems to me, harking back, is to try to put this in the framework of something which is broader than just who's there today and what the deal is today, but to institutionalize it. So we have some rules-based approach. Or, as you say, tomorrow it can be turned around if President Trump does not like the way India is proceeding on matters which are very extraneous in some sense to trade, on China, on what he wants to have done in real estate development. He has Trump Towers, which are at construction stage in India. He has allies in Elon Musk who have interest in Starlink and Tesla. Suppose he doesn't get what he wants, or his associates don't get what they want, then what happens? So it's very important to look at this relationship.
Very important points. Yeah, and institutionalize it, put safeguards and guardrails in place so that India does not get harmed. Meera Shankar, if I could come to you. Over the last few months, we've made a lot of overtures to the Trump administration. In the union budget, we reduced tariffs on high-end cars to 70%. High-end motorcycle tariffs were also reduced. We've done away with the equalization. Just yesterday, the Competition Commission of India accepted the settlement proposal of Google in an antitrust case for 20 crore rupees. There are also reports that we are willing to put the digital competition law, which has drawn from the EU digital markets law, which the US has been very concerned about. It seems that we put that law on the back burner. Do you think we're giving too many concessions too soon without putting it in pen and paper in the BTA?
Yes, I think with the US, you have to dot the I's and cross the T's as part of a official formal agreement. Any concessions given in advance are pocketed and the goalpost is moved. So I do think that you need to be a bit more conscious of how you are dealing with the United States, so that whatever emerges by way of agreement is beneficial to both sides. And also, as was mentioned by previous speakers, we have to avoid undermining the multilateral system. And also, we have to keep in mind that Trump's record, including with, say, Canada and Mexico, where first he overturned NAFTA and then renegotiated it, and now wants to overturn the renegotiated agreement, which he himself had renegotiated. So I think these are fragile foundations on which to build.
Right. My final question to Air Marshal Manmohan Bahadur. Air Marshal Bahadur, now when it comes to F-35s, I'm coming to that question once again. What has traditionally been India's issue with acquiring this aircraft? Is it that India's adversaries like Pakistan also have this platform? Is it because the US has never given us the technology wanted? They're giving us obsolete technology, which is at least 15 to 20 years older. Where does the problem lie when it comes to the F-35? And where do you think there would be a problem between the political will to buy more defense equipment from the US, including F-35s, and where the bureaucracy and the Air Force will draw a line?
To answer that, I'll actually quote a professor who wrote in the US Army War College Journal, Parameters. See, it says that a partnership can succeed only if it is grounded in mutual indispensability, since anything less creates a dependency, and a dependency by definition is not partnership. So we need to be clear that the person or the country with whom we are trying to partner, there is an element of mutual indispensability. So when it comes to defense, the American R&D is leagues ahead of what we have got or what we can manage in the next few decades. So to my understanding, it will build a tremendous dependency. You can ask the same question, don't we have a dependency on Russia? Yes, but I think the way our history is, the way our memories are, and the way our experiences are, we need to be careful. So when it comes to the F-35 in particular, as I said, will they give it with all the latest avionics? What would be the cost of acquisition? And more importantly, the maintenance, the spare parts, because that will build a dependency and the screw can be turned on you anytime. And thirdly, the point is that the
All right.
Pakistanis are likely to get the Chinese fifth gen, and that's why the pressure is coming on us. We need to keep our feet firmly on ground, eyes wide open.
All right, Air Marshal Bahadur, thank you very much. Prabhash Ranjan, Ambassador Meera Shankar, Raymond Vickery, thank you very much for joining us on the program. We've completely run out of time, but that's been a fantastic discussion, an eye-opening discussion on India-US trade ties and J.D. Vance's visit to India as well.
Hello and welcome to the Global Dialogue. I'm Shireen Bhan. 2024 was a breakout year for OpenAI's ChatGPT, and 2025 promises to be equally exciting. Joining us now to talk about the innovation pipeline, what we can expect as far as the AI war and the AI race is concerned, is Kevin Weil, the Chief Product Officer at OpenAI. Kevin, many thanks for joining us. I know it's late in the evening for you, and it's been a busy week, an exciting week with lots of launches lined up, including tonight, where you had the O3 and the O4 Mini. So let me start by asking you, Kevin, to give us a snapshot in very simple language. What does ChatGPT 4.1 mean for OpenAI and for consumers, and how do O3 and O4 Mini change the game?
Yeah, well, first of all, thank you for having me. I really appreciate it. Excited to be here with you. India is an incredibly important market for OpenAI and ChatGPT. It's our second largest market. It's our fastest growing market, and it's also the market where we saw our image generation just take off. But we had some great launches this week. You mentioned GPT 4.1. which is a model for developers that is fantastic at coding and complex instruction following. And so, for that was a model that we released focused on developers, and we're seeing them. We have over 3 million developers on the OpenAI platform, and they're doing amazing things. That is one of our fastest growing models by usage ever. And then just this morning in the US, we launched O3 and O4 Mini, which are our frontier reasoning models. They're the smartest, fastest, safest models that we have ever launched. They're incredible at things like computer programming. So if you look at measures like on competitive coding benchmarks, these models would be better at competitive coding than all but about 200 people in the world. And they can answer hard PhD level science questions better than 80% of PhDs in their field across all fields simultaneously. So they're really very intelligent models, but you can also use them for, more mundane tasks, understanding, medical jargon, or looking at what's happening in the world, creating images, helping you with writing, translating languages. These models are so dynamic, and we're super excited to see what people can do with them.
Well, thanks very much for giving us that update. But, I want to link this back to comments that you've made previously, including a tweet that I saw from you about 10 hours ago, where you talk about the fact that these are the worst AI models that you'll ever use for the rest of your life. As the Chief Product Officer at OpenAI, with things changing so quickly, and in your words, you believe that these are the smartest models to date. How does that get you to kind of constantly reinvent yourself, constantly disrupt yourself? I mean, how concerned are you not just about competition, but about creating moats that continue to give you the advantage that you enjoy today?
Yeah, it's one of the most exciting things about this industry. These are simultaneously the most intelligent models in the world, the best that we've ever created, we believe the best in the world. And they're the worst that we will ever use, because the models are progressing and getting more intelligent, getting safer, getting smarter. Every few months, there's a new breakthrough, and all of a sudden, computers can do something that computers have never been able to do before. If you go back 2 years or so to when ChatGPT launched, if I asked you to use those models, at the time, they were amazing. They were mind-blowing. If I asked you to use those models now, you would be disappointed. And that's just because of the pace that everything is getting better. We've kind of whooshed past the Turing test, which used to be the high watermark for, is AI here? Yeah. And now that's in the distant past. Every AI model is passing the Turing test. So it's an exciting time. And the fact that ChatGPT has gone from 0 users a couple years ago to over 500 million active users today just shows how valuable these things are in people's lives.
I want to double down on this, Kevin, because, you've also said that models are getting smarter, faster, cheaper, safer, more personalized, and more helpful. The future is bright. That's a lot to pack in. If I were to ask you what you prioritize today when you look at how you develop and build the next line of products, are you going to be prioritizing making this much more accessible, i.e. cheaper, given the kind of breakthroughs that we've just seen with DeepSeek? What do you prioritize in the attributes that you've outlined that models will need to focus on?
I think first and foremost, I care about making these models more broadly accessible and more useful to people. And that entails making them smarter and safer and things like that. But first and foremost, I want ChatGPT to help people live better lives, to help them accomplish their goals more quickly, to help them learn new languages, to help them learn new skills, to help them do the kinds of things they need to do for their family or their job faster, so that they can spend more time on the stuff that they really care about. These models are, and ChatGPT helps me do this every day. As we think about building models for developers, for programmers, for entrepreneurs who are running startups or working at companies, one of the things that we care a lot about is reducing the cost of our models, even as they get smarter. If you compare today to 2 years ago, again, when we launched, GPT-3, GPT-3 was more than 100x more expensive than some of our models today. And our models today are smarter and faster. And so, I talked before about how rapidly this industry is progressing. You can do so much more today with an AI model than you could 2 years ago. And it's cheaper, and it's faster, and it's safer. And so it affords an incredible set of opportunities for people, for businesses, for developers all over the world. And we're very, proud and humbled to be able to help provide that.
But Kevin, how much cheaper can we expect things to get, in the near term? What are we talking about?
Well, so I said 2 years ago, our kind of flagship model was more than 100x what many of our models today cost. So you're talking about maybe 10x a year in price drop for sort of a constant level of intelligence. So the same level of intelligence in a model maybe gets 10x cheaper every year. And that's, Moore's law, which has transformed the world and powers our lives, and every little thing that we do every day has a transistor in it. Moore's law was about the number of transistors in a chip doubling every 18 months. And that changed the world. AI is on a trajectory of going down by a factor of maybe 10x in cost every year. So it's a much steeper exponential than Moore's law, which means I think we're going to see AI transform the world even faster. And that's exciting. I'm very optimistic about that.
You're talking about AI transforming the world, and I know previously you've spoken about the fact that you believe AI will surpass human coding, perhaps even by the end of this year. To parents and to kids who are looking at grad school, at people who are graduating from engineering colleges today, you talk about a bright future, but as they look at the expanse of what's going on and the disruption and transformation that's expected to happen, what would you tell them? Because it almost sounds like, you're writing the obituary in a way for coders.
I actually don't think so at all. Jobs evolve, they don't evaporate. If you go back and look at, I watched the movie Hidden Figures recently, which is about some of the rocket scientists from back in the 50s and 60s. They were doing longhand calculations on paper to calculate rocket trajectories. And today, that seems wild that you would have people doing it, right? Computers are just better than humans at doing hard calculations. And so, of course, computers do all of that for us. But that doesn't mean that there aren't rocket scientists today. And in fact, we've probably made far more progress if you look at things like SpaceX and also things like, the ISRO, the Indian Space Agency, which is, an incredible space agency, one of the premier rocket launching agencies in the world. I think we're far better off because we have computerized these things and computers do it better than humans do. I think that will be true of code as well, but that doesn't mean that it won't pay to be technical, that it won't pay to have a computer science degree. I think these skills will still be important. They're just going to evolve.
Well, speaking of evolution, let's talk about what you're seeing in India. You talked about how it is today your fastest growing market for ChatGPT. How many active users do you have in India? What surprised you about the adoption, the rate of adoption, the pace of adoption in India? Why do you believe you've seen this kind of an uptick here?
Yeah, our active users in India more than tripled in 2024. So it's been incredible to watch. A few weeks ago we launched a new image generation tool using AI to generate incredibly images that you can control to a great degree, whether you want them to be vivid and lifelike or cartoony or following a particular style. We saw, Prime Minister Modi tweeted using our image gen feature. We had cricketers like Sachin Tendulkar tweet images from ChatGPT, and it just took off. Unlike anything I've ever seen. I've been fortunate to be at Twitter for many years. I led product at Instagram for a number of years. These companies were growing very quickly. I have never seen anything grow like ChatGPT was growing because people were having so much fun creating these images, sharing them with their friends, on WhatsApp and in other places. And it's just incredible to see. So we marshaled a whole lot of resources. We really tried to support it, especially in India. We released new features around our image gen, like image galleries that let you quickly view all of the images that you've created. There's just a huge amount of excitement in India for ChatGPT, and not just for this image gen feature, but also, ChatGPT speaks 100 languages. It can teach you any subject you want to learn. It can save you time at home and at work. And so, it's so broadly useful, and it's completely free. You don't have to pay us a dime. You can use it on an Android phone for free. So it's just, we deeply believe in bringing AI to the world and in the positive impacts that can make. And I can't think of a better example than, what's happening in India right now with ChatGPT.
Well, you talked about the Gibilization of India, and we've seen that go viral, as you just explained to us. But I want to link this to the broader issues that are being debated at this point in time, issues related to copyright, issues related to data privacy. Is this a great way of data capture for OpenAI? That's the question that's being asked as well. And Sam Altman has said that he believes it's a net win for society, but there are negatives. I want to ask you this as the chief product officer. When you're developing and designing products, you do need to factor in his words, the negatives. As you look at where you are today in your innovation cycle, how much more of that is a focus area for you?
Oh, we think about it all the time. I was at Twitter in the early days. I was at Instagram. I think we know, we know the promise of those platforms, and we also now know a lot better than we did 15 years ago some of the challenges inherent in broad scale platforms. OpenAI and ChatGPT, we spend more time and effort, and we put more thought into trying to understand both the positives and the negatives of how our work can be used. Far more than any company that I've worked at in the past. Doesn't mean we're going to get it right every time. I'm positive that we will make mistakes. We have made mistakes before, but we work very hard at trying to understand how this can be used. We also have a philosophy of iterative deployment. And when we say iterative deployment, what we mean is we want to get our products out to people early and often. We don't believe in developing something and keeping it in-house and then kind of launching it massively globally all at once to everybody. We believe in getting it out as soon as possible and in kind of co-evolving with society, learning as we go from how users are using the products, and where, if and when we make mistakes, we can fix quickly and continue to move forward. So there's this sort of humility to working to bring our products to people in an iterative fashion, listening, learning, making improvements, and then continuing to move forward. And I really appreciate that about OpenAI.
We are going to take a break here on the Global Dialogue and return with our conversation with Kevin Weil, the Chief Product Officer at OpenAI. Welcome back. You're watching the Global Dialogue. We're in conversation with the Chief Product Officer at OpenAI, Kevin Weil, on the big launch that they've announced last night. Launches, you have, of course, had a busy week, but ChatGPT-5, is there a pushback there? How much, what is the kind of delay that we should expect? And what should we be looking forward to now in terms of next steps? There's a lot of rumors and speculation around a Twitter kind of product. What can you share with us on that?
Yeah, well, we're very excited about GPT-5. There are teams working on it as we speak, and I think it's going to be a fantastic new model when we get there. But in general, this is the year that ChatGPT goes from answering questions for you to doing things for you in the real world. So, by that I mean we launched a product earlier this year called Operator that can browse the web like a human and do things for you. It can order food for you, through an online food ordering website. But it can also fill out forms. It can shop. It can do anything that you would do on the web. And of course, you're in control the whole way. It's before it takes a sort of definitive action, it will pause and ask you if you want it to continue some action. But when I think about the time I spend on the web, I bet 30 or 40% of the time that I'm browsing the web, it's not because I want to be doing what I'm doing. It's because I have to get something done. And there's some series of pages and forms I have to fill out and other things. I would love an AI to do that for me. I would absolutely love for an AI to fill out those forms for me so that I can concentrate on, either getting more work done or spending more time with my family. And this is the year when AI begins to do more things like that for you. I'm very excited about that. It comes because of the advances that we're making with these reasoning models that are getting smarter and safer. And it comes with, integrations into the sites that and use every day, so that our models can understand them and can take action on your behalf.
You didn't respond to the rumors and the speculation around a likely Twitter-like product launch.
We'll see. We'll see.
Kevin, I know you don't sleep a lot, so let me end by asking you, what's keeping you up at night? I mean, is it Anthropic? Is it DeepSeek? What's keeping you up at night?
Honestly, we have so many fun things coming. What's keeping me up at night is much more trying to make sure that we deliver as fast as we can and deliver the best products that we can as fast as I know we can to all of the people around the world that rely on us. There's a lot of good stuff coming. I wish I could, take you through the entire roadmap here. But I'm very excited by it. The whole industry is moving fast. Our competitors are doing great things as well. But, I've never seen something grow the way that ChatGPT is growing globally and specifically in India. It's such an important market for us. So we've got a lot more great stuff coming, and I think people are really going to like it a lot.
I want to link this and end by asking you about the use cases, and education, I would imagine, is the big one. And I know that you've spoken about that previously as well, Kevin, especially for a market like India. What can we expect? Is that going to perhaps be a focus area or priority that you would want to consider doubling down on?
Yeah, I think there are, people think about ChatGPT as you can make your job more efficient, you can write emails more quickly, things like that. But I think there are a handful of things that we can do, products that we can work on that will fundamentally make the world a better place. One of them is in the area of scientific discovery. These models are getting good enough that they are actually contributing to novel scientific research. They're advancing fundamental science. And, GDP and world advancement and human growth comes from advancing fundamental science. So, if these models can help scientists advance, if they can speed the pace of discovery 2x, 3x, 5x, 10x, that's an incredible impact in the world. If they can help people understand, my son went through a medical procedure not long ago, and we expected it was not going to be a big deal, but there was a small chance that it was a big deal. There was something wrong. I got a note later from the hospital that was full of, medical jargon that I didn't understand, but it sounded scary. And I couldn't get a hold of the doctor to ask. I uploaded the image to ChatGPT and said, "What is this? What's going on? Is this something to worry about?" And it said, "Oh, no. Here's what it is. You don't have to worry. This is totally benign." And, that was 72 hours of worry and stress that I would have had that was gone because ChatGPT helped me understand something that I didn't have the background to understand. And that's our family with, we're fortunate to have great medical care and all of that. There are lots of people around the world who don't have access to that, where having the ability to talk to something like ChatGPT could be life-saving. And then, you asked about education. every study I've ever seen says that when kids get individual tutoring, they get personalized education, their advancement rates are standard deviations better than kids that don't get personalized tutoring. And again, ChatGPT is free. It knows the curriculum for every class and every topic in the world and can give students personalized learning that evolves with them. Like I want to see every kid in the world have a personalized tutor that is helping them learn any topic they want to learn, whatever they're excited about, as fast as they want to go. The world will be a fundamentally better place when that exists. And I think we can be a part of making it happen, whether it's directly in ChatGPT, whether it's one of the developers and entrepreneurs using our APIs. I deeply want to see that happen because the world will be a better place. And, I would love to see that come from India.
Well, I'll end with India then, Kevin, because, on the back of the usage, the adoption, the acceptance that you have seen in India, is there anything specific that you've taken back in terms of learnings to iterate for the next wave of product launches that we could expect?
Yeah, I mean, we just had 10 or 12 people from the team in India doing a bunch of user research, talking to people in different, urban and rural parts of India. I was there a month ago with Sam Altman and meeting people, talking to users, talking to developers. The amazing thing is how broadly ChatGPT is used. You ask a room full of developers who uses ChatGPT and they all raise their hands. It's really exciting to see. And they all have 100 things that they want to see us implement or do better, new features, new ideas. We know that one thing that's really going to be important for us is performance in low bandwidth environments. Not everybody has a great network connection. We really want ChatGPT to be broadly usable across the entire country, no matter what, cell phone, no matter what network connection you have. That's important. We're also thinking a lot about how we broaden our language support. So ChatGPT, I believe, is the best ranked model in the world for the top 11 Indian languages. But there are a lot more than 11 Indian languages, and we want ChatGPT to be great for everybody in India. And so we're thinking about broadening language support and making more of ChatGPT voice forward for those kinds of use cases. So we have a lot of ideas. They're going to benefit people in India, and they're going to benefit users all around the world, and we're very excited about it.
Well, Kevin, thanks so much. We look forward to seeing more of you here in India and appreciate you taking our time very late at night to be able to speak to us today. Thanks so much, and we wish you the very best. Look forward to seeing you soon.
Yeah, thank you. And by the way, when I was prepping for the interview, I told our new model, O3, that I was going to be meeting with the premier broadcast TV interview or broadcast Indian business-focused TV station in India. And I said, what station do you think it is? And it said, oh, clearly that's going to be CNBC-TV18. So O3 is a genius.
Clearly, O3 is a genius. But Kevin, what an absolute pleasure. Many thanks for joining us. And we look forward to having a deeper, longer conversation with you. Thanks so much for your time today. We are going to take a break here on the Global Dialogue, but there's a lot more coming up. Don't go anywhere. We're back in a moment with more.
security forces have been deployed. You'll see that there will be a lot of chehel-pehl, a lot of buzz around this market at this point of time. But today it's silent. The forces are trying to contain the situation and to figure out that who really were the attackers who came here and carried out this particular
Very
attack.
quickly, I want to go across to some of my other colleagues who are tracking more facets of the story developing in Delhi as well. But Ishan, what's the latest number with you as far as the casualties and the injured is concerned?
That told that the figures are in double digits, and that's why the forces are trying to ensure that they are bring the situation to normal, and they're able to get hold of the things. And you will see that one of the injured has been rushed into another hospital for treatment from this particular location. It's not just the police, it's not just the CRPF, it's not just the army and paramilitary forces. It is also the other forces who were there and who were a part of that particular particular teams have been deployed at the location to ensure that they are able to bring situation back to normal. But
Ishan, I'm going to come back to you. Just stay with me. Take stock of the situation as around you. I see a lot of people. My colleague Arunima is joining us from outside the Home Minister's residence. My colleague Aman Sharma is also with me in the studio. Arunima, coming to you. The Home Minister has just tweeted out his first response as well. He's set to leave for Pahalgam. Is that been confirmed? And what are the other meetings that he has held? We'll go across to Arunima in just a bit. My colleague Aman is also tracking the latest. The big update that we're also tracking is coming in from Jeddah, Aman, where the Prime Minister himself has dialed the Home Minister.
Yes, Shivani, I think the timing of this attack and also the circumstances in which this attack has happened both are very significant. The Prime Minister is visiting Saudi Arabia right now, and the US Vice President J.D. Vance is in India. So the timing of this horrific attack, that also on innocent tourists in Jammu and Kashmir, is very, very significant. The Prime Minister has called up the Home Minister from Jeddah, asked him to take stock of the situation, conduct a security review, and the Home Minister has also now put out that he has spoken to the Prime Minister. He will be leaving for Jammu and Kashmir right away and hold a high-level security meeting there. The Home Minister has said that. Home Minister has also said that the perpetrators of this particular attack will face the harshest of consequences. Again, very significant statement, because this is expected to be and feared to be one of the most worst attacks on tourists in Jammu and Kashmir. Usually tourists are invariably never on the attack. In Jammu and Kashmir, in terror attacks, we have seen, yes, there have been attacks on security forces and also civilians, but this seems a very targeted attack, that also on Hindu tourists.
Yes.
It seems like the attackers have clearly gone after targeting Hindu tourists. So that is very significant. Pahalgam is the major tourist destination of Kashmir. It's also, Shivani, the base camp for the Amarnath Yatra, which will begin in the next few weeks from here. So I think the choice of this particular attack,
the timing and also the choice of the victims. There have been attacks on workers, on non-domicile workers who work in Jammu and Kashmir by terrorists in the past, and this has come now one step further of tourists who are enjoying, and these are unarmed civilians, but they are being attacked just like other non-local workers have been attacked in Jammu and Kashmir in the past. That was the pattern we saw grow over the last 2 to 3 years. Lieutenant General KJ Singh, Major General AK Sivaj, Aarti Tikku, who's an author and Kashmiri expert herself, joining us on the show. Lieutenant General KJ Singh, let me begin with you. This is coming a few days. It may sound superficial and almost laughable, but a few days after General Munir's speech about how different Hindus and Muslims are, and reminding everyone of the basis of the two-nation theory and the partition, few days after this attack happens, choosing Hindu tourists in Kashmir. Do you read it as such?
Shivani, firstly, it is indicative of great amount of planning and timing that has taken place, and that is done by an organization like ISI, because the Vice President of America is here, Prime Minister is in Saudi Arabia, tourist season is to start, Shri Amarnath Ji Yatra is to start. All this is coordinated, well thought out, but diabolic, desperate, because this is one thing that terrorists must fear. The ordinary Kashmiri, he thrives on the tourist season. His livelihood for the entire year depends on this window. When people come here, spend money, use their resources, and then he uses this income throughout the year. Lot of time, the weather is inhospitable. People can't go there. People are confined to their houses, and this is something where there was some kind of an understanding that don't hit at the livelihood, don't destroy economy. Now, this is the time where tourism is coming up. Films are being shot in Kashmir, and these idiots, I can only, I am forced to use this word, have taken such a desperate measure, such a desperate, stupid step they have taken. I can only condemn it. It is, it doesn't show any maturity. Even
well, maybe
the
it is to strike fear in the hearts of the Kashmiris themselves, who've moved on from the days of the militancy, or at least want to enjoy the fruits of development and progress. Just hold on. I request our guest to hold on with me for a minute. I want to go across to my colleague Arunima as well, bringing us the latest as far as the Home Minister is concerned. He is expected to leave this evening for Jammu and Kashmir. Arunima?
That's the expectation, but he's still in a high-level meeting trying to figure out what is the best course of action. You know, the death toll numbers that we are hearing, we are not putting them out officially yet, but you know, the numbers sound extremely disheartening. This could well turn out to be one of the worst terrorist attacks that Jammu and Kashmir has seen in recent times as far as the number of people dead are concerned. And these are not military men, these are civilians, these are tourists who had come to Kashmir to have a good time, and they've been gunned down in this dastardly terror attack. So what is the best response from the government? That's what the Home Minister is currently trying to decipher. Prime Minister has had a word with him on the phone, asked him to leave for Jammu and Kashmir, and we are getting an indication that the Home Minister could leave for Srinagar shortly, but the timing has not been confirmed as yet. He is being joined, you know, behind me is the Home Minister's residence. Currently, the Director General of the top paramilitary forces, also the Home Secretary, the Director of Intelligence Bureau, the Special Director of Intelligence Bureau, all the other MHA officials who deal with Jammu and Kashmir, they're all present inside, and on video conferencing, there are also security grid officials, both army, police and paramilitary, all three units from Jammu and Kashmir, who are logged in a strategy discussion with the Home Minister about the way forward. A coordinate search operation is underway in Pahalgam at the moment, but as the sun is dipping, every minute matters, because the cover of darkness is something that these terrorists would want to utilize. They're also in military fatigues, is what eyewitnesses have said. Looks like the preliminary assessment is that these could be foreign terrorists, but the situation is very fluid, and that's what the Home Minister is monitoring at this stage.
Right. We'll keep coming back to you for more. Major General A.K. Sewach, I'm coming to you as well. What do you make of the challenge that the security forces will face now?
Shivani, first of all, let's see why they have selected Pahalgam. First, we have already discussed why they have selected now. Obviously, that is the time when the Prime Minister is outgone to Saudi Arabia and Vice President of US is here. And he has selected Pahalgam for two reasons. Pahalgam is one of the major tourist spots. Even in summer, maximum tourists come there. And second thing is that Amarnath Yatra takes place from two places. From South Kashmir, it is from Pahalgam, and from North Kashmir, it is from Baltar. 80%, 70 to 80% goes from Pahalgam because it takes 6 days, but the route is very good. So therefore, they have tried to hit in this Pahalgam, try to put a fear in the minds of the tourists that in case you come here, you are vulnerable. You see, till now, in last about 15 years, I remember, they have never touched the tourist because they know it, the tourist, if you hit, it will hurt the economy of Jammu and Kashmir, which will hurt the common Kashmiri, and you will become very unpopular. So they have never hit. But this is the frustration. This is a do and die situation for ISI. You remember General Asim Munir 3 days back, what address has he given to his people there and also to the overseas convention. So the point today is very intelligently they have selected Pahalgam, which will have a lot of adverse impact. Now, what we need to do? We need to do, see, the point is I must accept there is some intelligence failure. They have come in a uniform of the police and some sort of intelligence of course, is a failure. But one must remember that there may be 20 operations which were successfully done, but the terrorists have been successful this time.
Yes.
But now the point comes is that what action we need to do. I suppose what has happened after you done a Pulwama, when you have a Balakot, you need to be responding to something of that nature.
Yeah,
Because
yeah,
it is
yeah,
high
absolutely.
time. It is high time. I having served on a line of control, commanded a brigade in Machal sector. I only remember the time when their terrorists used to be helped by the post to infiltration. We used to eliminate that post. That fear has to be put. Remember what is happening is we have been always telling that we have controlled almost militancy in Kashmir Valley. There are hardly 30-40 terrorists. But such sort of incident sent a very wrong message internationally.
No,
when the
absolutely,
vice
absolutely.
president
This
there.
is, of course,
So you have to
striking
hit
at the
hard.
heart of the government's, government's presentation or narrative as well. And therefore, the government will take it very seriously. Aarti Tikku, do you think it needs another, surgical strike level response from India? These are innocent
100%.
civilians that have been targeted. The cost at Pakistan needs to be much, much higher. This isn't an attack just on our forces, which is condemnable enough, but this is on innocent civilians.
Shivani, absolutely. Had General Asim Munir not actually given us the evidence about their mentality and what they are conspiring and what they are thinking, I would have refrained from saying that India, needs to actually respond, retaliate in a way that it becomes a lesson for Pakistani army. Pakistani army has shown us that it is incorrigible. It is not giving up on Kashmir. It has, in fact, destroyed itself. It has destroyed Pakistan in its obsession for Kashmir. And it is evident from his recent statement, that he wants Pakistani youth to be radicalized against India, against Hindus. And this hatred for Hindu is certainly, we also saw that hatred against Hindus, hatred of Hindus, how it manifested itself in Bangladesh with the help of Pakistan's ISI and Jamaat-e-Islami in Bangladesh. So clearly, it is something that the government of India needs to retaliate in the strictest, I would say, possible manner. And it has to show that there is a cost to terrorism in Kashmir. I think it's quite evident today that Pakistan is frustrated because of the kind of transformation that we saw in Kashmir in the last 5 years. Kashmir was inching very, close to normalcy in the last 5 years. We saw massive number of tourists flowing into Kashmir. We saw how Kashmir was thriving in the last 5 years. We saw huge development of infrastructure. We saw democracy flourishing in Jammu and Kashmir. Clearly, Pakistani army is frustrated because nobody in the world is actually on its side today.
Yes, they are
Everyone
isolated
has-
on the global stage. Let's not forget, in General Asim Munir's speech, there was also Lieutenant General KJ saying a reference of Kashmir being their jugular vein. The MEA had responded to that. It seems like the frustration is growing, and they're exacting these kind of
desperation.
attacks. It's desperation because not much else has worked so far, and Kashmiris themselves are moving on to an era of prosperity which they have been denied for 40, 50 years.
Pakistani army has been on.
Coming to the services side, services revenue came in at rupees 105,398 crores, which is a growth of 6.8% on a year-on-year basis. And I'm pleased to report that our services revenue crossed the milestone of annual revenue of 100,000 crores this year. Software revenue for the year came in at rupees 12,049 crores, which is a growth of 3.1% on a year-on-year basis. And profitability matrices for the full year, our EBIT came in at rupees 21,420 crores at 18.3% of revenue, up 8 basis points on a year-on-year basis, and our EBIT grew 7% on a year-on-year basis. Net income for the year is at 17,000 390 crores at 14.9% of revenues. Just an update on our return on invested capital. Our ROIC continues to improve thanks to our ongoing focus on profitability and efficient capital management. For the last 12 months, ROIC is at 37.9% for the company, which is up 411 basis points year on year. And for the services, ROIC is now at 45.5%, up 376 basis points year on year. Software also continues to improve with ROIC at 19.9%, up 370 basis points year on year. Cash generation is another highlight I would like to focus your attention on. Our cash generation remains very strong. Over the last 12 months, operating cash flow reached at rupees 22,261 crores, while free cash flow generation was at rupees 21,153 crores. The balance sheet remains strong with gross cash at rupees 30,943 crores and net cash at rupees 28,652 crores. Operating cash flow to net income conversion is healthy at 129%, and free cash flow to net income conversion is at 123%. This is on the back of our continued improvement in DSO. Our total DSO, including unbilled, is currently at 80 days, a 3 days improvement year on year basis. And now for the shareholders, our diluted EPS for the last 12 months came in at 64.09 rupees, which is a growth of 10.8% year on year. The board has declared an interim dividend of rupees 18 per share for this quarter, and the record date is 28th of April 25, and the payment date of the same shall be 6th of May 2025. That brings our last 12 months dividend payout at rupees 60 per share, effectively distributing 93.5% of our net income. That's all from my side for now, and I would like to hand over the discussion to Ram for an update on HR. Over to you, Ram.
Yep. Thank you, Shiv. Good evening, everybody. So this year we increased our employee count to 223,420. For this quarter, it's a net addition of 2,665. On a full year basis, if you recall, the first quarter we had a divestiture. If we offset for that on a full year basis, the headcount increased by 3,337. So that's a net addition through the year outside of the divestiture. In terms of freshers, this quarter we added 1,805 freshers. If you recall, we made a conservative projection last quarter to add about 1,000. We've done in excess of that. That's in line with our plans that move quarter on quarter basis. So on a full year basis, the number of freshers we added for fiscal 25 is 7,829. Attrition is at 13%. That's the IT services trailing 12 months attrition at 13%. It's a 24 BPS drop from the previous quarter. If you look at last 5 quarters, attrition has pretty much sort of stabilized around 12.5 to 13%. That's on the back of the new programs and initiatives that we have launched over the last 18-24 months. Many of these programs are not only resonating with our employees, it also catches the attention of external professional bodies. In FY25, we received as many as 26 different acknowledgements and certifications for the type of programs that we are running, which is showing results in the way we are able to attract and retain talent within the company. CVK spoke a lot about the opportunities for AI. We have spoken about investing in AI skilling. We planned for upskilling about 50,000 of our colleagues during FY25. We significantly exceeded that target to upskill about 106,000 of our people with AI skills, i.e., being prepared to take advantage of the opportunities that come in the marketplace. That's a quick brief. I'll pause here. If okay, we'll open the floor for questions.
Anyone questions, please?
Yeah, hi. Hi, everyone. This is Jitendra from CN Leader. Thank you very much for sharing all the details. Looks like it's a great performance as compared to your peers, given the macro uncertainty. I have two questions. One with AI at center stage, and HCL is betting big on it, and of course, clients also. How do you see which are the new verticals that you see are adding more to your business in the next 1 year? Plus, in terms of your clients, which are the primary use cases HCL is solving across industries in terms of AI and agentic?
Thank you, Jitendra. Yeah, thank you for your questions. With respect to which of the verticals are we seeing a higher growth momentum? Generally, our guidance is given at an overall company level, so I'm not providing any specific guidance by industry. But AI adoption is happening across all industry. It's pervasive across all our existing clients, new deals, all of that. Now, what are the typical use cases? We broadly classify them into two categories. One is service transformation, which is all the services that we deliver. How can they be delivered much more efficiently using generative AI, right? That's where we have a platform, which is a resounding success. AI Force is already deployed in about 35 customers, and we have a plan to deploy it to about 100 customers in FY26. The second theme is value stream innovation, which is in different industries. There are use cases like health clinician assistance is one example, trade surveillance is another example. There are about 100 different use cases across different industries, and we are selecting the use cases which can be repeated across multiple customers in a specific industry. So we call that as IFRS, industry-focused repeatable solutions. The second thing is horizontal solution. Like, for example, contact center transformation. How can we use generative AI to drive faster and a much better client experience using contact center transformation? So there are similar, that solution can go across all verticals. So these are called as horizontal repeatable solutions. So these are the two areas we are investing in value stream innovation. That's broadly my response.
Hi, Annapurna from ET here. Firstly, on the guidance, your FY26 guidance is lower than the FY25 guidance, but of course, a little bit more upbeat than your peers so far. Can you explain more of your thinking on where specifically you expect to see some impact of the tariff uncertainties, etc., but also any points of optimism or what levers you're looking at to have a better outlook than your peers? Secondly, on the AI projects, you said that there were some pricing pressures and in addition to gaining wallet share as well. Can you explain a bit more on the pricing pressures and how you've been navigating that? What have you been proposing to customers and sort of their evolving demands, what they're wanting to see from the AI solutions? And thirdly, for FY26, what are your hiring plans? Any numbers you can share?
Okay, a lot of questions. Thank you, Annapurna. Tariff impact, we expect. We haven't seen any specific impact so far. But in terms of impact, we see this play out much faster in consumer and manufacturing segments. But if the tariff impact were to play out, I don't think any vertical will be left behind. All industries would get impacted. However,
This is going to the tariff. The biggest impact will be on the costs for clients and their intention and their kind of focus on using generative AI to drive high efficiency in every aspect of their business will become the center stage of all the conversations. So we believe while there is uncertainty and there is going to be definitely a deterioration in the discretionary spend, we think AI-led efficiency is really the biggest theme where there can be large opportunities. We have a strong pipeline, and while there is conservatism in the way we look at our guidance at the lower end, overall we think this is a great opportunity to create significant opportunities for us in the market. In terms of pricing pressure related to AI, obviously when you're able to deliver at a much more efficient operating levers, then obviously we share some of the benefits with our customers. So there will be a deflation due to that. But with every renewal and every client conversation, we are able to ask for a higher wallet share of their spend as we proactively provide them the benefits due to generative AI. So that's been our strategy, to be very, very proactive with our existing clients in showing the art of the possible, and in return, expect a higher wallet share. And that strategy has worked well. In fact, all the renewals that we did, 95% of them had some incremental business. That's the second question. And on hiring plans, I would request Ram to respond.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. Walmart-owned Flipkart will shift its holding company from Singapore to India as it gears up to go public in the next 12 to 18 months. Move is aimed at easing compliance and streamlining tax structures. CNBC-TV18 was the first to report on Flipkart's plan to shift domicile in December last year.
Auto-grade flat steel processing company Bosch's Metal Industries raises 43 crore rupees in a funding round that was led by Avishkar Capital. These proceeds will be used to establish a new processing facility in Aurangabad.
Unacademy cuts down on its cash burn in the core business. It's down from over 1,000 crore rupees annually 3 years ago to under 200 crore rupees this calendar year, half of what the company spent last year. CEO Gaurav Munjal took to X to say the company has 1,200 crore rupees in the bank and is in a default alive state.
The Maharashtra government orders the shutdown of stores of Ola Electric that are operating without a trade certificate. Over 100 stores in Maharashtra received these show-cause notices. As per rules, the stores cannot operate without a trade certificate.
India's proposed digital competition law likely to be put on the back burner considering concerns from US government and industry. Sources say government is unlikely to introduce the bill anytime soon due to ongoing efforts to clinch a trade deal with the US. Those were the headlines that we're tracking for you this evening on What's Brewing today. Unicus Consultech has backed $20 million in a Series C round led by Nexus Venture Partners with continued support from Sorin Investments. The funds will be used to accelerate the firm's rapid growth trajectory, launch new services and expansion. Joining us now in the studio to discuss where the firm is headed is Jamil Khatri. Jamil, thank you so much. It's great to have you in the studio again. And, congratulations on raising this $20 million.
Thank you very much, and it's always a pleasure to be on the show. My lucky show, I say.
Absolutely. I mean, the last time we spoke to you was in the studio about a year ago when you had raised these funds, right? So if you could sort of take us through, what the growth story has been like for you since we spoke last year. What's working, what's not, what's happened in this 1 year?
Awesome. No, thank you. So it's been a great build for us over the last 12 months since we last met. We're now 550 people across the globe, 11 offices. We have 6 offices in India, big presence in Saudi Arabia, big presence in the UAE, and a very large presence on both parts of the US coast, which is New York and in San Jose and Silicon Valley. All our businesses are firing, Arundi. So great work on IPOs in India. We've been doing a lot of work on IPO readiness, a lot of work around finance transformation in the Middle East, a lot of work globally on risk and control because that continues to be relevant irrespective of the state of the economy, and good work on ESG and climate in the Middle East. We also added a technology consulting vertical since we last met. Been doing some great work on AI and would love to talk about that, some great work on cybersecurity and overall technology. And finally, consistent with the thesis of Unicus that we're just not a services company but an asset or a product plus services company, we created a tech stack for the CFO's office, for the risk officer's office. So yeah, lots been going on for us over the last 12 months since I was last here.
Absolutely. So firing on all businesses is what you said. But, you pointed out that you've been doing a lot on the IPO front. But, with the market volatility, what's happening globally, where does the Indian market stand when it comes to IPOing and, what's it looking like?
I think the big picture point is, as we all know, there's been a lot of money which has gone into startups over the last decade. But when you compare exits in India as compared to what we've seen in China and other parts, we've really not had those many exits through IPOs. Everyone realizes the need for a very robust flow of new startups into the IPO system. And to your point, irrespective of the volatility over the last few months, people realize that you need to be ready. So whenever the market opens up, you then have a window to kind of list yourself. That's what we're seeing in India. Equally, just to add on to the IPO point, a very, very strong IPO market in Saudi Arabia. And in fact, there are Indian businesses who have operations in the Middle East that are effectively thinking about how do they list their Middle East operations in Saudi Arabia. So yeah, there is a lot of prep work that's going on, even as the market remains choppy.
So lots of work going on there on the IPO front. But your target is to hit $100 million in revenues by 2026, right? So where are you currently at, and what's the India share? Are you on track to hit these numbers? If you could sort of give us an idea about where the globe stands versus India, especially when it comes to your business.
Yeah, so as I said last time as well, we started just 2 years ago. So we trebled our revenues in 2024. We're a calendar company. And this year we'll do $50 million of revenue, which is our third year of operation. So that sets us up beautifully for kind of, in fact, 2026 we'll be close to 100 million and 150 million by 2027. Right. So on track. The business is very well divided between our three markets. So around 40% of our revenues are in the US, 40% are in the Middle East, and the balance is in India.
Right.
And in India, we're very selectively focusing on what we do. So it's not that the market demand does not exist, but it's just very focused on things that we do in India.
So very focused work there in the India market. But you've raised this $20 million. Can you walk us through how you plan to spend this money? Do you see a shift in the way you're going to spend this money versus when you raised funds last time around?
Yeah, I think the good news is we are profitable.
Right.
And
that's always good news.
Always good news. And actually, we don't need that much capital. So we've raised, till date, we've raised $23 million. We only spent $7 to $8 million out of that. The rest of it is working capital and lying in the bank. To your point, what do we do with this capital? Three things. First is geographical expansion. We believe there are tremendous opportunities in a product market fit for what we do in markets like other parts of Middle East, like Bahrain, Qatar, Kuwait, and Oman. Canada is another interesting market. ASEAN, led by Singapore, is another market. So that's one place of spending capital.
Right.
Second is we have 250 plus clients globally now. And many of these clients are saying, look, you do 4 things for us. Why can't you do item 5 and item 6?
Right.
So we're looking at valuations, we're looking at diligence and those adjacencies. And finally, AI.
Right.
We believe that a lot of work in consulting that is being done. In the first instance, we tech enabled it, and now the opportunity is to AI enable it. That's really where the money is going.
Absolutely, and you preempted my next question, right? I was going to say you're going to use these funds to build out Unicus AI. So how are you going to use it? How will it integrate with or enhance your existing platforms like UniQuest and Risk Universe and all of the other platforms that you have? So what are you using AI already for?
Yeah, I think in the first instance, what we did, if you remember from our past discussions, is that we took a bunch of services that were done traditionally on-site by people in the US and elsewhere and created the on-site offshore model to do it. In the second instance, we created technology assets to automate as many of the workflows as possible. And that's really what we have in Risk Universe, Reporting Universe, ESG Universe. And now the question really is, how can you further enhance it through the power of AI that we have? And that will result in 2 things. One is it will result in a different experience for the customer in terms of not having to deal with people, but having to kind of, really managing technology. And second is productivity.
Right.
We believe that, 60 to 70% of efforts that go in certain solutions can be AI enabled. And that's really what the journey is going to be for the next 12 months for us.
Absolutely. So big plans there, big growth plans for you, already profitable. So looking to grow in other regions as well. But Jamil, we're completely out of time. Thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey.
Thank you. Always a pleasure.
And hope to see you here next time when
on
you raise more
Series D.
funds.
Yeah, indeed. Thank you very much for your time.
Absolutely. Thank you so much, Jamil.
Pleasure being here. Thank you.
All right, moving on. Wow Momo has raised a bridge round of funding of about 90 crores from its existing investor, Khazana, which is a Malaysian sovereign fund, and Haldiram's Nagpur owner, Kamal Agarwal. The company is also in talks with a few HNIs and investors to take this bridge round to a total of about 150 crore rupees. It has also appointed Avendus as a banker for a larger round of up to $100 million in a mix of primary and secondary that is proposed to be raised in the second half of this year. For more on the significance of this funding round and how it is going to be deployed, joining me now is Sagar Daryani, who's the CEO and co-founder of Wow Momo Foods. Sagar, thanks very much again for your time here on CNBC-TV18. As we understand, this bridge round is still in process, not yet closed. How soon before you close this targeted 150 crores, and who are you in talks with to raise that additional money?
Thanks, Ritu, for having me here. Basically, 150 is not the number that we have in mind. It's anything between 15 to 17 million USD. So, I think it should take a couple of weeks. Honestly, we have some good names backing us. It's just that, we want to take someone who can add value to the cap table. Like Kamal ji, he has deep-rooted experience in the FMCG space, someone who's been there, done that. So trying to figure out people who can actually add value to the business. In no rush, to be honest. Khazana has put in the money and so has Kamalji, and we will take a call very shortly, but in no rush, just trying to find the right fit in the cap table, to be honest.
And is it true you're looking at $100 million kind of a fundraise in the second half of this year?
Yeah,
and if you are, tell us why and how you want to deploy this kind of capital that you're raising.
So I think for us, we've never done such a large round before. So this will be the first large round. I think it'll be a mix of primary and secondary. I think it's more to clean up the cap table. This will be our last round before an IPO. So it's more like a pre-IPO. I think we plan an IPO between 24 to 36 months from now. So this is more to give Lighthouse an exit. They already have a part exit. So it's more to give an existing investor an exit. And I think raise enough capital to, steady the ship for the next 2-3 years. I think in the next 2 years' time, the business should start throwing back a lot of cash. So, when we hit IPO, we become a debt-free company or a debt-reduced company, and that's where we'll use the funds for. So yeah, I think it'll be more of 50 million primary, maybe 50 million secondary. We are okay with anything between 80 to 100 million. But yeah, I think it's more to, I think it's 50% of the share is secondary capital, right? So the business does not require that much cash. I think Wow Momo is already profitable. I think we are figuring out the FMCG vertical, which at the moment is burning money, but then it's a new vertical. It's growing really fast, growing at 100%. And we're very confident that in the next 2 years' time, we should be cash positive. So it's more to give exits. It's more to have enough capital, pay back your debts, and in 2 to 3 years' time, execute, put your heads down, perform, deliver, not to get distracted, and go out there and hopefully have a wow, have a wow IPO if we can.
And when is that Wow Momo IPO, Sagar? What is the timeline that you're working with?
See, you can't time the markets, but anything between 2 to 3 years. Again, it depends when the elections are. I think 28, 29 is the year when the elections are there. So we'll figure it, but we want to be IPO ready in 24 to 36 months. When we time the market, when we hit the market, I think it'll be a decision we'll take depending on the external circumstances. But yeah, we're very clear in our head that, we want to get to a, 1,100, 1,200 crore top line. We want to get to 100 crore EBITDA and then, aim for IPO. So, for a company like us growing at 35, 40% year on year, I think these are decent margins, good margins. And if we can meet our numbers, if we can walk the talk, I think kudos to the team and to our patrons to be able to get there.
All right, 2 to 3 years for an IPO that you're looking at. You briefly mentioned Wow Momos is profitable, but what about the overall business? You closed the current year with about 640 or so crores of revenue, and now we understand you're targeting almost 900 crores in the coming fiscal. What will drive this growth?
So I think the 640 crore will definitely jump to 900 crore. If you look at it on an ARR perspective, we are already an 800 crore business. And we're opening 250 new stores. I think the major fundraise is to open these new stores. As a business, we are a going concern, right? I mean, we just need to reduce the growth and, we can become cash positive. So it's more about, plugging and opening these 250 stores. That means on an average, we open 21 stores a month, which is almost opening one store every working day, right? So you need capital to fuel that growth, and that's why the raise is there. But net, I think it's more to do with FMCG growth. It's more to do with the QSR growth. We have a new vertical in Horeca where, we are selling momos to 5-star hotels. We are selling momos to, brands like Zepto, etc. So I think it's a big runway that we have, and we should touch 900 crores for this year, which will be almost a 45% growth as compared to last financial year. So I think we have our plans in place. I think we're doing the right thing at the right time. Personally, I think we've built a very, very strong team. We have a separate CEO for FMCG, a separate CEO for QSR. So the business is completely on a autopilot mode where we just need to go out there and deliver. It's only us who can make this big, or it's only us who can spoil this. So I think we don't want to be party poopers. I think we want to go out there and, give it our best and leave the rest to things to happen. I mean, you can't control external factors. There has been a major silent slowdown over the last few months. QSR has seen negative same-store sales growth. Fortunately for us, I think if I compare it to the listed peers, we've been plus 4% for the whole year. So I think we've really come back well from July. So we want to keep that momentum going.
All right. We see you already comparing yourself to the listed peers. We'll hope to see you in that space in the next few years. But quick word on your FMCG vertical and, of course, the newly launched hotel, restaurant and catering arm. What should we expect? What are your plans in terms of scaling this year? What will be the priorities?
See, we started FMCG 28 months back, right? And in 28 months, we've become a 5 crore monthly business. We're very proud of the team. I think when we started frozen momos, we were 0 and the competition was at almost 5 crores. Today, we are at 5 crores and the competition hasn't really grown much. So I think we've captured a lot of market share. And very proud of the way we've done it. Personally, I think for us, it's about, being category creators. So we just launched Kappa noodles where we have a Kappa Khawswe, a Kappa Thukpa. So we don't want to be a Me Too. We want to create new categories. We have frozen smileys that are coming into play. So, chicken and cheese smiley, chicken cheese smileys. In momos, we've done the Korean range of momos. We've done the kurkure momos. So I think lots of innovation happening in the product space. Very soon, I think by Q4 or by early beginning of next financial year, we're going to get into our own range of sauces, spices. I think the Wow Momo sauce is, it's in high demand. Consumers come to our store and they ask for extra.
Okay.
So I think a lot of traction happening in the NPD space in FMCG. So I think it's a big vertical market. We want to be focused on Oriental, and that's where our focal point will be.
And we wish you the best with that, Sagar. Thank you very much for your time here today. Thank you.
Thank you, Ritu. Thank you for having me.
On that note, it is time for us to head into a short break. But coming up next, an exclusive conversation with the co-founders of IPO-bound Ather Energy. The EV maker expects strong growth to continue as it focuses on cutting costs, sourcing locally, and strengthening supply chains further. Stay tuned for that conversation.
Years of being a part of country's EV revolution, Ather Energy is now gearing up for its biggest test yet, the IPO. Joining me now are the founders Tarun Mehta and Swapnil Jain. Thank you so much for joining us on CNBC-TV18.
Thank you.
I think the first question when an IPO comes on the block is a very obvious one, which is path to profitability. Is there a realistic timeline on breaking even?
So, path to profitability is basically two levers, your unit economics and then scale, which is the operating leverage. I think if you see our updated numbers till December, you will notice we've done a tremendous job on improving our unit profitability, gross margins. They've gone from 9 to 19, so they've scaled up really well. And this is down to some amazing work done by our teams on value engineering and a great job done by our sales system on the right kind of SKU mix and product mix overall. The second part of this equation is scale. Again, on scale, you will notice we've grown very healthily in the last 9 months, and this entire year looks like a great growth year. And what's ahead of us on both these axes is a lot of potential cost improvement on the back of our new platform, on the back of the transition to LFP batteries. And on scale, there's a tremendous lever of new stores and expanding our distribution that's ahead of us that we're very excited about. So put these two parts, we've done a good job with both. And there's a very strong outlook on both, which is why we think the path to profitability is at least clear now. And you will also notice that EBITDA has improved quite a lot in the last couple of years.
But with FAME 2 subsidy hitting pretty hard, the entire EV sector, especially the two-wheeler sectors, the two-wheeler market, How do you sort of future-proof yourself with these policy changes? Because policies are dynamic in this sector yet.
I think the good thing, the bad thing and the good thing that's happened with subsidy is that the bad thing is that it's come down, and the good thing is that it's come down. So now the overall reliance on subsidies has reduced for the industry. So the overall impact is not that high. Like 2 years ago, this would be a massive lever. If subsidies, if anything happens to them, this would change our financials massively. But now we've come to a point where subsidies are going to soon become something like 3% of the revenue. So while that makes our job harder, but in a way the company and the industry is better prepared for it. What can you do to better prepare for it? There's a lot of engineering. Our teams have been focusing on taking cost out. In fact, I think that continues to be one of the largest focus areas within product development overall. A lot of work on supply chain resilience and domestic sourcing. So those are things we've done to, in a way, future-proof ourselves against further subsidy reductions.
One of your biggest backers is, of course, Hero MotoCorp. How do the synergies work here, considering a legacy player is backing and betting on an up-and-coming company and a sector for that matter? Where do you draw the line? How much of, what is the sort of share percentage, if there's any?
Share percentage of?
If there's any like tech percentage that you're sharing with them, or are you helping them out with anything?
No. Ather and Hero are two completely different platforms, if I would describe them that way. They're very unique and strong advantages that Hero as a business has with their motorcycles, with their now expanding international, with their focus areas. The customer is very different. With us, our product, our DNA, our sales system, our customer focus, they're very different. So it kind of makes sense for us to build these businesses out differently instead of trying to find synergies. We've looked at synergies, and there are a few, like in charging infrastructure. But at the product level, at the sales level, we've realized it's better to build businesses differently. Hero has been a fantastic partner in our journey over 8 years. They've been our biggest backer, and Dr. Munjal has been a great supporter over the years. But ultimately, the business has to be built out.
I'm sure you get this question a lot, because with the release of the DRHP, they're not participating in the OFS at all and only going around ramping up their stake in the company. What's the future like? Is there an acquisition on the cards? Is there a merger on the cards? What would the future be like, or will it is it never a possibility?
Honestly, if M&A was the way forward, us spending all this time taking the company public is a bit of a tangential journey then. It would be far better if you want to pursue that path. Instead of us spending so much time with them building their EV business out, us building our EV business out, would actually be a fairly counterproductive exercise in a sense.
Top tech features of Ather that sets you guys apart from an Ola or any other EV in the industry?
So actually, we are all along our focus has not been about paper spec. It has always been about the depth of every feature which we offer. May it be the auto hold feature, may it be the maps. For example, we've been very clear that we will not move on to some other maps platform, because maps is not like a checkbox of a feature for us. Google Maps works best for customers, and that's why we will provide only Google Maps. So it's similarly on auto hold. It's not about, okay, can your vehicle hold, but how long can it hold? Can it hold for a half a minute, or can it hold for 2 minutes? Can it hold with one rider, or can it hold along with the pillion for 2 minutes, 3 minutes, 5 minutes of sort? So all our features, auto hold, or even a Bluetooth stack where your phone and your vehicle and your helmet sort of pairs together. We believe in depth of features than just the checkbox of features. Ecosystem is always going to be our strong focus, because that's inherently an EV enables that, and we also believe that we have to stop looking at just vehicle and look at there are a lot of ecosystem products around the vehicle, and they really enhance the ownership experience of the product.
This IPO is coming at a time when not just the market is struggling, but also EV sales are going through a slowdown in the country. How do you peg this double whammy of a situation?
I think we get too distracted, and it's funny you talk about the markets and EV sales month on month. because I think we get too distracted with this myopic view of monthly numbers. So markets in October are the greatest market ever. Markets in Feb are bad, and last week now was the best week ever, and everybody gets too distracted with it. Even EV sales, if you look at an annual level, or even if you look at a quarterly level, have been on a great path of growth. FY24 looks like a healthy amount of growth over FY23. Calendar 24 was a solid amount of growth over calendar 23. So we shouldn't read just weekly or monthly numbers. See how the entire picture is emerging. Tier 3 towns, Tier 2 towns in India are electrifying at a rapid pace. Scooters continue to win over motorcycles. Electric scooters are growing much faster than than petrol scooters. I think there's a tremendous area of growth. I think the outlook is beautiful over the next few years. The TCO makes a phenomenal amount of sense for an EV buyer with a scooter. We are focusing on the premium and upgrading customer, which we believe is the strongest growth category over the next few years. And for us, particularly, the story is very, very exciting because we've just launched a second product which has seen tremendous response with Rista, Ather Rista. So obviously, it's going to drive a lot of growth in the near term. EL platform is coming in very, very soon ahead of us. That's going to drive a lot of future products for us. And then finally, distribution. There are hundreds of cities where Ather is still not present. Opening our stores there finally this year, next year, is going to drive a lot of growth. So I think we are bringing our issue to the markets at a time when we've proven our brand with Ather 450. We have shown the promise with Rista. There is the future promise with more distribution and the EL platform, the new platform. And the industry continues to grow at an annual level very healthily. We love the timing.
But what are you, if I could frame this better, when we speak of markets, we saw Ola come down from a peak of $7 billion to now almost 65% from its peak ever since it got listed. Markets haven't changed much. And we saw that with your valuation also coming down from 20,000 to 14,000. Where is the confidence coming from, and are you exactly confident to go forward with this?
We are not trying to time the markets here, and actually I will say the same answer all over again. We are not trying to time the markets here. Pricing is ultimately a factor of where the larger indexes are and where the larger market is. What we believe is, what we've seen is tremendous amount of demand and excitement for our brand and our company. We've been building it solidly for the long term. There's a solid view, there's a solid focus on profitability. If you notice our EBITDA numbers quarter on quarter, we've improved them significantly. We're not a company that's just trying to grow top line at the expense of every other number. In fact, many of you have asked me the same question. Why not just sell more products at a lower price? We've not done that because we also have kept our eye on profitability. Ultimately, I think the market will reward strong, profitable, sustainable growth with a company with high governance, which is what we're trying to build at Ather. So we're very bullish on market, on our long-term prospects. And the pricing, exact timing of the market, I think that's, nobody can predict that. It's fine.
Thank you so much for joining us today on CNBC-TV18, and good luck for the IPO.
Thank you.
Thank you.
Thank you.
Hello and welcome to this special show. No, you're not fine the way you are. That's how the latest book by Dutch historian Rutger Bregman urges people to think outside their comfort zone. The book, titled Moral Ambition, shows you a path to make a difference to the world rather than just watch from the sidelines. The author argues that a 40-year full-time career consists of around 80,000 hours, 10,000 work days or 2,000 work weeks. But how you spend that time is the most important moral decision of your life. What should be the main ingredients of moral ambition? Where to start in terms of identifying the world's problems, and do money and idealism go together? Those are some questions that the book addresses. Joining us right now is the author, Rutger Bregman himself. Bregman had made headlines in 2019 in Davos for calling out billionaires for tax avoidance and flying in private jets to talk about climate change.
This is my first time at Davos, and I find it quite a bewildering experience, to be honest. I mean, 1,500 private jets have flown in here to hear Sir David Attenborough speak about, how we're wrecking the planet. And I mean, I hear people talk in the language of participation and justice and equality and transparency. But then, I mean, almost no one raises the real issue of tax avoidance, right? And of the rich just not paying their fair share. I mean, it feels like I'm at a firefighters conference and no one's allowed to speak about water, right? there was only one panel, actually.
Well, we've had two. You're the second of our panelists.
There was only one panel.
Let's go there.
One panel hidden away in the media center that was actually about tax avoidance. Yeah. I was one of the 15 participants. So something needs to change here.
Rutger, thank you so much for joining us on the program today to speak about your latest book, Moral Ambition. One of the lines that the book begins with is no, you're not fine just the way you are. People may spend their whole lives climbing up the ladder of success only to find, once they reach the top, that the ladder is leaning against the wrong wall. Why did you feel it is important to shake up your readers and their thinking and their approach towards work and professional life?
Yeah, well, my reasoning is pretty simple. In the first place, we have a lot of very big global problems. So 15,000 kids die from easily preventable diseases every day. 85% of the world population is below the poverty line of the country in which I live, the Netherlands. We have the threat of the next pandemic that may be just around the corner. There's war, there's democratic backsliding. There are a lot of things we got to do something about. But then the second thing is that a lot of people are currently stuck in jobs that don't really add all that much value. And I'm not talking about teachers or nurses or care workers. No, I'm talking about people who often went to great universities, who have beautiful resumes, who may be a marketeer or a banker or a corporate lawyer or whatever. And still, at the end of the day, they have the feeling that they don't really contribute all that much. There's one big study that showed that around 25% of people in developed economies even think that their own job is socially meaningless. So there's a huge waste of talent going on. And my book is basically a call to arms. It says that if you are very talented, if you have a little bit of ambition, then you should use that to make the world a wildly better place. And I call that moral ambition. It's the combination of the activism or the idealism of an activist and the ambition of an entrepreneur. When those two things come together, something really magical starts to happen.
Right. But at what stage and at what point should people start thinking about this? Because the common line that we hear when someone talks about changing the world or launching a political party or working towards a social cause is that you can't change the world, or it's better to stick to the beaten path, have a work life balance, earn a good enough amount of money for your family, for your holidays, so that you can retire well and early. Nothing wrong with it, but perhaps, according to your book, one wouldn't be very satisfied with this way of living. But how does one come to the conclusion that you're cut out for making a difference to the world, for leaving an impact? And where do you really start off?
Well, history is littered with examples of small groups of really thoughtful, committed citizens who made a massive difference in the fight against some of the greatest problems we face as a species. In the book, I talk, for example, about the abolitionists, those who took up the fight against the slave trade and against slavery. And you got to remember that in the 18th century, in a country like the United Kingdom, for example, this was really, really unpopular. The United Kingdom was making an enormous amount of money on the slave trade and on slavery and on having this whole system of colonies. But then there was a small group of mostly entrepreneurs and businessmen who said, this is the greatest moral atrocity of our time. We should kickstart a movement against this. So it is really small groups of really committed people that can make a difference. History shows us this. And I've tried to write sort of a self-help book, a guide that people can use if they also want to follow that path. Now, I got to say, if you want to read a book that will make you more relaxed or more mindful or happy or whatever, then you should probably not read my book. There are thousands of self-help books that will teach you, how to do less. But this is a book about how you can do much more and how you can really leave your mark on history.
Right. Now, speaking about leaving your mark on history, you speak about what startup founders, young entrepreneurs can also do. You know, your book also argues, and you've said this, that a lot of times we are launching companies or launching solutions to the problems we never really know we had, or it's probably too simplistic. So what is the kind of mindset or moral ambition that young entrepreneurs need to have?
Yeah. So we got to realize that ambition, it's just raw energy. You know, it can fuel a rocket that goes to Mars, but it can also fuel a bulldozer that, waltzes over a rainforest. So it's just energy. And what really matters is how you use it. What I currently see is that there are a lot of young entrepreneurs starting new companies that, create these products that are perhaps in the best scenario, okay, but in the worst scenario are actively harmful. So there's a famous quote from someone who worked at Facebook a long time, and who said that the best minds of my generation are thinking about how to make people click on ads. And that is pretty sad, isn't it? That you have all these really smart people who could technically do an enormous amount of good, in a country like India in particular. If you would take up the fight against some of the greatest health problems, just imagine how many lives you could save. It's honestly extraordinary. So it's always a little bit sad to me when those very, very talented people, spend so many hours on something that doesn't actually matter all that much. Maybe you can make a lot of money with it, but in the end, what are you going to think about when you lie on your deathbed? About all the PowerPoints from colleagues that you didn't see, about all the long meetings that you didn't attend, or about the actual impact you made. That's I think what really counts in the end.
Right. How would you define moral ambition today? Of course, when you hear the term, you immediately think about doing something good for society. But according to you, what would be the 4 main ingredients of moral ambition that youngsters, that entrepreneurs, industry veterans, CEOs can keep in mind?
So I co-founded an organization called the School for Moral Ambition that helps as many talented people as possible to pivot their career and to use their resources, whether it's their talent or their capital or their network, to make the biggest possible difference. And we use a simple framework to help people focus on those biggest problems. It's called the SSS framework. So we focus on problems that are really sizable, they're very big, they're solvable. You got to have some plan of, what to do about them. And most importantly, they're also sorely neglected. If you go and work on the issues that everyone else is already working on, then you're not going to make the biggest impact. So, for example, I'm someone who grew up in a rich country, in the Netherlands, in Northern Europe. If I want to, help as many people as possible and to improve their health, then, probably focusing just on the Netherlands, where we already spend a huge amount of healthcare, is not going to make the biggest possible difference. If I would shift my focus and focus on something like malaria, for example, 600,000 people die from malaria every single year, mostly kids under 5. Well, then I can suddenly do much more good, right? Because it is so neglected. So if you're really morally ambitious, you gotta dare to go where others don't go. You gotta be able and be willing to do the unpopular or the unsexy things.
Right. And does this mean, because when we hear about working for a social cause, or working for the betterment of society or world, you often hear that you need to lead an austere life. Can one have a day job where you're working as somebody in the corporate sector, have the ambition of rising up the corporate ladder, yet be an idealist? Can money making, idealism all go hand in hand together?
Well, I think that money is pretty important if you want to make a big difference. The former UK Prime Minister, Margaret Thatcher, she once said that the Good Samaritan, from the Bible, he didn't just have good intentions, he also had money. So yeah, if you want to make a biggest possible difference, you got to find some way to attract capital. And here, I think philanthropists or brave philanthropists can make an important difference. If you study these great movements of the past, I mean, I already mentioned the abolitionists. They weren't financed by governments. Government was not giving subsidies to these people who fought the slave trade because the government was making an enormous amount of money facilitating the slave trade. The same was true for businesses. They were certainly not giving money. So there you need very brave individuals who are willing to go against what is fashionable, against what is popular. And look, I also realize that there are a lot of young people who are like, well, how am I going to buy my own house? How can I make my own career if I don't climb this corporate ladder? And I do understand that. I just think that there's more to life, probably. And for a lot of these talented, privileged people, my message is, look, you can only drive one car at a time, right? At some point, it's okay. And then other things become much more important. And it would be a shame if you lie on your deathbed and you're like, oh, as you said, I've been climbing the wrong ladder my whole life.
Right. You've spoken about how awareness is the best starting point, while for many it has become the end goal. What do you think we need to do in order to become a more satisfied individual, make a difference? And what is the problem, according to you, with the kind of activism that we see?
The reason I wanted to write this book is that, honestly, I became a little bit fed up with myself. I'm a writer. I spent 10 years of my career providing my opinions from the sidelines. Indeed, as you mentioned, shouting things like taxes, taxes, taxes when I was invited to Davos. And that can be very satisfying, but it's also quite easy. Here I was, on the sidelines, watching the people who are doing the real work, who are in the arena, with the sweat on their faces. And I started experiencing this emotion that I like to describe as moral envy. I was just jealous of the people who have some skin in the game, who do the real work. And I indeed realized that awareness is vastly overrated. I had spent 10 years in the awareness industry, providing my opinions. But very often, people don't do much with what they know. To give you one simple example, most people know that billions of animals are terribly tortured in what we call factory farms. Or we can know about that at least, but most of us just choose to ignore that. So the real challenge is in bridging the gap from awareness to action, to actually do something. And so I wanted to write a book that would be a big kick in the butt for myself, that would force myself to make a difference. And hopefully it's helpful for others as well. I've, as I said, I've co-founded this organization now, completely changed my life, turned into a social entrepreneur. And that has taught me many lessons, and also, caused me to believe that it might be possible for others as well.
All right, just stay with that thought, Rutger. We have to take a short break, but don't go anywhere. When we return, this conversation with Rutger Bregman, the Dutch historian, will continue on his book, Moral Ambition. We'll get you much more after this break. Welcome back. You're watching CNBC-TV18, and we are in conversation with the Dutch historian Rutger Bregman on his latest book, Moral Ambition. I just want to go back to that Davos moment of 2019 when you called out billionaires for tax avoidance, for using, for burning aviation fuel to fly down to Davos in private jets as well. How was that moment in your career as a historian, as an author? Were you invited to Davos again after that incident? And what was the kind of feedback you received?
So for some reason, they never invited me back. I guess it was something I said that they didn't particularly like. But I have been wondering, obviously, after those years, like, how can we make more progress in the fight against tax avoidance and tax evasion? Because wherever you go, whether it's the United Kingdom or India, the United States or the Netherlands, everywhere billionaires have lower effective tax rates than working class people. And that seems to me utterly unreasonable and utterly unfair. Now, you can just shout that and say that and go viral for it, but wouldn't it be much more effective to build a SWAT team, a very dedicated cohort of people who want to dedicate their career to fighting for tax avoidance and tax justice? So that's what we're doing right now. We are starting a campaign on Wall Street in New York. We are recruiting the best wealth managers, the best bankers, the best fiscal lawyers, and we are convincing them to pivot their career, basically saying, look, you're now working on the wrong side. You can leave your job and work for us. It's only going to be for the best of the best, so it's very hard to get into one of our fellowships, as we call them. But that's what we're going to do. We've already been doing it for other cause areas. So, for example, in Europe, we've recruited a bunch of marketeers and corporate lawyers who quit their job in order to fight the tobacco industry, big tobacco. And in this way, we want to make doing good more fashionable. We think that we should move towards a world where the best and brightest work on the most important global problems. It's as simple as that.
Right. You've also said that when you start off with your thinking process about what kind of change you want to bring about, you should really try and understand what does the world need right now, and whether your approach or what you're working towards can go wrong maybe 10 years down the line and cause more harm to society. Keeping that in mind, which are some of the biggest, if you had to say, top 3 world problems that entrepreneurs can start thinking of working towards right now and maybe have a cult to work around with?
Yeah. So I'm not sure how famous the Lord of the Rings trilogy is in India, but that's always the comparison I like to make. Gandalf, the wise wizard, he never asked Frodo, hey, Frodo, what's your passion? Right? He said, look, if you want to save the world, this is what you need to do. You need to throw the ring into the fiery mountain, right? And that's also how we like to work. So we work with so-called prioritization research. It's a whole branch of social science, people who spend a lot of time thinking about, indeed, the question you just asked. What are the biggest problems we face as a species right now? It's difficult to make a definitive ranking, but there are a couple of obvious examples that come to mind. Think, for example, the threat of the next pandemic. We've just gone through a pretty bad one, COVID, that cost us 20 million lives across the globe. And still we know that the next one could be much, much worse. Then you wonder how many people are currently working on preventing that next pandemic. And it's really outrageous. So currently, the whole world spends only $1 billion on researching emerging infectious diseases. That's about as much as Americans spend bleaching their teeth every year. You've got the Convention Against Bioweapons, a very important organization, and it has the budget of an average McDonald's franchise. So it's super, super neglected. We need way more smart doctors, inventors, entrepreneurs, lobbyists to fight for global health and for pandemic prevention. There are also so many innovations that need to be done here. So that's one example. Now I can go on for a long time. Another one that I think is really, really important is the fight against factory farming. I think if the historians will look back on our age and will think about, okay, what are some of the most immoral things people did back then? I think the way we treat animals is very high up on that list. We're talking about 80 billion animals slaughtered every year. And every week, scientists come in with new evidence about how sensitive and how sentient these animals are, even though we lock them up in these horrible prisons where they don't see the daylight, only if they go to the slaughterhouse, perhaps. So that, for me, is one of those examples where historians will look back on us and say, oh, my God, that is like similar to the people who practiced slavery or the people who, did all kinds of other horrible things in the past.
Right. You've spoken about the need for lowering your threshold to act. You said that at different points in history, every individual has their own threshold to act, a tipping point to taking action. How do we lower that threshold? If you were explaining that to someone in college, or maybe a young student who's finishing school and going to college? How do you explain that?
So when I was a young boy, I was fascinated by the history of the Second World War in my own country of the Netherlands. As you probably know, the Nazis invaded the Netherlands and started abducting many Jews, and many of them, millions of them, were murdered in concentration camps. And there was just a small percentage of the population that resisted the Nazis at the time. And already as a young boy, I was fascinated by the question, what made these people different? Why were some people so brave that they would risk their own lives to help persecuted people? And I've done a lot of research into that question for this book, and I discovered that there actually isn't such a thing as the altruistic personality type. There have been lots of studies, hundreds of interviews done, but researchers really couldn't find anything. You know, these very brave people, they could be men or women, rich or poor, young, old. It's really a cross-section of the population. But what they did discover was that this resistance was very contagious. So there was one factor in particular that predicted very well whether people would join the resistance, yes or no. And it was the question, were you asked to join the resistance, right? In 96% of cases, when people were asked to join the resistance, people said yes. So that creates a very different perspective on how we can actually make a difference and indeed lower our threshold to act. It's by surrounding ourselves with other brave people, with other morally ambitious people, because then it can become infectious. And that's exactly what you saw during the Second World War, is that resistance wasn't evenly spread out over the country. No, there were like pockets, local pockets of resistance, where people started infecting each other, and they saw other people doing brave things, and then they were like, hey, maybe I can do that as well. And got to remember, it often starts small, right? You take a first step and then another step, and then it escalates, and you become someone who you never thought you could become. And I think that's the way we lower our threshold to act.
Okay, you've spoken about how you once saw a school which said Hogwarts for do-gooders. Would you say we need more Hogwarts for do-gooders around the world?
Absolutely. We need many more of them. This is an extraordinary school based in London. It's a little bit like a startup incubator, but it doesn't help people to start their own for-profit to make as much money as possible. No, it helps you to build a non-profit that helps as many people as possible. So it's incredibly hard to get into. It's only for the best of the best. If you've gone to Harvard, well, that's very nice, but it's not nearly enough. And then they incubate all these kind of non-profits. Quite a few of them work in India, by the way, because they're really looking to maximize their impact, to save as many lives as possible, for example, and help as many people as possible. And it's just a beautiful example of how we can redefine success. I think that throughout history, we've often seen that societal renewal starts with a redefinition of what it means to be successful. And currently around the world, we are sadly ruled by, the most immoral elites. I currently live in New York in the United States, and it's a pretty clear example where you have, a whole establishment that is becoming more and more immoral by the day. But we've been here before, and I think there can be a counter-revolution. We've seen that in the UK in the late 18th century. We've seen it in the United States in the 19th and the early 20th century, when people of privilege stepped forward and said, okay, now it is enough. And now we're going to make a difference, not by pointing at others, not by blaming others and using the finger. No, it is by doing better ourselves, by giving a better example ourselves. And that's what we desperately need today.
Okay, my final question would be, in the India context, how do you think individuals, citizens can raise their moral ambition? Today, there is great power competition in the world, to put it very simply. It's about who is going to lead the AI revolution, who's going to lead the economic race, who's going to be the strongest player in the manufacturing supply chain. So when you have this great power competition between India and China, China and the United States, fight for supremacy at the top, what kind of moral ambition do you feel that someone in the Indian context needs to have?
Well, at the heart of being morally ambitious, there's the recognition that we humans all have equal dignity, all have equal worth. So it is absolutely fine to care deeply about your own country. But I think that we should move towards a world where all countries can flourish, where all nations can flourish. And if anyone, in India is watching this and, maybe went to one of those top universities, I think the message of this book and my message today is use your privilege, not just check your privilege, but use your privilege to make the world a wildly better place. And obviously it makes a lot of sense to start in your own country because there are still so many big challenges to solve in India. If I only think about, the health aspects, one of the most cost-effective interventions, for example, is just to make sure a bigger percentage of the population is vaccinated. You can do an insane amount of good in that way. Yeah, just think about your life in a bigger way. Think about how you want to be remembered. I think that's the main message of the book.
All right, Rutger, thank you so much for your views on your book, Moral Ambition. That's all we had time for on this broadcast. Thank you for watching. Goodbye. Hello and welcome to this special show. No, you're not fine the way you are. That's how the latest book by Dutch historian Rutger Bregman urges people to think outside their comfort zone. The book, titled Moral Ambition, shows you a path to make a difference to the world rather than just watch from the sidelines. The author argues that a 40-year full-time career consists of around 80,000 hours, 10,000 workdays or 2,000 work weeks. But how you spend that time is the most important moral decision of your life. What should be the main ingredients of moral ambition? Where to start in terms of identifying the world's problems, and do money and idealism go together? Those are some questions that the book addresses. Joining us right now is the author, Rutger Bregman himself. Bregman had made headlines in 2019 in Davos for calling out billionaires for tax avoidance and flying in private jets to talk about climate change.
This is my first time at Davos, and I find it quite a bewildering experience, to be honest. I mean, 1,500 private jets have flown in here to hear Sir David Attenborough speak about, how we're wrecking the planet. And I hear people talk in the language of participation and justice and equality and transparency. But then, almost no one raises the real issue of tax avoidance, right? And of the rich just not paying their fair share. It feels like I'm at a firefighters conference and no one's allowed to speak about water, right? there was only one panel, actually.
Well, we've had two. You're the second of our panelists.
There was only one panel.
Let's go there.
One panel hidden away in the media center that was actually about tax avoidance. Yeah. I was one of the 15 participants. So something needs to change here.
Rutger, thank you so much for joining us on the program today to speak about your latest book, Moral Ambition. One of the lines that the book begins with is no, you're not fine just the way you are. People may spend their whole lives climbing up the ladder of success only to find, once they reach the top, that the ladder is leaning against the wrong wall. Why did you feel it is important to shake up your readers and their thinking and their approach towards work and professional life?
Yeah, well, my reasoning is pretty simple. In the first place, we have a lot of very big global problems. So 15,000 kids die from easily preventable diseases every day. 85% of the world population is below the poverty line of the country in which I live, the Netherlands. We have the threat of the next pandemic that may be just around the corner. There's war, there's democratic backsliding. There are a lot of things we got to do something about. But then the second thing is that a lot of people are currently stuck in jobs that don't really add all that much value. And I'm not talking about teachers or nurses or care workers. No, I'm talking about people who often went to great universities, who have beautiful resumes, who may be a marketeer or a banker or a corporate lawyer or whatever. And still, at the end of the day, they have the feeling that they don't really contribute all that much. There's one big study that showed that around 25% of people in developed economies even think that their own job is socially meaningless. So there's a huge waste of talent going on. And my book is basically a call to arms. It says that if you are very talented, if you have a little bit of ambition, then you should use that to make the world a wildly better place. And I call that moral ambition. It's the combination of the activism or the idealism of an activist and the ambition of an entrepreneur. When those two things come together, something really magical starts to happen.
Right. But at what stage and at what point should people start thinking about this? Because the common line that we hear when someone talks about changing the world or launching a political party or working towards a social cause is that you can't change the world, or it's better to stick to the beaten path, you know, have a work life balance, earn a good enough amount of money for your family, for your holidays, so that you can retire well and early. Nothing wrong with it, but perhaps, according to your book, one wouldn't be very satisfied with this way of living. But how does one come to the conclusion that you're cut out for making a difference to the world, for leaving an impact? And where do you really start off?
Well, history is littered with examples of small groups of really thoughtful, committed citizens who made a massive difference in the fight against some of the greatest problems we face as a species. In the book, I talk, for example, about the abolitionists, those who took up the fight against the slave trade and against slavery. And you got to remember that in the 18th century, in a country like the United Kingdom, for example, this was really, really unpopular. The United Kingdom was making an enormous amount of money on the slave trade and on slavery and on having this whole system of colonies. But then there was a small group of mostly entrepreneurs and businessmen who said, this is the greatest moral atrocity of our time. We should kickstart a movement against this. So it is really small groups of really committed people that can make a difference. History shows us this. And I've tried to write sort of a self-help book, a guide that people can use if they also want to follow that path. Now, I got to say, if you want to read a book that will make you more relaxed or more mindful or happy or whatever, then you should probably not read my book. There are thousands of self-help books that will teach you, how to do less. But this is a book about how you can do much more and how you can really leave your mark on history.
Right. Now, speaking about leaving your mark on history, you speak about what startup founders, young entrepreneurs can also do. You know, your book also argues, and you've said this, that a lot of times we are launching companies or launching solutions to the problems we never really know we had, or it's probably too simplistic. So what is the kind of mindset or moral ambition that young entrepreneurs need to have?
Yeah. So we got to realize that ambition, it's just raw energy. You know, it can fuel a rocket that goes to Mars, but it can also fuel a bulldozer that, waltzes over a rainforest. So it's just energy. And what really matters is how you use it. What I currently see is that there are a lot of young entrepreneurs starting new companies that, create these products that are perhaps in the best scenario, okay, but in the worst scenario are actively harmful. So there's a famous quote from someone who worked at Facebook a long time and who said that the best minds of my generation are thinking about how to make people click on ads. And that is pretty sad, isn't it? That you have all these really smart people who could technically do an enormous amount of good, in a country like India in particular. If you would take up the fight against some of the greatest health problems, just imagine how many lives you could save. It's honestly extraordinary. So it's always a little bit sad to me when those very, very talented people, spend so many hours on something that doesn't actually matter all that much. Maybe you can make a lot of money with it, but in the end, what are you going to think about when you lie on your deathbed? About all the PowerPoints from colleagues that you didn't see, about all the long meetings that you didn't attend, or about the actual impact you made. That's I think what really counts in the end.
Right. How would you define moral ambition today? Of course, when you hear the term, you immediately think about doing something good for society. But according to you, what would be the 4 main ingredients of moral ambition that that youngsters, that entrepreneurs, industry veterans, CEOs can keep in mind?
So I co-founded an organization called the School for Moral Ambition that helps as many talented people as possible to pivot their career and to use their resources, whether it's their talent or their capital or their network, to make the biggest possible difference. And we use a simple framework to help people focus on those biggest problems. It's called the SSS framework. So we focus on problems that are really sizable, they're very big, they're solvable. You got to have some plan of, what to do about them. And most importantly, they're also sorely neglected. If you go and work on the issues that everyone else is already working on, then you're not going to make the biggest impact. So, for example, I'm someone who grew up in a rich country, in the Netherlands, in Northern Europe. If I want to, help as many people as possible and to improve their health, then, probably focusing just on the Netherlands, where we already spend a huge amount of healthcare, is not going to make the biggest possible difference. If I would shift my focus and focus on something like malaria, for example, 600,000 people die from malaria every single year, mostly kids under 5. Well, then I can suddenly do much more good, right? Because it is so neglected. So if you're really morally ambitious, you gotta dare to go where others don't go. You gotta be able and be willing to do the unpopular or the unsexy things.
Right. And does this mean, because when we hear about working for a social cause, or working for the betterment of society or world, you often hear that you need to lead an austere life. Can one have a day job where you're working as somebody in the corporate sector, have the ambition of rising up the corporate ladder, yet be an idealist? Can money making, idealism all go hand in hand together?
Well, I think that money is pretty important if you want to make a big difference. The former UK Prime Minister, Margaret Thatcher, she once said that the Good Samaritan, from the Bible, he didn't just have good intentions, he also had money. So yeah, if you want to make a biggest possible difference, you got to find some way to attract capital. And here, I think philanthropists or brave philanthropists can make an important difference. If you study these great movements of the past, I already mentioned the abolitionists. They weren't financed by governments. Government was not giving subsidies to these people who fought the slave trade because the government was making an enormous amount of money facilitating the slave trade. The same was true for businesses. They were certainly not giving money. So there you need very brave individuals who are willing to go against what is fashionable, against what is popular. And look, I also realize that there are a lot of young people who are like, well, how am I going to buy my own house? How can I make my own career if I don't climb this corporate ladder? And I do understand that. I just think that there's more to life, probably. And for a lot of these talented, privileged people, my message is, look, you can only drive one car at a time, right? At some point, it's okay. And then other things become much more important. And it would be a shame if you lie on your deathbed and you're like, oh, as you said, I've been climbing the wrong ladder my whole life.
Right. You've spoken about how awareness is the best starting point, while for many it has become the end goal. What do you think we need to do in order to become a more satisfied individual, make a difference? And what is the problem, according to you, with the kind of activism that we see?
The reason I wanted to write this book is that, honestly, I became a little bit fed up with myself. I'm a writer. I spent 10 years of my career providing my opinions from the sidelines. Indeed, as you mentioned, shouting things like taxes, taxes, taxes when I was invited to Davos. And that can be very satisfying, but it's also quite easy. Here I was, on the sidelines, watching the people who are doing the real work, who are in the arena, with the sweat on their faces. And I started experiencing this emotion that I like to describe as moral envy. I was just jealous of the people who have some skin in the game, who do the real work. And I indeed realized that awareness is vastly overrated. I had spent 10 years in the awareness industry, providing my opinions. But very often people don't do much with what they know. To give you one simple example, most people know that billions of animals are terribly tortured in what we call factory farms. Or we can know about that at least, but most of us just choose to ignore that. So the real challenge is in bridging the gap from awareness to action, to actually do something. And so I wanted to write a book that would be a big kick in the butt for myself, that would force myself to make a difference. And hopefully it's helpful for others as well. You know, as I said, I've co-founded this organization now, completely changed my life, turned into a social entrepreneur. And that has taught me many lessons, and also, caused me to believe that it might be possible for others as well.
All right, just stay with that thought, Rutger. We have to take a short break, but don't go anywhere. When we return, this conversation with Rutger Bregman, the Dutch historian, will continue on his book, Moral Ambition. We'll get you much more after this break. Welcome back. You're watching CNBC-TV18, and we are in conversation with the Dutch historian Rutger Bregman on his latest book, Moral Ambition. I just want to go back to that Davos moment of 2019 when you called out billionaires for tax avoidance, for using, for burning aviation fuel to fly down to Davos in private jets as well. How was that moment in your career as a historian, as an author? Were you invited to Davos again after that incident? And what was the kind of feedback you received?
So for some reason, they never invited me back. I guess it was something I said that they didn't particularly like. But I have been wondering, obviously, after those years, like, how can we make more progress in the fight against tax avoidance and tax evasion? Because wherever you go, whether it's the United Kingdom or India, the United States or the Netherlands, everywhere billionaires have lower effective tax rates than working class people. And that seems to me utterly unreasonable and utterly unfair. Now, you can just shout that and say that and go viral for it, but wouldn't it be much more effective to build a SWAT team, a very dedicated cohort of people who want to dedicate their career to fighting for tax avoidance and tax justice? So that's what we're doing right now. We are starting a campaign on Wall Street in New York. We are recruiting the best wealth managers, the best bankers, the best fiscal lawyers, and we are convincing them to pivot their career, basically saying, look, you're now working on the wrong side. You can leave your job and work for us. It's only going to be for the best of the best, so it's very hard to get into one of our fellowships, as we call them. But that's what we're going to do. We've already been doing it for other cause areas. So, for example, in Europe, we've recruited a bunch of marketeers and corporate lawyers who quit their job in order to fight the tobacco industry, big tobacco. And in this way, we want to make doing good more fashionable. We think that we should move towards a world where the best and brightest work on the most important global problems. It's as simple as that.
Right. You've also said that when you start off with your thinking process about what kind of change you want to bring about, you should really try and understand what does the world need right now, and whether your approach or what you're working towards can go wrong maybe 10 years down the line and cause more harm to society. Keeping that in mind, which are some of the biggest, if you had to say, top 3 world problems that entrepreneurs can start thinking of working towards right now, and maybe have a cult to work around with?
Yeah. So I'm not sure how famous the Lord of the Rings trilogy is in India, but that's always the comparison I like to make. Gandalf, the wise wizard, he never asked Frodo, hey, Frodo, what's your passion? Right? He said, look, if you want to save the world, this is what you need to do. You need to throw the ring into the fiery mountain, right? And that's also how we like to work. So we work with so-called prioritization research. It's a whole branch of social science, people who spend a lot of time thinking about indeed the question you just asked. What are the biggest problems we face as a species right now? It's difficult to make a definitive ranking, but there are a couple of obvious examples that come to mind. Think, for example, the threat of the next pandemic. We've just gone through a pretty bad one, COVID, that cost us 20 million lives across the globe, and still we know that the next one could be much, much worse. Then you wonder how many people are currently working on preventing that next pandemic, and it's really outrageous. So currently, the whole world spends only $1 billion on researching emerging infectious diseases. That's about as much as Americans spend bleaching their teeth every year. You've got the Convention Against Bioweapons, a very important organization, and it has the budget of an average McDonald's franchise. So it's super, super neglected. We need way more smart doctors, inventors, entrepreneurs, lobbyists to fight for global health and for pandemic prevention. There are also so many innovations that need to be done here. So that's one example. Now I can go on for a long time. Another one that I think is really, really important is the fight against factory farming. I think if the historians will look back on our age and will think about, okay, what are some of the most immoral things people did back then? I think the way we treat animals is very high up on that list. We're talking about 80 billion animals slaughtered every year. And every week, scientists come in with new evidence about how sensitive and how sentient these animals are, even though we lock them up in these horrible prisons where they don't see the daylight, only if they go to the slaughterhouse, perhaps. So that, for me, is one of those examples where historians will look back on us and say, oh, my God, that is like similar to the people who practiced slavery or the people who, did all kinds of other horrible things in the past.
Right. You've spoken about the need for lowering your threshold to act. You said that at different points in history, every individual has their own threshold to act, a tipping point to taking action. How do we lower that threshold? If you were explaining that to someone in college, or maybe a young student who's finishing school and going to college, how would you explain that?
So when I was a young boy, I was fascinated by the history of the Second World War in my own country of the Netherlands. As you probably know, the Nazis invaded the Netherlands and started abducting many, many Jews. And many of them, millions of them, were murdered in concentration camps. And there was just a small percentage of the population that resisted the Nazis at the time. And already as a young boy, I was fascinated by the question, what made these people different? Why were some people so brave that they would risk their own lives to help persecuted people? And I've done a lot of research into that question for this book, and I discovered that there actually isn't such a thing as the altruistic personality type. There have been lots of studies, hundreds of interviews done, but researchers really couldn't find anything. These very brave people, they could be men or women, rich or poor, young, old. It's really a cross-section of the population. But what they did discover was that this resistance was very contagious. So there was one factor in particular that predicted very well whether people would join the resistance, yes or no. And it was the question, were you asked to join the resistance, right? In 96% of cases, when people were asked to join the resistance, people said yes. So that creates a very different perspective on how we can actually make a difference and indeed lower our threshold to act. It's by surrounding ourselves with other brave people, with other morally ambitious people, because then it can become infectious. And that's exactly what you saw during the Second World War, is that resistance wasn't evenly spread out over the country. No, there were like pockets, local pockets of resistance, where people started infecting each other and they saw other people doing brave things. And then they were like, hey, maybe I can do that as well. And got to remember, it often starts small, right? You take a first step and then another step and then it escalates and you become someone who you never thought you could become. And I think that's the way we lower our threshold to act.
Okay, you've spoken about how you once saw a school which said Hogwarts for do-gooders. Would you say we need more Hogwarts for do-gooders around the world?
Absolutely. We need many, many more of them. This is an extraordinary school based in London. It's a little bit like a startup incubator, but it doesn't help people to start their own for-profit to make as much money as possible. No, it helps you to build a non-profit that helps as many people as possible. So it's incredibly hard to get into. It's only for the best of the best. If you've gone to Harvard, well, that's very nice, but it's not nearly enough. And then they incubate all these kind of nonprofits. Quite a few of them work in India, by the way, because they're really looking to maximize their impact, to save as many lives as possible, for example, and help as many people as possible. And it's just a beautiful example of how we can redefine success. I think that throughout history, we've often seen that societal renewal starts with a redefinition of what it means to be successful. And currently around the world, we are sadly ruled by, the most immoral elites. I currently live in New York in the United States, and it's a pretty clear example where you have, a whole establishment that is becoming more and more immoral by the day. But we've been here before, and I think there can be a counter-revolution. We've seen that in the UK in the late 18th century. We've seen it in the United States in the 19th and the early 20th century, when people of privilege stepped forward and said, okay, now it is enough. And now we're going to make a difference, not by pointing at others, not by blaming others and using the finger. No, it is by doing better ourselves, by giving a better example ourselves. And that's what we desperately need today.
Okay, my final question would be, in the India context, how do you think individuals, citizens can raise their moral ambition? Today, there is great power competition in the world, to put it very simply. It's about who is going to lead the AI revolution, who is going to lead the economic race, who's going to be the strongest player in the manufacturing supply chain. So when you have this great power competition between India and China, China and the United States, fight for supremacy at the top, what kind of moral ambition do you feel that someone in the Indian context needs to have?
Well, at the heart of being morally ambitious, there's the recognition that we humans all have equal dignity, all have equal worth. So it is absolutely fine to care deeply about your own country. But I think that we should move towards a world where all countries can flourish, where all nations can flourish. And if anyone, in India is watching this and, maybe went to one of those top universities, I think the message of this book and my message today is use your privilege, not just check your privilege, but use your privilege to make the world a wildly better place. And obviously it makes a lot of sense to start in your own country because there are still so many big challenges to solve in India. If I only think about, the health aspects, one of the most cost-effective interventions, for example, is just to make sure a bigger percentage of the population is vaccinated. You can do an insane amount of good in that way. Just think about your life in a bigger way. Think about how you want to be remembered. I think that's the main message of the book.
All right, Rutger, thank you so much for your views on your book, Moral Ambition. That's all we had time for on this broadcast. Thank you for watching. Goodbye. Hello and welcome to this special show. No, you're not fine the way you are. That's how the latest book by Dutch historian Rutger Bregman urges people to think outside their comfort zone. The book, titled Moral Ambition, shows you a path to make a difference to the world rather than just watch from the sidelines. The author argues that a 40-year full-time career consists of around 80,000 hours, 10,000 work days or 2,000 work weeks. But how you spend that time is the most important moral decision of your life. What should be the main ingredients of moral ambition? Where to start in terms of identifying the world's problems, and do money and idealism go together? Those are some questions that the book addresses. Joining us right now is the author, Rutger Bregman himself. Bregman had made headlines in 2019 in Davos for calling out billionaires for tax avoidance and flying in private jets to talk about climate change.
This is my first time at Davos, and And I find it quite a bewildering experience, to be honest. I mean, 1,500 private jets have flown in here to hear Sir David Attenborough speak about, how we're wrecking the planet. And I mean, I hear people talk in the language of participation and justice and equality and transparency. But then, I mean, almost no one raises the real issue of tax avoidance, right? And of the rich just not paying their fair share. I mean, it feels like I'm at a firefighters conference and no one's allowed to speak about water, right? there was only one panel, actually.
Well, we've had two. You're the second of our panelists.
There was only one panel.
Let's go there.
One panel hidden away in the media center that was actually about tax avoidance. Yeah. I was one of the 15 participants. So something needs to change here.
Rutger, thank you so much for joining us on the program today to speak about your latest book, Moral Ambition. One of the lines that the book begins with is no, you're not fine just the way you are. People may spend their whole lives climbing up the ladder of success only to find, once they reach the top, that the ladder is leaning against the wrong wall. Why did you feel it is important to shake up your readers and their thinking and their approach towards work and professional life?
Yeah, well, my reasoning is pretty simple. In the first place, we have a lot of very big global problems. So 15,000 kids die from easily preventable diseases every day. 85% of the world population is below the poverty line of the country in which I live, the Netherlands. We have the threat of the next pandemic that may be just around the corner. There's war, there's democratic backsliding. There are a lot of things we got to do something about. But then the second thing is that a lot of people are currently stuck in jobs that don't really add all that much value. And I'm not talking about teachers or nurses or care workers. No, I'm talking about people who often went to great universities, who have beautiful resumes, who may be a marketeer or a banker or a corporate lawyer or whatever. And still, at the end of the day, they have the feeling that they don't really contribute all that much. There's one big study that showed that around 25% of people in developed economies even think that their own job is socially meaningless. So there's a huge waste of talent going on. And my book is basically a call to arms. It says that if you are very talented, if you have a little bit of ambition, then you should use that to make the world a wildly better place. And I call that moral ambition. It's the combination of the activism or the idealism of an activist and the ambition of an entrepreneur. When those two things come together, something really magical starts to happen.
Right. But at what stage and at what point should people start thinking about this? Because the common line that we hear when someone talks about changing the world or launching a political party or working towards a social cause is that you can't change the world, or it's better to stick to the beaten path, have a work life balance, earn a good enough amount of money for your family, for your holidays, so that you can retire well.
Good evening. Thanks for joining us on India Business Hour. The top stories we're tracking for you this evening.
He wants America to grow. He wants India to grow. And he wants to build the future with our partners all over the globe.
U.S. Vice President J.D. Vance says India-U.S. relationship will determine the future of the 21st century, and a strong alliance is a win-win for both nations. Nudges India to buy more defense equipment from the U.S., including the F-35 fighter jets. Calls for strengthening energy ties and more market access for U.S. companies. The U.S. Trade Representative welcomes India's constructive engagement in tariff negotiations after Prime Minister Modi held bilateral talks with Vice President Vance. The U.S. also claims serious lack of reciprocity in the trade relationship, calls for reducing non-tariff barriers and robust set of additional commitments to ensure long-term benefits. India's proposed digital competition law is likely to be put on the back burner, considering concerns from the U.S. government and industry. Sources say the government is unlikely to introduce the bill anytime soon due to the ongoing efforts to clinch a trade deal with the U.S. A major terror attack on tourists in Kashmir's Pahalgam. At least 27 people reportedly killed, including 2 foreign nationals. Chief Minister Omar Abdullah says the attack is much larger than anything seen in the recent years. Home Minister Amit Shah heads to the valley on directions of the Prime Minister. The Sensex and the Nifty gained for the 6th straight session. The Nifty Bank hits another record high as RBI eases liquidity coverage norms for banks. Gold record rally continues. 10 grams of gold now costs more than 1 lakh rupees in India. The International Monetary Fund raises the red flag on Trump's tariffs, cuts the global growth outlook by 50 basis points to 2.8%, cuts U.S. growth forecast by 90 basis points to less than 2%. India's FY26 growth outlook also trimmed by 30 basis points to 6.2%. Walmart-owned Flipkart will shift its holding company from Singapore to India as it gears up to go public in the next 12 to 18 months. The move is aimed at easing compliance and streamlining tax structures. CNBC-TV18 was the first to report on Flipkart's plans to shift domicile in December last year. Ather Energy becomes the first company to file for an IPO in FY26. The electric scooter maker files its red herring prospectus with SEBI to raise more than 2,600 crore rupees through a fresh issue. HCL Tech marginally misses estimates, capping off a disappointing Q4 for the Big Four in Indian IT. Clients turn cautious and adopt a wait-and-watch approach, but deal wins remain strong for the sector. The Delhi High Court pulls up Yoga Guru Ramdev for using the term Sharbat Jihad at Hamdard's Ruh Afza while promoting Patanjali's rose syrup. The court rules the comments are indefensible and shocks the conscience. Patanjali Food agrees to take down all advertisements targeting Ruh Afza after the rebuke. The Enforcement Directorate is likely to examine Gensol Engineering's case under the Prevention of Money Laundering Act. SEBI has accused the company of diverting and misusing funds and barred its promoters from the market. Well, let's start with the day's trading action. The Wall Street extending its winning streak now on to day 6. The Nifty holding on to the 24,000 marks, and banks continue to lead from the front, with the Nifty Bank hitting a new record high. So that's up by about 340 points. 24,167 is where the Nifty closed, about 40 points higher. The mid-caps added about 400 points today. Banking heavyweights like HDFC Bank, ICICI Bank and Kotak Mahindra Bank continued to see buying today. So that's the story as far as the stock markets were concerned. The rupee trading in a narrow range, ending the day at 85.18 against the dollar. The greenback fell 6 paise after 6 to 7 days of gains, and support from positive domestic equities has negated by the dollar short covering by investors. This is concerns over economic headwinds from tariffs persist. So that's as far as the currency market goes. In the commodity markets, gold prices in India hitting an all-time high, crossing the 1 lakh rupee per 10-gram mark for the first time ever. Spot gold prices also hit a record high of $3,473 an ounce in the global market. The yellow metal is rallying on the back of a weak dollar index and increasing global economic uncertainty. So if you're going out to buy gold now, is perhaps not a good time if you are for the purposes of weddings and so on and so forth. The top story tonight, Donald Trump's deputy and U.S. Vice President J.D. Vance laying out America's wish list for India. Vance, along with his family in Jaipur on day 2 of his India visit, they visited the Amer Fort and the Hawa Mahal in the Pink City. He then addressed the Rajasthan International Centre. In his speech, Vance said the India-U.S. relationship will determine the future of the 21st century, and a strong alliance is a win-win for both nations. Vance also nudged India to buy more defence equipment from the U.S., including the F-35 fighter jets. This is the second time that the US has talked about the F-35 as an item that India should consider. President Trump did that, and now J.D. Vance doing the same. Vance has called for strengthening energy ties and allowing more market access for U.S. companies. Now, last night, Prime Minister Modi hosted Vance for dinner and held bilateral talks. Separately, the U.S. trade representative released a statement on the talks, welcoming India's constructive approach. The statement also claimed that there is a serious lack of reciprocity in the trade relationship and called for reducing non-tariff barriers and robust set of additional commitments to ensure long-term benefits. Here's J.D. Vance speaking earlier today.
India, like America, wants to build. And that will mean that we have to produce more energy. It's more energy production and more energy consumption. And it's one of the many reasons why I think our nations have so much to gain by strengthening our energy ties. As President Trump is fond of saying, America has once again begun to drill, baby, drill. And we think that will inure to the benefit of Americans, but will also benefit India as well. We actually feel that India has much more to gain from its continued defense partnership with the United States, and let me sketch that out a little bit. We, of course, want to collaborate more. We want to work together more, and we want your nation to buy more of our military equipment, which, of course, we believe is the best in class. American fifth-generation F-35s, for example, would give the Indian Air Force the ability to defend your airspace and protect your people like never before. And I've met a lot of great people from the Indian Air Force just in the last couple of days.
J.D. Vance there, and Parikshit joins us from Jaipur. Parikshit, take us through the response coming in to the Vice President's speech there in Jaipur. Of course, continuing to talk about what President Trump has been highlighting, but also making it clear that India needs to do more when it comes to buying more on defense, energy, etc. from the U.S.
Be vigilant. Do not give in to unilateral concessions. That's the word of advice coming from foreign policy experts, former diplomats and defense officials after watching the visit of US Vice President J.D. Vance very closely. Observers have said that it seems that the US is not really interested in a bilateral reciprocal trade deal with India. They're only interested in US pushing more defense equipment, pushing more energy exports and more US manufactured products into the Indian market. In fact, diplomats have gone on to the extent of saying that any unilateral concessions or reduction of non-tariff barriers that India gives outside the BTA will be pocketed by the US and negotiations will begin from scratch. So whatever we offer to the US must be in pen and paper, in black and white. Also on the F-35s that J.D. Vance spoke about, officials have said, and former defense officials point out, that F-35 is a carrot that several US governments, US presidents in the past have dangled before the Indian government, but we've never really got assurances on long-term supply contracts, maintenance contracts that we really need, or the cutting-edge technology with the F-35 platform that we really need. So unless and until that happens, we would be creating another dependency for ourselves. So we need to be very watchful on that as well. Experts also point out that we need to look out for the environmental impact of what Trump is pushing in terms of more energy exports to the United States, the importance of working within the WTO framework, because if any unilateral concessions or favoritism is done for the US government, it could land us with the problems with the European Union, for that matter, with UK and other nations as well.
It's not looking really, talks about reciprocal trade, but it's not looking at reciprocity in terms of trade. It's looking at pushing unilateral advantage. And that is something that India will have to consider very carefully, because in the process of trying to manage the Trump administration's shift in trade policy, I think India cannot open up sectors which are problematic, like agriculture across the board.
F-35 is a carrot that has been dangled for quite some time now in front of India. We've got to manage our interests just the way the Americans are doing for their trade and for their strategic interests. So we need to remember that our Air Force is still 36% Russian. And so are the other two services. So when we are getting an equipment, and incidentally, we've never bought a fighter aircraft from the United States, ever.
Well, experts are reacting to J.D. Vance's comments being made in Jaipur today. But Parikshit, back to you. Let's also talk about the digital competition law. It's not directly linked to the Vance visit, but it is linked to the overarching negotiations between India and the US, because we learned from sources that the proposed law is likely to be put on the back burner. Why is that?
As India looks to clinch an early trade deal with the United States to get a pause on the reciprocal tariffs, it seems that the digital competition law that India has been mulling over for almost 15 months now may be put on the back burner. The US government and also US industry bodies such as the Coalition of Service Industries, which represents the likes of Google, Walmart and Amazon, has been expressing strong objections against the digital competition law of India, which it believes draws from the EU Digital Marketplace Act. And the US government and US industry believes that this will treat American companies very unfairly, and such a law must not proceed. Now, keeping in mind such strong objections, it is possible that the Indian government may not want to rush with the digital competition law and may not want to bring it to Parliament anytime soon. Let there be more deliberations on this, because currently the focus is on the trade negotiations with the US, probably conclude an interim trade deal and then look at the more difficult issues in the months to come. So for the moment, it seems that the bill is not likely to be brought into Parliament anytime soon. It's also important to point out that the Parliamentary Committee on Finance had first recommended the need for such a digital competition law to regulate big tech companies in the digital marketplace in 2023. Over the last 12 to 15 months, a committee led by the MCA Secretary prepared a report on why such a law is actually important. There have been stakeholder consultations, but the government has not really moved forward in terms of pushing the bill or introducing the bill in Parliament. So let's see what happens now.
Parikshit, many thanks for joining us. Now, ever since Donald Trump assumed office and triggered the tariff war, India has been undertaking several measures. The tax on Harley-Davidson in India was among President Trump's most repeated grouse. Now, the Indian government has cut the basic import duty to 40% and 30%, depending on the size of the bike. Now, this move was announced in the budget before Prime Minister Modi visited Washington, D.C. And it's not just super bikes. The government has cut the effective import duty on bourbon whiskey from 150% to 100%. The tariff has been reduced for Ethernet switches, synthetic flavoring essences, among other items. And it's not just tariff measures. India's also removed the 6% equalization levy on online advertisements. Remember, this was popularly called the Google tax. The move will benefit US tech giants like Google and Meta, who've long opposed this equalization levy. So these are some of the concessions already made by India. Now, Prime Minister Modi is on a two-day visit to Saudi Arabia. This is his third visit to the country since he succeeded former Prime Minister Manmohan Singh in 2014. Both nations are slated to sign at least 6 memorandum of understanding across sectors. Ahead of his departure, Prime Minister Modi, in an interview to Arab News, called Saudi Arabia a trusted friend, strategic ally and one of India's most valued partners. The big national story, terrible news coming in from the Kashmir Valley. At least 27 people killed, including 2 foreign nationals, after a major terror attack on tourists in Jammu and Kashmir's Pahalgam district. Now, as per reports, militants opened fire at tourists at the Baisaran Valley, a popular tourist spot. The injured have been rushed to nearby hospitals. Prime Minister Modi has condemned the attack. Union Minister Amit Shah heading to the valley on the directions of the Prime Minister. Chief Minister Omar Abdullah has called the attack much larger than anything seen in recent years. Ishan Vani filed this report from Pahalgam.
I'm in Pahalgam right now, and behind me you can see is the exact location where the attack has taken place. This is the Baisaran Valley behind these mountain peaks. Now, every top official, police, army, CRPF has been deployed here to ensure the situation is brought under control. And additionally, aircrafts have also been used to ensure that the monitoring of the situation is done. The situation is grievous, and the entire market wears a deserted look. There is a hospital where it's overwhelmed by the number of injured that have been made in this particular attack. What we have been also told is that the additional mobilization of forces has been done, and they will ensure that they're able to bring the situation on control as soon as possible.
Absolutely shocking news, devastating news. They're coming in from Pahalgam in Kashmir. Now, the International Monetary Fund has cut its global growth forecast for 2025 by 30 basis points to 2.8%, and that's on account of the uncertainty created by Trump's tariffs. The IMF has downgraded the forecast for most major economies, including the US, China and India. However, it expects India to be relatively stable thanks to private consumption. Ritu standing by with the latest as part of the IMF outlook. Ritu, so IMF cutting its growth outlook for the world on account of Trump's tariffs.
The IMF has downgraded its growth forecast for nearly all countries, citing a sharp escalation in trade tensions, which has triggered unprecedented policy uncertainty. Now, in response, it has presented a range of forecasts under different scenarios. Under the reference forecast, which is based on data up to the 4th of April, global growth is projected to fall steeply to 2.8% this year and 3% next year, marking a cumulative downgrade of 80 basis points from the January update and well below the historical average of 3.7%. The pre-April 2nd forecast pegs global growth at 3.2% for both years, while the post-April 9th model-based forecast aligns with the reference scenario largely. Now, for advanced economies, growth is seen at 1.4% this year, with a steep 90 basis point cut in the US forecast compared to the January update. Emerging markets and developing economies are projected to grow at 3.7% this year, which is also down 50 basis points from the previous estimate. Now, IMF has also cut India's FY26 growth outlook by 30 basis points to 6.2% and for FY27 by 20 basis points to 6.3%. But it says India's outlook is relatively more stable, supported by private consumption, particularly in rural areas, and the downgrade is on account of higher levels of trade tensions and global uncertainty. The IMF has also revised down its projection for global trade growth by 1.5 percentage points this year, with a slight recovery penciled in next year, while global inflation is expected to ease more gradually than earlier estimated. Now, IMF